Thank you so much for joining us.
Great to be here with both of you.
So you're President Biden's scientific advisor, and you also lead the Office of Science and Technology. You also spent a lot of time at DARPA, which is the federal agency that developed technology like GPS and the foundations of the internet. Many people don't know that. And that's because government today isn't exactly known for being at the cutting edge of technology. Can the rise in AI mark a change in that, where government plays a bigger role in driving innovation versus playing catch up to the private companies that are developing it?
Well, AI is changing a lot of things right now, and that's why President Biden's been extremely clear that it's one of the greatest opportunities of our times, and it's going to come with risks that we have to manage. And the work that's underway, the White House has been driving a lot of forward action here in this area. That work is about managing risks, but it's also about seizing the opportunities. And some of those big opportunities from AI are about the research that continues to be funded by the federal government.
So do you think that government can be a driver of innovation in this new age of AI versus just relying on private tech companies to come up with that technology?
Well, we're seeing a surge, and we're very happy that that surge in AI technology has come from American companies. It builds on the shoulders of many, many, many decades of publicly funded R&D, and now what the companies are doing on top of that. So I very much see it as a system where all the pieces have to work together. I spent half of my professional life in public service, but the other half in commercial technology, and every big thing this country has ever done has taken all of us, and that's certainly going to be true for seizing these opportunities from AI as well.
What are some of the moonshots that the U.S. government is currently working on that could incorporate AI in advancing them?
President Biden likes to talk about this being the only country in the world that can be defined in a single word, and that word is possibilities. And that's what science and technology is all about. So I'll mention a couple of areas. One very important area of focus is changing health outcomes. And in this area, the President and the First Lady last year reignited their cancer moonshot. It set an extremely aggressive goal of cutting the age-adjusted cancer death rate by half over the next 25 years. That's about double the rate of progress that we've been making on cancer. The other goal that went with that is to change the experience of people and their caregivers and their families as they are all going through this cancer experience. And if you think about it, who isn't touched by cancer? This is one of the most foundational things, and an area where everyone in this country can pull together for a moonshot goal that really, really matters. Well, how are we going to do that? Well, to do that, we need to prevent more cancers. We need to detect more cancers quickly so that they can be caught. And we need better treatments for when cancer does move forward. And in every one of those areas, from public health to developing new drugs to tailoring clinical care for an individual, every one of those is an opportunity for AI to help accelerate progress in some very dramatic ways. So that's one huge example. I could tell you a similar story about dealing with all the effects of climate change as they're coming, modeling extreme weather and helping the country be more prepared for resilience.
Could you expand a little bit on your outlook on how that could be achieved?
Well, let's step back for a minute. What these AI systems are so powerful that they can seem magical, but really what they are doing is statistics at an extraordinary scale. So large language models that led to chatbots are about training these systems on human language so that they can build statistical estimates of answers to your prompts. When you're thinking about something like weather, that's another very, very, very complex system. Think about how huge the atmosphere is that surrounds the world. Think about how complex the calculations are when we run simulations to try to estimate how the weather will progress in the short term. And then think about how hard that problem is when we're thinking about climate effects over many years and many decades. That is the complexity that AI helps wrangle because of this new approach of training a computer on a lot of data so that it can build better estimates of what could happen in the future. And harnessing that power is going to lead to some very practical advances, we think, in both understanding weather better, but also understanding long-term climate effects. That's what's going to help us be more prepared and more able to deal with what's coming.
And obviously, the US is a huge key driver in developing AI technologies. But I'm curious, as a non-US citizen, who do you see elsewhere in the world doing interesting things?
Well, this is a global technology. First of all, again, AI, it seems like magic, but it really is human beings and corporations that are building compute, that are training it on data. They're using algorithms that are developed in research communities and widely shared. And so the ability to build AI of various sorts, it happens around the world. And in fact, I think that's good because there's so many applications globally that we'll want to pursue. But of course, it does mean that it really comes back to the question of what kind of a future we're going to build. And, if you think about it, it's such a powerful force right now. Every country around the world is using AI to build a future that expresses their own values. And I think this is why it is so important that like-minded countries with democratic values and norms come together and agree about how we're going to build the rules of the road for AI.
You're advising President Biden on this new age of artificial intelligence. How is the Biden-Harris administration thinking about AI?
The starting point for this administration is what the president talks about every time he talks about AI. He sees its power and its potential, and every time he talks about it, you can hear his optimism about all the things that it's going to bring, and he's very clear-eyed that that doesn't come for free and that managing its risks has to go hand in hand with it. President Biden frequently talks about the fact that we're at a pivotal moment in history in which the choices that we make in the next few years are going to shape many, many decades ahead. AI for him is very much part of this moment. And that's why you've seen this administration move out so actively with urgency, starting by listening to all kinds of communities. We talked about the work that we've done with industry, but also we've had very active engagement with civil society.
Dr. Prabhakar, thank you so much for joining us.
It was a pleasure. Thanks for having me.
Nima and Kumar, thank you so much for joining us. So you're a professor at Caltech and you're senior director of AI research at NVIDIA.
Which actually makes you the perfect person to answer a question that we've had, which is really broadly, how is AI changing, or has it been changing the scientific process over the last couple of years? Let's begin with that.
Yeah, this is such an exciting time. Thank you for having me on this show. And, the world has seen ChatGPT and the power
हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव कमोडिटी एनालिसिस। स्टार्ट करते हैं आज का सेशन। मार्केट इज जस्ट गोइंग टू ओपन इन फ्यू मिनट्स। कल एनएससी की एक्सपायरी थी। कल ध्यान रखोगे तो मार्केट फ्लैट ओपन हुआ था, कंटिन्यूसली नीचे आया, सपोर्ट एरिया पे आया था, एंड देन उसके बाद एक मोमेंटम आया। उसमें एक न्यूज़ भी आ गई थी एक्चुअली, दैट यूएस प्रेसिडेंट सेज दैट वी आर गोइंग टू अटैक ईरान अगेन बिकॉज ऑफ द अपाचे हेलीकॉप्टर विच इज़ डाउन्ड बाय द ईरान। एंड उसके बाद आज यूएस ने अटैक किया है, एंड उसके रिस्पॉन्स पे ईरान ने भी अटैक किया है। नेचुरल गैस में देखोगे कल साइडवेज ही था मार्केट, एक थोड़ा बहुत मोमेंटम अपसाइड की ओर आया, वहाँ रेजिस्टेंस से फिर से सेलिंग हुई एंड मार्केट वहीं पर चला गया। अभी फिलहाल देखोगे तो फ्लैट ओपनिंग है। नेचुरल गैस विल बी फ्लैट ओपनिंग। क्रूड ऑयल हल्का सा गैप अप है, नथिंग मच। एक छोटा सा गैप अप दिख रहा है, ज़्यादा बड़ा कुछ खास नहीं है। इसी एरिया के आसपास लग रहा है 8600 यहाँ तक ही जाएगा। इसके बाद यहाँ से एक सेलिंग ही एक्सपेक्टेड है वापस से। बढ़ेगा यूएस क्या और रिस्पॉन्ड करता है या फिर नहीं। बाकी यूएस क्रूड ऑयल अगर इस लेवल को नीचे ब्रेक करता है, अगर फ्रॉम हेयर इस लेवल के नीचे अगर सक्सेसफुली ब्रेक डाउन करने में सक्सेसफुल रहता है, देन वी कैन एक्सपेक्ट इट कैन गो टुवर्ड्स 7100 7200। फॉरेक्स चार्ट में देखोगे अगर ये $85 के नीचे सक्सेसफुली ब्रेक डाउन कर पाया, $85 के नीचे सक्सेसफुली ब्रेक डाउन कर पाया, सो वी कैन एक्सपेक्ट इट कैन गो टुवर्ड्स $76 एज वेल। ठीक है, उस केस में $76 की ओर भी जा सकता है। इंडियन मार्केट आई थिंक थोड़ा सा गैप अप लग रहा है, लेट्स सी। ठीक है, तो क्रूड ऑयल ओवरऑल बेरिश ही है, नॉट लुक्स बुलिश। ईरान और यूएस के बीच में मोस्ट प्रॉब्ली एक डील होने ही वाली है, तो मुझे लग रहा है शायद उसकी वजह से प्राइस डाउन ही आएगा, ओवरऑल क्रूड ऑयल का प्राइस। बाकी नेचुरल गैस देखेंगे, कल हमारा मार्केट जहाँ पर क्लोज हुआ है वहाँ से कुछ खास तो लग नहीं रहा मुझे। थोड़ा सा गैप डाउन जरूर है नेचुरल गैस में, मुझे लग रहा है नीचे सपोर्ट एरिया की ओर आता हुआ जा सकता है। ठीक है, कल मैंने आप लोगों को बताया था एनएससी एक्सपायरी बड़ी वॉलेटाइल होती है, सडनली मोमेंटम आ जाता है। कल एनएससी ऑप्शन की एक्सपायरी थी, मार्केट मॉर्निंग से तो थोड़ा बहुत स्लोली स्टडी जा रहा था। सेकंड हाफ में जब ये न्यूज़ आई, ऑलमोस्ट ₹5 का प्रीमियम 100 तक गया था। ₹5 प्रीमियम गोज 100। किसी की पहले से पोजीशन बन रही होगी, वही होल्ड कर पा रहा होगा, बिकॉज आई थिंक आफ्टर 9 और 10 PM के बाद नए ऑर्डर फ्लोज लग नहीं रहे थे। मार्केट रिजेक्ट कर दे रहा था ऑर्डर ऑटोमेटिकली बिकॉज ऑफ द हाई वॉलेटिलिटी। ये तो फ्लैट ही लग रहा है मुझे, 57 पॉइंट गैप डाउन। गिफ्ट निफ्टी फिलहाल 57 पॉइंट गैप डाउन है, तो कोई बहुत बड़ा गैप अप गैप डाउन तो नहीं होने वाला। देखिए गोल्ड कंटिन्यूसली फॉल कर रहा है, 2% डाउन है इंट्राडे में 4178 के आसपास। डेली टाइम फ्रेम पे 3 दिनों से गिर ही रहा है। एक एक्सपेक्टेड है थोड़ा सा हो सकता है मार्केट 4000 के नीचे जाए, फिर प्रॉफिट बुकिंग दिखाने जा सकता है। 3000 मुझे लग रहा है 800 पहले जैसे डिस्कस किया था आ सकता है बहुत इजीली। 3800 900 इज़ वेरी इजी टू रीच। अल्टीमेट टारगेट वही रहेगा 3500 का लॉन्ग टर्म में अगर आता है तो इस एरिया पे, और फिर 3000 विच इज़ अ वेरी हाई बाइंग एरिया। सो मेरे अकॉर्डिंग अगर ये 4100 के नीचे सस्टेन किया तो 3800 विल बी द फर्स्ट टारगेट। लेट्स सी, 3 दिनों से गिर रहा है, 3-4 दिनों से थोड़ा पुल बैक आता है या फिर डायरेक्टली गिरता है। अभी नीचे 4000 के आसपास सपोर्ट है, तो मेरे अकॉर्डिंग ये 4100 के नीचे जाएगा तो लिक्विडिटी मिलना शुरू हो जाएगी वापस से। ठीक है, बाकी क्रूड ऑयल में सेल ऑन राइज ही रखेंगे। ये जो एरिया है ना, अब यहाँ से वापस बाइंग नहीं प्लान करेंगे, बिकॉज ये बहुत बार टेस्ट हो गया है। यहाँ पर ये थर्ड टाइम टेस्ट हुआ है। यहाँ पर पहली बार एक हाई बना था, दूसरी बार एक लोअर हाई बना था, एक थर्ड टाइम आई है बाइंग। एक और लोअर हाई बनने के चांसेस हैं, तो अगर ये ब्रेक हुआ तो और नीचे जाएगा। जैसा मैंने बताया, नीचे लास्ट सपोर्ट है आपका 8100 के आसपास आई थिंक। फॉरेक्स में देखोगे $85 इसके नीचे जाता है तो फिर वी कैन एक्सपेक्ट बढ़िया सेलिंग आ जाएगी। फिलहाल एक छोटा सा गैप अप इन क्रूड ऑयल, छोटा सा गैप डाउन इन नेचुरल गैस। नेचुरल गैस भी थोड़ा नीचे आएगा तो वी विल एक्सपेक्ट बाइंग। कल का सेलिंग का ट्रेड है, एक अच्छा ट्रेड मिल जाएगा यहाँ पर। एक्सपेक्ट करेंगे थोड़ा सा डाउन आए तो यहाँ हम बाइंग का प्लान रखें। सपोर्ट अच्छा है नेचुरल गैस में, एक्सपेक्ट करेंगे डीप लेवल से बाइंग ही आएगी इधर इस एरिया पे। सपोर्ट इज गुड ओवर हियर। कल सेंसेक्स की एक्सपायरी रहेगी तो ध्यान रखना आप। कल सेंसेक्स की एक्सपायरी है, उसके बाद फिर वीकली एक्सपायरी है, नथिंग एल्स। ओके, मार्केट ओपन गैप अप एज एक्सपेक्टेड। क्रूड ऑयल छोटा सा, ज़्यादा बड़ा नहीं। एंड नेचुरल गैस छोटा सा गैप डाउन। लेट्स सी थोड़ा नीचे आ जाता है तो ठीक है। क्रूड में बाय मत करना कहीं पर, थोड़ा सा ऊपर आएगा तो एक्सपेक्टेड सेलिंग ही रहेगी। ज़्यादा स्पेस ऊपर है नहीं अब। फॉरेक्स में देखोगे ऑलरेडी $89 से सेलिंग चल रही है। ये जो एरिया बनाया हुआ है, इस एरिया के आसपास रेजिस्टेंस है। अगर एमसीएक्स में आता है तो सेल करेंगे यहाँ से, एंड टारगेट एक्सपेक्ट करेंगे नीचे सपोर्ट ब्रेक हो जाए। लेट्स सी, देखते हैं वहाँ तक पहुँचता है या फिर नहीं, बिकॉज फॉरेक्स में तो जा ही चुका है वहाँ पर। अर्ली मॉर्निंग ओपन हुआ था फॉरेक्स चार्ट। ये आते ही सेलिंग स्टार्ट हो गई है क्रूड में, थोड़ा सा ऊपर आएगा तो अपॉर्चुनिटी मिलेगी, नहीं तो फिर ब्रेकडाउन पे देखेंगे। सेल करेंगे, एसएल काफ़ी बड़ा हो जाएगा ऑटोमेटिकली। तो लगभग 3400 3500 मुझे लग रहा है शायद गोल्ड लॉन्ग टर्म में वहीं जाएगा शायद, मोस्ट प्रॉब्ली। ऑब्वियसली है, आज ही नहीं गिरने वाला। मार्केट ऑलवेज फॉल वेरी स्लोली स्टडी, बट जब भी पुल बैक आएंगे मुझे लग रहा है नेक्स्ट पुल बैक वही 3800 के आसपास आ सकता है, 3900 3800 थोड़ा बहुत फिर से। एंड देन द लास्ट वेव विल स्टार्ट। फर्स्ट वेव स्टार्ट हुई थी पुल बैक की 4400 से 5400, फिर वहाँ से सेलिंग आई। दूसरी बाइंग वेव जो थी पुल बैक वेव 4100 से 4800। थर्ड वेव विल स्टार्ट फ्रॉम 3800 टू 4400, and then last fall will towards 3500 or 3400 ultimate target. Indian market भी just open ही होने वाला है. In few minutes Indian market is also going to open. ओके, नेचुरल गैस ऑल्सो फॉलिंग। ये तो सपोर्ट की ओर आने वाला है, थोड़ा सा ऊपर चाहिए। क्रूड ऑयल अभी भी नहीं आया रेजिस्टेंस एरिया पे।
department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we and the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is just very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China, in terms of what you're saying.
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest?
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Oil rises as the United States and Iran exchange fresh strikes after a U.S. helicopter was downed, further testing peace talks. Stocks resumed their slide as tech shares remain under pressure and investors trim positions ahead of a key inflation report in the U.S. And while IPO mania takes hold in the United States, the Iran war derails a major Saudi listing. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Well, it's a sea of red when it comes to equities this morning. U.S. futures turning a little bit lower, 0.3% down. The S&P did close in negative territory yesterday. And there's a lot of factors in play here, right? The volatility that we're seeing, some of it stemming out of the geopolitical tensions in the Middle East, the prospects of the Fed possibly hiking rates, and then the AI trade coming into the picture. Asian equities equities also feeling the pain, 1.7% down, set for a fourth loss in 5 days. The Kospi is leading those declines. And oil prices, 0.7 higher. Brent crude at around $92 a barrel. Now, we keep monitoring the situation in the Middle East, but fresh hostilities in the region this morning. We'll talk about that later. The yield on the 10-year notes not doing much, 2 basis points, as we await the CPI report coming out later in the U.S. hours today. Now, if we flip the board, we take a look at a terminal chart that is quite interesting, courtesy of our colleague Anthony Stevens in Hong Kong. And look at that surge. This is the SOX, the volatility in the SOX index. Now, this is the index that gauges how semiconductors are faring. It is up more than 90% so far this year. And what Anthony points out to is this huge intraday volatility is without a clear driver and is a risk management signal that traders are rebalancing their books. So a gauge that we've been keeping a close eye on since March or April, and it's something to continue to keep an eye on with everything that's happening in the AI trade. And now, speaking of that, we've got Winnie Su in our Hong Kong studio to talk to us more about what is happening in Asian markets. Winnie?
Good morning, Abir. We are seeing investors turning more cautious today in Asia, especially ahead of the U.S. CPI numbers, as we've actually got those hot U.S. jobs data from last week, reinforcing the bets on the Federal Reserve to raise rates. And now you can see that Kospi here driving losses down more than 4%. But in fact, it was up about 8% yesterday. So lots of volatility and leverage in this market. Now, remember, that is still the world's best performing stock market so far this year. But today, leading the gains is actually the world's worst performing stock market so far this year, which is actually the Indonesia market. Here, up 2.6%, extending gains of about 7% from yesterday, coming after the Bank of Indonesia's surprise rate hike yesterday to support the currency. And hence, we are seeing that Indonesian rupiah rising, strengthening for a second day. Now, flip the board, we take a look at how, while we are seeing lots of pressure for the overall tech stocks in Asia, the bright spot is, in fact, in China's tech names. And that is coming after how we've learned last night that Beijing is preparing to spend about $295 billion for its AI build-out in the next 5 years. And that is supporting some of the data center names as well as the telecom names that are expected to keep these data centers all connected. Back to you, Abir.
Winnie, with those market details. Now let's turn back to the geopolitical story in the region. Iran has hit 21 aerial and naval U.S. targets across the Middle East. State-run Arab News reports that the IRGC targeted countries including Jordan and Bahrain. That is in response to U.S. strikes launched against Iran on Tuesday after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. For more, we're joined by Onur Ant, our managing editor for the Middle East and North Africa. Onur, ceasefire, no ceasefire, what is happening? Where does the latest leave us when it comes to the broader truce?
Well, there was a bit of a calm in the region, as you know. It lasted only about 24 hours, and that's mainly down to this Apache helicopter that we knew went down off the coast of Oman, as you pointed out the other day. So U.S. ordered strikes on Iranian military sites, mainly radar and control and command centers, that lasted overnight into Wednesday after Trump blamed Iran for downing that Apache helicopter, and in response, the Islamic Republic said it launched missile attacks, largely missile attacks at various U.S. bases in the region, including in Bahrain, Kuwait, and as you said, in Jordan. And it said they were all very significant targets. So what we have currently right now is that, well, there is no indication that the fighting is still going on as we speak. Both sides, especially the U.S., made it very clear that they concluded the strikes. So on the one hand, that's something to be somewhat happy about. And you can tell from oil prices that the market reaction has been somewhat contained on the expectations that both sides do not want to resume an all-out war. Yet, on the other hand, every single bout of violence in the region shows that the truce that took hold about 2 months ago remains very fragile, and anything can happen as long as it is not translated into a lasting peace as part of negotiations between the U.S. and Iran.
And look, I was taking a look at the CENTCOM response to the attack. It was very calibrated, suggesting, as you alluded to, that, we might not see a return to full-on hostilities. But why do you think President Trump sort of went ahead with this attack? Do you think it's something that he felt the need to do because of the helicopter that was downed, and then that's it? That's the moment we stop, just an attack, and we stop it.
Well, President Trump has made it clear that one of his red lines, at least as of recently, is death of American troops. Now, in that particular helicopter crash, no one died, but after pointing out the fact that the helicopter was downed by Iranian forces, it was Trump really didn't have a choice but to launch an attack on Iran in response. But as you said, what is important to note is that they were very careful about how they framed the attack. They said it was a proportionate response to Iranian aggression, and they said it has been concluded as of this morning.
Onur, thank you for those details and the latest on that story. Onur Ant, managing editor for the Middle East and North Africa. Now, India has effectively frozen approvals for Elon Musk's space-based internet service Starlink to begin commercial operations. Bloomberg understands it's due to concerns over the use of its satellite terminals in the Iran war. The final clearances Starlink needs to launch have been withheld as New Delhi is concerned about its ability to control a U.S.-based operator during geopolitical tensions. Oil prices remain in focus as markets digest fresh U.S. and Iranian strikes in the Gulf. Brent crude briefly neared $93 a barrel a few hours ago before easing once U.S. forces said their strikes on Iran were complete. Joining us now is Jeffrey Sexton, Demeter Tactical Investments CEO. Jeffrey, thank you for being on the set with us. Now, let's start with the fresh round of hostilities that we've seen outside of the region. The market has been, I don't want to say complacent, you're the expert here. You can tell me whether the market has been complacent to those geopolitical tensions. But where do we get to a point where, those wider concerns about inflation and what the region is bringing about those concerns globally, where do we get to a point where we can definitively say this is the impact on global growth, this is the impact on markets widely?
First of all, thank you very much for having me. I'm going to use a very technical investment term called complacency. You just said it. The market's complacent. The market is shrugging its shoulders now. I think you see that in the Brent WTI spread is still around $3, which is historically, the narrow band, which is telling you that the market is not concerned that the oil is going to be locked into the Gulf forever. So when do we actually know it's over and its effect on global growth and the economy? When the Strait of Hormuz is actually opened and oil starts flowing. But at this point, what's being priced into the market is this sense of de-escalation. No one wants to escalate anymore. This tit for tat, a shrug of the shoulders. You can see that in the Brent WTI spread. Yeah. So it is being complacent right now.
And look, typically at times of geopolitical tensions, when they're stoked, markets tend to go to bonds for safety. But we've seen the yields on global bonds massively surge in boons, in gilts, in U.S. Treasuries, also JGBs. What would it take to change that? And does the 60-40 portfolio sort of way of doing things change, in your opinion?
60-40 is dead for the foreseeable future. As you know, oil prices and interest rates both go up, they both go down, because there is the stagflationary result of long-term rise in oil prices. And the concern that inflation's high, the Fed would have to raise rates. So they're moving in tandem. So the relief trade is on today, even though there were these overnight events. Now that both countries have basically said that was it, we're done, we're not doing anything else. This relief trade is kind of back on. The crisis is not over. The strait is not open, but there is no sense of escalation. So we are in this wait and see mode of whether or not the stagflationary trend is going to be there permanently, or it's going to back down. And so interest rates and oil are both going up and down at the same time. That's unfortunately the pattern we're in right now.
So if I were to pin down two big themes so far this year, it's the geopolitical tensions in the Middle East and then artificial intelligence. And we spoke earlier about SpaceX coming to the market possibly this week. We have other big names, OpenAI and Anthropic, also possibly coming to the market. When it comes to AI and the surges and the staggering number we've seen outside of the US, what do you think about valuations? How stretched are they?
Well, look, it's fun to see these things coming to market, finally. I am also a U.S. securities lawyer, so I have done these before. When someone is selling something, you have to ask yourself, why are they selling it to me? Why? Yeah, I want to buy it, but why are you selling it? SpaceX, Anthropic, we all know that these are hype trades right now. But the U.S. is way behind China. These companies have been going public in China for a while. So it will be interesting to see how they get priced. You need to let 1 or 2 or 3 or 4 quarterly earnings come through on these companies and really see where they are. But are they going to be priced as secular growth, or are they going to end up being priced more as cyclical companies? But right now it's hype and it's just excitement. And I want to buy it because I want to flip it and sell it tomorrow for someone else. It's a gambling trade at this point. It's not an investment, but it's fun. And the valuations are off the charts. Doesn't mean you're getting something that's worth what you're paying for it. It's just going to be fun to say that you got shares in SpaceX. Does not mean that they're worth what you paid for them. They're worth what the next person will buy it from you for.
So at times like this, how do investors distinguish between what are the genuine metrics leading to a bubble? And my other question, I guess, is do you think then after that answer, are we in a bubble?
Well, the definition of a bubble, one man's bubble or one woman's bubble is another person's game on. And look, here's the problem with the general U.S. stock market right now. It looks like this beautiful red Ferrari that's flying down the road, and it's amazing, but you don't realize the brakes don't work. And sometimes that doesn't end well. So this is just, here's my fun question. What are all the Bitcoin bros doing now? We're not talking about crypto anymore, are we? Now we're talking about SpaceX and we're talking about AI. So it's the next latest, greatest thing. Is it a fad? Is it a bubble? Look, a bubble can expand for a long, long time before it ever pops. So we're in the early stages of how the real stock market will treat a real AI company that has gone public and really does have to report quarterly earnings. And there will really be attention paid to earnings. And are these people really making money? Or are we all buying this hype that we all apparently want to live on Mars one day? And that's why you should buy SpaceX. Like, nah, I'm not so sure about that. So whether it's a bubble remains to be seen. But I will tell you that it is a Ferrari going down the road really, really fast, and you don't know if the brakes work on that car or not.
Well, there you go, a Ferrari going down fast. Jeffrey, thank you for being on set with us today. That was Jeffrey Sexton, Demeter Tactical Investments CEO. Now, still ahead, China's consumer inflation unexpectedly stalled in May. We'll dig into the details of that ahead. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Abir Abu Ahmed in Dubai. Now, China's consumer inflation unexpectedly stalled in May. The consumer price index climbed 1.2% from a year earlier, just below estimates. Let's bring in China's correspondent Minmin Lo to discuss the details of that report with us. Minmin, I guess just walk us through the breakdown of that report.
Yeah, you mentioned the CPI. It came in slightly below estimates, flatlining compared to the previous month. But then the PPI actually had accelerated to 3.9%. This is the highest number that we had seen since July of 2022. It was in line with estimates. And a lot of it is because of the impact of the Iran war, right? You have oil prices remaining elevated. You have commodity prices higher. So that's fed into higher costs for the upstream industry. So things like the mining sector, factory gate prices going up by 15%. But then if you look at the further downstream industries, the factory gate prices for consumer goods, for example, actually turned negative by 0.8%. So what this tells you is that consumption sentiment still is remaining quite lackluster, right? And these consumer-facing factories are not able to pass on that higher cost to consumers. And that's why we are still seeing the CPI lagging behind at about 1.2%. So this is a supply-led inflation rather than demand-led, which could be quite concerning for the longer term.
So what in turn does that mean for the policies that China could conduct, Minmin?
Well, the fact is that we are still seeing a pretty positive print overall, right? It's putting an end to this 3.5-year-long deflationary streak when it comes to the PPI. So it also means that when it comes to monetary policy easing, perhaps there is less of an urgent need for that. And we're already seeing the impact there on the bond markets, right? Yields are climbing, and some analysts are saying that we could see the cyclical floor to the 10-year bond yield, although because of the lackluster consumer sentiment and the slow growth in credit growth, that could still delay any structural steepening of the yield curve. And also, if you look at the trade data that we got yesterday, a lot of China's growth is now dependent on on the more advanced manufacturing sector, which is less sensitive to price increases. So when it comes to the impact on the yuan, for example, that also means that the government might tolerate a gradual strengthening of the yuan as well.
Yeah. That was Bloomberg China correspondent Minmin Lo with the latest on those inflation details. Now, coming up, Anthropic CEO Dario Amodei says the use of AI in war is broadly positive, but still comes with risks. That is next. This is Bloomberg.
the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Horizon's Middle East and Africa. I'm Abir Abu Omar in Dubai. Anthropic CEO Dario Amodi says AI use in war is broadly positive, but risks remain amid uncertainty and human error. He spoke exclusively to Bloomberg's Emily Chang for the latest edition of The Circuit.
Bloomberg has reported that Claude is being used by the U.S. military in the war in Iran to do AI-assisted targeting via a platform made by Palantir, Maven Smart System. In February, a U.S. missile reportedly hit a girls' school in Iran, killing more than 150 people, most of them children. Did Claude play a role in that strike?
We don't know exactly how, these models were used. Obviously, these things that mistakes that happen in warfare are really, really terrible. This is a really terrible thing to happen. We were willing to risk the future of our company to limit how, these models are used. And, what you're talking about is a use case that doesn't even violate our red lines. We're worried that there will be 100 times as much, with use cases that do violate our red lines. Now, again, I would say, I think overall, the use of these models is appropriate. I think it's good on net, but military decision makers make terrible mistakes, even at the best of times. And I don't know if we're in the best of times. What we've seen here is Claude assists, but a human makes the final call. So a human made that final call, not Claude. Imagine if you had a world in which not Claude, because we haven't allowed it, but someone else's AI model, the AI model just makes the decision and the human never sees it. That's what we were standing up for. That's what we were fighting against.
This school had a website. You could have found it in a Google search. Shouldn't Claude have spotted that? And does it speak to a scarier issue about using technology as a shortcut in war?
The principle that was obeyed here is a human makes the final decision. I don't know what role Claude or any other AI had, but if this isn't an illustration why that principle is so important, I don't know what is.
You can see that conversation in full on a new episode of The Circuit with Emily Chang. Subscribers can access it on the terminal and on Bloomberg.com from 8 a.m. Eastern Time later today. Now for a look at some of the other stories we're following this morning. Shares of US-based AI server maker Supermicro fell in extended trading after it announced plans to raise $7 billion through a package of equity offerings. The proceeds will be used to purchase components needed to fulfill customer orders for its AI servers. Supermicro says it currently has around $39 billion in outstanding orders. Nintendo's shares fell by the most in a month after the game maker's presentation of upcoming releases fell short of expectations. The firm's stock fell as much as 8.2% after it failed to unveil brand new titles from heavyweight franchises such as Mario at its Nintendo Direct presentation. And Bloomberg understands Starbucks is considering options for its Japan business, including a potential stake sale. We're told the coffee chain has held preliminary talks with investment banks as it reviews the business, one of its biggest markets with around 2,100 stores. A listing is also said to be under consideration. Now, a quick look into where markets are doing this morning. Equity futures in the United States, 0.3 down. Same story for the Nasdaq and the Dow Jones. We're seeing slightly lower Euro Stoxx 50 futures. Oil prices only slightly ticking down after the hostilities in the region. Now, coming up, the U.S. and Iran exchange fresh strikes, putting new strain on an already fragile ceasefire. We'll discuss what that means for the region with Rachel Ziemba, founder of Ziemba Insights, next. This is Bloomberg.
Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Oil rises as the U.S. and Iran exchange fresh strikes after a U.S. helicopter was downed, further testing peace talks. Stocks resume their slide as tech shares remain under pressure and investors trim positions ahead of a key inflation report in the United States. And while the IPO mania takes hold in the U.S., the Iran war derails a major Saudi listing. That's next. It's just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Markets still turning lower by the minute as it seems. U.S. futures 0.4% lower now. Now the S&P did close in negative territory yesterday. Multiple reasons are leading to this. We're talking about stretch valuations. We're talking about a pause in the AI trade. Yet again, the geopolitical tensions out of the Middle East. And then this possibility of the Federal Reserve hiking rates, it keeps looming. Asian equities feeling the pain this morning, 2.3% lower, led by the Kospi. Those losses led by the Kospi, still one of the best or the best equities gauge this year. But today, Asian equities not doing very well. Brent crude prices, the price on that is $92 a barrel, 0.8 higher because of those fresh rounds of hostilities that we're seeing out of the Middle East. Just this morning, Iran attacked countries in the region, including Kuwait, Bahrain, and Jordan, after the United States attacked areas in Iran. Now, the yield on the 10-year notes not doing very much, 2 basis points higher as we await the CPI report out of the United States later today. Now, let's turn the board and take a look at what our teams have been working on when it comes to chart making. And this is volatility in the SOX index. Now, this is the index that gauges how semiconductors in the United States are performing. And it's been doing pretty well this year, up more than 90%. It saw some stabilization in recent days. But what our colleagues point out to in markets is that this huge intraday volatility in the SOX index without a clear driver is a risk management signal that traders are rebalancing their books, essentially. So something to keep an eye on as we look at this whole AI rally in markets. Well, let's take a look at how Asian markets are doing this morning. We've got Winnie Su in our Hong Kong studio. Winnie?
Good morning, Abir. We are seeing more pressure on the Asian stocks today as a loss is really extending on the MSCI Asia in the afternoon, now down more than 2%. And as you just mentioned, we are seeing the Kospi leading the decline, now down about 6% after having risen 8% yesterday. So lots of volatility there. And in fact, it just triggered a selling halt on the Kospi just now by the South Korea's exchange. So that shows you how volatile the market really has been. But today's bright spot is actually in the Indonesia market, up about 2%, and that is coming after that surprise rate hike by the Bank of Indonesia yesterday. So extending a bit of those gains since yesterday, with a bit more support coming through for the currency as well. Now you flip the board, we take a look at the Japanese assets, because when we look across the board, it really is the tech stocks still leading declines, and hence Nikkei 225 underperforming the broader Topics gauge. And in fact, we are seeing Topics' bank stocks, in fact, rising today. So really outperforming on further bets for the Bank of Japan to raise rates next week. Now, that expectation is also reinforced by today's PPI numbers. So pretty strong numbers driven by the higher energy costs. We are seeing it jumping by 0.4% compared to the previous month, but on an annual basis, in fact, it is rising at the fastest pace in about 3 years. When it comes to 30-year yield, we are seeing pretty much fluctuating here. We did have pretty weak bond auction just coming through earlier today, and that is driven by the yields really coming down in the past few sessions. Back to you, Abir.
Winnie Su in our Hong Kong bureau with those details. Now, U.S. forces carried out strikes against Iran hours after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. Former Australian ambassador to Washington, Dennis Richardson, says it's critical that America must win this war against Iran strategically and not just militarily.
It'll be important for the end of the peace process to have something in place which is better than the Biden-Iran agreement. We should never forget that whatever frustration we might have with President Trump in terms of the beginning of the war, in terms of the way it's been conducted, in terms of what he might say on a day-to-day basis. It's in our national interest, and I would argue it's in the interests of Western countries generally, for the US to emerge the strategic winner.
Joining us now is Rachel Ziemba, founder of Ziemba Insights. Rachel, thank you for being with us this morning. It's a pleasure to have you on. Look, I mean, the flare-ups this morning that we saw across the Middle East, we might not see a return to full-on hostilities, but I want to know what it means really for demand destruction. That is something that you talk about. We're not at that point yet, but more than 100 days into this war, the Strait of Hormuz is still effectively shut. When do we get to a point where we can say we're headed towards that direction of destruction?
Thanks, Abir. Pleasure to be on with you, even if the context. So we have seen some demand destruction, just we've seen more supply held back, right? So the markets are not in balance, and we're drawing down strategic reserves. At this point, the prices are higher than they were before the war, but not meaningfully. And so that's not sending the same price signal to consumers to cut back. And policy and price-driven demand destruction in Asia is still moderate. So I think over the summer we would see more pressures. And you're right, we're just seeing a trickle of flows coming out of Hormuz, and all of the flows that we're seeing, are really using evasive techniques that don't seem sustainable. Now, of course, we are seeing a bypass. We are seeing some effective supplies getting to market through other channels, but it's just not enough. And as strategic reserves are drawn down, I think we'll be in a tougher position.
And look, you spoke about this briefly, but at the beginning of this war, we were talking about that by this time we'd see Brent way higher than it is. And then there's the paper price and the physical price of where oil barrels are. But why do you think that Brent prices or oil prices generally, because we're seeing same movements in WTI, not ticking up higher? Do you think the market is not reacting as it should to those geopolitical headlines? Is it too complacent?
So I think the market is responding to the two things. One, that there is more light sweet crude than heavier sour crude. Both WTI and Brent are those lighter, sweeter crudes. But it's also, I think, responding to the fact that strategic reserves are being drawn down, notably in the U.S., even to some extent in China. China is a key piece of this. They stopped filling their strategic reserves. That was a significant part of their imports last year. And they seem to be tapping in. So ultimately, I think refiners have gotten used to this time of managed scarcity for now. But today, we're at a level where the U.S. strategic reserve is the lowest it's been in more than 40 years. It's Japan's is at a similar level. We can't keep drawing those buffers. So if we zoom out a couple of months, I think we'll be in a tougher position.
And look, energy transition has emerged as an important topic over the past few months or so. So I want to ask a little bit about it. Energy security generally has reemerged as this dominant policy concern. Do you think that we're shifting to prioritizing that and the resilience of those supply chains instead of the transition that we've been talking about over the past few years or so?
Yeah, I think we're focused on energy security, on economic security, on localization of supply chains. And so that does mean that more solar is being installed and even wind in some locations because there's not a need to keep importing new supplies. But we're also seeing more coal and nuclear is back in the picture. So to the extent we are seeing renewables going in, especially Chinese clean tech, which is benefiting, this is a story about economic and energy security rather than a transition goal. And of course, we're seeing the impacts of climate change on volatility and demand. So, but But at the end of the day, I think we'll continue to see entities move away from their net zero goals.
And look, just to touch on the economic aspects of things, we're also seeing that sanctions, export controls, industrial policy, those are being used more and more as tools of statecraft, really. So when do you think, at what point do you think economic competition becomes fragmented or so fragmented that it starts weighing on wider economic growth prospects?
So I think in some sectors it already is. We are seeing a lot of investments in critical minerals. We're seeing investments on clean tech, even on semiconductors. But that's where I think we will see in the coming months as China uses its own export controls in that area and outbound investments to limit the transfer of intellectual property. So at the end of the day, this is an environment where businesses face more compliance costs and there are more frictions in trade. And people are still waiting for what the new tariffs are going to be once these 301 investigations are complete in the United States. It makes it difficult for businesses to plan what their costs are going to be.
Yeah, that's another thing that everyone is keeping an eye on, tariffs as well. Rachel, thank you for your time today. Rachel Ziemba Insights founder. Now, a Florida trading company says it's in advanced talks to send Cuba the biggest cargo of U.S. fuel since the Eisenhower administration. Vanguard Energy is gearing up to export 250,000 barrels of diesel and gasoline. Company president Matthew Klan says the fuel has been designated exclusively for the private sector rather than state actors. Hong Kong Financial Secretary Paul Chan says efforts to restrict cross-border capital flows negatively impacts the U.S. In a fireside chat at the Bloomberg Invest Hong Kong conference, Chan weighed in on the upcoming SpaceX IPO.
I think that this is detrimental to your U.S. interests. Why don't you welcome the liquidity from all over the world? Yeah, I think this is for us. When you look at Shanghai, look at Shenzhen, we have huge number of excellent tech companies at very attractive valuation, waiting for investment. No matter it is IPO or private equity, VCs, or even patient capital. Nowadays, through the Hong Kong IC, we have been channeling sovereign funds from the other jurisdictions and long-term funds to co-invest with us into industries of the future.
Now, before we head into the break, just some flashes across the Bloomberg terminal. Korea's Kospi extends losses to 6.1%, with its second biggest constituent, SK Hynix, falling 9%. So that is contributing to the wider weakness in Asian equities this morning, 6.1% downward for the Kospi. Now, coming up, protests erupt in Kenya over plans to establish a U.S.-backed Ebola quarantine facility. That is next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Protests have erupted in Kenya over plans to establish a U.S.-backed Ebola quarantine facility. The unrest highlights growing public concern over the outbreak in Central Africa, even as Kenya says it has not recorded a single Ebola case. For more, I'm now joined by Bloomberg East Africa Bureau Chief Helen Nyambura. Helen, why are Kenyans unhappy about this quarantine facility?
Hi. Yeah, just for the simple reason that there have been no reported cases in Kenya. In June alone, we've had 2 days of protests and 2 people killed in those demonstrations against the U.S. quarantine and isolation center at Kenya Military Air Base. Many protesters say that the U.S. should build such facilities in countries that have already reported infections, and currently that's just the Democratic Republic of Congo and Uganda. So by building such a facility here, Kenyans are concerned that the disease could be imported into Kenya, and Kenya doesn't have the specialized facilities for an outbreak of such a contagious disease, while the U.S. has spent hundreds of millions of dollars beefing up its biocontainment capacity. So Kenyan protesters are demanding that the U.S. should use those facilities back home for its citizens.
And how is the government there really handling their Ebola response, Helen?
So Kenya has received $13 million from the U.S. to set up about 2 dozen isolation and quarantine facilities, one of which is that American facility at the military air base. In addition to this, it's also training nearly 1,000 workers, medical workers, for the response, and it's beefed up its surveillance and monitoring at border posts.
Bloomberg East Africa Bureau Chief Helen Nyambura with those details on Ebola. Now, Zambia has received enough support from bondholders to buy back its $2053 debt in full. That is after offering an extra $65 million to pull in a group of holdout creditors that were resisting the transaction. A successful buyback of the $1.36 billion of bonds will clear the way for Zambia to proceed with a debt for development swap. The IMF says Nigeria should keep monetary policy tight to curb inflationary pressures from the war in the Middle East. The fund raised concerns about a $5 billion debt swap, warning it would undermine central bank independence. The IMF also described the deal as opaque and lacking transparency, cautioning that the high collateral and possible margin calls introduce additional fiscal risks. South Africa's economy grew more than expected in the first quarter, despite early headwinds from the Iran war. GDP expanded 0.5% in the 3 months through March, beating median estimates of economists. However, data also showed signs of weakness, with household spending slowing sharply, with fixed investment declining. Now, coming up, the Iran war has put the dampers on a Saudi firm's plan for a multi-million-dollar IPO. The details on that story next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Saudi Arabia's Mutlaq Al Ghawari contracting company has postponed plans for an initial public offering, due in part to concerns over the impact of the Iran war. The deal was set to be the first major Middle Eastern listing of the year, raising as much as $799 million. Now let's bring in Bloomberg's Middle East Equity Capital Markets reporter Laura Gardner-Cuesta to talk to us about the details. So, Laura, the details, what happened there?
So I think it's fair to say there was an impact from the Iran war. So during the book building last week, our sources suggest that some investors asked to be scaled back. So remember, this is when we started seeing the Kuwait and Bahrain headlines. So the subscription levels were actually quite low for a Saudi IPO. Single digits. We're used to like double, triple digit subscriptions. So obviously this created some concern around aftermarket performance. And, I think it's fair to say that the Iran war had an impact. I think there's other things as well that we should keep in mind and that are more Saudi specific. In Saudi, companies have six months to list from the moment they get CMA approval. So MGC's approval was expiring in end of June. So it creates a bit of a use it or lose it situation, because you might ask why would you go ahead? But this really means you have to do it, otherwise you have to go through the process again, and it's just a bit of a
yeah. Well, it was lose it in this case for the time being.
Exactly.
But look, how does this delay affect the wider IPO plans for Saudi Arabia and the region, and how does the war impact those prospects?
So actually, Saudi was looking pretty promising. The TASI has actually outperformed other stock exchanges in the region because Saudi is seen as a bit more insulated. It has more export routes. However, a lot of companies were looking at this deal because it was the first significant deal out of Saudi in almost a year, not just because of the war, right? So it's something that companies were closely watching. So I think we know they're continuing with preparations. RFPs have been sent out during this period, but I think the conversation will be we do it post-summer? Be a question of timelines being reevaluated. So I guess we'll see.
We'll have to wait and see. That was Laura Gardner-Cuesta with the latest on those IPO stories. Now, for a look at some of the other stories we're following, private credit lender Blue Owl Capital is opening an office in Abu Dhabi. The firm joins Wall Street peers that are continuing to expand in the Emirate despite tensions stemming from the war in Iran. The alternative asset manager's new outpost will serve as its regional headquarters and house members of its institutional capital and general partner stakes teams. Brookfield and BlackRock's global infrastructure partners are among firms shortlisted for a stake in Kuwait's pipeline network. The deal could raise as much as $7.5 billion and is seen as a test of investor appetite for Gulf assets amid ongoing regional conflict. The deal indicates sustained interest for Gulf assets despite the ongoing war that's roiled energy prices globally. And Emirates President Tim Clark says the airline will bounce back strongly from the disruption caused by the war in Iran. Clark said Emirates has no intention of scaling back operations and warned European airlines to, quote, watch their backs. He also renewed calls for greater access to international markets as the airline looks beyond the oil crisis. Well, let's take a quick look into markets before we head out for the day. Equity futures in the United States turning lower by the second 4/10 lower at this point. Euro Stoxx 50 futures barely down 0.1% lower. The stories in oil really today. Brent prices ticking lower this morning because of the fresh rounds of hostilities that we saw coming out of the Middle East this morning. Brent at 92 almost, NY crude higher as well. Now, that is it for Horizons Middle East and Africa. I'm Abir Abu Amar in Dubai. Stay around with us for Daybreak Europe. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Oil ticks higher as the US and Iran exchange strikes after the downing of an American helicopter over the Strait of Hormuz. Stocks resume their declines, with tech leading losses in Asia ahead of today's US inflation print. Plus, concerns over the outlook for private markets dominate the Super Return Conference in Berlin. We'll be hearing from top deal makers throughout the day. Well, a very good morning. Here is the picture in markets. Tech sliding again this morning, so weighing on stocks and futures. South Korea's Kospi is down 6.3% as things stand, dragging the broader index down 2.5%. Nasdaq futures lower 0.8%. We had a choppy session yesterday, so S&P E-mini futures down 0.5%. Chip stocks under particular pressure, and Euro Stoxx 50 futures even now in the red, down 0.2%. 0.3%. So as you can see, risk appetite remaining fragile all around the world this morning. Now flip cross asset and you can see the geopolitics playing out as well. Brent is up 0.6% at $91 a barrel. This, of course, not helping stocks either, but it's after those fresh US strikes on Iran. Counterintuitively, perhaps, gold slipping below $4,200 an ounce. This on the US-Iran clashes as well, slumping deeper below that 200-day moving average on the inflation risks and the possibility of rate hikes. And indeed, you've got Treasury yields there on the right, climbing in advance of that US CPI print, up 2 basis points at 4.5% on the 10-year. Expectations really mounting that the Fed is going to have to raise rates to fight inflation. And indeed, the 2-year yield is at its highest in over a year. Now let's take a look at the risk events on the docket for today. At 7 a.m. London time, top of the hour, we'll get Norway and Denmark's inflation reports, followed at 1:30 p.m. London time by the US CPI report. Of course, we had that blowout May jobs report earlier last week, fueling bets on Fed hikes. Does this challenge that view? Is a big question. Then at 2:45 p.m. London time, the Bank of Canada will make a rates decision, expected to keep them on hold. Well, let's set you up for the day ahead. We begin with oil a touch higher on another escalation in the Middle East. Iranian state media saying that the country has hit 21 US aerial and naval targets across the region, including sites in Jordan and Bahrain. Now, that's in response to US strikes that were launched against Iran on Tuesday after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. For more, let's go to our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. She joins us now from Dubai. Abir, I have to say, ceasefire, what ceasefire? Just bring us up to speed on the latest. Good morning.
Good morning, Lizzie. Yeah, it definitely feels like that is the sentiment this morning, with a fresh round of strikes between Iran and the U.S. directly. Now, what President Trump told ABC News yesterday was that he has to really respond powerfully to Iran downing an American helicopter yesterday. And that is what we saw happen overnight, where U.S. forces had attacked areas in Iran. They didn't say what they were, but Iran state media afterwards came out and said that they were areas in the Qashm Island, for example, that were suffering from explosions, 6 of them, as a matter of fact. Iran retaliated a couple of hours earlier against U.S. bases, the 5th Fleet in Bahrain, also Kuwait, also Jordan. And so we're seeing this uptick in hostilities. And Lizzie, this follows a week of hostilities that we saw between Israel and Iran, and then Israel's actions in the southern part of Lebanon, where it continues to have its deepest incursion in 25 years, since the year 2000, as a matter of fact. So when you talk about ceasefire, that is something that everyone is questioning. President Trump maintains that a ceasefire truce, or the MOU, this interim deal that we've been talking about over the past couple of months, to reopen the Strait of Hormuz and establish further ceasefire for the next 60 days to then discuss more concessions. He maintains that this is still ongoing. Sources tell us that the wider truce talks are actually intensely going, and that Pakistan is still mediating. It doesn't feel that way across the Middle East this morning, however, Lizzie.
Yeah, would Washington like us to look through the strikes? Because it does seem that they're using more calibrated language when it comes to discussing the back and forth militarily at the moment.
You're absolutely right. Look, the CENTCOM response to the attack that they had overnight was that it did feel very calibrated. It did feel like the language that they used suggested that this is a one-off, that this is a retaliation against the attack by Iran. And look, President Trump last week did say that one of his red lines is going to be the death of American troops. Now, that did not happen this time around. Both crew members on the helicopter that was attacked were safe. they did not die, and so that was not crossing Trump's red line. But he did suggest that an attack against American troops in the region would constitute a response by the United States. Now, Iran's Foreign Minister Abbas Araghchi came out and said that, well, it constitutes a red line for Iran as well to have American troops circling around the country. And so this tit for tat has seemingly been going on over the past couple of weeks. We await and see what further action the U.S. takes when the U.S. wakes up and what further comments President Trump has. But for the time being, it looks like the calibrated attacks against Iran and then Iran's retaliation seem to have stopped for the time being, Lizzie.
OK, Abir, thank you for the update. That's Bloomberg's Abir Abu Omar. We'll be back with Horizons at 5 a.m. London time. Well, let's see how all this is playing out in markets. We can go to Asia now. Winnie Hsu's in Hong Kong for us. Winnie, it looks like you've got geopolitics and tech as headwinds this morning.
Yeah, exactly, Lizzie. We are seeing investors turning more cautious, especially ahead of that U.S. CPI numbers, because we did get pretty hot prints for the U.S. jobs data last week, reinforcing the Federal Reserve's rate hike path ahead. And that is really weighing on markets today as we see MSCI Asia extending losses to over 2%, with declines led by South Korea's Kospi index at one point down as much as 6%. Remember, it was up actually 8% yesterday, so lots of volatility in the world's best performing stocks so far this year. Now, when it comes to the bright spot, it's actually in the world's worst performing stock gauge so far this year, which is actually in Indonesian stocks here, up 2.3%, extending gains of as much as 7% yesterday after the Bank of Indonesia announced a surprise rate hike to support its currency. And hence, you can see that the Indonesian rupiah strengthening for a second session. Now you flip aboard, we take a look at Japanese assets because, yes, tech is a drag. Hence, we are seeing tech-heavy Nikkei 225 underperforming the broader Topix gauge, while the bank index in the Topix is actually outperforming on expectation for the Bank of Japan to raise rates. And that expectation is also reinforced by today's strong PPI numbers. We are looking at PPI numbers up 0.9% compared to the previous month. And in fact, when it comes to the annual base, it's actually rising at its fastest pace in about 3 years. Bond space, we are looking at a weak demand coming out from the 30-year bond auction at its weakest level since about a year ago because of the recent decline in yields, dampening interest in the investors as well. Now, flip aboard as we take a look at the CPI and PPI numbers from China. Now, that is a bit of a different picture because we continue to see that divergence in the PPI and CPI. Here for the producer inflation numbers up about 3.9%, and that is a pickup from the previous month. And when it comes to the CPI numbers, 1.2%, in fact, missing estimate of 1.3%. And it goes to show how manufacturers have been struggling to pass through these higher input costs to the consumers, and that this is also complicating the reflationary picture in China. Back to you, Lizzie.
Winnie, thank you. That's Winnie Hsu in Hong Kong. And staying on the inflation data, we're going to get another batch of it today, this time from the United States. The print expected to show inflation ticking above 4% year on year, and that reading could add pressure, more pressure for the Fed to hike rates, with options markets showing bond traders piling into bets on a move higher as early as September in the wake of Friday's hotter than expected jobs report. Let's bring in Bloomberg's Ven Ram, MLive strategist, of course. Ven, what's it going to take for this CPI report to change the narrative when it comes to Fed hikes? Good morning.
Morning, Lizzie. I think that, the markets will be riveted on how much of an overshoot there is relative to the forecast. I think that 4% is pretty hot. It'll be the first time in 3 years that we get a number like that. And it'll immediately call into question the Fed's credibility, because they're in their March report, dot plot and summary of economic projections, they estimated that a core PCE would be 2.7%. A reading above 4% would, of course, be inconsistent with that 2.7% forecast. So the question is, how much of a revision, upward revision, are we going to get to the summary of economic projections next week when the Fed meets? Of course, we don't know very much about Kevin Walsh yet. I mean, he may do away with the dot plot and the summary of economic projections completely, and that is a risk that the markets are aware of. I think that, the markets are thinking that, look, even if a hike comes, it will come only in September, as you mentioned, Lizzie. But I think the risk is that, you need to watch the 30-year yield here because it's already hovering around 5%. And if the Fed gives an indication that, look, they're willing to ride this out. And remember, Kevin Walsh has said that he's more interested in the core trimmed mean inflation, meaning if you remove all the outliers in inflation, what you get is a docile inflation print. That, of course, fools nobody. Definitely not the long-term investors, and they will demand a higher inflation risk premium to hold the 30-year maturity. So that's the maturity that I'm keenly watching after today's inflation data.
To say nothing of the pressure on Kevin Walsh from President Trump to cut rates, Ben. But I also want to put this in a global context. I wonder how different the Fed's inflation challenge is to that of the BOE and the ECB. It seems strange that you've got more hikes priced here in Europe when the growth outlook is weaker.
Yeah, absolutely. I think that, unlike the Fed, it pays to keep in mind that the ECB is a single mandate central bank, meaning its core focus is inflation, not so much about growth, whereas the Fed has both growth and inflation written into its mandate. So I think that the ECB is going to be raising rates. I think that the markets are thinking at least 2 rate hikes this year. And if the ECB delivers along those lines, I think the inflation will be very well controlled because they're projecting, mind you, the inflation will be 3.5% this year under the adverse scenario. So I think that they want to get inflation, they mean inflation target of 2%. When they say it's 2%, they actually mean it, unlike some of the other central banks. But when it comes to the UK, it's a slightly different story, Lizzie, because, the Bank of England has missed its inflation target for the better part of 5 years now. And if they're going to look through the second round effects and wait for the second round effects to show up, I think that'll tell adversely on inflation in the UK, which is why I think that gilts have been coming in for some severe treatment, especially at the long end. So I think that that's a concern as far as the UK is concerned.
Ben, thank you very much. That's Ben Ram, Bloomberg MLive strategist, ahead of that US CPI print later this afternoon. We're still ahead on Daybreak Europe. Private markets in focus as the industry's elite gathers in Berlin for super return. We'll be speaking to Julian Salisbury, co-CIO at 6th Street, later on in the show. But first, Anthropic releases its latest Mythos AI model, and we'll bring you the details along with some of our exclusive interview with the company's CEO. That's coming up next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Well, Anthropic has released its latest Mythos model, Fable 5, with one major caveat. The AI will reportedly be blocked from responding to queries related to cybersecurity and biology. The rollout will also be joined by Mythos 5, a version of the same model without such guardrails, to be used as part of its Project Glasswing initiative. I'm joined now for analysis by Bloomberg senior strategist Neil Campling. Neil, this is quite confusing. Just talk us through what Anthropic's strategy is here. Is it just about getting ahead of OpenAI ultimately?
I think that may be one of the reasons. Obviously, there's a battle to come to market, but also in terms of showing the highest growth possible for these businesses. So if they can come with new tools and new products that they can then charge for, it helps in terms of that growth rate. And what they're talking about, the launch of these new products, is that they're able to do, they gave examples yesterday, where the tasks they can perform in one day had taken a team of developers at Stripe, for example, 2 months to try and achieve the same task. So trying to show these tools as being very efficient for specific tasks, but then also removing some of those issues around cybersecurity, because they had found flaws previously in other cybersecurity models, which had been uncovered, hadn't been detected for multiple years. So they want to prevent those potential tools being used to prevent bad actors from getting hold of these tools.
Also on Anthropic, interesting that Google, who of course was one of Anthropic's earliest investors, is now increasingly backstopping the financing that underpins data centres for the startup. It sounds very complicated, this financing web. It sounds like they're complicating it even more. Is it just to try and make money at every stage along the way?
I think that is part of it. We forget, maybe there is some worries about these circular arguments in terms of the way these financing and funding rounds go, but actually, Alphabet has been a really smart investor in terms of the money it's made. So let's think back to Alphabet being an early investor in Anthropic. They invested $300 million to get 10% stake in the company at a $3 billion valuation. Now, based on recent reports, that means they've made more than 300 times their money on that investment. That 10% today, in theoretically, would be worth nearly $100 billion. So huge return. So the backstopping on these valuations will have already made a significant return on those original investments. So AI is expensive. You need the backing. Google and Anthropic are basically having a business relationship as well as a funding relationship. And Google, as the investor, has made considerable returns already on what they've invested in this platform.
OK. Neil, thank you for the context. As always, Bloomberg's Neil Campling there. Well, Anthropic's CEO says that AI will make the software industry larger, not smaller, although firms that don't adapt will disappear. Dario Amodei spoke exclusively to Bloomberg Originals about how the company's working to align its business model with its values.
If you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, we've seen the world of social media, the consumer world, it really seems to, encourage engagement, even addiction, the slop we've seen with AI video models. It's like, what's going on is it want to maximize the number of minutes that you're paying attention to, because that's the advertising revenue driven incentive. Whereas if we look at enterprise, we want to make these models useful to people. We want to use AI to cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, like the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But like, I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
And you can see that conversation in full on a new episode of The Circuit with Emily Chang. Subscribers can access it on the terminal and at Bloomberg.com from 1 p.m. UK time today. And for more on the tech outlook here in Europe and London's role in the AI race, do check out the latest episode of Bloomberg Tech Europe. Catch that at 8:30 a.m. London time this Friday. But coming up right here on Daybreak Europe, as the sole supplier of EUV machines powering ahead advanced chip manufacturing, ASML looks like the quintessential pick and shovel play on the AI boom. But investors aren't so sure. We'll tell you why next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Daybreak Europe. ASML's ascent to fresh record highs has boosted European markets, but it's done little to improve what is the chip-making machine company's cheapest relative valuation in years. While the Dutch firm's shares are up some 64% this year, the gain has lagged that of broader US semiconductor sector, which has been lifted by soaring demand for AI tools. Dasha Afanasieva, Bloomberg's Amsterdam bureau chief, joins me now for more. Morning, Dasha. I mean, it seems like investors' main concern is that however strong demand is, ASML won't be able to monetize it. Is it more a case of won't than can't, though?
That's right. So ASML is often referred to as a monopoly. And even though it is true that it is the only company in the world that makes extreme ultraviolet lithography machines that are crucial to the big AI boom, it's actually competing with other parts of the sophisticated chip-making technology supply chain, which means that companies decide to allocate money to each of these different stages. And investors are concerned that in relative terms, ASML's EUV machines aren't actually getting the boost that other parts of the supply chain are, like etching or advanced packaging. The other issue is that they're actually not increasing prices, despite this kind of much coveted, almost monopoly style sell position. They've decided not to raise prices. So it's kind of like they're sitting on this amazing tool that's the only of its kind in the world, but they're not quite capitalizing it into this kind of runaway market success that they might want to see.
Which seems so strange. But then on top of that, you've also got worries about whether ASML can actually meet demand, right?
Exactly. So that there have been worries about capacity constraints. So can it ramp up production quickly enough? Because these are extremely technically advanced, sophisticated machines that require super expensive technology to make. It's not, it's much more sophisticated, compared to, say, a shovel and pick, if you go with that analogy. And the capacity issue that, they're getting a new site online in the Netherlands, and that's taking longer than they might have hoped. So there are these long-term capacity constraints. But on the other hand, some of those have eased, because Bank of America recently said that actually they're going to be able to sell 90 EUV machines, up from 48 in the year prior. So that's a pretty hefty jump.
Dasha, thank you for bringing us that story. That's Dasha Afanasieva, Bloomberg's Amsterdam Bureau Chief. Thank you very much. Well, coming up on the programme, we're going to be talking markets with Pilar Gomez-Bravo from MFS Investment Management as we look at futures now pointing south here in Europe. Eurostoxx 50 futures flat to the downside. S&P E-minis down 0.5%, following the moves we've already seen in the Asian session. The MSCI Pacific Index down 2.6%. Two headwinds this morning: geopolitics and tech. More next. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Oil ticks higher as the US and Iran exchange strikes after the downing of an American helicopter over the Strait of Hormuz. Stocks resume their declines, with tech leading losses in Asia ahead of today's US inflation print. Plus, concerns over the outlook for private markets dominate super return in Berlin. We'll be hearing from top deal makers throughout the day. Well, a very good morning. Welcome to Wednesday. Here's the picture in markets this morning, and tech is sliding again, weighing on stocks and futures. We've got the South Korean Kospi down 5.8% now, so dragging down the broader MSCI index 2.5%. Nasdaq futures down 0.8% after a choppy session yesterday. We had chip stocks under particular pressure, so the S&P E-minis index down 0.4% now, and Euro Stoxx futures are now in the green ever so slightly, but we have been flipping between positive and negative even just throughout this programme. So in the end, risk appetite remaining fragile. There you go, back to unchanged, just as I am speaking. Now, flip the board over to the cross-asset picture, and you can see how the geopolitics is playing into all of this. Oil climbing again, just a touch now. Brent at $91.50 a barrel. That, of course, though, not helping stocks. And counterintuitively, perhaps, because of the US-Iran clashes, we have gold slipping, now below $4,200 an ounce, slumping deeper below that 200-day moving average because of the raised inflation risks and the possibility of rate hikes. Now, taking that to the bond space, Treasury yields have been climbing in advance of the US CPI print, expectations mounting that the Fed's going to have to hike rates to fight inflation. The 10-year now at 4.53%, and the 2-year, in fact, at its highest in over a year, I believe. Now, let's look at your front pages this morning. The Financial Times leading with the latest exchange of fire between the US and Iran after the downing of an American helicopter over the Strait of Hormuz. The Wall Street Journal, meanwhile, features the results of the Democratic Senate primary in Maine, one of the party's key targets in this year's midterms. Political newcomer Graham Plattner winning despite controversies that have plagued his campaign so far. And then here in Europe, in France, we look at Le Monde. They're also on the geopolitics, leading with Iran, a headline which says that Donald Trump is determined to strike Iran to preserve his credibility, which, of course, partly comes back to those midterms. But you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which terminal subscribers can find by going to DAYB Go. Well, let's turn back to the markets now. Bond traders piling into positions targeting multiple Fed hikes in the coming months, with some looking for a move as early as September. Now, the flurry in activity comes off the back of that surprisingly strong US employment report on Friday. Investors also now waiting for May's CPI data due later on today. I'm pleased to welcome to the studio Pilar Gomez-Bravo, co-CIO of Fixed Income at MFS Investment Management, for some analysis. So thank you so much for coming into the studio. Friday's jobs report seemed to change the market narrative. Did it change yours?
I think it was undoubtedly a very positive report. I think if you go into the innards of the report, you can start sort of seeing that there's some areas, obviously government employment was high. Healthcare continues to surprise us, being high. But I think the one thing that kind of paints a slightly different picture is that when you look at sort of average hourly earnings, that did not go higher, unemployment rate did not go lower. So, yes, I think that if you look at it in the non-farm payrolls per se, it was certainly a very positive number, not just on its own, but also because you've seen the last 3 months being very positive. So it's not like a one-off. It has been a trend that's been quite positive. Other employment reports maybe mitigate that a little bit. But we do definitely want to sort of see kind of obviously what the CPI numbers are going to be today to either confirm that or not. But undoubtedly, I think that sort of spooked the yield markets quite a bit.
Well, yeah, what would it take in the inflation data today and in the months ahead for you to see Fed hikes before the end of the year?
I mean, I think you need to see headline inflation really start translating more significantly into core CPI, right, and core PC, which is what the Fed looks at. That can take a little bit of time. I think if you look at sort of obviously what Brent futures, you were talking about that earlier, are doing is the markets, and even if you look at TIPS break-evens, right, in the inflation markets, you're not seeing the markets particularly concerned about this being a very persistent inflation shock. But that's yet to be seen because, as you mentioned also, we still are waiting for a resolution on Iran conflict. So the more that persists, the more the physical bottlenecks will start hurting. So whilst the markets are relatively sanguine yet, yes, there's going to be an increase in inflation expectations. You might get to year-end inflation, core CPI, that's certainly going to be above 3%, maybe 3.1, 3.2. I think from there to sort of get to much higher levels, you need to have that persistent inflation shock that comes through an oil bottleneck and also memory chips, right? I mean, that's also very expensive. So certainly that the tail risks are for higher inflation. And I think that the crux is going to come in September, October. You're going to have a confluence of risk factors, either oil, rate hikes, and potentially having to price in more. And at the same time, obviously, these wonderful IPOs that we're getting on the equity markets that are going to crowd out capital, right? So those three factors are not as impactful today for Fed. But certainly as you get into the next 2 or 3 months, I think that certainly the Fed's going to be tested and the bond markets and equity markets will also be tested.
But also we've got a new Fed chair, right? And we don't know what his communication style is going to be. There are rumours, Ben Ram was highlighting this earlier, that he might do away with his own dot when it comes to the dot plot. Maybe he'll want fewer press conferences throughout the year. Is the market ready for that? What sort of reaction would you expect to see?
I mean, I think that's certainly kind of the case that we would expect his first meeting to be more about how he intends to carry forward with regards to the processes and the protocols that the Fed has established. I mean, the Fed is a slow-moving animal as well, so I think that it's going to be a gradual process. If he wants to sort of create new projects for revisions of sort of standard procedures, it's going to take some time. I don't know that he'll refrain from a dot or not, but I certainly think that the most important thing for us is that the easing bias will be kind of like eliminated, that you're going to have a more neutral stance. And I think it's going to be about what he does with the press conferences at the end of the day, whether guidance, is going to be coming forward or not.
So right now, where are you thinking the 10-year ends the year?
I mean, I think the 10-year has been surprisingly steady around that 4.5%. So I think it's still going to be within a range. I think that if you sort of get higher than 4.75, 5%, you're going to have a ceiling. Look at the 30-year. The 30-year barely can break 5%, right? So I actually think a lot of the volatility is actually at the front end, which is where it should be, because that's where you're pricing in central bank action. I think that the more the central bank hikes, the less pressure it should be on sort of the long end of the curve, right? Because in theory, you're controlling inflation expectations lower. But yeah, I think that you might end up surprisingly close to where you are today.
5.01% where we are on the 30-year right now. I also just want to take us over to Europe, though. Can the ECB hike as many times as price when you've got this growth backdrop?
I mean, I think the ECB is sanguine about, look, we need to hike to protect inflation expectations from going higher.
But some are saying one and done.
And however, I think that the path might be one. Let's hike a couple of times, insurance hikes, as they call it. And if we do have a very negative growth impact, then we'll cut rates again next year. So they're a more pragmatic approach of sort of saying, look, we need to do something now because obviously they're at the forefront of higher inflation. They are really true to that target of 2%. They don't have an employment mandate. However, I think they're also ready to cut. I mean, remember that it was the one bank that sort of came down quickly to that 2% target level of neutral rates, whereas the Bank of England, the RBA, or the US Fed were in theory still planning more cuts, so they were a little bit late to the game.
But let's say that the messaging on Thursday isn't as hawkish as perhaps expected. How much do we see yields dropping as a result?
I mean, I think it depends on where you are on the curve. I mean, we have these wonderful meetings where we bring all the portfolio managers together and the rate strategists. And I think that it's a question around the tail risks, right? If you look at the volatility in the front end, it's very high. You'll have times where, depending on kind of the noise on the Iran war, you will set 20 basis points moves in the front end. But again, look at that bund. Look at that 10-year bund. It's been around the 3% for a long time. So I think that if there is if there's a more dovish interpretation, I actually think that the markets might worry because the Iran conflict has not been resolved. So, in fact, you might perversely see a sort of higher level of rates in the long end if the ECB becomes super dovish all of a sudden. I don't think that would be taken positively whilst you still have core inflation above 3%.
OK, really interesting. I just have to finally end on the UK.
Yes.
Of course, we're looking ahead to that Makerfield by-election. Are we just waiting for gilt yields to spike if Burnham wins?
I mean, that's actually kind of like the consensus, right? That sort of this leaning towards a much more left-wing type of fiscal policy would obviously put at risk the fiscal rules that the UK has sort of abided by for quite a long time.
Even if he says he's going to stick to them.
Even if he says, well, you know, you're in campaign mode, right? So but I also think that you need to be realistic. I don't really think that there's that much fiscal space, frankly, that even he could move with. So I think if you do have a significant move up in yields in the UK, we might sort of see that as an attractive opportunity, frankly, rather than not, because I really do think that the UK is somewhat constrained with regards to even the politics of what might be realistic once, you know, you're in power. So that's something to watch. I think the Bank of England is more interesting because they're in a bit of a pickle. They might not be as adventurous as the ECB in terms of hiking rates, even though, again, they do have certainly some inflation pressures like the U.S. does. But, you know, I think, you know, what at the end of the day really matters is that there's amazing opportunities in fixed income. Yields are high. Yields are higher than the earnings yield in the S&P. And therefore, if you're an active investor, you know, when you think about all the central banks that are coming, and we haven't even spoken about the Bank of Japan. Yeah. I mean, I know it's fixed income, but it's exciting. Yeah. And so there's a lot of things that are going to happen over the next 3 months that are going to be really relevant, not only for fixed income investors, but for investors in general. And again, especially around sort of risky assets as well.
All right, well, we haven't got the time to go to the BOJ. We'll do it next time. Pilar, thank you for visiting us in studio. Pilar Gomez-Bravo, co-CIO of Fixed Income over at MFS Investment Management. Well, coming up on Daybreak Europe, are the returns still super? Private capital's biggest names descend on Berlin for super return, and we'll be hearing from the 6th Street co-CIO Julian Salisbury next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the 3rd floor or the lobby. You actually have to start in the basement.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, much of the private capital industry's top brass is convening in Berlin this week at the annual Super Return Conference. It comes as the private markets boom shows signs of faltering amid unprecedented withdrawals from retail-focused funds. Bloomberg's Danny Berger's on the ground for us in Berlin, a long-time face of Daybreak Europe that viewers will remember fondly. Danny, who have you got with you?
Lizzie, thank you so much. I missed being on your airwaves this early in the morning. Clearly, you can't get rid of me. I am so pleased that I'm here at Super Return and here nonetheless with Julian Salisbury, the co-CIO of 6th Street. Julian, thank you so much for joining.
Great to be here.
Thank you you're the first victim, bright and early. Hope you're awake.
I don't know why I got the graveyards.
Because you're the most important person. So we're starting out on a strong note. And look, you know, it's kind of funny because Maybe 2-3 years ago, the word of super return was, golden age of private credit, and now it's withdrawals. There's a bit of calm. You have Cliffwater starting again. You have Blackstone. There's still these fears. Software hasn't gone anywhere. I just wonder where in your mind we are right now. Is this still an industry that's going through some growing pains and stress, or are we kind of on the back end of it?
Look, it depends on the platform that you're operating on. For us right now, we've never seen such high levels of activity. It's actually a tremendous environment for us. The fact that you've seen withdrawals in certain types of vehicles, people who use short-term liabilities to invest in their companies and their platforms, it's not how we operate. We have long-term, drawdown, flexible capital. So when we see an operating environment like this, it's actually better for us. These kind of tight upward to the right capital flowing in, it's actually much more difficult. A kind of more complex environment like this, where you're seeing technical pressures, people pulling back in terms of their own capital, it's a great operating environment for us. It's never been so busy. So is this a unique Sixth Street thing then? And what does that mean for the rest of the industry? Is your gain other people's pain, I guess is my question. I wouldn't put it that way. It's like when the industry overall grows, that's good for us all. I mean, growing private capital markets, growing economies, growing businesses. There's some great success stories we can talk about here in Europe where we've been able to find growth. But I'd say, it is typically better for us when, the markets are not just like grinding up and to the right all of the time. So moments like COVID, moments like the rate hikes at the end of 21, where you see stresses around industries, whether it's real estate or software, these are typically better environments for us to be able to use our conviction around particular themes and sectors and not be worried about what other people are doing and lean in heavily. In the rest of the market, though, there is this real conversation happening. Is it headlines or is it something deeper? At this moment, is there a deeper stress? Are marks honest right now, Julian? Look, here's the reality. When an industry grows as fast as the private credit industry has grown, it's like doubled over the last 5 years. It's likely going to double again over the next 5 years. You're also coming off an environment where, frankly, default levels were at, historic lows. So when it's natural that you would see an uptick in defaults. It's natural you're going to see an increase in nominal defaults because the industry's just doubled. So you're going to see an increasing number of defaults and headlines associated with that over the next few years. But if you look at the true underlying health of the businesses, certainly for our portfolios, I think for many people's portfolios, companies are performing just fine. But doesn't mean you aren't going to see some accidents along the way. When things grow this fast, typically some things break. The other thing that's growing very fast right now is AI data centers and the involvement of private capital in it. I was listening, John Gray was speaking at a conference earlier this week basically saying a great way to play AI is to buy Blackstone shares because we're becoming an AI investing company. Is that another aspect, another asset class, that it grows so fast that surely there are accidents along the way? Look, inevitably, yes, but for now, we're seeing tremendous growth signals. The investments we have in and around the space are just continuing to outperform our expectations quarter over quarter. The sheer capital need is just tremendous, whether it's equity capital for development platforms, equity capital for stabilized assets, financing of the data centers, leveraging the people financing the data centers. The capital needs are of a magnitude nobody's really seen before, certainly at this scale, and that creates opportunities. I suspect there are going to be, there will be generational great businesses that emerge from this period of time. But yeah, when things grow this fast, inevitably there'll be some losers along the way, and at some point in the next 2, 3, 4 years, there'll likely be some kind of shakeout. Well, one of the points, I believe it was Oaktree made, this fear, and Double Line too, this fear that you have a loan, it's maybe 5 years, but within that, the technology within it goes absolutely, it's no longer applicable. It basically gets old. I wonder how you're thinking about the life cycle of these loans, that maybe they're attractive now, but what happens on the back end? Yeah, look, it's a great question. It's something that comes up in every investment committee discussion we have around the durability and sustainability of the revenues for certainly software businesses. I mean, I don't think it's anything particularly insightful, but it depends how ingrained the business is. I mean, not just software, like a data center, the actual chips in the data center need to be replaced. Yeah, of course. Look, there's been a replacement cycle for chips for many years, yes. Typically, we're all used to our iPhone upgrades, our computer upgrades, our laptop upgrades. There'll be a replacement cycle. I think that's largely factored in. People understand that's a challenge. I mean, look, the longer term debate that, the debate that's been coming up recently is, are data centers in space ultimately going to be the source that disrupts all of these terrestrial data centers? But I still think that's some ways out, and the need for the powered land, terrestrial powered land, is going to persist over a medium and long term.
Lucky for us, we all get to debate and talk about data centers in space because we get SpaceX this week, so it's a topic of conversation. There's so much capital flowing to IPOs, to data centers. At the moment, the supply-demand dynamic has been capital needs to be put to work, and it's kept spreads really tight. Does that change at all with just the amount of supply coming online that's competing for a lot of the same institutional capital?
Look, it's a great question. I think over the next couple of years, I think you're going to start butting up against concentration limits against individual borrowers or sectors as a whole. But the financial services industry is pretty good and adept at evolving and adapting to that. So, what started out as data center specific financing, it's people have now been tapping, the insurance market, the CMBS market, the leverage finance market, the bond market, the IG market. So there's a lot of capacity out there, at least for the next few years. But ultimately, people are going to start butting up against industry concentration limits. The other thing that I think is super exciting is, how a lot of this capital is going to get recycled as these IPOs happen. It's going to free up a lot of capital and that's been built up and returns that have been generated in the private markets, and how much of that's going to get recycled back into the next generation of growth businesses. I think it's a tremendous opportunity for that market.
What happens if we start to breach concentration limits and these things are coming back up again? It's not the first time investment. The loan is coming due, what have you. People are looking at selling some of their data center assets. Are there enough buyers out there to continue this cycle going? Or do we reach a problem because so many people are jumping in and all the big pensions and all of the big insurers are already in this market now?
Yeah. Look, I think this is a real challenge that we're going to have to work through over the next couple of years. And specifically right now, I think there's a lot of demand for lending to data centers with long-term IG offtake contracts, and certainly a lot of demand for people to lend against those loans. There's certainly a ton of demand right now to invest in development platforms where you're making incredible development economics, developing data centers at a 10% yield, thinking you can sell them at a 6 or a 6.5% yield. The longer term challenge is going to be the stabilized takeout. How do you, ultimately a long-term market needs to evolve for the purchasing of all these stabilized assets, a REIT market essentially. And there are early signs of that happening, but it's still in the very early days of that. And that's people who are going to be willing to take what you referenced earlier as the longer term, residual value bet on these properties.
All right, Julian, we're going to have to end it there. Thank you so much for joining. Appreciate your time this morning. Great to see you as always, Lizzie. Of course, that was Julian Salisbury of 6th Street.
Danny, thank you very much. That's Bloomberg's Danny Berger with the 6th Street co-CIO. And Bloomberg TV will be live from Super Return in Berlin both today and tomorrow with exclusive interviews just like that one with some of the leading figures in private markets. So don't miss Danny's coverage. Now, to some other top stories that we're following for you this morning. Bloomberg has learned that the UK Treasury is resisting calls to speed up an increase in defence spending days before the government unveils its long-awaited military investment plan. We're told that ministers are still debating whether to commit to reaching defence spending equal to 3% of economic output by 2030. The target is currently set for the next Parliament. Defence Secretary John Healey and military chiefs are pushing for a faster timetable. Elsewhere, a Florida trading company says it's in advanced talks to send Cuba the biggest cargo of U.S. fuel since the Eisenhower administration. Vanguard Energy is gearing up to export 250,000 barrels of diesel and gasoline. Well, those are some of our top stories from around the world. We've got plenty more coming up for you on Daybreak Europe. We'll frame your day ahead with some terminal charts. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:56 a.m. here in London, and I just want to set you up for the key risk event on the docket for today, which is, of course, the US CPI print. These are the expectations, a tick up from 3.8% to 4.2% at the headline level year on year. But how often are we surprised by the CPI numbers, I hear you ask? We'll flip the board over, and our macro man, Cameron Cries, has been crunching the numbers for us. You can see that at the headline level, we've seen more upside surprises regularly happening, but at the core level, you tend to see downside surprises. That's the blue line here. Of course, all of this is crucial to Fed expectations, and these data go back to 2012 when the Fed formally adopted an inflation target. So that number coming up later on today. The opening trade is coming up next. Anna Guy and Tom will take you to the open. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Good morning, everybody. It is Wednesday, June the 10th, and here's what is on our agenda. U.S. strikes on Iran, testing overnight the ceasefire. U.S. inflation set to jump after that hot jobs report. We watch Fed expectations. And Chinese factory gate inflation tells the AI and war effect story on prices.
So European futures today pointing to gains of 0.2% after the losses of about 0.5% yesterday. To Anna's point, the central focus for the markets today, beyond the geopolitics, will be that inflation print out of the US, and after the hot jobs report that we got on Friday, US futures pointing lower by 0.3%. For this month at least, European stocks have outperformed their US counterparts. We'll see if that continues. On the oil story then, Brent at $91 a barrel, down 0.1%. The continued volatility out of the region and the focus, of course, on the conversation between the US and Iran. But right now, Brent is at $91 a barrel. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's just gone 7 o'clock then here in London. Let's get straight to today's Wednesday agenda. And we start then, Tom, with the oil price and its response to what's been going on in the Middle East. So we're pretty flat, as you've been saying, on the Brent price this morning at 91.32. But that doesn't really tell the story of the last 24 hours. We got down to the high 80s on the oil price, on the Brent price during yesterday's session, but back up overnight above 90. This as the US takes what it says is retaliatory action for the downing of that helicopter that we talked about yesterday. So the US attacking Iranian military targets. Iran says that the attacks went wider than that. The US, though, then signalling that they have finished their activity with this particular purpose in mind. And so oil did rise, but then it paired those gains a little bit. The Iranians, though, this might not be a done deal for them. The Iranians saying they will leave no attack unanswered. And they tell Gulf countries not to allow US troops on their territory. So all of this raises questions about the fragile nature of the ceasefire, the extent to which it still holds, and where is this peace deal? Where is this extension of the ceasefire, if that is all we are realistically to expect?
And if we step back and look at the oil price action, and currently Brent at $91 a barrel, as the US and Iran trade military blows, in some respects, it's pretty remarkable that we're not seeing a much higher print on oil prices. Maybe part of this is down to the demand destruction that the US government is pointing to, about 1 million barrels per day. We know, of course, China's been cutting back on its imports. We know that Asian governments have been putting in place measures to restrict the purchases and the demand around oil. That has been a factor. But also the news today from our team covering this, that Kuwait has actually successfully, or at least is putting on the market now for sale to its Asian buyers for the first time since the conflict, its own crude, potentially around 4 million barrels per day on ships that have crossed through the Strait of Hormuz and now apparently on the way to those Asian buyers. So it's a reminder that there is a trickle, at least, going through the Strait of Hormuz. All of those factors seemingly playing that role in capping oil prices, at least for now, but we know inventories are drawing down.
Yeah, it is a trickle, isn't it? But it is something. It is something that seems to be getting through the Strait of Hormuz. Nothing seems to be going back in, but and much that is coming out is turning off its transponders, so it's very difficult to get a sense of how much is coming out. But it is notable, as you say, that Kuwait is offering this crude to Asian buyers for the first time since the war began. So that's the oil price. It is perhaps surprising, as you say, that it is not higher. But that takes us to a lot of inflation data and the broader risk conversation and the big risk event, I suppose, of the week.
Well, if there isn't volatility in the oil markets, at least in terms of the context that we're seeing, in terms of volatility on geopolitics, then certainly it is there in the equity markets. And we're seeing that again, very pronounced in Asia, with the Kospi right now over in Korea down close to 6%. So Asian markets across the benchmark set for the fourth straight day of declines, or fourth day of declines out of 5. It's been very volatile. The VIX is up. It's at 19, so it's not at the most extreme levels, but the VIX is up since the start of this month by about 30%. So volatility has ticked up. You're seeing today a little bit of pressure on treasuries. yields are up. You're seeing significant pressure actually on gold and Bitcoin. Bitcoin having one of its worst weeks in the context since about 2022, and gold back below $4,200. And that does tie in not just to geopolitics and concerns in the equity markets about valuations, but the question about inflation and what the print is going to look like today. 3.8% on the headline level is the forecast.
Right, yes, I think expected to go from that 3.8% up to above 4%. So that is certainly going to be the area of focus this morning, or going into the afternoon European time. And of course, Tom, this comes on the hot on the heels of the December print for jobs, which was, for the print, the jobs print just at the end of last week, which meant that we increasingly were pricing in a December hike from the Fed. And so where does that leave us and leave our thinking, and where does that leave vulnerabilities in the markets? You mentioned the gold price. The gold price has been dropping, and some people pointing to that as an area of concern that we are getting closer to interest rate hikes coming through from the Fed. So a lot of focus on the fact that historically the headline number for inflation, as Lizzie was pointing out to us, does have a history of coming in hot, of outperforming, of coming in with upside surprises. So we'll watch for airfares, appliances, electronics, all of these things set, according to Bloomberg Economics, to push inflation higher, above that 4% this time, compared to the prior number of 3.8%.
Yes, 4.2% being the May forecast versus 3.8%. Talking of inflation, that is upcoming. We have had already the inflation data out of China, and that is fascinating in terms of the split, the divergence you're seeing now between consumer prices that essentially remained unchanged in the most recent month versus the producer prices, which ticked up pretty significantly. Part of that is energy, but interestingly, part of that is the AI demand as well. But that divergence not necessarily telling a positive story for the domestic Chinese economy.
Absolutely. So these businesses, these consumer-facing businesses, perhaps then having to take this on their margin, because, yes, you see PPI really responding to the dual challenges of higher AI, electronics prices and higher energy prices. That's the PPI story, but you don't see it in CPI. They can't pass it on to consumers. And as a result, this is bad for the margins of those businesses, and raises questions about whether the Chinese consumer is going to be able to step up. So we do expect this is a country to exit deflation this quarter, but it's not smooth sailing in terms of a more solid footing for the consumer price story.
Yeah, so 3.9% on producer prices versus 1.2% on consumer prices. Producer prices 3.9, consumer at 1.2 out of China. And there's another question as well as to whether or not China starts to become reflationary in terms of its exports, given producer prices are close to 4%. What does that mean in terms of higher prices as they export maybe some of that inflation to their global customers?
Let's talk about some of the things that are coming up today then. We've already talked about US CPI. That's going to be a highlight from a data perspective. But we have one big event taking place here in Europe from a markets perspective, and that's Super Return in Berlin. Scott Kleinman, the Apollo co-president, will be with us really shortly on this programme. Danny Berger on location for us to tell us all of those private market stories. James Reynolds, Goldman Sachs Private Credit Global Head, will also be joining Danny. Plus, we'll be joined by Emma Moriarty, CG Asset Management Fixed Income Portfolio Manager. What is at stake now with this CPI print following on the heels of that jobs report? What is at stake for Fed expectations? And Marina Zavalot will be with us, Morgan Stanley Chief European Equity Strategist. Interesting that we saw headline the indexes drop in the States yesterday, but so many component parts of those US markets actually moving higher.
Let's look at what else we are monitoring throughout this Wednesday then. The Bloomberg Invest event begins in Hong Kong. Some great names there that we're speaking to. Of course, the annual Super Return gathering gets underway in Berlin. Danny Berger is on the ground for us. We're going to hear from some of the guests attending throughout the day and in this show. And at 9 a.m. UK time, we're going to get Italy's industrial production data. 1:30 p.m. UK time. It is that key data, of course, out of the US with May CPI, Consumer Price Index data, coming out later. That is a big one for us. We'll be across that for you, of course. And after the market stateside, we'll also get on the earnings front Oracle's fourth quarter results.
Yeah, just how quickly can they build those data centres? Now, much of the private capital industry's top brass, they're convening in Berlin this week at the annual Super Return conference, just as the boom shows signs of faltering amid unprecedented withdrawals from retail-focused funds. For more, let's get to Bloomberg's Danny Berger, who is at the gathering in the German capital. Danny, great to have you on the programme. And set the stage for us around private markets right now. Such a boom area a couple of years ago, such a focus on their exposure to software over recent months, and then are retail investors therefore just as excited as they used to be? What's the mood there?
And I mean, this conference is just kicking off. And I have to say, about a year ago at this conference, Robert Smith from Vista basically made this declaration. 60% of people in this audience aren't going to be here because AI will have replaced their job. I say it's early here and it's already busy. So yes, there are the headlines, there are concerns about private credit and redemptions. But the mood here is still one of strength. But around private equity, there's this real question. M&A volumes have been really robust to start the year. But a lot of that sponsor-backed M&A has been somewhat absent. In fact, volumes are down about a fifth so far this year. And I have the perfect person with me to discuss that. It is Scott Kleiman, the co-president of Apollo. Scott, thank you so much for joining.
Great to be here.
And look, this is a topic that you have been a leader on talking about. I think it was, 2 years ago? It wasn't 2 years, right? Or was it last? Yeah, 2 years where you talked about this idea. It's a pig making its way through the python, and we're not there yet. Still, it's been 2 years of LPs asking for their money back. Volumes are still down. The SaaSpocalypse certainly didn't help. I mean, has this whole thing just been set back? Are we going to just be kept waiting for this digestion period to finally finish?
Yeah, I think that's the right way to think about it. The pig is literally moving through the python. Maybe it's 2 years ago it was in the abdomen. Now it's sort of moving a little bit further down. But yeah, there was 10 plus years of 0% interest rates where sponsors went on a buying spree, paid ever increasing prices for assets, generally good assets, but now they're stuck holding these things. The inventory, as you alluded to, of private equity owned companies is really, really high. And it's tough to exit those companies at valuations that sponsors in general want to sell at. And so, yeah, I think we are somewhere still mid-river, waiting to get to the other side.
I had a banker make the comment to me the other week that it just shows that something about private equity is broken because it's a promise. You give me money, I buy an asset, I sell it, I return. And public markets have been really robust. They're at all-time highs. As I mentioned, strategic M&A has been really high, too. So what has gone wrong? I mean, is this a promise broken for this industry?
I would say I think the industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up. What you paid for it didn't really matter because at 0% rates, valuations always went up. When all of a sudden, in 2022, 2023, we saw rates move 500 basis points, that changed everything. I'll make a shameless plug for Apollo here, but this is where, fortunately, we didn't get the memo that the cycle was going to last a decade and stayed very disciplined on valuation. And as a result, we've been actually pretty active selling and exiting companies.
And did things like avoiding software. I mean, you mentioned higher rates. We're going to get CPI today. The odds have now shifted to a rate hike in the United States, certainly here in Europe, too. Does this just exacerbate the problem even further?
Well, exacerbated if you thought rates were coming back down. I think we've been pretty vocal that rates were going to stay at these levels for a while because we didn't see the economy slowing down. We didn't see a need for rate cuts, and I think that's probably where things are headed.
So we're going to get some mega IPOs. SpaceX this week. We learned that OpenAI is filed for an IPO. We don't know when we'll get that. Anthropic's going to be coming soon. Do these big IPOs, is it helpful for this industry? Does it open up the gates to allow people to exit? Or is it we're all competing for the same institutional capital, and unless you're SpaceX, it's a bad environment to go public?
No, it's a little bit different. Again, this is not about the ability to exit. We've done 4 IPOs in the last year, several sales. There's capital available. It's just you may not like the valuation that's being offered. So if you've paid a reasonable price going in, you can get out in this environment. If you've paid a high price going in, well, you're kind of stuck. Most of the assets that private equity owns are not SpaceX or Anthropic. And so when you look at, the S&P setting new records, every other week, it's a dozen companies, right? It's not, the 490. And it's certainly not the next 2,000 companies. Most of those companies are trading at pretty, reasonable or modest valuations, which is why the new money environment for making private equity investments is pretty attractive right now. We've certainly been active. Others have as well. You mentioned volumes are down slightly for new M&A, But it's still a pretty robust environment for making new investments.
Again, it's just the exit picture that we're stuck on. So what eventually happens? Is there something that happens to this industry that we say, okay, we need to come to terms with this, we need to take a valuation hit and just sell that stuff? And what prompts that if that does happen?
Yeah, the passage of time, right? So as long as there's not an intervening recession, these companies are accreting in value, and you get closer and closer to your target valuations, even if multiples have come in. And so each year that passes, you will see.
Does that make it
more
harder to exit, though? Because they get bigger. So your options of where you sell this company are more limited.
No, in the grand scheme of things, what it means is you're generating cash flow, you're paying down debt, you're creating more equity value, and you're approaching that target MOIC. Now, your hold period is extended, and so that's impacting IRRs, and so you are seeing IRRs come down in the industry for that 17 to 22 vintage. But no, with the passage of time, you'll see it. But yeah, folks are going to have to start capitulating for sure.
What does capitulation look like? Is it painful? Is it a reckoning?
Well, I think you will see a shrinking of just the expansion of private equity firms that you saw over the last 10, 15 years. You'll see firms raise smaller funds. You'll see some firms go away. That's just the nature of the cycle. Yeah, for sure.
A lot of this current private capital cycle, too, a lot was pinned on the hopes of democratization, of more retail funds. Very much so private credit story. It kind of leaked into private equity with the latest on Partners Group and their Evergreen Fund. I just wonder if that's part of the conversation here, too, that we've rethought that as the next pillar of growth for the industry.
Yeah, look, Apollo's been very vocal. We have not brought a retail private equity fund because we just haven't thought that's sort of the best asset for that asset class. And so for the very reasons that we're seeing in private credit, at least in private credit funds have maturities, debt have maturities, so you get your money back eventually if you move into a withdrawal cycle. In private equity, as we've seen, it's been 3 or 4 years with depressed monetizations. That could be pretty painful in a retail type product, and so we've been cautious on that. We know others have pushed into that. We've tended to stay away in a wealth or semi-liquid private equity product.
Do you think that's kind of the next evolution of this? Again, we kind of saw echoes of that, but it starts with private credit, but now you have retail rethinking exactly for the reasons you're saying about their holdings in private equity.
Look, remember, limitations on the semi-liquid funds withdrawals is a feature, not a bug, right? It's meant to protect the rights of redeeming investors and remaining investors. And so you will always see the ebbs and flows of that in a product like that. It's not a bad thing or a good thing. It just is. It's just the media makes a lot of hay out of that when you hit those points.
So it's our fault, Scott. I see where this is going.
Yeah. No, but the point is it's a different type of product.
Right.
But yeah, you will absolutely see those points in the cycle for wealth private equity products, just like you do in wealth credit products.
Yeah, and again, I know a tiny sliver of Apollo as a whole is the retail products for credit, and again, not really existent for equity. Scott, thank you so much for joining. Always a pleasure to start the mornings with you.
Yeah, great to be here.
London, I'll send it back to you. Anna and Tom, that's, of course, Scott Kleiman of Apollo.
Okay, Danny, fantastic conversation. Thank you, Danny Berger, at the annual Super Return Gathering in Berlin. And our coverage, of course, from Super Return continues throughout the day. We're going to be speaking to guests, including Victor Kosa from Strategic Value Partners and the Thoma Bravo co-founder, Orlando Bravo.
Coming up on the programme, we'll go live to the Middle East as fresh US strikes overnight on Iran risk prolonging the near-total closure of the Strait of Hormuz. Plus, the global energy crisis and AI boom drive inflationary pressures in China. We will unpack what is happening there. Up next, though, we'll talk about AI. Anthropic releases a new version of its Mythos AI model without its much talked about cyber security capabilities. We'll have the details next. If you want to get involved in any of these conversations, please use the function IB plus BBTV Go. That's on the Bloomberg terminal. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevryan in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Welcome back. This is the opening trade, Wednesday the 10th of June, and the European futures picture looks broadly positive. Perhaps the FTSE 100 underperforms just a little bit. We've seen quite a lot of volatility in the oil price since the closure of these European equity markets, but we're now back to $91 a barrel on Brent. US markets closed down yesterday, as we were pointing out earlier, but quite a lot of the components, Tom, actually managed to head higher.
Here's what else you need to know this morning then. Australian firm Cigna Healthcare has confirmed it has engaged in preliminary discussions in relation to the sale process of UK retailer Boots. The FT earlier reporting that private equity firm Sycamore Partners, which took control of Boots through the acquisition of its parent company in 2025, had started talks with potential buyers over a $10 billion sale. If a deal takes place, it would mean Sycamore could abandon plans for an IPO of Boots in London. Supermicro shares fell in extended trading after it announced plans to raise $7 billion through a package of equity offerings. The proceeds will be used to purchase components needed to fulfill customer orders for its AI servers. Supermicro says it currently has around $39 billion in outstanding orders. Anthropic has released its latest Mythos AI model, Fable 5. Though with one major caveat, the company says it will be blocked from responding to queries related to cybersecurity and biology. The rollout will also be joined by Mythos 5, a version of the same model without such guardrails, to be used as part of its Project Glasswing initiative. Meanwhile, Anthropic's CEO has told Bloomberg he thinks AI will make the software industry larger, not smaller, although firms that don't adapt will disappear. Dario Amodei spoke exclusively to Bloomberg Originals.
If you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, you know, we've seen the world of social media, the consumer world, it really seems to, you know, encourage engagement, even addiction, you know, the slop we've seen with AI video models. It's like, what's going on is it want to maximize the number of minutes that you're paying attention to, because that's the advertising revenue driven incentive. Whereas if we look at enterprise, look, I mean, you know, we want to make these models useful to people. We want to use AI to, you know, cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to, like, you know, to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, like the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But like, I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
So it's all about the moats. You can see the full conversation and that latest episode then of The Circuit with Emily Chang. That's from Bloomberg Originals, of course. So go seek that out. It is all about the moats then. Not all software will disappear, so says Serio. So that is interesting. I was also drawn to the reporting around the circular nature of some of the deals that support the build-out of data centers right now. And some of that involves Anthropic and Google. I'm losing track. I mean, they compete, but they also are in business with each other. It's kind of incredible frenemies relationship.
It really is. So Gemini competing with Anthropic's products, but we have that reporting that Alphabet, the Google, is backstopping essentially Anthropic's leasing of 5 data centers around the US, which accounts, or at least amounts to, or essentially a $35 billion loan from Google and its balance sheet to Anthropic. They are underpinning those leaseholds for those data centers that, of course, are so important to Anthropic, a company into which Google and Alphabet have invested as well.
More on the AI story as we continue. Coming up on the programme, though, bond traders raise bets that the Fed will hike rates. That's been the story since Friday, of course, and that incredible jobs report and the market reaction was been much discussed on this programme. We'll get back to that. We will speak to Emma Moriarty from CG Asset Management ahead of today's US inflation print. Will that have the markets double down on expectations for a Fed hike in December or pull back from those expectations? That is next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. The opening trade is 30 minutes away, and the European futures picture, well, it looks broadly positive, not expected to go higher by much. And I should point out that US futures are pointing lower. So clearly some nervousness, in particular around the tech story, continues because NASDAQ futures are down by around 0.4%. And yesterday it was in particular volatility around the tech story that led to the weakness that we saw in markets where we saw weakness. And that continues to be an area of concern, doesn't it? The AI story as we approach some giant listings just this week.
And this month, European markets, European equities have outperformed their US counterparts, at least so far this month. Let's check in on the bond market moves then. We are building up, of course, to CPI out of the US around 1:30 p.m. UK time. So that macro event is front and centre. Right now, you're seeing a very modest amount of selling coming through across sovereign debt of Europe. French OAT, 382 right now, yields up 1 basis point. You're seeing a similar picture for BTPs over in Italy, 381 yields up, just 1 basis point, largely unchanged on the German benchmark, which is yielding just over 3%. So bond traders, of course, increasing their bets on Fed rate hikes ever since Friday's surprisingly strong US jobs report. Today's US CPI then print expected to show continued price pressures. Let's bring in Emma Moriarty, portfolio manager at CG Asset Management. Emma, how crucial is this inflation story that we're getting today to confirm and lock in expectations of a hike? Do you think that's what we get to at the end of today, locked in and ready to go with a Fed hike this year?
Yeah, I think it's really difficult because on one hand, this upcoming Fed meeting is going to be Kevin Warsh's first chaired meeting. And of course, he was sort of understood to be a candidate who really wanted to cut interest rates. And that's just not the situation that the US economy is in at the moment. We've had very robust growth for some time. We've had strong jobs prints for a while, and we've got US CPI this afternoon expected to come in above 4%. So it's all looking quite difficult. I think probably the situation is, as expected by markets, for a hold to rates this time. But if this is something which is set to continue for the rest of the year, then it will be looking quite difficult not to hike.
OK, so a hike if the inflation data comes in as expected, 4.2% is the expectation from 3.8%, and then a hike becomes more likely. Where does that leave the trajectory then on the data that we currently see today as we look through the end of this year and into 2027? If they end up hiking this year, do cuts come through in 2027 for the Fed, or is the structural and the foundation supporting this US economy enough to propel further upside potentially?
Yeah. So I think it's difficult. If you look at the economy as it is at the moment, inflation's now looking quite strong. Growth is looking very robust, kind of at or potentially above trend growth rate. So you'd have to look at the interest rate setting and say, well, versus neutral, it's possibly looking a little too low. Of course, there's a separate question about what goes on in, say, US equity markets, and whether if we see any weakness down the line there, that's something that then begins to undermine the AI capex going on in the economy, which has held up so much of US growth for a while.
Emma, good morning. Just by way of a thought experiment, if we could go to a world where Kevin Warsh is not coming in as the new Fed chair, how many hikes do you think the market would be pricing in if we sort of remove that as an unknown quantity?
I think potentially a couple more. I think one of the things that's notable about the OIS curve for US rates was despite the fact that inflation had been rising because of AI spending, and then there was the additional shock of the war in Iran, OIS markets were really slow to price in rate rises for the US, and it was really after sort of sustained strength and then sustained job market strength particularly that things started to turn. So it might have been looking something more like what's being priced in for the US or the UK, where there's a few additional rate rises.
Okay, so yes, it could be, and they're in quite different camps now, aren't they? Europe and the United States. We talked to a guest yesterday from BNP who was saying the US is looking as if it might hike because of real strength in the economy, whereas Europe is going to hike because of inflation concerns. Sticking with the US for a moment, I know that you think we're going to see a steepening of the curve. So do you think then that the Fed will not be able to tackle inflation in a timely manner and we get more term premium at the end of the curve, there's more expectation of more supply coming in, and that we get a steepening effect on the yield curve? What are you looking for?
I think that's right. And it has been the case that even if we take Kevin Walsh out of the equation, the revealed preference of the FOMC so far in this cutting cycle seems to have been for a slightly looser policy setting than might have been justified by the data. And now that we have someone who's coming in and has specifically said that they think the interest rate setting for the US should be lower, the expectation, I think, has to be that we probably won't see the number of rate rises needed or as quickly enough as we can to bring inflation under control. And then you get into questions of, OK, well, how big does term premium have to be to compensate for those expectations?
And the risk of second-order effects and wage increases and shifting expectations around inflation. I mean, that is potentially the risk if things play out as you expect from the Fed.
Exactly, and I think whereas the debate in, say, Europe or in the UK has been about, well, we've had this inflation shock, but actually the rest of the economy is not so strong, the labour market's not so strong, and therefore the likelihood of second-order effects is much lower. That's not the situation in the US, and the US is coming in with a strong jobs market at a moment when actually immigration's been cut quite materially, so things could be looking really tight in the US job market if all of this is to continue.
The markets are pricing in for the ECB potentially 3 hikes by the end of this year. Is that what happens to the Eurozone economy if we get 3 hikes from the ECB?
Yeah, I think that's going to be fairly challenging for the Eurozone economy. On one hand, you can look at it and say, well, the ECB has a single mandate around price stability, and that naturally will make it more hawkish about what it signals around inflation. On the other hand, the business of central banking is all about aggregate demand management, and if actually what's going on is there's weak demand, budget deficit constraints in the UK and sort of just structurally weak growth, then increasing policy rates 3 times over the next 12 months could be quite self-defeating.
What about increasing the policy rate once, Emma? If we get a hike this week, will that be a mistake?
I think it's complicated. I mean, if you look at euro area growth at the moment, it effectively rounds to 0. So you can look at it and say, well, we've got a weak demand problem, which might be getting made even worse. But the ECB is quite clearly tossing up between that and the reality that inflation's on the rise, and the crisis that's been going on in the Middle East and the impacts on energy markets are now something that looks much longer than something they can look through.
And finally, on the UK, Emma, we spoke to another guest yesterday who flagged the elevated household saving rates in the UK as a sign of consumer caution, I think. And I note that you mentioned the same thing in your notes. What do we take away from that? What's the message, and what does that mean for policy?
I think it's sort of similar to the euro area. It's this idea that actually, interest rates may not have to rise by as much as OIS markets currently predict. And the reason is there's less likelihood of these second-order effects in the labour market and kind of through sort of general economic activity when actually, the prevailing demand conditions are not particularly strong.
Yeah, so the market kind of did the central bank's job for it a little bit. Yep. Emma, thank you so much. Thanks for joining us. Good to see you on set this morning. Emma Moriarty, Portfolio Manager at CG Asset Management. Coming up on the programme, China in focus. Chinese consumer inflation unexpectedly stalls in May. Producer prices really rising, though. Details next. This is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade, Wednesday the 10th of June. European equity market futures points a little bit higher this morning. A bit of catch-up to be done in the US perhaps, but we have US futures actually pointing lower. In particular, NASDAQ futures seem to be losing their footing once again, Tom. We're down by 0.4%, and E-minis down by 0.3%. So we see the green on the screen, but we're cautious perhaps about the trading day ahead.
Yes, and some caution as a result, maybe, as a result of the inflation data out of the US, CPI data, of course, which is going to be front and centre for many investors in terms of the inflation dynamics of the US. Meanwhile, China's inflation and the split there has widened. Consumer price rises unexpectedly stalling in May, while factory prices gained at their fastest pace in almost 4 years. Let's bring in Bloomberg's China economy and government editor Alan Wong for the details on this. Alan, what exactly then kept consumer inflation so weak in May, despite what we saw in terms of factory prices up pretty sharply?
Yeah, Tom, it's the old story. In China, the weak consumption sentiment is effectively just sealed consumers off of the global commodities rally. If you look at something like pork prices, they fell 16% compared to the same period last year, which basically shaved off 30 basis points off of the headline CPI number. And overall, obviously, there's the same old story of China's home prices falling, and that also contributed to a really modest rise in the CPI.
So that's the CPI picture. Global factors like AI, the boom in AI that we've seen doing incredible things to memory prices then, Alan, and the war in Iran pushing up energy prices. I imagine that both of those things show up very clearly in the producer price side of the Chinese economy.
Absolutely. So the closure of the Strait of Hormuz and the global energy shock really increased fuel prices for China and as with the other economies. Fuel prices for vehicles in particular rose 21% in China for the month of May. That obviously put a lot of upward pressure on prices for producers. And at the same time, we've heard this very familiar story of the global AI build-out, which really put a lot of upward pressure on prices for things like aluminum, copper, and also chips and other electronic equipment. In fact, the prices in the electronic sector rose at the fastest pace in more than 20 years. So that is something that the AI boom is doing to the Chinese economy.
Wow, so electronic prices up the most in 20 years. That is significant, isn't it? The AI impact is there then in terms of the inflation readings of China. And yet, as you said, Chinese manufacturers are really struggling to pass that cost on in terms of the material costs on, at least in the domestic market. What is behind that? And should we expect maybe China to be reflationary for its export partners? Should we assume that there's going to be high inflation coming from China as it exports those costs to its trading partners?
Yes, that reflation is so far very contained in those sectors where prices are surging. For example, producers that they rely on all of the higher oil inputs in their production process, and also obviously the AI-related sectors. But then overall, in the other parts of the Chinese economy, we're seeing a lot of still very intense domestic competition that really limits how much companies can pass on the cost to consumers or the buyers. One example is in the traditional manufacturing sector, where lots of companies are still churning out a lot of products and being unable to raise prices just to hold on to their market share. This is made worse by still very weak domestic consumption. When people aren't buying enough goods, they have to export it. So those export prices will also stay quite low. But obviously the exception being that things that like AI or AI-associated sectors, then in those areas, China will have more bargaining power. The companies in those sectors will have more ability to raise their prices.
Yes, we'll see where prices rise and where margins are hit. Alan, thank you very much. Bloomberg's Alan Wong in Hong Kong with the latest on the Chinese economy. Let's turn, with inflation in mind, to the markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore. Mark, good morning to you. I see that the Asian stocks are negative, US futures are negative, and in particular US tech looks a little weaker this morning. Nasdaq futures on the back foot. Is this just precautionary as we head into a big data point? What's new when it comes to the tech sell-off?
Yeah, it is very much tech focused. It is, I guess, a little bit kind of technical in terms of that this has been the boom era of the stock market or the boom sector. So therefore, people just taking a little bit of money off as they're getting a little bit more nervous. What's interesting is that some of the physical names have really suffered over the last couple of days, which was kind of the latest sector of AI was to really kind of take off in recent weeks. I do think, and we've talked about this a lot in the last week or two, that I think that we're now in the kind of the more problematic end game phase of the AI bubble more generally. Now, how long does that end game last? That's the multi-trillion-dollar question that I can't pinpoint. I think, in prior bubble cycles, we saw that increase in volatility as markets reach fresh all-time highs, whether in the dot-com bubble or in 2008, it wasn't the stock market that made fresh all-time highs, but we saw commodity markets and emerging markets outperform as we were in that kind of end phase when markets were trading broken. I feel we're in that phase now. Does it last months? Does it last, 9 months? I don't know. I think it's probably only a couple of months phase. So in the very short term, yes, this is just technical ahead of CPI. People are worried about a headline print expected at 4.2%, probably has upside risk, if anything. And you're certainly seeing that in yields. You're seeing that in other assets in the reaction. We're expecting there's nervousness that yields might be going higher again, and we're going to have to really shift the narrative around what the Fed is going to do this year. So it is technical in the short term, but I think overall the increased volatility suggests that we're in the end game phase of the AI bubble. But I emphasize that's an end game that in prior bubble phases lasted for 6 months, subjectively saying.
So, Mark, there is more. Are you seeing more market sensitivity around this inflation print from the US than maybe typically we would see, given the backdrop that you've just outlined for us?
Completely in context that, like, up until last Friday's jobs data, we've been kind of ignoring macro data recently. Really, we've just been trading the AI tech bubble versus the idea of like what's happening in the latest US and Iran headlines. And in many ways, we've kind of been quick to move beyond US-Iran headlines and really focused on the AI tech bubble. Friday's jobs print changed the game. I mean, that was a very, very strong print. And it really, jobs is the one bit that people are nervous about that will kind of prevent the Fed from being backed into hiking rates. So now with that CPI print coming on the back of that jobs print, if we do get an upside surprise today, which is very likely, there's real kind of sensitivity in this market. Now, what's interesting is we've priced in such nervousness since Friday. I actually think there's probably two-way surprise risk now. I'm not sure it's quite as asymmetric as I would have said maybe a few days ago. And I reiterate, my narrative for the Fed is either they're probably on hold or they hike multiple times. Because I think by the time they get forced into doing a hike, that means they are acknowledging they're behind the curve and they'll have to go multiple steps. So it's a little bit binary on the rates path as well.
Mark, thanks so much. Bloomberg Markets Live Executive Editor Mark Cudmore joining us with thoughts ahead of that US CPI print. And there'll be plenty more of that on the Markets Live blog. You can get up-to-date analysis and insight from Mark and all of the Markets Live team. MLIV Go is the function on your Bloomberg terminal that will take you to their latest thoughts. Let's get stocks that we're watching this morning. Alex Morgan has a briefing. Good morning, Alex.
Good morning, Anna. Yeah, let's kick off with WH Smiths, which have got a couple of headwinds this morning. They've just cut their profit forecast year-to-date down about 23%. Now, they obviously last year offloaded their high street stores to focus on travel. Well, they're saying that the headwinds from the Iran conflict, from the conflict in the Middle East, is hitting their travel stores. Also, yesterday, it was announced that there was going to be an accounting audit by the UK into a PwC valuation for the financial year ending August 2024. So that as well could potentially weigh down on WH Smiths this morning. So a couple of headwinds there. We're keeping an eye on them. Let's turn it over to Leonardo. That's the Italian aerospace firm, and they're talking up enthusiasm and optimism around a potential deal for European powers to come together and work on a future space defence programme. You can see up around 6%. We'll keep an eye on them this morning. Their new CEO talking up the need for European cooperation. Lorenzo Mariani saying that Europe has to work together intelligently. Now, this is interesting because, of course, yesterday we were talking about that Franco-German next-generation fighter project that was basically shelved. This focus here on space and defence and the need for Europe to come together. We'll keep an eye on Leonardo this morning. And just finally, turning to ASML, we've been talking about that this morning. We've had 30% increase in sales from TSMC. ASML, one of the suppliers of TSMC, so TSMC does well. ASML potentially doing well as well. We'll keep an eye on them when trading opens shortly.
Alex Morgan, thank you very much indeed on some of the stocks that could be on the move this Wednesday. ASML, really fascinating reporting from our team as well in terms of the run-up that the stock has seen, but the fact that in terms of the valuation and the gains, it has missed out versus some of its peers. And there's details in the reporting that's worth checking out on that. Also in tech as well, and ST Micro getting an upgrade over in France. So we could be watching that stock as well. ST Micro set for strong earnings inflection. Bank of America then, that's their view, raising to buy on that stock.
Yes, and the TSMC story getting quite a lot of attention overnight as well in linked developments. TSMC reporting a 30% rise in its monthly sales. That reflects ongoing strength, it would seem, in demand spurred by that global rush into AI infrastructure, a story we know very well. Let me just mention Sanofi on the drugs front, because Sanofi has halted an autoimmune disorder drug trial, and this is the latest setback perhaps for the relatively new CEO, somebody we've spoken to on this programme in her previous guise, But Belén Garrido, who is the CEO of Sanofi now, used to speak to us when she was with with a German business. The French drug maker said on Wednesday it's going to stop the study of this particular chronic inflammatory drug that was to treat this autoimmune condition, so raising more questions for that particular drug maker.
We can also watch the miners as well, because gold and silver are down again in the session today. 4,200 right now on gold per troy ounce. It crossed below 4,200 at one point. This is on those concerns about inflation, higher interest rates, so we'll see what the impact is on some of the miners. Silver is also down around 0.8% so far in the session.
Yeah, absolutely. Keeping an eye on gold as we head into that inflation report out of the United States. The opportunity cost of holding something that doesn't pay a yield, of course, increasingly in focus then, as we have already started to price in that December rate hike then from the Federal Reserve. That is it for the first hour of the programme. Coming up on the opening trade, we'll bring you the market open. European futures are pointing slightly higher this morning, but US futures still in the red. We'll be back with the market open next. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning, everybody. A few minutes then until the start of the equity trading session for this Wednesday morning. And this chart tells the reason as to why perhaps we don't get overly excited about the fact that futures in Europe are pointing a little bit higher, because this tells you the session after we closed here in Europe yesterday over in the United States. So the line, of course, is the closure of European markets. And after that, we saw US equity markets recover a little bit of strength. So we do have European futures pointing a little bit higher, but I would flag that US futures are once again pointing to the downside. So NASDAQ NASDAQ futures are down by around 0.5%. And so ongoing focus perhaps in taking some profits on those AI-related trades. Maybe that is where the market is putting its focus as we approach that CPI data. The CPI print is going to be the big set-piece event of the day, the big data point to watch. And as we were hearing, Tom, from Mark a little bit earlier on, perhaps there's some two-way risk increasingly around this print, even though the headline number does have a history of surprising to the upside.
So that's the macro. On the micro, some of the individual names we're going to be watching in the tech space here in Europe. ASML in focus. TSMC coming through with some strong sales numbers, an increase of 30%. Sales rising 30% on strong and sustained demand for AI chips. We'll see if there is a positive read-through for ASML. We're watching Sanofi as well. That is potentially a stock that will face some pressure. It's halting an autoimmune disorder drug trial. Latest setback for the company after finding that evidence that is not working, so that is a potential drag on Sanofi. Watch that stock. Also watching WH Smith coming through with a potential impairment charge and may also be raising additional capital. The impact in the Middle East weighing potentially on that company's numbers, so we watch that stock as well, Hannah.
OK, so tech in Europe in focus, drug makers in focus. They were yesterday, again in focus on the back of that Sanofi story, and a bit of focus on UK retail as well, perhaps, or global retail, in fact. Let's have a look at the start of the European trading day. We are out of the gate, and the FTSE 100 first to move, pretty flat actually this stage of the trading day, perhaps reflecting the fact that we've got some mixed inputs, if you like, to the FTSE calculation this morning. On the one hand, US markets went higher after the European close yesterday. On the other hand, the FTSE set to underperform, perhaps on the back of some of the mining moves, the oil price moves. Perhaps that's all part of the conversation as well. So the FTSE 100 up, though, by 0.2%, and in fact not underperforming the rest of the market. So the futures had suggested that maybe we would see that. But no, the FTSE kind of in the mix with the CAC 40 and the Xetra DAX, both of those moving higher this morning. The IBEX over in Spain up by 0.4%. Thinking about where the US futures picture is, though, Tom, and thinking about the still big unknown in the trading day ahead, which is the US CPI picture, raises questions about whether these gains in the European stocks are maintained. But for the moment, we move higher.
And again, I'll repeat, the European stocks have outperformed their US counterparts so far this month. We'll see if that continues. Across your sectors, travel and leisure at the top of the list, gains of 0.6%. Also coming through with some relatively decent upside is tech as a sector that is seeing some upside as well, up 0.4%. Auto is also gaining 0.4. On the downside, just two sectors so far in terms of what we're seeing on selling. Telecoms down about 0.1%. Utilities also down just 0.1%. But broadly, this is very modest upside that we're getting across most sectors. Again, just two sectors in negative territory, and across the benchmark gains of around 0.2%. And we're also watching some individual names, of course, the likes of ST Micro and ASML in the tech space.
Yeah, absolutely. Yeah, it's interesting on a day where US futures are pointing quite decidedly to the downside now, down by 0.5% on NASDAQ futures. Europe is maybe increasingly going its own way, and we see most, as you say, most sectors in positive territory. Yes, there's catch-up from yesterday's US trade, but it's interesting nonetheless. Utilities and telecoms, as you say, the negative sectors this morning. Let's get some further analysis of what's happening on these markets then. 8:02, so 2 minutes into a European session that shows modest gains on this CPI day over in the US. Marina Zavalock joins us, Chief European Equity Strategist over at Morgan Stanley. Marina, nice to speak to you on this programme. Thanks for joining the opening trade. So I guess I want to ask you first off about the detachment between European stocks and the global narrative, because it seems on quite a few occasions we come in and we can join dots between what we're seeing in Asia and the US, but it seems to sort of bypass Europe. And some days that's great for Europe and some days that's not great for Europe, depending on where the rest of the global markets are moving. And often it has to do with tech. So how do you play Europe in that context?
Yeah, I mean, maybe I'll explain that dynamic first, which is that basically earlier this year, we had a lot of diversification flows coming into Europe. And since the Iran escalation began, back 3 months ago, that completely stopped. So all the flows basically started to go into the U.S. week after week, flows into the U.S., basically nothing into Europe. So then when you have a market pullback, we're not participating as much in the pullback because we didn't participate as much in the rally to begin with. And then within Europe, I mean, you could take a tactical view. You can kind of look through the current volatility. We prefer to do the latter. We just refreshed our sector model. We would actually, on this volatility, we would be doubling down on the AI complex within Europe. So we've already liked the semis number one in our model, but
yes.
I mean, the fundamentals are just outstanding, and they're just going higher.
Okay.
We also like mining. We would be buying it on this dip as well.
Okay.
Capital goods, we just upgraded.
So let me ask you about that, about Europe's AI complex then. Is that trade, is it linked to your view on the AI theme more broadly, or is it for the reasons that you've described, the fact that Asia and the US have moved in different directions sometimes to Europe? Is it kind of detached from your broader global AI view?
It's linked to the global view, but of course in Europe we don't have as much retail participation, so we've lagged the moves in the US and in Asia. So it's linked to the global view, but it's not as volatile in the current market volatility. And it has more catch-up to do as a trade. The AI trade overall is going to continue to broaden.
On the European AI theme right now than the US one, based on pricing and how far they've come?
I mean, me personally, I have a lot of conviction on the European AI trade, but I haven't compared them side by side because I focus on Europe.
How broad-based is that view on European AI? And are there parts of the stack that you want to be leaning into more than other parts? And you pointed out there's a smaller number, clearly a much smaller number of players. So is it a fairly broad-based view? Anything related to AI that sits within European tech, you want to lean into that, or is it do you bifurcate it a little bit?
I mean, there's definitely different pockets.
Yeah.
So there's the AI capex trade, where in the US you can argue that half of the market cap, at least, of the S&P is exposed to this AI capex trade. In Europe, it's about 15% of the European MSCI Europe or SXXP. That's our favorite part of the complex, and that's especially semis. And there's various cap goods, which are now the largest weights in the cap goods index. There's powering AI, that's utilities.
Yep.
That's taken a bit of a breather, but we still like it longer term. We think it's kind of a grind higher trade. And then there is AI ROI efficiency, which is less of a focus for the market, but we really like the banks for multiple reasons, one of them being that they're the first in line to see the ROI benefits.
The banks
are
the first in line
Europe.
to see the ROI benefits of AI?
Yes.
That's interesting. Is your call on miners, your positive call on European miners, is that also an AI story?
That's also, copper, our commodity strategist estimates about 1/3 of demand growth is AI linked, but copper has other drivers as well. There's supply constraints, supply disruptions. There's a lot of inventory building both in China and in the US. So it's a dynamic story, but it is AI related.
Can I ask Marina what kind of upside you would expect to see for European stocks if we see some dramatic developments in the Middle East, by which I mean a medium-term peace deal, even just a short-term extension of the ceasefire?
Yeah.
What kind of expectations should we have about the upside that still remains for European stocks on that kind of theme?
Yeah, so if we had, say, an MOU agreement announced one day here in the future, then we think this would unlock inflows that have been lacking in European equities and a broadening. And the upside we estimate just in the short term from that kind of tactical dynamic is 3 to 5% tactically. And then longer term, we have 10% upside to European equities, but probably upside risk to that.
Is there a limit to the bounce because of a perception that perhaps this war, this issue could return? You know, the Strait of Hormuz has been closed, and so it could be closed again.
Yeah, I think there's the initial trade on any deal, which is the market will just assume that it will remain, you know, the deal will lead to a resumption in flows. And we'll have that 3 to 5%, you know, sharp spike higher. Probably half of it will happen day one. And then there's the trade after the trade, which is thinking about, well, how quickly will the Strait of Hormuz reopen? And how much of this has already been priced in, because we've had various waves of the market pricing in imminent deals.
We're looking ahead, of course, to the European Central Bank and its action tomorrow, and markets not quite consensus, but almost there in terms of expecting an ECB hike, and the market's pricing in more than 2 hikes this year. So I'm thinking about the European economy, I'm thinking about discretionary. Is something like discretionary something you'd steer clear of? How are you thinking about the European consumer and sectors related to that?
We're underweight discretionary retail. It's a tough environment. I mean, a lot of the macro indicators that are Europe specific are deteriorating. Hiring is slowing down. It's one of the, in general, I'm not very worried about ECB hikes. in general for the index, as long as it's moderate level of hikes, it's good because we have a lot of exposure to banks.
Yes.
But for these smaller pockets like discretionary retail, real estate, I would steer clear, and we're underweight.
Discretionary retail, real estate, but banks get another boost, not just from AI and ROI, but also higher rate environment.
Yeah, definitely. Higher yields, steeper curves, very bullish for banks.
So you like the banking sector. What's your concern? What's the thing that could undermine the way you're thinking about European stocks right now? So we've talked about AI, we've talked about banks, talked about mining, and I guess one of the big challenges is what's going on in the Strait of Hormuz.
Yeah.
There's a huge amount of new listing coming to the market around AI. What worries you about your strategy at this point? What's the biggest unknown?
I mean, my biggest concern is that every year for the last 10 plus years in the summer, Europe trades choppy and sideways in aggregate as an index, choppy, sideways. You know, one day we're up, the next day we're down. Even under the surface, you will have momentum unwinding, you know, the short momentum leg squeezing one day. So it's a bit of a directionless environment, period,
that's
seasonally.
World Cup.
Yes. Yeah.
Although
Anna's obsessed with this story.
I am obsessed with this, but I mean, it does often distract. I remember working in a bank, and the bank had to put on screenings because they anticipated that if they didn't, people would leave the building.
Yeah, we have all of our flags going up in my.
Yeah, you see, you know, it can be
Anna's front running the fact that you're going to be
It's a huge
distracted.
distraction. Yes, I am. I'm making excuses
Many
to
of us will
myself,
be.
perhaps. Although I will say these things happen late in the European day, don't
Yeah,
they,
so
this time around. So maybe it's not quite the distraction.
But back to your question, I'm less concerned about material downside. I'm more concerned about a lack of direction, choppy sideways markets, and that some of these fundamental drivers that I'm talking about, they are more material. I mean, Europe tends to take a life of its own at the end of the year and in 1Q. So just having to wait for that period where we can focus on European drivers.
Just picking up on the World Cup again, Marina. Is there a case that you could see some consumer stocks jump on the back of the World Cup?
I think less so in Europe.
Less so in Europe.
Yeah.
Okay. Don't lean in necessarily to the drinks makers of the Netherlands and elsewhere. Marina Zavalok, thank you very much indeed. Really interesting views on the European equity space as we see that outperformance, at least this month, European stocks versus the US. Morgan Stanley's chief European equity strategist. Let's look at the core six for today then and check in on some of those movers. Standing out right now, Nestle actually, talking the consumer, up 1.2%. So a decent session so far, a decent print at least, early days for Nestle. On the downside, you're seeing a bit of pressure when it comes to that AI story, because Schneider Electric does have exposure to data centres, currently down 1%. ASML also a little weaker, despite the strength coming through from TSMC and their sales on AI demand. ASML is actually down 0.3%. Rheinmetall on the defence space, that's been under pressure in recent days, currently down 0.3%, but a decent session for LVMH, up 0.9%. And Novo also getting a lift, up 2 points. Let's cross over to Alex. Alex Morgan standing by with some of the other names on the move this Wednesday. Alex.
Morning, Tom. Yep, WH Smiths, as we were talking about earlier, expected to get a hit this morning. They're down around 15%. Now, they've had, if you like, sort of a profit forecast cut. They've had that capital raise and an impairment charge, now 16%. So the stock very much in the red. WH Smiths, of course, having moved to focus on the travel sector being one of the areas hit by the conflict in the Middle East. All right, let's flip it over and have a look then at other stocks on the move this morning. Sanofi, now, you were talking about them. Of course, they've had a new hit for the CEO to deal with, down around just under 1%. That was focusing on the autoimmune drug that's just been pulled, so that's another headwind for Sanofi. Turning over then to have a look at something else, another one on the move this morning. Yeah, ST Micro, this is an interesting one, up around 2%, this course on the semiconductor trade. And just finally, we've got Adidas, which are on the move this morning. Adidas, you were talking about the World Cup there. I can tell you, as an Englishman, it's always a nervous time around the World Cup. But Adidas around 1% up this morning. They had an upgrade to buy from BFOA, and that's putting them alongside some other names like LVMH. So Adidas in the green, WH Smith this morning very much in the red, Tom.
I'll pick up, Alex. Thank you very much, Alex Morgan, with your movers and ahead of the World Cup, of course. Coming up on the programme then, we'll be back to the tech theme. Anthropic releases its latest AI models, but there's one big caveat. Find out what next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We are 16 minutes into today's session. You're seeing some modest upside coming through for European stocks across the benchmark, up 0.3%. Of course, investors, many of whom will be holding their breath ahead of inflation data out of the US. The biggest gains coming through right now for the FTSE MIB over in Italy, up 0.6%. Here in the UK, the FTSE 100 adding 24 points at 10,251.
Let's talk about some corporate news flow here in the UK. The owner of Boots is reportedly in talks to sell the business for around $10 billion. That report coming from the Financial Times, which says that Sycamore Partners, which took control of Boots last year, is talking to parties including the billionaire Weston family and the Australian pharmacy group Sigma Healthcare. Let's get more then with Jennifer Creary, Bloomberg's global business reporter, who is with us to give us the latest on this story. So why could Sycamore Partners then want to offload Boots? Jen, bring us up to date.
Well, because it could be potentially very lucrative. So a potential sale of Boots could come in at about $10 billion. That would make it the largest for a UK retailer since 2021. That's when private equity firm CD&R bought supermarket chain Morrison's for $9.4 billion. So in a way, this is Sycamore's modus operandi, right? They want to cash in on Boots' recent turnaround through either an IPO or a sale. Boots itself is set to get a new CEO. It's got Alex Baldock coming in, formerly of Currys. So Sycamore would be going out on a high. I think what's really interesting here are the prospective buyers. So the FT is reporting that Sycamore is in talks with the billionaire Weston family. So they're the owners of Associated British Foods, as well as the Australian pharmacy group Sigma Healthcare. Now, the FT is also reporting that talks with strategic buyers started before Easter. So what does this tell us? If the Westons buys Boots, it'd mark the family's return to UK retail after it sold Selfridges for £4 billion in 2022. And if Sigma buys Boots, then it would signal an acceleration of the Australian group's international expansion. So Sigma recently formed a joint venture with a chain of pharmacies in and around London called Greenlight Healthcare. So this isn't the first time that the city has seen a potential proposed Boots sale. Walgreens first explored a sale of the chain in 2022, but the sale process was pulled after bids failed to meet expectations. So let's see if things change this time around.
So, Jen, we can rule out an IPO for now. Is that pretty clear? That sounds like bad news for London, at least for our capital markets.
Yeah, exactly. So if an IPO doesn't take place, it would come as a blow to the City of London. So bankers were hoping that several kind of household names, including Boots, Waterstones and Superdrug, could really buoy London's IPO drought. So it would certainly be a disappointment, but it's also worth noting that the FT report says that these talks are at an early stage and no decisions have been made over a sale yet.
OK, yeah, an important caveat. Bloomberg Global Business reporter Jennifer Curry, thank you for getting us up to speed on that story. Meanwhile, let's get back to the IPO story that we know is going to happen, which is SpaceX, the IPO on Friday. Concerns, of course, are being raised about the potential impact of demand then for the company's shares from index tracking funds. With us now is Bloomberg Equities reporter Henry Wren. Henry, what are the concerns when it comes to SpaceX, its IPO, and how these funds, ETFs and others, index funds, are exposed to that stock or will be exposed?
Yeah, so many of the index providers, they have announced that they are going to fast-track SpaceX into their indexes, right? So that includes the likes of NASDAQ and FTSE Russell. So when you think about it, according to third-party research, about 30% of SpaceX float will be bought by those passive funds in just 15 trading days, a very short of time. So we're talking about, in terms of volume, about $22 billion here. So why is this important? Well, think about it, because those passive funds, because they're buying based on rules, so they will automatically generate upward pricing pressure in SpaceX. But also in the meantime, if you're an active investor in anticipation of passive buying, you would also buy as a result, because you're thinking of there could be upward pricing pressure, so would buy into it as well. So this upward pressure is self-reinforcing. And then we look at the other side of the market, the other stocks, because for index funds to buy into SpaceX, they would have to use the other stocks to fund their purchase. And for the sake of that, they have to sell the other stocks, so other stocks may face a downward pressure instead.
Yes, so the portfolio effects of all of these big listings, certainly an area of focus, Henry. And so the AI build-out is part of the SpaceX narrative, and it's certainly been something that has been supporting some of the AI universe within Europe, and ASML is one of those. You've been writing about ASML. I was looking at the year-to-date gains for ASML, up by more than 60%, but that's not actually that impressive, is it, given the company with which ASML sits?
So on the surface, indeed, like ASML, as you mentioned, up 60%, near a record high as well. One of the Europe's pride, for sure. But if you compare to the other folks in the industry, like, for example, its peers like Applied Materials or Lam Research, or its key customers like Intel and Samsung, its gains are lagging. Actually, our data would show that on relative basis, ASML's valuation is close to a decade low versus its key semiconductor equipment peers like Applied Materials. So what's really going on here again? So there are some concerns in the market about its supply capacities. So obviously the demand is very strong. It's not a concern. But how fast can ASML ramp up its supply? This is question number one. And question number two being, like, how, in terms of its key customer, TSMC, how fast it could adopt its next generation of EUV machines, its most cutting-edge, advanced chip-making machine. So that's another question as well.
OK. Henry, thank you very much indeed with the deep dive on ASML, well worth a read, and the potential market implications, of course, of SpaceX and its IPO. Bloomberg Equities reporter Henry Wren. Sticking with tech, the IBM CEO says AI will change the shape of workforces but won't necessarily lead to fewer jobs. He was speaking exclusively to Bloomberg's Romain Bostick at the Mizuho Technology Conference in New York.
I'll give you an example. So you can certainly improve productivity of individuals. We'll call that productivity apps. That's where both economists and CFOs get very concerned. But where's my bottom line on that? Is it leading to less expense or more revenue? Where is that? And that's hard to find. But let me give you a second example, and you'll say, OK, I can see that. We are pretty acquisitive. Anybody who does M&A, you often bring the entity in, and actually normally your profits might decrease for the first year or two until you take all of the cost and get the cost synergy. Using AI tools now, we can probably add 10 points of profit synergy on day one, because the amount of time it used to take to move contracts over, to do all of the sales automation, to do all of the revenue forecasting, all of that now using AI can be shrunk down to literally a few weeks. If you can do that, I can now take that 10%. I'm not saying it's 90%, but 10%, and invest it instead in marketing and R&D and innovation to drive the revenue growth even higher. That's an example of what I mean by use the AI to really fundamentally change how you do business. It's got to become part of your operating model of the company.
Are you taking that medicine yourself internally?
We are. In the last acquisition we did, we actually managed to take out about 60% of the G&A on day one.
What's the message, though, that you have, not only for your partners, but also internally for your own workforce with regards to how this actually not only helps, but maybe the idea that maybe it requires a smaller headcount?
It's not necessarily going to be a smaller headcount. So a lot of people talk about this. So let me give you an example. On college hires, we tripled our hiring in 2026 compared to 2025.
Okay.
Is the
for entry-level positions?
For entry-level positions, tripled. Absolute number, tripled. So you look at me and say, why? Because my belief is if these tools make people who are coming in out of college more productive, quicker, that means we are going to be advantaged by having more capacity to build things at a cheaper cost point, which means we can go get market share. Will the shape of the workforce change? Absolutely. But I think there will be more people in the value-driving functions, be it R&D, be it sales, be it marketing, and the creative activities. And some of what I would call classic back office will decrease because you don't need so much there. So the shape of the workforce changes. Total employment is not decreasing.
Okay, IBM CEO Arvind Krishna speaking to us exclusively with views there on how AI will reshape the labour market. For more on the tech outlook here in Europe, and particularly London's role in the AI boom, check out the latest episode of Bloomberg Tech Europe. It's at 8:30 a.m. UK time, airing this Friday.
They come around quickly. Excellent. Essential viewing on the tech story. Coming up on the programme then, Tom, we're going to get into the subject of private credit, and that links to technology, doesn't it? Because at the beginning of this year, we spent so much time talking about the links between software and private credit. That led on to lots of conversations about retail investors trying to get their money out, about gating, redemption requests. A feature, not a bug, is the message you were hearing earlier on from Apollo.
Yeah, Scott Kleiman of Apollo saying that there will, though, need to be, because of the lack of exits, at least in the industry as a whole, some capitulation, particularly as interest rates normalise. So we'll have a lot more on that. We're going to head back to Super Return in Berlin. We're going to be speaking, Danny Berger, to James Reynolds from Goldman Sachs Asset Management. Going to be asking him why he sees resilience in the private credit market. That is next. This is Bloomberg.
We are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with the debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
You're back with the opening trade, 30 minutes into our session that shows Europe standing out from the crowd, really, when it comes to the global narrative around stocks. So Asia under pressure, selling in the Asia session. The US, it seems, the futures picture there looking weak as well. NASDAQ futures now down by 0.6%. So a continued focus on technology weakness. Now, to some extent, Europe has not played in the technology boom as much as other parts of the world, as we were hearing from Morgan Stanley earlier on. So maybe that leaves us with the ability to go our own way a little bit. For today, it's the CAC 40 that outperforms, up by 0.4%. Other markets in Europe actually pretty flat, but the CAC 40 lifted by a combination of energy stocks, technology. So those are the themes that lift us a little bit higher, with the DAX broadly flat this morning. Tom, what do you see under the hood?
Yeah, it's also worth noting volumes are down about 20% versus that 20-day average. So that's also a factor. Maybe a bit of a story around investors on the sidelines ahead of that big macro event, which is the inflation, the CPI data out of the US. Across the breakdown, though, that you're seeing across the stock 600, you are seeing the majority of stocks in positive territory then. 400 stocks seeing some upside. On the downside, 185. So that is the breakdown broadly in terms of gainers and losers. If we look at some of the individual names on the upside, interesting to see as we think about the NASDAQ 100 called lower again. ST Micro getting an upgrade from Bank of America. So that French-listed company gaining 2%. Again, on the AI story, so some upside there for one of the tech names in Europe. And it was interesting to hear from Morgan Stanley saying they are bullish on European AI names. Adidas up 0.9%. This is also an upgrade coming through, and a view from RBC that actually the luxury sector could turn around. LVMH then getting a lift on the back of that as well, up 0.8%, adding close to 4 points. On the downside, let's flip the board. WH Smith, potential impairment. There's the impact of what's happening in the Middle East. So that stock is down, and down hard, down 15% right now, the retailer. So global ramifications as a result of the Middle East and an impairment charge. That is a challenge. Sanofi is currently down 1%. It has halted an autoimmune drug trial, not getting the results it was hoping to get. So that is a negative for Sanofi. And Nokia, which was under pressure yesterday, it is exposed to the data center story, currently down 2.6%. And there is a view maybe that the TSMC numbers, with the read across to the sector here, maybe not quite as strong. Sales were up 30%, but maybe not quite as strong as some of the estimates out there. And Nokia potentially exposed to that story, currently down 2.6%. It has been a bit of a bellwether around the AI story. Anna.
It has. Let's get an update on some of the other stories we're following this morning. And we'll start with developments in the Middle East, Tom. US forces carried out strikes against Iran hours after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. In response, Iranian state media said the country hit 21 US targets across the region, including sites in Jordan and Bahrain. Supermicro shares fell in extended trading after it announced plans to raise $7 billion through a package of equity offerings. The proceeds will be used to purchase components needed to fulfill customer orders for its AI servers. Supermicro says it currently has around $39 billion in outstanding orders. And Taiwan is said to be considering tighter export controls on AI chip sales to China to further align with US measures. Sources say the proposal would restrict sales to all Chinese customers and allow authorities to prosecute chip smuggling as a criminal offence for the first time. The move is part of ongoing trade talks with the United States. Tom.
Now, the biggest names in private equity are back in Berlin for Super Return, the global industry's largest event. But with returns for investors dwindling in recent years, dealmakers are likely to face demands to hand their money back. Let's take you back then to Berlin and Bloomberg's Danny Berger, who is on the ground with another great guest. Danny.
Tom. Thank you so much. That's right. I am here in Berlin and so pleased to say that joining me now is James Reynolds, Goldman Sachs Asset Management Co-Head of Private Credit. James, thank you so much for joining.
Thank you for having me.
And there's a moment where it feels like your industry, at least the media attention, had kind of calmed down a little bit. But in recent weeks, more redemption requests, be it Cliffwater, be it from BCred, still this concern looms large. Does it just show to you that the kind of stress in the system, that it's here to stay for some time?
I don't think so. And first of all, we need to contextualize a little bit. You know, the media gets access to the BDC,
right?
Because only the BDCs do report.
Yeah, right? I should probably clarify the stress in the retail
raw materials, right? But that's only about 450 billion in a context. Direct lending is about 6 trillion, and I would also have the broadly syndicated loan market in that, because at the end the borrowers are the same. So that's 6 trillion. By the way, when we talk about private credit, and you start looking at private IG, investment grade, and also ABF, you're probably talking about a 30 to 40 trillion asset class. So we need to contextualize a little bit. Like the news flow is a narrow lens onto something that is much bigger, and it's difficult to extrapolate.
Well, perhaps the reason that it's been brought on this narrow lens is just the fact that this industry, not necessarily Goldman Sachs, but a lot of your peers, basically pinned their next leg of growth on retail, that this was the future, the democratization. And I just wonder if that narrative has also shifted, that this industry needs to take a step back. I mean, your co-head, Vivek, has been very clear, you know, the term, and you as well, that the term semi-liquid doesn't make sense. Gates are a feature, not a bug. Do you think that the lessons have been learned for this industry, or is there still some maturing that needs to be done?
Look, I think, and we've been very clear about these vehicles should not influence how a GP does invest, right? And, you know, there are a lot of benefits to these vehicles, but if you think about our platform, about 85% of our platform is made of different type of vehicles. You know, more sticky, long-term, patient, institutional type investors. And so it's very complementary to what we have as a platform, but it's not the sole driver of how we do invest, right? And that's really important for us, and that has allowed, you know, to create, I would say, further growth on our platform. But the growth has not solely come from those vehicles.
Got it. So is that basically...
And the mix is very different for us, is what I would say. I was saying to you earlier, 20% would be institutional investors in these in our private BDC. About 40% would be Goldman Sachs, wealth management clients. So the mix is a little bit different as well. And so you're starting to see dispersion.
So what difference does that make to you then if you do have some of these BDCs pulling back? Are you just seeing less people in processes, for example?
Yeah, so what happens, by the way, a lot of the attention is on the outflows. We really need to look at the outflows, the inflows, the repayment as well. So it's a more nuanced picture. But what it means is that there's less capital available to be deployed. If you think about the BDC industry as a whole, it went from 60 billion of AUM in 2021 to 450 billion roughly in 2025. So very active, and you could say that the marginal price setter was the BDC industry in the US. By the way, we're talking US here again. We need to contextualize. So right now, with that industry being somewhat on pause in terms of capital available to deploy, the yields have increased, right? Supply demands, the yields have increased 20% at least in the US compared to maybe 3-6 months ago. We have capital, we're deploying, we're very active. I was saying earlier that Q1 was our most active investing quarter. Our business is also very global and diverse. Doesn't rely solely on, our US BDC to be active. But yeah, this is a good environment for us to lean into.
When you think about activity levels for the industry as a whole, maybe they're more depressed. But I wonder for GSAM specifically, if you would compare this to a 2021, for example, which is how your volumes actually look, what would you compare this period in history to?
I would say first our business is much more diverse today than it was in 2021. We have new businesses that didn't exist for us in private investment grade, asset-backed finance. The main difference is that the capital structures today take into consideration the fact that the rates are higher, much higher than they were back in 2021. I would say M&A volume is lower. If you think about M&A volume in particular when it comes to private equity M&A, it's lower certainly than it was. But I would say because you probably have less availability of capital, certainly less from the BDC standpoint, again, the yields are more attractive overall than they were back in 2021. And so, we have the opportunity with kind of how the platform is set up to lean into a market where we think the opportunities are more attractive, or lean back, slow down, and that's what we've done, frankly, in 24, 25, in particular in the US. If you look at those kind of 2 years or year and a half, we invested more outside of the US, where we found better opportunities, better priced, maybe slightly more reasonable leverage levels. And now is a good time actually to lean back into the US.
So if a large part of that is because there are just less players who are present in the market, does that dynamic continue? Do you think it's an industry that shrinks even more than it already has and presents more opportunity for GSAM?
I don't think the industry is shrinking, by the way. I mean, again, you have to net the outflows with the inflows.
Sure.
Right?
But something's happening if it's just less competitive.
It's on pause. I would say it's on pause.
Okay.
I think it's a test for the industry. Performance matters, right? Underwriting matters, and you're starting to see dispersion in performance. I was saying earlier, we're starting to see a real flight to quality, in particular amongst institutional investors. They're looking at the performance and they're starting to vote with their feet as well. So I think the industry is on pause. I mean, we've been doing private credit for 30 years and 26 years for me. It's been a very good asset class, certainly for us, consistent returns, especially when you also adjust for the risk. So I would say it's not shrinking. We're still growing, by the way, certainly for us. I think the industry as a whole, maybe some parts of the industry, maybe it's more on pause. But if you think about private investment grade, asset-backed finance, I mean, this is also a growing part of this industry.
Well, one of the parts of the industry that it felt like it was on pause was tech-related deals are way down. Software valuations have come under pressure. How are your software companies performing right now? What does it look like on the ground?
Actually, our software sector across our portfolio is one of our best performing sector right now, and we just finished our portfolio reviews for the first quarter. We also learned to, I mean, you've got to be nuanced, right? I mean, not all software is created equal, and and we've had a framework for a long time, by the way, with dedicated teams, in the US and in Europe to software and healthcare, and our software investments tend to be very large, very entrenched, systems of record, mission critical, high risk of failure. And right now, the key question really for those companies and their owners is embrace AI. Embrace AI, embed AI in all your features, in your product suites. We're not seeing churn away to AI native. We're not seeing downsell because of AI, but the key is to embrace AI, and then hopefully we'll see, and we're starting to see it for the market leaders, acceleration of the top line, and then we'll see whether it also provides a margin boost in the next few quarters.
Can I just say, just hearing you being one of the leaders of private credit saying that software is one of your best performing businesses, it's just so counter to what we've been hearing at the moment. So does that mean that this is even a sector that could grow within GSAM, that it is successful clearly on your platform and you're not backing off of it?
Well, we're constructive about it. We also need to answer the questions from our LPs, and so we're being very detailed about this is the type of software that we like and that we would underwrite, and this is what we have shied away from, right? Also, these businesses that we have in our portfolio tend to have very high margins, they're very cash flow generative. I mean, they're really they're special businesses. And so, but there's a lot of education to be had as well with our own investors, right? Because they read the same headlines. The public markets, by the way, starting also to differentiate. When you look at valuations of software businesses, 3 months ago, the whole sector took a plunge. I think right now you're starting to see a real differentiation amongst the software companies.
On the point of margins, I wonder how much you're looking at the cost of compute. It feels like this narrative that is starting to creep in of these companies that are having to adopt a lot of AI. You hear stories of Uber runs through their entire year's tokens budget in just a couple months. Are you starting to see that filter through some of your portfolio companies, just how expensive it is to run some of these systems?
Not yet, I would say, but that is certainly a consideration for management teams and the owners. By the way, that's going to create a further barrier to compete and further barrier to entry, because scale does matter. When you think about the investment that you need to make here, the cost of compute, the tokens, I think that's going to favor the more scaled businesses. That's true to software, that's true everywhere. It's true in our industry as well.
So it just goes back, benefits Goldman companies yet again in this trend.
Yes, it will benefit the larger scale players, and I think that's true across most industries.
All right, James, unfortunately we're out of time. Thank you so much for joining.
You.
Really wonderful to
see you.
Great to see you as well. Tom, Anna, that, of course, is James Reynolds of Goldman Sachs Asset Management.
Danny, thanks very much. I'll pick up Bloomberg's Danny Berger live on the ground at Super Return, and her coverage continues throughout the day. We'll be hearing from guests including Victor Kozler from Strategic Value Partners and Thoma Bravo co-founder Orlando Bravo. Coming up on the programme, oil is ticking a little higher this morning, up 0.3% as traders weigh fresh strikes between the US and Iran overnight. The ceasefire clings on. We have the latest from the region next. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Welcome back to the Opening Trade. We are 47 minutes into today's session. You're seeing European stocks modestly higher by 0.2%. Strongest gains coming through for the Italian FTSE MIB, up 0.9%. Here in the UK, FTSE 100 is gaining 18 points. Anna.
OK, let's focus in on oil because it's ticked a little higher, actually, this morning, just up 0.1%, though, 91.63. But it's been quite a journey over the past 24 hours. We've seen the United States and Iran exchange strikes once again overnight. President Trump said the US retaliated against Tehran for shooting down an American Apache helicopter. For more, we're joined by Bloomberg's Abir Abu Omar, who's in Dubai and can bring us up to speed. I mean, we still talk about the ceasefire clinging on, Abir, even though we've seen the US and Iran exchanging fire by some definition, at least overnight. Bring us up to speed.
Good morning, Anna. So look, I mean, the question we woke up to this morning was what ceasefire really when you see these hostilities taking place over the past week and into this morning. So what happened overnight was that the United States troops had attacked Iran. Some parts in central Iran were attacked, according to IRIB, that is the state-owned media in Iran. And this is essentially what the U.S. had said. This is what Centralcom had said about the attack, saying that it was a proportionate attack in response to Iran downing a helicopter, a U.S. helicopter, yesterday. Now, President Trump did tell ABC News yesterday that he has to respond in a powerful way to the downing of the helicopter. This morning, Iran retaliated against the attack by attacking GCC countries. That includes the Fifth Fleet, the U.S. Fifth Fleet in Bahrain, and also a U.S. airbase in Kuwait, but also in Jordan as well. So you're seeing an uptick in these hostilities between the United States and Iran, following what we saw at the beginning of this week, where Israel got directly involved in Iran again by attacking central cities in the Islamic Republic, including places in Tehran, the capital. Iran retaliating by hitting northern Israel as well. Meanwhile, look, the incursion of Israel in Lebanon continues. It is the deepest in 25 years. That is a sticking point for Iran, where it said it will not come back to the negotiating table unless Israel's attacks against Lebanon cease to happen. But President Trump maintains that the truce talks are still ongoing, that they are continuing to be intense, and that is definitely something that we're keeping an eye on over the next couple of days.
Abir, what does this mean for the oil markets? There's some reporting that Kuwait is actually getting oil onto the markets for its Asian buyers.
Yeah, so look, Kuwait is providing about 4 million barrels of export crude or export materials crude to countries in Asia, including South Korea and China. This is more evidence to show that a trickle of shipment is coming back to the Strait of Hormuz. Now, inevitably, it's not what it used to be pre the war in late February, but we've seen signs over the past couple of weeks about movement coming back to the Strait of Hormuz. But again, look, as I mentioned, it's nothing compared to the movement, the normal movement of the tankers and ships in the waterway that used to carry 20% or so of the world's crude shipments. But something, again, to keep an eye on, it is a sticking point for President Trump to reopen the Strait of Hormuz if this MOU that we've been talking about over the past 2 months or so is reached, along with an extension of the ceasefire for 60 days, and then the other concessions will be discussed at a later stage, Tom.
OK, Bloomberg's Abir Abu Omar in Dubai with that update. Abir, thank you. Let's look at what else we are monitoring throughout the day. The Bloomberg Invest event continues, or at least begins, in Hong Kong. The annual super return is underway. Danny Berger's on the ground for us in Berlin with some fantastic conversations and insights. At 9 a.m. UK time, we're going to get Italian industrial production. At 1:30 p.m. UK time, it's the big one. Key data, of course, out of the US. May consumer price index data, CPI data, and aftermarket stateside. On the earnings front, Oracle's fourth quarter results.
Let's turn to Skylar Montgomery Coning from the Markets Live team for some analysis ahead of the key CPI print, which is coming out of the US later on. Good morning, Skylar. So what's your thinking going into this number? Clearly, we're impacted by Friday. The jobs report was really strong and had a big impact on markets. As a result of that, do you think we're primed to see more of the same, sort of doubling down on pricing in a Fed hike in December? Or is the risk that actually we see something dovish?
Yeah, I mean, I think it's a very, very high bar to get a dovish print. And I'll give you 3 reasons for that. The first is just the momentum and data has all been one direction, right? Economic surprises are positive. We've had 3 above expectations non-farm payroll prints that have been very strong in a row, and inflation surprises are already positive as well. The second is, if you look at economists' estimates, there's this bias to really believe in the Fed's inflation fighting ability. So if you look at economic surprises prior to 2022, 2020, through the 2010s, they were biased very much to the downside as the Fed kept missing its inflation target. In the 2020s, they've been biased upwards. So you've had inflation surprises very much tending to be to the upside. And then finally, I'll just say there's no world or no one expects a low inflation print or an inflation print that's in line with the Fed's target. So if you look at consensus estimates for headline CPI, that ranges 4% to 4.3%. So if your low range or your low estimate is 4%, that's still very concerning and tells you that the direction of inflation is upwards and hawkish.
Skylar, what happens to the 60-40 portfolio in this environment? You're seeing a correlation between bonds and equities.
Yeah, absolutely. So if you look at the 3-month correlation between bond and equities, since the Iran conflict started, that's been positive. And it's really worrying for investors because the idea is when you have inflation come in from a supply shock, that inflation being higher means that the Fed has to react hawkishly. That's negative for bonds, but it's also negative for growth, which isn't as positive for equities either. So they sell off together. So going into this inflation print, yes, we very well could get a downside surprise, and that would boost bonds and equities together, whereas an upside surprise would have them sell off together. But I think the worry from a portfolio perspective is that your bonds aren't insulating you anymore. If they're not moving in opposite directions, then where is your protection coming from?
Yes, a topic of conversation on this programme. Let's talk about FX and what is likely to happen with the dollar. So the dollar will be in focus as we get that data. We'll see what response we get there. But I wonder how much the AI dynamics are also sticking to the dollar as well. I mean, clearly the geopolitics also has been a driver of a recovery in the dollar over recent months. But the AI theme stands out to me. We're going to get the listing, of course, of SpaceX this week. We've got Oracle earnings coming later on today. So we've got news flow coming around AI, and I know Standard Chartered have been making this link between the dollar strength they see coming actually from the AI theme and the way that drives the US economy.
Yeah, absolutely. I think when I'm thinking about growth and inflation dynamics right now, AI is positive for growth in the US and it's positive for inflation, whereas the energy shock isn't as negative for growth in the US as it is elsewhere, but it's still positive for inflation. And the worry is when you have a supply shock, yes, it's technically a one-time supply adjustment. How long it lasts depends on how long energy prices stay high, but it can be persistent more so if growth is stronger, because that means that companies can pass on that cost to consumers. So the worry now is because AI is boosting the US economy, that inflation becomes more persistent. That feeds into your growth outlook for the dollar, so you get performance as well because people are wanting to buy US equities and US bonds with higher yields. But you also get yields moving in the dollar's favor recently. And so I think certainly the next few months, the outlook is very positive.
The relative outperformance of European stocks in the last 10 days, at least, does that unwind pretty quickly, given the dynamics you're pointing to in terms of AI in the US? Or is there space now for European stocks to start to put in a better showing?
I'm very hesitant on European equities. I think the growth outlook is quite negative because they're so dependent on imported energy. And the market's been focusing on inflation, rightly so, because inflation surges before you start to see that demand destruction. But we've had it long enough that you will get demand destruction. And I think people are saying, well, what if the bubble bursts? But if you look at the .com, when the bubble burst, European equities underperformed U.S. equities. So, if you're imagining a worst-case scenario, risk sentiment turns against European equities.
Thank you very much indeed. Skylar Montgomery-Koenig from our Markets Live team. That is it for the opening trade. Currently, European stocks are up 0.2%. U.S. futures pointing lower. The pulse is up next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The U.S. and Iran trade fire after President Trump blames Tehran for shooting down a U.S. helicopter off the coast of Oman. The SpaceX IPO frenzy continues to build ahead of its debut on Friday. Analysts warn demand from index tracking funds could drive up shares even higher. Plus, U.S. inflation is set to jump after a hot jobs report. Bond traders pricing multiple Fed hikes, with some seeing a move as soon as September. So happy Wednesday, everyone. Some will say that it's, bump day. So let's have a look at what the markets are telling us. We've seen quite a lot of volatility. The tech retreat has been deepening somewhat. Again, I guess traders pairing exposure ahead of day that is also expected to show that U.S. inflation has hit the highest level in more than 3 years. A couple of other things we're watching out for. Look, oil prices mostly weathering some of these retaliatory attacks between the U.S. and Iran. Brent at 91.42, and then gold. Spot of gold, we don't look at gold actually every day. Now, probably we should go back to that $4,179. When you look at the European markets map, again, stock markets seem to be turning a little bit more volatile, certainly than they did in the last couple of weeks. Traders, I guess figuring out this growing list of risks. So stretched tech stock valuations, but also escalating Middle East tensions, with the FTSE MIB and the CAC gaining between 0.2 and 0.4%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So geopolitics and tech definitely dominating the news agenda again. The U.S. and Iran have exchanged fire again, and we'll have the latest in just a moment. Meanwhile, traders await today's, of course, U.S. CPI numbers. Out in a few hours, we discuss all of this with BlackRock's Vasiliki Pachaturidi and our very own Simon Kennedy shortly. But first, let's continue our coverage of SpaceX's upcoming IPO. Concerns are being raised about the potential impact of sharp demand for the company's shares from index tracking funds. Well, we're now joined by our Bloomberg senior strategist, Neil Camping, who's been really looking at tech very closely. Neil, thank you for joining us. So what exactly are the worries?
Morning, Van. It's the question that's being discussed is potentially that the passive funds will inflate, if you like, perhaps to a degree artificially, the appetite for this particular offering. And of course, once the passive funds are then positioned into the stock, then where is the follow-up demand thereafter? Passive funds clearly are a very big determinant. I mean, we know that in certain instances, passives for certain funds are twice as big in terms of overall valuations relative to active funds. The key things to look out for in the next 24, 48 hours are messages around how many times oversubscribed the deal is. Speaking to an IPO specialist recently, suggesting to me that if we hear multiple times oversubscribed, that's low numbers of oversubscription. If they talk about 10, 20, 30x, then we know that there's a lot of appetite from retail, from institutions, active and passive funds. So we'll have to keep a close eye on the words used in press releases, press reports in the next 2 days.
So interesting. It's like central bank watch. Every word matters. So meanwhile, Anthropic is also set to release basically its latest mythos. Do you say mythos or mathos? Mythos. I say mythos, but I don't know the Greek way. Models. How are these different and new?
So the new models are basically the ones that we had in beta form earlier, and they were not available for public use because of the cybersecurity issues. The issues were they found that sort of other technologies couldn't find flaws in existing models for 40 years. They found them in a matter of minutes. What they're releasing now is products into the market. They've used examples where they can do a task in 1 day that has taken a group of engineers 2 months to do in the past. This is accelerating products to market, brings in revenue, and clearly is trying to widen the gap in terms of the revenue model versus rival OpenAI.
Neil, thank you so much. Neil Camping there with the very latest on some of the tech stories. Now, the U.S. launched strikes against Iran yesterday after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. Now, the U.S. Central Command described the operation as, quote, proportional response, suggesting that Washington was seeking to contain the confrontation rather than resume full-scale hostilities. Well, according to Iranian state-run media, Tehran later hit several U.S. targets across the region. So let's get the latest from Abir Abu Omar. Abir, what is the latest exactly on the ground?
Good morning, Francine. So look, some retaliation that has happened this morning from the Iranian side. This is after President Trump told ABC News yesterday that he will hit Iran in a powerful way because of what happened on the day prior, which is when Iran had downed an American helicopter. The crew members were safe, so they ejected. President Trump had said that a red line for him to return back to hostilities would be the death of American troops on the ground. Now, that did not happen, but he felt the need to respond. So the Iranian retaliation came this morning in the shape of attacks against some U.S. bases in the GCC. That includes Bahrain. The U.S. Fifth Fleet was attacked. Kuwait as well had a U.S. base attacked. And then we also saw attacks in Jordan. Iran, on its side, said it will not sit idle in the face of these American hostilities. But for the time being, it looks like the attacks on both sides have stopped. Meanwhile, President Trump did say that the truce talks are ongoing. Our own sources do confirm to us that the truce negotiations are intensely being held, with Pakistan still mediating. Now, we've been hearing this we've heard this a lot of times over the past few months, Francine. But for the time being, again, President Trump seems to be intent on getting this truce, or the MOU, as we've been calling it, that would reopen the Strait of Hormuz and extend the ongoing ceasefire, if we're still calling it that, for the next 60 days or so.
Yes, but where does it leave the peace talks?
So yes, look, they're still ongoing according to our sources, according to President Trump. Again, he's mentioned over the past couple of months that he wants to get this deal across the line. He's getting a lot of pressure internally as well, with those polling numbers coming in, and also the elections coming up in November, the midterm elections coming up in November. So he seems intent on getting a deal down the line. Now, there are some concessions that are left on the table. Lebanon, for example, sticking as the last concession point for the Iranians, that are adamant on not getting back to the negotiation tables unless Lebanon is stopped, unless Israel stops attacking Lebanon. Now, Israel does have its deepest incursion in Lebanon over the southern part of Lebanon for the past 25 years. Israeli Prime Minister Benjamin Netanyahu saying he will not stop those hostilities because he's seeing Hezbollah attacking the northern part of Israel. Israel is adamant on protecting itself against the Iran-backed militia in Lebanon. So look, the concession points are still very much on the table. We still haven't talked about the highly enriched uranium, the frozen assets, $24 billion of those, and also the oil sanctions that Iran wants to get through the line again. So those will come at a later stage, but for now, the MOU or the interim deal negotiations, according to the American side, according to our own sources, are still very much on the table, Francine.
Abir, thank you so much. Abir Abu Omar. Now, for more on the markets, we're joined by Vasiliki Pachatouridi, EMEA head of iShares Fixed Income Product Strategy at BlackRock, and Simon Kennedy, our very own senior executive editor for macro markets. He lives and breathes markets. So thank you both for joining us. Vasiliki, I mean, overall, look, we're expecting a CPI print in the U.S. It's unclear how central banks deal with inflation, but it's very likely that inflation is going up in the U.S. given the jobs report on Friday.
Yeah, absolutely. I mean, in general, we've seen a bit of a shift across central banks, both here in Europe, in the UK, and in the US, a more hawkish tone. We have a lot of meetings coming up. I would say that the message has to be one of patience and nuance. Yes, definitely, I can see the hawkish tone being validated to an extent, but policy is already tight to an extent. We know inflation is not purely demand-driven, it's supply-driven, and then the transmission mechanism from rate hikes is uneven. It doesn't hit necessarily the places where inflation is coming from. It's hitting the real economy first. But having said that, I do think that the case for owning bonds remains strong, and we do see that from bond ETF flows having had a record month last month in May. So there's still a lot of demand for income, resilience, diversification coming through from investors.
Sam, what are you looking out for in the next 24 hours? And one of we have brilliant pieces on Bloomberg, but one of my favorites was basically, if you look at the Treasury market, it's kind of telling the Fed they really need to hike.
Yeah, so if you look in the US 2-year, and we had this story yesterday, we've touched on it again this morning in the positioning, is that the 2-year yield is suggesting that the Fed is not restrictive, and therefore the message to Kevin Walsh as he takes over at the Fed is that at some point rates are going to have to be hiked. If you look at other parts of the market, they're looking at a series of hikes. Mark Cudmore talking earlier on Bloomberg about how either they'll hold or they'll do several. You can't just go one and done really in this kind of instance. So that's what markets are on guard for. And in the next 24 hours, the next few hours, as you say, US CPI coming up, and that's a really big. Above 4%, that's a really big number, and it's starting to, since that jobs report on Friday came in strong, people have tuned into this. There's definitely a sense that this is a big report than perhaps it was a week ago.
Do you think, I mean, could it be one and done?
I mean, we know that the Fed doesn't move in such singular ways. But again, I just don't think that we're going to see a Fed that is going to rush into it. Obviously, we're now in blackout period. Next week is also going to be the first meeting that we're going to see the new chair coming through. So I also think the next couple of Fed meetings are also going to be communication tests that will shape market expectations when it comes to the new composition of the Fed and the new chair.
So, I mean, what does it mean in terms of where you want to be positioned, for example, even in European bonds compared to treasuries?
Yeah, absolutely. As I said, I mean, we've seen record flows into bond ETFs. So, again, taking a couple of cues from what investors are really doing. A couple of things. Core exposures, they do definitely stay on the short to intermediate part of the curve. People want to earn income, but they don't want to take big durational bets. I don't blame them for that. Cash is kind of increasingly being seen as a source of return. The front-end rates are very elevated. And we are starting to see some re-risking in parts of the credit market and also emerging market debt. But again, investors are focusing very much on the carry as opposed to the idea of spread compression, which we know spreads are very tight right now.
Simon, when you look at the big driver in U.S. economics, I mean, how much of it is actually AI? So the idea that, equities are supported, people feel richer, they spend, and that's fueling inflation, but also growth after that blowout jobs report on Friday.
So, yeah, the recent debate is that maybe AI is more inflationary in the short term. The dream that Kevin Walsh has talked about a bit, the AI being this productivity miracle that we saw in under Greenspan. It's going to take some time for that. While we're investing in data centers and the like, there's going to be inflationary. But certainly the wealth effect is a big one, and we see stocks continuing to go up. And certainly, we talk about the K-shaped economy. Certain elements of the American economy are feeling very happy about what they're seeing in their pensions, in their 401s and the like. And so that does lead into a kind of an inflationary environment, a spending environment, and one that kind of boosts inflation at the same time gives markets that long end we've just talked about some slight concerns.
Vasiliki, I mean, I guess two questions. On the back of that, we have a brilliant opinion piece by Clive Crook saying, let's count the ways that Kevin Warsh could disappoint and will disappoint Trump. But actually, my question to you is that if the Fed hikes maybe more aggressively than we had expected, what does that mean for Europe?
I think, I mean, the idea, like some of the more structural issues that central banks are facing, economies are facing, the developed market is facing, remain quite similar in the sense of like fiscal sustainability is something, it's a transatlantic phenomenon. So again, kind of Europe, we know that tomorrow is pretty much locked in. September is on the table for the ECB, but I just want to emphasize that, you know, it's all about inflation. That's the primary kind of issue, the driving data point. But the indirect effect of inflation, the secondary market effect of inflation, they can take us up to the end of 2026 or early 2027. So timing has become uncertain as well, and markets don't like uncertainty. But on par, I would say we prefer duration in Europe over duration in the US, and we are even more cautious about long end duration from US Treasuries as opposed to European government bonds, which have been very well bid and very much in demand.
Is emerging market debt actually becoming more attractive in this kind of environment?
Yeah, I would say so. Again, selectively, we've seen emerging market debt, particularly local currency debt, performing really well. Like real yields remain quite elevated, and there are pockets. There are markets within that I would urge kind of investors to look that have different fundamental stories than the US and Europe. And a good example of that is Brazil. Obviously, real yields are the highest amongst all sovereigns, and also Brazil is the only economy, EM economy, that is expecting rates to go lower over the next 12 months. So again, the issue of diversification, we talk a lot about diversification from fixed income being challenged, but again, within fixed income, there are pockets, areas of the market that people can diversify, and of course, other asset classes that offer that as well.
And Simon, you and the team are, I know, looking at dollar. Is there anything else that we should be looking out for in the next couple of weeks?
Yeah, I think the interesting thing on the dollar, and ING was talking about that this morning, is that the big debasement trade that we were talking about a year ago has kind of been put on the back burner as people see the Fed talk about inflation, talk about the Fed raising rates. So there has been this kind of a little bit of a platform for the dollar. Whether it continues, whether we kind of get back into the US exceptionalism debate, remains something to be seen, but there's certainly some support there for the dollar from this environment.
All right, thank you both for joining us. A great way to get us started on this Wednesday morning. Vasiliki Pachaduridi, EMEA Head of iShares Fixed Income Product Strategy at BlackRock, and our very own Simon Kennedy, Bloomberg's Senior Executive Editor for Macro Markets. Coming up, private capital is in focus as the boom shows signs of faltering. We're live at the world's biggest private markets event for an interview with the Fortress Co-Chief Executive. That's coming up next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is The Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Now, the private capital industry is convening in Berlin at an uncertain time following warnings of a credit market downturn and some significant write-downs. Redemption requests that were previously contained to U.S. private credit vehicles have spilled over to Europe. Well, let's head to Super Return, where Danny Berger has a great guest for us. Hi, Danny.
Francine, thank you so much. I'm so pleased to be here this year at Super Return with Jack Newmark. He is, of course, the co-CEO of Fortress Investment Group. Jack, wonderful to see you. Thank you for joining.
Thanks for having me on.
And look, this is an industry where I think there's a lot of contemplation as to whether the pain for credit right now is very much so just headline driven, or if under the surface there's a real reconsideration that needs to happen. Fortress is interesting because you can often take advantage of other people's pain and maybe stress in the system. I just wonder, is there stress in the system at this point?
Yeah, so I think the way we think about it is that there's certain parts of the private credit market that are going to go through disruption. I think the software part of the market is the most obvious one right now. But when we look at credit more generally, there's a lot of sectors that are still performing really well. There's a lot of opportunities to go originate loans that we think are good risk-adjusted returns. But there are parts of the credit market that I think started to get a little bit toppy, and there may be some repercussions in those.
Well, what do
sectors.
Repercussions look like?
I think it's going to be lower recoveries. Namely, I think there's going to be defaults in the software sector, but I think you really have to watch what those recoveries look like. And I think the severities in some of these software loans could be more extreme than what we've seen in the past. And for managers that over-concentrated in those sectors, that could obviously have an effect of having their underperformance be more material than it would be in other credit cycles.
It does feel like a lot of the conversation has been defending software and saying, look at our underlying portfolio companies. They're still performing healthy. I wonder if the reckoning has actually happened yet. Because, again, the conversation is there, but has the actual reckoning occurred of looking at some of these loans, which, again, defaults and recoveries are going to look poor?
Yeah, I think it's more the anticipation of what could happen at this point. I don't think you've necessarily seen a lot of these software companies get in a position where there's actual bankruptcies on the near-term horizon. But I think when you look at where some of them are heading, especially the 2020, 2021 vintage software loans, I think people are fairly highly confident that there's going to be defaults that come and that there's going to be some bad outcomes for those loans.
Do you think that has an overall effect on the industry itself? Maybe an icing over, especially for funds who were over-indexed to software? Does it have wider ramifications than just those individual performances themselves?
Yeah, I think in terms of future opportunities for certain managers, it could have an impact. I think when people think about credit, they want diversification, they want good portfolio management, and over the last 10 to 15 years, there hasn't been a big difference in managers, and you could over-concentrate your book, you could take certain risks, and it ultimately didn't show through in the returns because we had such a benign credit environment. I think now the world we're heading is going to be one where there's different return profiles for different credit managers, and some credit managers are going to have to justify the fact that they got over-concentrated in certain sectors.
It's interesting you talk about this because a lot of people have said it's time now for diversification. We learned that over-indexing to software was a mistake. What do you then make of some individual funds piling so heavily into AI and AI data centers? I know this is something specifically Fortress is not doing. So are you seeing something others aren't and staying away from this trade?
Yeah, look, I think that some of these data center trades are really compelling. If you look at the counterparty risk, they're incredibly high quality counterparties. They have lots of access to capital. That can make you feel very good. I think from an equity perspective, investing in some of these AI opportunities are clearly important for your equity return profile. But I think as a credit manager, our view is you have to diversify. I would not over-concentrate in software. I would not over-concentrate in AI. I think you just see that as a credit manager, there's real risk you could have underperformance if you make too big of a bet on any sector. So I don't see anything coming with data centers that are problematic. But when we look at our portfolio, we have questions about residual value, and ultimately we just want to be more diversified across a series of sectors.
So it sounds like it's fair to say that this is not something you'll participate in, or is there some elements that maybe you're eyeing that if you get comfortable enough, maybe with the digital economy, Fortress might?
Yeah, we've definitely done a couple triple net lease transactions with data centers. I think we look at smaller size transactions. We think those may be more liquid if you ever need to try to sell the underlying real estate. So I think that's one thing we focus on. And then we look at the overall concentration in the book, and we want to keep it relatively small as a percentage of our portfolio.
Well, I mean, you've seen, for example, banks have started also to become over-indexed to AI because of the bonds coming through the broadly syndicated loan market and some of the other deals. So they've started to sell SRTs, and some of your peers have been interested by this trade. I wonder what you make of that, of buying exposure that way via what the banks are putting out.
Yeah, it's similar to the data center trade for us. We don't want to chase trends. We don't want to over-concentrate. If we think we can get excess yield by doing something that's more unique to Fortress, that's what we're going to lean into. And so for SRTs, a lot of the underlying exposure you can originate on your own, and you can control the structure, you can control what assets go into it. You're not going to be a passive, very high attachment point lender, which is effectively what you are in an SRT. I think if SRTs were trading at high teens yields, I might have a different answer than I do when they're trading at lower double-digit yields. So for us, we'd rather just try to go create that exposure on our own rather than be a passive, highly levered exposure to something someone else originated.
Where on the platform are you most excited about? Where are you seeing some of the biggest opportunities right now?
Yeah, I think real estate credit has been one that we've been really focused on. I mean, that trade has gotten a little bit more competitive over the last 6 to 12 months. But I think if you look at where we are in the real estate cycle, lending against real estate right now, you're lending at lower LTVs than you've ever lent against. You're getting paid for the risk, high single digit, sometimes low double digit unlevered yields, and you're doing it on cap rates that are sort of at the bottom of the cycle. And so you have a lot of cushion in your real estate credit investment, and you can still get leverage on those loans from the banks to generate high teens levered returns. And so for us, that seems like a really attractive way to get exposure to real estate without having to make a bet on rent growth or cap rate compression.
I was going to say, just on that, how big of a difference does it make if we start to see hikes instead of cuts in this rate cycle right now for real estate and otherwise? The ECB will be meeting this week. The Fed right now, bets are on markets that they'll have a hike this year instead of a cut. How big of a difference does that make?
Well, it's going to hit everything if you have higher rates for longer. I think it's a combination of interest rates, inflation, and watching the consumer that we're really focused on. I think that there's a lot of companies that already have a very little cushion on their cash flow, and so if you have higher rates for longer, you have a little bit of consumer pressure because there's an inflationary environment. That could have real ramifications and could be a trigger for more opportunity on the corporate side or the real estate side.
Right, Jack, just about out of time. Thank you so much for joining. Really wonderful to see you.
Great, thanks, Danny.
Hopefully see you back in New York sometime soon. Francine, that is Jack Newmark, co-CEO of Fortress Investment Group.
Danny, thank you so much. Great interview, as always. And we'll get back to Danny with plenty more from the Super Return Conference in Berlin. Because up next, we have an interview with Victor Kozla, the founder and chief investment officer at Strategic Value Partners. That's coming up shortly. And this is Bloomberg.
is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. and Iran trade fire after President Trump blames Tehran for shooting down a U.S. helicopter off the coast of Oman. The SpaceX IPO frenzy continues to build ahead of its debut on Friday. Analysts warn demand from index tracking funds could drive up shares even higher. Plus, U.S. inflation is set to jump after a hot jobs report, while bond traders price in multiple Fed hikes, with some seeing a move as soon as September. So back to super return in Berlin now, where much of the private capital industry's top brass is convening this week. Weighing, of course, on private credit is the impact of AI risks on investments in tech companies. Let's get back to Danny Berger, who has another great guest for us.
Francine, I do indeed, and that guest is Victor Kosla of Strategic Value Partners. Victor, thank you so much for joining. I just say, you know, we were just talking about this. A lot of people love to talk about at Super Return that everything is okay and there are no issues. You often are more outspoken than most when there are pockets of stress, and you've warned of fat tails and maybe things are calm on the surface, but underneath the hood, not so much. Where do we stand in that at the moment? Are you seeing some still maybe red, amber flags underneath the surface?
Yeah, you know, we've got a real disconnect today, right? The economy's okay. Credit spreads at the headline level are tight, right? And then at the same time, what you have is you've got higher default rates. There are entire sectors, Danny, like private equity, like real estate, which are constipated, right? They can't sell. Private credit just joined the party a little bit too. So I think it's fair to say that there's a lot of stuff going right. I think on balance, it's also fair to say, my God, there are lots of the canaries in the coal mines are telling you a bunch of stuff.
That has to be an issue, though, because this industry needs to be exiting, right? That's the promise you give to your LPs. Well, what has gone wrong in that we got to this point, that year after year of LPs saying we want our money back, and we're still not at that point?
You know, when trillions and trillions of dollars of deals were done before the hike in interest rates in 2022, right? So 0% rates, people did all these deals. Rates are no longer zero. You've got valuation multiples are no longer what they were. For a lot of these businesses, you've got a problem. Now, add to that just more zip, right? You have a software shock. running through. 20% of software debt is valued, priced below 80 cents, suggesting distress. That much distress in software. There's an oil and gas shock, which is starting to reverberate through. Interest rates are starting to go up. So trillions of dollars of deals, interest rates changed, and now you've got these, it's amplified by these shocks, and that's the problem. You've got to find clearing levels for these assets if you want to sell, and the clearing levels are not what people thought they would be, should be.
Can I just go back? You mentioned within some of that there's a canary in the coal mine. Is that just the stuck assets or the canary in the coal mine, and what does that indicate to you?
No, to us the canary is really when assets are stuck. Assets are stuck because people can't get the price they think those assets deserve, right? Assets are stuck when, when you have a line of redemptions and you can't meet the redemptions and you have to gate, right? Those are very obvious canaries in the coal mine telling you there are lots of problems underneath this unruffled extent.
I guess also what I'm trying to get at is if there are canaries in the coal mine, what does it lead to? Like, what is the big disruption if at the moment it is just people not willing to mark down assets?
It started slowly, because people have been waiting for so long. It's starting. So can I tell you what we see?
Yes.
In our world, we lend money to people at 15% plus so they can hang on to assets longer. We go out and we buy assets, paying very little for the equity because they are so over-levered, and we de-lever them. And then we also convert debt into equity to kind of own the asset. That entire ecosystem opportunity set has just exploded in size. If you look at somebody like us, we started out 3-4 years ago with a pipeline of $75 billion. We have a pipeline today of $365 billion, right? And we invest $6 billion, $7 billion a year. So for us, and when we say a pipeline of $365 billion, it's moving. People are starting to recognize the issues, and every one of those transactions.
Does this go beyond software? Like how widespread is this? Or are there any other industries that this phenomenon is concentrated in? That are opportunities for you?
Danny, we've talked in the past. I know I can sound pretty brave. We have 0% exposure to software. When software goes bad, it just doesn't have cash flow go down 20%, it falls off a cliff.
But I would figure, Victor, like maybe there's some nice little juicy deals in there that maybe you want to get some because valuations have fallen enough. We're not there.
The businesses which get into trouble in software don't just get into little trouble, they fall off a cliff. So we've looked hard, we haven't done anything, and I bet you if they are talking a year from now again, I'll tell you, still done very little because the businesses which are in trouble are so damaged.
Well, where are the opportunities then you're finding? Any sectors in particular?
The real economy. For us, our focus over the last 10 years, 15 years, right? It is in buying into industrials, manufacturing, chemicals, consumer products. We buy a lot of real assets. Power plants, airplanes, toll roads, right? That real economy is kind of our focus. And Danny, for us, all these problems in software or oil and gas shock, this stuff, one tree does not fall in the forest all by itself, right? It reverberates through. Because the amount of capital available to do this stuff is shrinking so quickly, right? So the opportunity set in the real economy, it has just gotten so much better with these problems.
Is part of that also just because so much money is being funneled into AI data centers? Is there a kind of crowding out that you're seeing, that there's it's less competitive and you're seeing more opportunities in other parts of manufacturing because everyone's being distracted by this big shiny thing over here.
Yeah, it is. It's that. The data center, these guys are such voracious users of capital. Most firms now, they used to have private credit and CLOs and high yield. They've got a now special asset class called data centers, right? It just tells you the crowding out effect. I think it's a little bit more than that, though. You know, when you buy into these real economy assets or businesses, our view, you've got to fix them. They're broken. Some of the stuff which gets into trouble, good management teams are gone. You've got to often strengthen the management team. We bought assets like real estate, where leasing prices compared to the peers have dropped by 30%, and they shouldn't. So I think to our point of view, you need those skills to kind of actually work the asset. It's not just, hey, I'm buying a good asset cheap, right? And those skills are in short supply, right? So, and that to us is kind of, so the capital would like to do this, it just has trouble. Those skills are in short supply.
And AI can't do that yet. AI can't turn around a company yet and hire the right management.
They can't get leasing in a property up by 30%.
That's probably right. Victor, thank you so much for joining. Really great to see you. Francine, Victor Khosla of SVP.
A pleasure.
Danny, thank you. Danny Berger there in Berlin. Danny will have plenty more interviews throughout the day. Now, there's plenty more from Super Return, but in the meantime, we also really focus on Anthropic because the chief executive says AI will make the software industry larger, not smaller, although firms that don't adapt will disappear. Well, Dario Amodei spoke exclusively to Bloomberg Originals about how the company is working to align its business model with its values.
If you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, you know, we've seen the world of social media, the consumer world, it really seems to, you know, encourage engagement, even addiction, you know, the slop we've seen with AI video models. It's like, what's going on is it want to maximize the number of minutes that you're paying attention to because that's the advertising revenue-driven incentive. Whereas if we look at enterprise, look, I mean, you know, we want to make these models useful to people. We want to use AI to you know, cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to, like, you know, to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, like, the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But, like, I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
That was truly a fantastic conversation, and you can watch that full conversation on the new episode of The Circuit with Emily Chang. Subscribers can access it on the terminal, but also on Bloomberg.com from 1 p.m. UK time today. Now, coming up, quantum computing has the power to transform industries across the globe, but has yet to move from the lab to practical use. Well, our interview with the Chairman and Chief Executive Officer of IonQ is next, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurray.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
A quantum foundry that we have committed will be open to all comers that are acceptable to the United States. So the 36 odd companies that are here, we are happy to give them our best technology, the same as we use for ourselves at that level, that they all get access to.
And you say all comers as to what's been approved. This is the idea that this is about furthering the U.S.'s aims to make sure that they have an advantage with regards to what gets made, and I would presume so that it doesn't get in the hands of the countries that we don't want it to happen.
Well, I think that is easy. I mean, there have always been restrictions on advanced technologies that you cannot sell it or provide it to certain places. I think that is fine. But in a new area, it's really important to be first, both for the economic competitiveness long term, but also for national security. I think for those two reasons, it's imperative that we get there first.
Do you think the U.S. will be there first?
On quantum, absolutely.
You're not concerned about some of the reports that we've heard about some of the progress that we've already seen in China?
I'm paid to be paranoid, so I wouldn't say I'm not concerned.
Yeah.
However, from everything I can see, I think we are ahead. Are we ahead by a decade? Probably not. But are we ahead by a couple of years? That would be my guess.
Well, that was Arvind Krishna, the IBM Chief Executive Officer, speaking with Romaine Bostic about the future of quantum computing. Now, several large companies are racing to build working quantum computers, which they argue will transform finance, medicine, and, of course, cybersecurity. While some have demonstrated impressive advances recently, none have yet been able to demonstrate applications beyond research. Well, we're now joined by Nicolas Demasi, Chairman and Chief Executive Officer at IonQ. So, Nicolas, thank you so much for joining us. So this is exciting. We have a lot of research also that our Bloomberg Intelligence put together saying, if you look at the funding of quantum computing overall, we're looking at $17 billion. Why was IonQ not part of the recent Commerce Department funding announcements? Did you do that intentionally?
Yeah, so we're actually buying another public company in the U.S. right now called Skywater. There's SEC rules about issuing equity when you're in the middle of a merger. We raised $3.5 billion last year, so we have tremendous access to the private capital markets. We were the first public company in our sector. We're the largest public company in the sector. We've been at it for 30 years. And so, you know, for sure, we always look at our capital needs, and we also, of course, are very active on the M&A front. We bought Oxford Ionics, you know, here just a year ago for $1 billion.
So, I mean, the big question is, when do we really see it in real practice? So where do you see and when do you see, like, real-life application of quantum?
Well, IonQ demonstrated quantum advantage a number of times even a year ago on our 2024 machines. So we announced, you know, a 20x speed up in computational drug design with AstraZeneca, NVIDIA, and Amazon. We've made progress with ANSYS and Synopsys on computational engineering. We announced over a year ago that we were able to help LLMs speed up and reduce their error rates while they're learning by putting one of our machines on the loop. So IonQ is a very different category, I think, than most companies that, you know, you said a couple minutes ago, people were in the research phase. We've moved out of the research phase. We're into the engineering, manufacturing, and scaling stage. It's why we're buying Skywater. It's why we bought Oxford Ionics. You know, we started this industry 30 years ago. We're the first company that has published a shovel-ready blueprint of our full fault-tolerant system 6 weeks ago. And so we're really at the point where we can throw money at this scale-up, if you will, to go faster, and that's very much where we are right now.
Nicola, do you need others also to be successful so that investors really latch onto this? So on this program, we talk quite a lot about quantum computing. Not everybody does. So does it need to almost go more mainstream to have that, advantage?
Well, we were the first quantum company to reach 7 figures of revenue, 8 figures of revenue, and last year 9 figures of revenue. We very much, our ambition is to be the first to 10 figures of revenue. So it's becoming a real business. We were the first IPO in the sector in 2020. People used to ask me what quantum computing is 5 years ago. Today, your program speaks about it. And of course, governments are also realizing this is important for economic growth, national security, and of course, the jobs of the future. We've seen Prime Minister Starmer and Minister, Lord Valence, taking a great leadership position in the UK with programs such as their Procure and the National Quantum Computing Center. U.S., of course, is also running a DARPA, QBI, and other nations are realizing that resilience through quantum is very much an important national theme and opportunity. So I feel like it's going mainstream pretty quickly. I mean, people see tech trends and they can, envisage the future, and they want to capture that for their country and their company if they can.
So what does President Trump's funding of IBM actually mean for IonQ?
Oh, I think it's a great bet on both sides of the Atlantic on the growth, maturity, and opportunity for quantum leadership in the Western world, right? So our business is unique. We believe we're the leader in quantum computing and quantum security and quantum sensing. And we also have a merchant supplier function and product family that's important to IonQ. So we make the world's most accurate atomic clocks. We sell those to other quantum computing companies. Assuming our Skywire transaction closes, over the summer, we will then have the largest merchant supplier function in the world. And so a lot of these companies are actually customers of ours. We're supporting their growth as well. So, investment IonQ is an investment on the industry, not just IonQ's individual path to computing, sensing, networking, and so on.
I know you mentioned the UK, but how much of your business actually comes outside of the U.S.?
About a third. About a third. So we said about a third of our customers are international. About a third are buying more than one product from us across our quantum platform. And about 60% are commercial, is what we said on the last earnings call. So we're a business that has been, we've been first at everything. We turned our machines on in 2017. We've been doing useful things in the last 5 years. It becomes more powerful every generation of system. And of course, we were also the first to predict that the so-called Q-Day event was going to come, in the late 2020s, not the 2030s. And we're really making the future happen at IonQ with partnerships like Oxford Ionics, here in the UK. I was the only quantum CEO of the Technology Prosperity Act signing last September with Prime Minister Starmer and President Trump. So I think both nations recognize how special Oxford Ionics and IonQ are together. 1 + 1 = 30 is what I'm trying to achieve here for both nations.
So, Nicola, Q-Day, for those that are less familiar with the term, is basically the day where a quantum machine breaks the RSA encryption. I think Google's prediction is that it comes as soon as 2029.
Yeah. So we said end of 28 last year.
Yep.
I think a number of companies, were still thinking this was 2033 last year. And we said, look, we published our roadmap last year on June 9th. And we said, we're going to be able to do it by the end of 28, by the end of this U.S. administration. I think, like with everything we've done at IonQ, we always lead the way, and other people then agree with us, ultimately. And so, China's goal is 29, I believe, in their 5-year plan. I think Google agrees with us. I'll be unsurprised if soon the whole world agrees with us. But for sure, it's inside the planning cycle of CTOs, CEOs, and commercial companies. And governments also need to take notice of this.
How does quantum computing differ from, but also complement AI? And is there a bottleneck for acquiring talent?
Yeah, good question. So we're finding that the most successful adopters of our systems are the ones that are, of course, working with us on hybrid workflows.
Right.
So, you have a computer in front of you. The input machine is probably analog. You're calling the quantum computer. The output probably comes back to an analog computer. You need to have domain expertise, classical computing expertise, and quantum expertise. The intersection of those talent pools is certainly going to be, I think, some of the hottest jobs, in the coming years, and probably even, this century. I think the 21st century is going to be the quantum century. But starting, in the next year or 2 or 3, you're going to see that intersection of those 3 talent pools and that Venn diagram is where the kind of $100 million AI engineers today are going to be generated. So we very much are speaking to, you know, political leaders and, of course, commercial leaders about how we can work together to create those jobs. One of the most exciting things for INQ is we're not a job disruptor, we're a job creator. There's no jobs that are going away because of quantum computing at INQ. These are all brand new problems that currently take between a century and a millennium for a GPU data cluster to solve. We're trying to, you know, turn that into hours and days. So turning almost every impossible applied science problem for classical GPUs into a solvable problem. That means we're creating jobs, we're driving economic growth, and most importantly, we're keeping humans in charge. So there's no hallucinations, there's no correlation engine. You know, I don't know about you, but I'm not using AI for my, you know, my calendar because I can't afford hallucinations, you know, mistakes.
No one can afford hallucinations.
No one can, right? No one can. But quantum is old-fashioned computing. You know, you're in charge, you design the algorithm, you tell the machine to run the algorithm. It doesn't go off and try and do something else.
Yeah, very reassuring. Nicolas, thank you so much for joining us. I hope this is one of many interviews to come. Nicolas de Masi, Chairman and Chief Executive Officer at INQ. Now, there is a little bit of breaking news out of Iran. This is one of our biggest stories today. Iran is said to review the U.S. talks in light of the latest attacks. This is according to the state-supported IRNA news agency. Iran also saying that diplomacy does not happen in a vacuum. And this is a state-run IRNA agency citing the foreign ministry spokesperson. So we'll have plenty more on Iran throughout the day, of course, and we'll keep a very close eye on what's happening in the Middle East. Staying with tech, though, ASML's ascent to fresh record highs has boosted European markets, yet it's done little to improve what is the company's cheapest relative valuation in years. Now, while the Dutch firm's shares are up some 64% this year, the gain has lagged that of the broader U.S. semiconductor sector. So Sarah Jacob, our Amsterdam reporter, joins us now. Sarah, good morning. ASML up more than 60% this year. Its relative valuation is the cheapest in years. What exactly is going on?
Good morning. Yes, that's right. ASML stock has reached record highs. In fact, earlier this month, ASML became Europe's most valuable stock ever. And, you know, just to remind, you know, the viewers who are watching, ASML is the only company that makes extreme ultraviolet lithography tools. These are machines that are necessary and crucial to make, you know, advanced chips that power all these artificial intelligence applications. So we've seen the demand for their tools to be really high, the stock gaining still. Those gains have lagged its, you know, chip equipment peers, for instance, Applied Materials in the US, but also customers like Samsung Electronics. And a couple of reasons here. One of them, of course, is in terms of adoption of its, you know, next generation tools. Investors worry a little bit about the pace of that adoption. We heard from TSMC, its key customer, which said it would hold off on using ASML's or adopting ASML's high-NA tools through 2029. And there's also some concerns about supply and ASML's ability to capture this momentum.
Sarah, thank you so much for the great explanation. Sarah Jacobs in Amsterdam on ASML. Now, for more on the tech outlook here in Europe and London's role in the AI race, also check out our latest episode of Bloomberg Tech Europe with our Tom McKenzie. That's at 8:30 a.m. UK time this Friday.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Tensions escalating. Iran and the U.S. exchange fire overnight after Tehran shot down an American helicopter. CPI on deck. Investors bracing for the latest print with strong jobs data, bolstering bets on Fed rate hikes. And an all-star lineup throughout the day from Super Return as private market dealmakers flock to Berlin. Don't miss our interviews with Churchill Asset Management CEO Ken Kensel and Brookfield Private Equity CEO Anuj Ranjan this hour. All right, let's get a check on how markets have been faring around the world. A volatile week so far. Let's get straight to Winnie Su in Hong Kong for the latest from Asia. Winnie.
Good morning, Vonnie. We are seeing investors turning more cautious in Asia ahead of that CPI data from the U.S., especially after these hot prints from the U.S. jobs number last week, reinforcing the bets for the Federal Reserve to raise rates. And hence, you can see that MSCI Asia here down 2%. And also, the declines are mainly led by South Korea's Kospi Index down 4.5%. Now, the bright spot is still in the Indonesia market, with the index here up 2.7%, still extending gains from yesterday as the Bank of Indonesia raised rates yesterday. Now, flip aboard, we take a look at the inflation numbers from China because we continue to see that divergence with the CPI and PPI numbers. When it comes to the PPI, we are actually seeing a bit of an uptick there, while CPI continues to struggle, coming at 1.2% year over year, and that is missing estimate of 1.3%. Now, it really goes to show how these manufacturers continue to struggle to pass these higher input costs to their consumers, and that consumption demand remains pretty weak, and hence we are seeing the onshore yuan, in fact, erasing some of its earlier gains.
All right, Winnie, thank you so much. Now we'll get over to London for a look at Europe. Here's Justina Lee. Justina.
Good morning, Vonnie. Now, here in Europe, we always have the fear of missing out on the AI trade, but actually this month it's kind of helping Europe hold up a little bit better, you know, even after the sell-off overnight. And of course, U.S. futures still down. I mean, the stocks Europe 600 down modestly, and we can see, of course, there's still kind of a big fall when it comes to tech stocks. But ultimately, for the European benchmark, that's a relatively small weighting, and I think that explains kind of the relative resilience in European stocks here. Also pretty resilient are Italian stocks, as we've been talking about. You know, ST Microelectronics actually kind of is doing pretty well today, and also a lot of focus on those Italian bank stocks, potentially over a deal that's kind of the talk of the town in Milan. And now if we flip the board here, now a lot of focus is, of course, on the U.S. CPI number today and also the ECB decision coming tomorrow. Now we can see here that when it comes to short and bond yield, that's been on the rise kind of all year long, reflecting the gains in oil. Now they're going to telegraph kind of more hikes coming this year, with traders unsure of whether we're going to get 2 or 3 by the end of this year, Vonnie.
All right, Justina Lee, thank you so much. Justina Lee there in London. Resilience in Europe, as Justina said, not so much here in the United States, though we should reserve judgment until after the CPI data. That could change the calculus wildly. Yesterday, we had, again, a wild day. At one point, the S&P was down 2%. At one point, it was up 1%. So these markets are really confounded. Right now, we are pointed lower. Lots of geopolitical tension in the air, even though oil is not reflecting that so much. Lots of offsetting factors for oil, of course, including emergency reserves getting released and inventories getting drawn down and all sorts of other things supporting prices potentially to have them not rise as much as they potentially would. But we do have the VIX trading at a 21 handle. Yesterday, it was really just the tech companies and energy that sold off. Everything else in the market was strong. We'll see what happens today, but right now, futures pointed lower and bond yields are staying where they were. So just a little bit of a movement, maybe a basis point or two here and there, but we're back up, as you can see, 413 and change on the 2-year and almost 501 on the 30-year. All right, let's get to some individual movers now. Back over to London and Chloe Melly. Chloe.
Good morning, Bonnie. We're seeing a real retreat in that tech sector this morning as traders expect U.S. inflation to hit the highest level in more than 3 years. And at the same time, we have also got those renewed tensions in the Middle East and all of those worries about this potential AI bubble. And so all of this is dragging down that sector this morning. Moving on, but staying within tech, and Supermicro is also seeing a bit of weakness after announcing a plan to raise $7 billion through equity offerings to buy the components that are needed for AI servers. And so this announcement is dragging down there. And finally, we've got Cracker Barrel boosting its guidance thanks to very strong sales of its patriotic merchandise. And so that is really boosting the stock this morning, up almost 10% for Cracker Barrel.
All right, Chloe, thank you so much. Chloe Melly there in London. Also coming up this hour, we'll be live in Berlin at Super Return with Churchill Asset Management CEO Ken Kensel and Brookfield Private Equity CEO Anuj Ranjan. Plus, we'll count you down to the CPI data with Andrew Hollenhorst of Citi later this hour. Overnight, Washington and Tehran exchanging attacks after President Trump blamed Iran and retaliated for the shooting down of an American military helicopter off the coast of Oman. U.S. Central Command describing the operation as a proportional response. Iran later hit several U.S. targets across the region, according to state-run media. Bloomberg's Abir Abu Omar joins us now from Dubai. Abir, where does this leave what already has been a fragile ceasefire?
Indeed, Vonnie, a fragile ceasefire. But look, for the time being, we saw the attack from the U.S. side and the retaliation from the Iranian side. That is across countries in the GCC, including the U.S. Fifth Fleet in Bahrain, a U.S. base in Kuwait, and then another U.S. base in Jordan as well. From both sides, however, it seems like the hostilities have ended. For the time being, President Trump is adamant on the fact that the deal or negotiations towards a truce are still underway. Our own sources report to us that the truce talks are going intensely and that Pakistan is still very much involved to get this MOU through the line. And look, from the response that we got from the Central Command, from the United States, it looks like this retaliation or that this response in the U.S. attack was very much calibrated. It looks like it was proportional. This is quoted from CENTCOM saying that the attack was proportional to the degree of attacks that came from Iran earlier on. And so it looks like it's ended for the time being, but President Trump has come across over the past 2 months or so and said that reaching a deal or an MOU or an interim deal that would reopen the Strait of Hormuz immediately and extend the ongoing ceasefire for 60 days. He said that that was imminent multiple times before. The last of those was yesterday, where he said we could see a deal within a day or two. So we continue to monitor the situation and whether President Trump will come again and say anything about this MOU getting through the line. But for the time being, as I mentioned, the hostilities seem to have paused in the Middle East for today, at least.
All right, Abir, thank you so much. That's Abir Abu Omar there in Dubai. Here in the U.S., results for congressional primaries rolling in, with Democrat Graham Plattner winning his Senate race in Maine and GOP incumbent Lindsey Graham securing his spot in South Carolina. Kate Ackley of Bloomberg Government joins us now from Washington. So, Kate, what can we tell about turnout in Maine that gives any kind of clues as to what the runoff and what the November portion of this is going to look like?
Well, for sure, Graham Plattner, the Democrat there who won handily, he's had a lot of negative media stories, stuff about his past and his relationships with women. He still was able to get more than 70% of the vote there, almost 75%. But, the state's governor, Janet Mills, who had suspended her campaign, she still picked up a fair number of votes. But you look at that general election matchup with sitting senator, the incumbent Susan Collins, and we're just expecting to see a ton of attention on this race, really a key battleground race for control of the Senate. It's one of those situations where obviously President Donald Trump is not on the ballot in these midterm elections. So races like this will be sort of a proxy. We're going to hear a lot about Trump, and already Graham Plattner in his speech last night was talking about Susan Collins being, voting too much with Trump, even though she does have a fairly, more independent voting streak than many other Republicans. But that's going to be a big line of attack. Expect to hear a lot about Trump, who obviously is not on the ballot there. And yes, you mentioned Lindsey Graham won his primary in South Carolina, easily. We've seen some other general election matchups set going out to the battleground state of Nevada, for example, where a President Trump-backed candidate won the Republican nomination to take on Congresswoman Susie Lee in the 3rd District. So, we're starting to really, as we get through this primary season, starting to see these general election matchups really take shape throughout the country.
Kate, thank you so much. We will be looking forward to the primaries coming up with you as well. That's Kate Ackley joining us from Washington. Let's turn to tech now, and TSMC reporting a 30% rise in monthly sales as companies rush to build AI infrastructure. Joining us now is Neil Campling. So Neil, 30%, certainly the market is not suggesting that it was a better than expected number. ADRs are down in the pre-market. At the same time, it was better than last month. What can we tell about the earnings season, let's say?
Yeah, morning, Bonnie. I think you mentioned at the top of the hour about the volatility in the market tape yesterday, and underneath the hood, actually, if we look at the chip sector in particular, there's an 11% intraday swing from highs to lows at some point during the session. So investors are nervous about the sector, given it's had a massive run, and TSMC have just delivered an improvement from the April numbers. But given that the street analysts are expecting 35% growth for all of Q2, we're going to need to see another incremental uplift in terms of that growth rate in the June monthly sales to meet analyst expectations. So good numbers, but we have a high bar to beat for the rest of the quarter for sure.
Can we talk about ASML for a second? Because its gains, while great year to date, haven't matched those of its peers. Does it have the same pricing power, and can it ramp up supply?
That's a great question. I think, interestingly, perhaps it's a reflection of the fact that Europe has few tech winners, again, as you alluded to earlier in the program. But if we look at it, ASML has probably got the greatest pricing power of all the chip equipment makers, because it really makes the leading edge technology manufacturing productions that no one else can make. It really has a monopoly in the business. So perhaps it's a sign of being European more than anything else, but actually it should have more pricing power than I think many investors give it credit for, to be honest.
All right, Neil, we have to leave it there, but much appreciated. Neil Campling of Bloomberg News. Now to other top stories trending on the terminal this morning. Apollo co-president Scott Kleinman sees private equity capitulating on valuations after borrowing costs are normalized. Speaking with Bloomberg's Danny Berger from Super Return in Berlin, he said PE has lost its way a bit and some managers will now have to raise smaller funds or, quote, go away because of mistiming investments. SoftBank's talks to raise at least $6 billion through a margin loan backed by its OpenAI stake have stalled. This coming just weeks after SoftBank got its initial target from $10 billion. According to sources, the company is considering various fundraising options and could move forward with the margin loan at a later stage. SoftBank declined to comment. And Florida-based Vanguard Energy is in advanced talks to send Cuba its largest U.S. fuel cargo since the Eisenhower administration. Vanguard is set to ship 100,000 barrels of gasoline and 150,000 barrels of diesel. That's enough gasoline to supply about 11 days of typical demand. The fuel is designated exclusively for the private sector rather than state actors. Coming up, Churchill Asset Management CEO Ken Kencel joins us from Super Return in Berlin. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. The biggest names in private markets gathering in Berlin for the Super Return Conference. Bloomberg's Danny Berger is live at the event for an exclusive conversation. Danny.
Bonnie, thank you so much. I'm so pleased to say that here at Super Return, I am with Ken Kencel. He is, of course, the Churchill Asset Management CEO. Ken, wonderful to see you.
Great to see you, Danny.
You've been a busy man at this conference. I know you chaired the Private Debt Day.
Yes.
I just wonder, what's been the mood? How does this Super Return and the private credit players, how does it compare to years past when, we were kind of singing Golden Age from the rooftops?
Right. Golden Age from the roof.
Yeah.
Well, maybe it's more like platinum designer platinum period, maybe versus like golden age. But I would say the mood is optimistic. And optimistic because for the first time, you're seeing some disruption in the market that is actually creating opportunity, right? So obviously, concerns about redemptions, concerns about AI and software, but for traditional middle market lenders that maybe aren't as oriented to software or AI, and there are those of us that aren't, I would say more optimistic about terms and structure and opportunity to do new loans than lenders have been in some time.
Does that mean if you are still one of the lenders that, unlike Churchill, has been very over-indexed to software, that you're still feeling the pain right now, that they're not really making it through this period as unscathed?
I would say redemptions are causing certain lenders to pull back, but that's creating opportunities for other lenders. So we're, for example, we're very low software. We're less than 5%. So for us, the dynamics today actually are creating opportunity. Opportunity for new deals, opportunities to maybe do some larger deals that ordinarily would have gone to the BSL market or even to those large cap private credit managers. So in that sense, I'd say, a better dynamic than we've seen in some time.
Can you explain that a bit? Why are larger deals coming your way now? What in the dynamics has changed that's allowed that to occur?
So the folks that were doing those kind of large cap deals, many of them were software, were primarily driven by retail flows. So if you look at what's happened to those firms, because of the redemption pressures and the redemption dynamics, they're pulling back a bit. And those were the firms that were generally leaning into those private credit deals at the upper end or even the BSL market. So with that bid gone, you're seeing traditional private credit managers like Churchill and others step in and get access to somewhat larger deals, but on terms that are more consistent with a private credit execution.
So part of the retail pullback that happened, it was in large part software, but it was also this bigger conversation of, are marks honest? Are funds really marking these things how it should be? Is there some can kicking, extend and pretend? I wonder if that reckoning has happened in this industry. When you look out in your peer group, do you think marks are more honest today than they were in the past?
Look, I certainly think private credit marks, and all of us, pretty much all managers today are getting quarterly marks from third parties. I'd say private credit marks tend to be more direct and more influenced very quickly because of those third-party valuations. I mean, all of us that have publicly registered vehicles utilize third parties on every asset every quarter. So I think in that sense, it's translating very quickly into our marks. Private equity tends to be a little bit slower, longer term in terms of how they look at things. And many of them don't have public vehicles, so they're not using third-party marks. So I think in private credit, you're seeing that play out pretty quickly, and I would say pretty transparently.
Because of some of the stresses of other players, consolidation has been a really big theme. Churchill, I know you're celebrating your 20th anniversary this year.
20th anniversry, yes.
Happy.
We rang the bell.
Very cool.
Weeks ago.
I actually remember seeing you on. We had you on our show. We called you out. I know you didn't see us, but we saw you. 20th anniversary, and you've been now with Nuveen for some time as well.
Yeah.
And I just wonder how we should be thinking about consolidation in this industry. You've done this, you've melded with a larger platform.
Yeah.
Just how difficult is it? And are you expecting that process to happen a lot? And should there be a lot of speed bumps we see as funds try to come together?
I think you are absolutely going to see continued consolidation. The difference today is that in order to be relevant and really be active in private credit, you have to deliver the whole solution. And that means $300, $500, $1 billion of financing. The days of clubbing up in advance of each lender doing $50 or $100 million are over, right?
Why is that? Why are club deals over?
Because the private equity firms, primarily the drivers of those new deals, are looking for a full solution. If they're looking to raise $500 million, they're not going to go to 5 people today. They're going to go to one lender.
That's interesting. So it's not just the LP side, it's also the buy side that's driving
the buy side, the private equity side. So the result is the largest scaled players are seeing the most attractive deals, and it's become very difficult to build a diversified portfolio if you're starting from scratch. So we've seen consolidation in the space, larger managers raising more capital. I think the statistic I saw was 95% of the capital that's been raised in private credit over the last 5 years has been with managers that have had 4 or more funds. So the allocators are looking to consolidate the number of firms they work with. That's resulting in a consolidation in the marketplace overall in terms of lenders at scale. And I think smaller lenders are going to try to find larger partners or be part of larger platforms as fundraising becomes more important.
Do you think we'll see a lot of heartbreak, if I can torture a metaphor? Marriage is hard, and it's hard to undo.
Yes.
Especially when egos are in the room, which this industry might have 1 or 2.
Yeah, 1 or 2. Yeah. I think the benefits of a global platform from a fundraising perspective are actually very significant, right? So you're seeing smaller managers be acquired by insurance companies. You're seeing smaller managers see the benefits of being on a larger platform. You've seen traditional asset managers want to get into alternatives and acquire private credit, private equity, and other types. So I think that consolidation is something that's here to stay. And certainly we've benefited from our partnership with TIA and Nuveen and having global distribution. And I think that's going to be a theme for sure.
Does it go beyond smaller lenders looking for larger lenders? Do you think it will also be the case that if you're a standalone private credit, you need to have equity, you need to have real estate, that you also see more asset class leaders come together too?
Absolutely. Absolutely. I'd say if you're a boutique today, you're going in one of 2 directions. You're either accepting that you're going to continue to be a boutique and have a very clear niche where you invest. You've seen that with some of the lower middle market managers, maybe some of the distressed or restructuring managers. But if you want to raise broader capital and scale your business, global distribution is absolutely critical. And there are only a few platforms that can help provide that, right? Whether it's a large-scale traditional asset manager or even an insurance company, I think that's going to become the name of the game. So I would say you're going to see a bifurcation of managers, either go large and scale or stay a boutique, stay very niche-focused, and kind of be what you are, which tends to be more limited from an investor standpoint.
And obviously you have a huge global distribution channel as well, given, as you were saying, TIA and Nuveen. So are you fielding phone calls every day of someone saying, hey, Ken, can you buy us up?
Well, it's interesting. So we're launching new strategies all the time. So we're launching a capital solutions strategy. We're looking at credit secondaries, but it's all in and around our private equity relationships. So I think the best managers are evolutionary versus revolutionary in the way that they grow and build their platforms. So we are looking at adjacencies to grow our platform where we already have strength in relationships and we can capitalize on that. So absolutely have benefited from TIA's support and Nuveen as a global partner. Obviously, they're going through their own transaction now with the Schroders deal.
Right.
So I think, we look forward to continuing to build that global platform. And look, institutional investors continue to allocate to private credit. Despite the dynamics in retail with redemptions, if you look at institutional allocations, they remain growing and actually are up year over year in private credit. So despite all the noise we've seen in retail, having institutional global investor base is very important.
I only got about 30 seconds here, but I would be remiss if I didn't ask you. The flows are coming in. There's still institutional demand. What is the big opportunity right now, Ken? Where are you putting that to work?
I would say that it's actually a very attractive opportunity. We're seeing larger deals. We're seeing wider spreads today, 50 to 75 basis points wider spreads today. And we're seeing a dynamic, because of the disruption we've seen in retail, where the dynamic overall today is actually favoring lenders versus borrowers. So a little disruption is not a bad thing.
Certainly not. Ken, we're going to have to leave it there. Thank you so much for joining.
Thank you.
Always a pleasure to see you. That's, of course, Ken Kinsell of Churchill Asset Management.
Danny, thank you so much. That's Bloomberg's Danny Berger. Let's get straight now to your front page news. Major news outlets leading with the US and Iran exchanging strikes following the downing of a US helicopter gunship off the coast of Oman. U.S. Central Command says its jets struck Iranian air defense, ground control stations and surveillance radar sites near the Strait of Hormuz. The U.S. says the operation has been completed. Iran then said it had launched drone strikes against a U.S. Navy fleet in Bahrain. All right, coming up, we're going to look ahead to the CPI data with Andrew Hollenhorst of Citi. Stay with us. This is Bloomberg Brief.
Poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a...
It's on Fed rate hikes. And we're live from Super Return in Berlin as private market dealmakers flock to the city. Don't miss our interviews with Brookfield private equity CEO Anuj Ranjan and many more later this hour and into the next hour. So we have equity index futures on the decline. Yesterday was a strange day. The S&P at one point was down as much as 2%, up as much as 1%. This was a tech-led sell-off, tech and energy for the most part, with oil prices continuing to be muted, dampened even as there was escalation overnight between Iran and the United States. But as you can see, it looks like we might be in for another decline day for tech companies. But we wait till after the CPI print because that, of course, has the potential to change everything. Right now, we're trading with almost 21 handle on the VIX, so definitely tension rising. The dollar index is trading at 99.9. The yen trading at 160.43. So there's lots of potential little pain points in this market here. Volumes have returned as well. Total equity volume was the third highest of the year yesterday. If we look at bonds, we can see that we are still elevated, remaining so, back up a point for the 2-year yield at 413.49 and back up another more than a point at nearly 501 on the 30-year. Let's get to some individual movers now. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. It's set to be another tough day for the U.S. tech sector, with traders paring back that exposure to some of those names because of that CPI data that we've got later on, but also those renewed tensions in the Middle East and some of those worries around a potential AI bubble. So we're seeing all of those names in the red this morning. Moving on, but staying within tech, and Supermicro is also seeing some weakness today after announcing a plan for a $7 billion equity raise to buy the components that are necessary to make those AI servers that are in very high demand from that company. But we are seeing that weigh on that stock a little bit. And finally, let's flip over to Cracker Barrel and end on a positive note, because that is a company that has boosted its guidance, and we are seeing that reflected in that stock this morning, up almost 9%, really seeing that strong demand from its patriotic products. So good day for Cracker Barrel at least.
Chloe, thank you so much. Chloe Melly there in London. Iran's foreign ministry saying it is reviewing its diplomatic process with the U.S. A state-run news agency reporting that the ministry's spokesperson added, quote, "Wherever necessary, our armed forces will respond to the enemy with authority." This all after Washington carried out what it called proportional strikes against Tehran following the downing of an American military helicopter near Oman. Bloomberg's Abir Abu Omar is back with us from Dubai. Abir, it looks like things have calmed down just a little bit. Is this potentially done for the moment?
For the moment, it seems like that would be the case, Vani. But look, we had a 24-hour calmness after Iran and Israel were exchanging fire earlier this week. And then we had this attack by the United States on Iran. This is after Iran yesterday downed a U.S. military helicopter. No one was injured. The 2 crew members were reported to be safe. But President Trump did tell ABC News yesterday that he must retaliate or respond to Iran in a very powerful manner. And this is what we saw happen with a lot of sites in Iran, including Qashm Island, seeing explosions. A couple of water tankers as well had seen explosions in parts of Tehran, and that led Iran to respond by retaliating against Gulf allies, or some Gulf allies, as well as Jordan this morning. That is what we saw, some U.S. bases in Kuwait, as well as the U.S. Fifth Fleet in Bahrain and a U.S. base in Jordan. Now, President Trump throughout this whole thing has maintained that a truce is underway, that it is imminent, that we could see it in a day or two. This is what he told reporters in New York yesterday. And so we wait and see whether this deal is in fact imminent. It's not a narrative that we haven't heard over the past couple of months for sure, but this is what we're going with for the time being. And what else we're going with is the fact that the hostilities between those 2 warring parties for the time being, again, seem to be over for the day, Vani.
Abir, thank you so much. Abir Abu Omar there in Dubai. Citi's Andrew Hollenhorst looking ahead to the CPI print in just a couple of hours, writing, quote, "May inflation data overall unlikely to change the recent market narrative that sticky price pressures may lead the next move in policy rates to be a hike rather than a cut." I'm pleased to say Andrew joins us at the desk. He's chief U.S. economist at Citi. Of course, Citi and you not looking for a hike next. In fact, looking for 3 rate cuts still by the end of the year. Is that still what you're thinking?
That's still our view. We think cuts are certainly more likely than hikes. To get to rate hikes, I think you need to see evidence that inflation is really picking up, the labor market is tightening, and we have kind of broad inflationary pressure. But having said that, the Fed does have an issue here with their preferred measure of inflation, which is core PCE inflation. That's been elevated. Core CPI should come in a little bit cooler, a little softer today, but core PCE is still going to come in quite strong. We think there's some methodological reasons for that, but it's a big messaging problem for the Fed. How do you talk about holding rates steady, even cutting rates, when you have core PCE inflation that's running north of 3% now?
So is that what Kevin Warsh will do next week? He'll come in and talk about other measures of inflation, and if we get a hot print today, he'll be able to say we're not concentrating on the traditional CPI data?
Yeah, I think that's the key question for Warsh. If you look at core PCE inflation has been the Fed's preferred measure. When they talk about the 2% target, that is a PCE target. What we heard from Warsh in some of his congressional testimony and earlier was this openness to thinking about things like a trimmed mean inflation. So what you're trying to do with these various measures of underlying inflation is cut out the outliers. If you have prices that are rising very quickly, prices that are falling very quickly, things that are volatile. What you do with a traditional core measure, you strip out food and energy. What you do with a trimmed mean is you just say, let's take out those things that are outliers and let's just focus on what's kind of in the middle of the distribution. That trimmed mean PCE number is down at 2.4, 2.3%. So that looks a lot closer to target as opposed to core PCE itself, which is above 3%. So what's Warsh going to focus on?
And we also have the Cleveland Fed's median, right?
Yep.
But there are problems with both of those indicators too. Andrew, what should we be watching out for if we do start to look at those instead?
Yeah, so this is going to be the big debate. Which measure should you look at? How should you look at those measures? I think what I would like to see Fed officials do, what I think they might ultimately come out with, is not emphasizing any one measure over another. Yes, PCE is the target, but we're trying to get a sense of underlying trends. So try to basically take an average of these measures and say, if I look across all these measures, where are we? I think if you look across all those measures, we're somewhere certainly north of 2% inflation. I think we could argue, is it more like 2.5% inflation? Is it 3% inflation? But the trend has been downward. That's the important point to me. Let's see what Warsh has to say about it.
Andrew, what would it take for you to change your mind on 3 rate cuts by the end of the year? And bear in mind, 2 of those rate cuts you say are coming before the November midterms.
Yeah, so we have inflation that's above target. We have an economy that's still expanding. So the only real reason for the Fed to be cutting rates here would be some concern about the labor market. Now, you look at the last 3 jobs prints, and we have an acceleration in payroll growth. So you say, okay, how could this Fed be even thinking about cutting rates? I think what we need to see is some weakness in the jobs data. Those payrolls numbers have been strong. If you look at the full constellation of labor market data, we still see pretty weak hiring, pretty weak demand. We saw that in that NFIB small business survey. Small businesses are not excited about hiring. So if we see weaker labor market data over the next several months, then we would still be on track for those rate cuts. On the other hand, if we have a strong jobs report for the month of June that we'll get in early July, that would be a signal to us that the Fed's not going to cut this year. We'd shift those cuts out. The bar to hikes, I think, is very high. So I don't think we'd be putting hikes into our forecast, but could we be pushing those cuts out further? Yes, if the labor market data stays strong.
And they would go sort of as a trio. Or you're saying that if you decide to change your mind, all of those 3 cuts will be shifted out of this year, not just one?
Yeah, I think we'd probably shift all of those 3 cuts into next year with the idea that by next year, we think that we're going to see inflation that really has come down to something closer to 2%. We still think that we're on that track. It's obviously been a very, very bumpy road to get there with this issue that we're having now with core PCE. But the idea that, yes, the Fed can slide rates back towards neutral.
You're not concerned about secondary impacts from the Iran war then? You think that's pretty much behind us in terms of what it will cause prices-wise?
It's still early days. It usually takes months for those effects from energy prices to pass through to core inflation. But 2 things are making us feel a little bit more confident that we're not going to have a big pass through into core inflation. One is that the oil price spike just wasn't as high as we were worried about, right? We were talking 3 months ago about, could we get oil prices up to $200 a barrel? Certainly we're elevated, but we haven't seen those kind of numbers sustained. And then number 2 is, how is this coming out and passing through into the areas where we would expect there to be very quick pass-through? Things like airfares. We've seen airfares go up, but again, that effect has been relatively muted in the U.S. as well as internationally. So that's making us feel more confident that we're not going to get a lot of pass-through into core inflation.
In terms of who else is on the Fed, many people say, look, it's going to be consensus. It's not just Kevin Warsh. Now, we know Kevin Warsh is going to have a very strong voice at this Fed, particularly in the beginning, because the Fed is going to want to show, support for the new Fed chair as well. Who will he have as allies, or is there anybody we should be watching out for in terms of potential dissenters or people that really will not be in agreement with him on economic views?
So that's absolutely right. He has to forge a consensus. He's going to want to forge a consensus. And we had some dissents at the last meeting. We had 3 Fed officials who said the Fed should now formally have a neutral bias, not to be easing, not to be hiking. Right now they have an easing bias. That probably will come out of the statement, and there probably will be consensus around that. And I think Warsh can characterize that as just providing less forward guidance. I'm really interested in where Governor Waller is going to be. We've seen Waller, who's been quite willing to look at the data, change his views. A few months ago, he was more worried about the labor market. Now he's less worried about the labor market and more worried about inflation. So in terms of somebody who could kind of swing and potentially be an ally for Warsh, potentially have a different view than Warsh, Waller would be someone to watch.
Andrew, we have to leave it there already, but cannot wait to speak to you after the FOMC decision next week. So this is the appetizer to the main event, if you like, with the CPI data later today. Andrew Hollenhorst of Citi joining us there. Now to other top stories trending on the terminal this morning. Democrat Graham Plattner won the party's Senate primary in Maine after a campaign riddled with accusations of past misbehavior. Those include a since-covered-up Nazi symbol tattoo and a report that some of his ex-girlfriends found his behavior disturbing. Plattner will now face incumbent Republican Susan Collins in a race that is increasingly important for Democrats if they want to reclaim control of the Senate. Apollo co-president Scott Kleinman sees private equity capitulating on valuations after borrowing costs are normalized. Speaking with Bloomberg's Danny Berger from Super Return in Berlin, he said PE has lost its way a bit and some managers will now have to raise smaller funds or, quote, go away because of mistiming investments. The Qatar Investment Authority's deal-making push may be hampered by Iran's attacks on the country's energy infrastructure and its inability to ship products. The conflict is expected to cost Qatar about $20 billion in lost revenue and impact the sovereign wealth fund's financial resources, which are linked to gas revenues. Coming up, back to Super Return, an exclusive interview with Brookfield Private Equity CEO Anuj Ranjan next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got
got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Some breaking news. We are getting information from Kyoto that the Bank of Japan chief Ueda is in hospital and will miss the policy meeting. He's going to be absent from the policy meeting this month, and he's expected to be in hospital for about 2 weeks. As we know, the yen has been trading around 160.45. It is still around that level, but this is important news for BOJ watchers. Obviously, a hike expected at this month's meeting, but the BOJ chief will be absent from that meeting. He's hospitalized and will be in hospital most likely for about 2 weeks, according to Kyoto. Let's head back now to Berlin, where leaders in private markets are gathered for the annual Super Return Conference. Bloomberg's Danny Berger is at the event with another exclusive conversation. Danny.
Bonnie, thank you so much. I'm so pleased to say that I am here with Anuj Ranjan, the Brookfield Private Equity CEO. Anuj, thank you so much for joining.
Thank you for having me.
And just looking at the backdrop of where things stand for private equity right now, deal volume, realizations are down about like 20% so far this year compared with last year. It is this logjam that has been ever present. We're talking with Scott Kleiman earlier, who said we still have a while to go to work through that. Is that your estimation, too, that this kind of stickiness, the stuckness of the industry is going to take some time to get through?
I think yes, but I think it's really differentiated into different categories of the private equity universe. Resilience is really the new growth, and the markets used to pay up for things that could scale very fast. And today, it's changed. The market is now paying up for things that can't be knocked over. Businesses or assets that are hard to replicate, hard to replace, that are critical to the global economy and form the backbone of it. These are the areas that people want to invest. And if you own businesses in that space, there are still buyers in that universe. And it's not just about the public markets. It's not just about the sponsors. It's about strategic investors that want to own these businesses for the long term.
What I also hear from you is just asset heavy. I mean, what you're describing is an asset heavy business. How big of a paradigm shift is this for the private equity industry? Because it used to be high cash flow, asset light, really fat margins. Is that model now pushed to the side? Is that gone?
You know, it's not pushed to the side, but I'd say more broadly, even if you look beyond private equity, the world is shifting. And even the world's biggest and greatest technology companies are now asset heavy. If you think about it, AI, it needs power, it needs land, it needs chips and compute, and it needs steel. And these are some of the critical resources and ingredients to the success of AI and the success of these major technology companies. At Brookfield, we're a big investor in real assets. We find ourselves at the center of this build-out, and it's created a tremendous amount of opportunity in a space that actually one would have not normally considered was traditional private equity in the past.
And you've been in real assets for some time. That's certainly part of Brookfield's DNA. A lot of other people are trying to make this pivot now, too, which maybe haven't before. Maybe they were more software-inclined investors. And I wonder, how much of a change is it to have an IC to evaluate these companies? Do you think it's difficult, I don't want to call them tourists, but people who are more new to heavy industry real asset, is it difficult for them to make the switch?
Absolutely. I think these businesses are amazing companies. They're highly resilient, they're highly durable. But knowing and understanding them at depth, knowing and understanding the operations of them at depth is not something that's so easy to learn overnight. It takes decades of building a capability. Not much different than building a capability in software or in technology or in consumer. And my personal view is the private equity universe is very big. Those that will do the best are the ones that focus on areas where they can run businesses better than anyone else could. It's probably not possible to run such a wide array of businesses so great. You have to have a spot where you have history and experience. Ours is heavy assets. It's a space that we've been in for decades, and it's a space that we know really well. We're leading in, and we're doing even more.
But for focus in that asset class specifically, it feels like money is going in to literally everything. Like ex-politician can lease some land in Louisiana and have some concept of a plan. An IPO and money comes in. It feels like money is flowing indiscriminately to anything that seems like it's linked to AI data centers. Does that end in tears?
You know, it's funny. Headline grabbing news is often around big IPOs of the tech companies that are coming, that are often AI linked, and that's where it seems like there's a bit of a gold rush. But while it grabs the headlines, there's actually, I think what the real point is that the public markets have actually been quite healthy and healthier than they've been in the past. And there have been many mid-market industrial businesses and other businesses that are also going public and also attracting those capital markets. But I think the real trick, to be honest, it comes back to owning businesses that create their own optionality for exit. Right. Coming back to your first point on DPI and the logjam, I mean, you want to own businesses that can be appealing to a strategic, that can generate cash flow and pay dividends, and that aren't only dependent on IPOs. You want to create your own exit, not be dependent on the timing of the public markets alone.
By the way, when it comes to public markets, do the big IPOs, do they help or do they hurt trying to exit via IPO? Because it is competing at the end of the day for the same institutional capital, and these are giant companies between SpaceX and the large language models that are likely coming public.
Yeah, look, so far we've seen that overall, I'd say it's helped. I'd say the inflows in public markets in general across IPOs or across issuances has been stronger in the last year than it's been in the past. And many companies have managed to go public that are hard asset linked, heavy asset linked, heavy asset services. At the exact moment that a big IPO comes, like this Friday, maybe there's an attention shift. But overall, I think the public markets are healthier than they were in the past.
So you wouldn't recommend taking a company public on Friday, for example?
Maybe not.
Might not be the move.
Might want to wait past the weekend.
Yeah, I think that's probably fair advice. By the way, on these large language models, you have this partnership with OpenAI along with some of your peers, the Deploy Co. I know it's only been a month. It's in its infancy. Just how is that going? Has the work started there yet?
Absolutely. Look, we're really, really excited about it. We think the AI race is shifting. It's shifting from invention to execution. And the technology is no longer the bottleneck. The bottleneck is being able to deploy AI at scale in industry, in enterprises. And the winners in this market will not be those who have the best model. The winners will be those who can get the technology in the hands of real traditional businesses in the real economy as fast as possible. That's the gap that we're investing in, and that's the gap we're trying to fill with the deployment company, with our partnership with OpenAI. And it's an incredible opportunity. I think that's going to be what really defines OpenAI and others as category winners.
Well, on that, because whether your competitors are part of this deal or not, it has been this attempt to try to enable companies with AI to make sure that they don't get left behind. Is there alpha generation to that, or when everybody has these tools, it becomes just a need to have, and it's not necessarily, if everyone's improving their margins through AI, it basically nets out in the wash?
It's a great point, and I'd say it's actually both. On one hand, there is alpha generation. There are absolutely productivity gains in these businesses. We've seen examples of many of the traditional portfolio companies that we own where we've been able to derive real EBITDA improvements, cash flow improvements in a business. We're able to reduce costs. We're able to help predictive maintenance or increase throughput of a manufacturing facility using real AI tools. So it does lead to real benefits, and we're really excited about that. At the same time, I don't think it's that you invest in AI as a business and you have alpha generation, but if you don't, you stay flat. If you don't, you get left behind. And your business actually, it may decline. And so there really are going to be winners and losers coming out of this. And so it is a little bit table stakes. It is something that if a company wants to survive and thrive in this new era, they do have to make the investment. They do have to deploy AI in their enterprise. And so they have to do that just to keep up. But those that do it well, those that do it fast, those that can do it at scale, I think they'll have huge advantages in the future.
And we're gonna have to leave it there, but just quickly before we do, on this point, the stuff is expensive. The cost of compute is just going higher. How are you thinking about that in your portfolio companies and the margin compression or the margin pressure you might face as they adopt more AI and use up more tokens?
You're absolutely right. Compute is one big bottleneck. It's one area that we see all of these groups trying to expand. But the truth is, the productivity gains need to pay for that. And a lot of those productivity gains are not just the compute power of the technology, it's actually utilizing your people, upskilling your people to be able to use technology more efficiently and to deploy it more efficiently in your company. And then you can maybe minimize how much compute you need or that cost while maximizing the impact on the business.
So you're not token maxing. You're not calling your CEOs and being like, hey, how many tokens can you use at once?
Not yet. Maybe I'll see something different in a year.
Anuj, thank you so much for joining. Such a pleasure to see you here in Berlin. Bonnie, that's Anuj Rajan of Brookfield.
Danny, thank you so much. Bloomberg's Danny Berger will be bringing you interviews throughout the day from Super Return in Berlin. Now a look at what's ahead for your trading day. First up, the main event today is May CPI. That's out at 8:30 a.m. New York time, obviously. Then we get the federal budget balance. That's at 2 p.m. Eastern. And earnings coming from Chewy before the bell and Oracle after the close. Here are some pre-market movers. Supermicro tumbling once again, down more than 8%. It says it's planning to raise $7 billion in an equity deal for AI equipment. TSMC, well, came in with sales rising about 30% in May. Investors not loving that. It's not on track to beat for the earnings quarter. We'll see what it does next month. Oracle down more than 3%. It's falling ahead of earnings due after the market close, and we're anticipating quite a large move after earnings, at least according to options markets. Let's take a look at your macro environment as we go into the Wednesday session with a lot of question marks. So we have NASDAQ 100 futures pointing to a second down day for the NASDAQ. Remember, yesterday we were going to be looking at a second up day, and it all turned around. Tech selling off and continuing to sell off in the pre-market. The 2-year yield is at 4.13. It is back up that basis point that it lost yesterday. And we have the VIX trading just below 21. It was above that just a few moments ago. This unsettling environment that we're in, where the US and Iran were trading fire overnight, appears to have stopped for now. But there is that tech sell-off to contend with as well. And volume is back. This is what we're looking at in terms of Brent crude. So even with all of those over and backs, Brent hasn't really advanced. We're at 91.26, and WTI is still below $88 a barrel. Gold as well continuing its sell-off. It's staring firmly in the face now of $4,000. All right, that's it. Do stay with us. We will be counting you down to that CPI data, the all-important data coming at 8:30 a.m. Eastern. It will be key in terms of the Fed decision coming next week. We also want to reiterate that we got news that the Bank of Japan Governor Ueda is hospitalized for 2 weeks and will be missing that Bank of Japan meeting next week, where widely the bank is anticipated to hike rates. That's it for Bloomberg Brief.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Good morning.
morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The markets are wagging the economy, not the other way around.
The majority of the opportunity here is really in the AI compute space.
As long as the capital markets remain open to these really massive market caps, that's the opportunity.
This is really, I think, an earnings-driven story.
It could be more choppy this summer, but we don't think that the bull market in equities is over.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, tech stocks decline, extending losses following wild swings for high-flying chip stocks as a record-breaking SpaceX IPO is reportedly 4 times oversubscribed. Investors are bracing for a hawkish Fed heading into the next read on inflation. CPI expected to hit fresh multi-year highs.
There is so much money sloshing around in capital markets. You see companies that are spending and spending, and they have the money to spend. They are raising money, and people want to give them money to spend. How much of it is bleeding into the increase in consumer prices that everyone is feeling? And that's what we're going to see today at 8:30 a.m. The potential for a north of 4% CPI year over year would put it at the highest level going back to 2023, as we see components and energy costs for everything rising.
So we haven't had a 4 handle for 3 years. Just think about that. Where was FUD funds 3 years ago? 5 handle. Right now, 375. How much work does this Fed have to do later this year?
In 2023, the Fed was hiking rates. At that point, people thought that they were on a rate hiking cycle, and they expected this to cause pain. Remember the pain speech? Well, now we're in a situation where people are still pricing in potentially, not pricing in, we're pricing in 1 rate hike by the end of this year. But the talk on Wall Street is still of the potential for a rate cut, even as you see a reacceleration of inflation. And I will tell you, down on the beaches of Rio, when I was talking to different CEOs, all I can say is everyone's talking about how demand is absolutely surging regardless of higher prices.
Okay, well, I wasn't on the beaches of Rio, but I was at the Knicks game, which in itself is basically highlighting inflation. I think it's particular to New York City, but obviously highlighting inflation. When you look at what Bloomberg Economics is talking about, they're saying that core inflation, though, which is more relative to Fed fund rates, actually they expect a subdued reading because people are paying up a lot more for things like gasoline, which is going to be part of this hot CPI print, and potentially taking away from other parts of the basket.
I'm looking for something to throw around the table. You're going to be fired. Right, I'm just looking around. I can't find anything right now.
I came in and rearranged you to set up so that you couldn't throw anything at me this morning.
I'll find it in the commercial break. Let's turn to crude. Brent, WTI looks like this. It's pulling back. We're down by 1/10%. Such an unusual week for the energy market. It's been an unusual year. Brent crude on Monday topped at 98. It's down to 91. We've got an 88 handle on WTI, yet we've got every single reason in the last week to expect crude prices to be higher.
And we had one last night. You have the U.S. carrying out 3 waves of strikes against 20 IRGC targets. This is a retaliation of Iran downing a U.S. helicopter. I was with the president right after the Knicks game, before we went back to Washington, D.C. We asked him about this, and he said there's going to be a report that comes out Tuesday. Well, it wasn't a report. It was a response to Iran, and still oil is lower. And a lot more barrels are coming out than people had expected, whether it's ADNOC, whether it's now that Kuwait is able to get some barrels to Asia. It's just hard to really understand that all of this is going on while the Strait continues to be closed.
Jeff Curry of Carlisle put out another piece essentially saying you guys are all crazy. And he said, we're robbing Peter to pay Paul. Essentially, we are flooding the market with all of this oil, whether it's from the SPR, et cetera, and then keeping demand high so that you don't get the corrective mechanism that you need to really right-size the situation, which is why he thinks we have a couple weeks left before we hit tank bottoms and all hell breaks loose. And that's essentially the reason why he is incredibly bullish on commodities.
88 as it stands won't crush demand, not stateside, that's for sure. Given the performance of this economy so far, Brent crude at 91. Coming up this hour, Steve Chevron of Federated as tech stocks retreat. Stephen Kirk of the Council on Foreign Relations as the US and Iran trade fresh strikes. And Veronica Clark of Citi suggesting rate cuts are more likely than hikes. We begin this hour with stocks extending losses following a very volatile session. Steve Cheverone of Federated calling it the storm before the calm, writing, to be clear, we would see any volatility as a buying opportunity. Steve joins us now for more. Steve, good morning. Good to see you. Good morning. What do you think is behind the latest fragility, the latest wild swings for tech stocks?
Yeah, let me just say, I'm not coming from either Rio or courtside at the Knicks game. I'm fresh off the New Jersey Turnpike, where our traffic has been insane coming into the city, which is, I think, a sign of actually strong consumer demand. But look, I think there are a lot of non-fundamental factors that are going to interfere with markets and cause volatility over the summer. People need to make room in their portfolios for all the equity capital that's being raised, including SpaceX. Pension funds and kind of investors that are targeting allocations, equities have run so hard over the last quarter. Fixed income has struggled so much that there's going to be a rebalancing trade, very likely, that I think will interfere with markets. Inflation. I think today's inflation report is going to mark the worst of the worst. This is going to be the biggest jump on a month-over-month. I think we kind of stabilize from here.
You think this is the peak?
Well, not necessarily the peak. You could get a report that's hotter, but the jump. I think we're going to go from 3.8 to 4.2 likely today. I think that's the biggest jump. So after this report, I think things will get bad at a less bad rate, which is usually what markets look to have an inflection point. You've got uncertainty around the midterms that'll start to come in and then you have a new Fed chair that's going to get challenged. So I think you could see volatility over the course of the summer. Our anchoring point, though, is that we still sit in what is, at worst, the middle of the biggest infrastructure build-out since the railroads, and margins that are growing at the fastest pace in my lifetime, and it's not as short as it was, you can see from the gray hairs. So we want to own that, and if we see volatility on some of these non-fundamental factors, we're likely to buy it.
Own at what price? And this is the key issue, because everybody has their hand out. Everybody wants to raise money, and the sums of money are getting bigger and bigger to pay for higher and higher cost items because inflation is going up as quickly as people can raise money to pay it.
I think prices are up. I don't think inflation is in place. And I think that that's a key element. I don't think what we have is a self-reinforcing upward cycle in prices. And the reason I don't think we have that is we don't see it in wage gains, which are still pretty modest at 3.5%. And what you're seeing is pockets of weakness in parts of the consumer basket that's offsetting the strength that you see in energy commodities. What we have is a Strait of Hormuz that's closed. And if energy is not flowing, prices are going to be higher. But what we don't have that we had in kind of 22 and 23 was just more and more money getting pumped into the system, whether it was through government stimulus or rates that are zero. And so I think what you're going to see is, on a year-over-year basis, the biggest jump, this kind of 4% number. And then I think we'll see a string of 4% numbers. But then all of a sudden, when you get to the back half of the year, you've lapped the tariffs. Even if energy prices stay exactly where they are, once you get to next March, energy inflation is zero at that point, right? So, and I think what we're likely to see is energy prices that ease some, not necessarily go back to where they were pre-conflict, but ease some. So I think we have higher prices. I think it's hurting some people, but I don't think that this is that self-reinforcing inflation cycle.
I would take issue with one thing, and this is something that I was hearing
from a lot of... I would expect that, Lisa. That's kind of what we do here.
By the way, you're off to a fantastic vacation next week, so don't exactly cry me a river about our experiences.
Fair enough.
Let's not go there. But I will say, one thing that, as I was talking to different CEOs, they're talking about how much money they have and that their margins have been increasing, not decreasing. And you said that fiscal isn't necessarily coming in the same way that it did during the pandemic. Maybe so, but you're getting tax breaks that are giving them a lot of cash. At what point will companies have to raise wages in a commensurate way because they have so much money, they need to build their business, they are all investing in CapEx? I mean, why isn't that a likely outcome?
So let's talk about the margins first. And this is really important because in a high inflation environment, usually stocks don't do as well as they do in a low inflationary environment, unless earnings are growing above trend. And they do particularly well when margins are growing. So what the history shows is that stocks can do as well in a high inflation environment as they do in a low inflation environment if margins are growing. And that's why you see the stock market as resilient as it is. As it relates to wages, wages are growing. They're growing at about 3.5%. And that's about where you want it, right? When it gets over 4, that generally becomes a self-sustaining kind of problem. That's 2022. 3.5% with inflation kind of around 3, let's say that's been the average, that's real wage growth. And again, that's very different than what we were seeing with the inflation of 22-23 when we had a record period of negative real wage growth for the consumer. So the consumer here, and I think this is the biggest contrarian call, we all know how difficult the consumer's been, how K-shaped it's been. But look at the bottom part of the K. All of a sudden, instead of adding 10,000 jobs a month, we're adding 180,000 jobs a month. And the biggest decline in the unemployment rate so far this year is folks, some college degree, high school diploma, less than a high school diploma. I think that bottom part of the K is set to do a little bit better than what we've seen over the last year.
Steve, what do you think the Fed does next week with all of this?
I think you're going to see the Fed likely on hold. What I expect to hear from Warsh is how he's going to look at things. He's not going to come out and say, hey, we're not hiking or we're hiking. I think he's going to maybe reiterate that he's going to look at trimmed mean measures of inflation. I think he's going to lay out a framework or a series of breadcrumbs that will communicate to the market that this Fed's not going to hike. I mean, I really think that
not going to hike this year.
Because here's why. What is it going to do? The parts of the economy that are rate sensitive have already been in a recession. That's been what we've talked about around this table. So are we going to punish the low-end consumer more? Or are we going to punish small businesses more? Because you can raise rates all you want. It's not lowering a chip price. It's not lowering the price of a gas turbine because the buyers don't need debt and they're price insensitive. So what you don't want to do is hike rates and destroy those interest rate sensitive parts of the market so that if AI CapEx slows down, you find yourself in a negative cycle. So I think this Fed will understand that. I hope that they'll understand that. I think it'd be a real policy error to get too aggressive on rates.
So you're looking for something dovish relative to more hawkish expectations?
I'm expecting him to, drop some breadcrumbs. And the breadcrumbs would be things like, I'm going to focus on trim mean inflation.
I or we?
What's that?
I'm going to or we're going to?
That's the question, right? Because he does have the hardest management role, I think, of any Fed chair in a while, particularly with his predecessor sitting there, apparently keeping a low profile, but then giving speeches that aren't so low profile. So we're gonna see. We've always assumed that even though it's a committee, the Fed chair sets the direction. I would expect that Warsh, being well prepared and very interested in this job for a long time, will be able to navigate that. We will see if it really is a committee. Strap in.
He's had 10 years to think about it, that's for sure.
He's very well prepared for this job.
Without a doubt. Steve, you wear the New Jersey sun well. It's good to see you. Thank you, sir. Steve Chevron of Federated. Who needs a vacation? Who needs Rio?
Is that what you said? Okay, this is John's take. This is John's take. After I went to Rio and Bree went to the Knicks game, John's like, who needs to go on vacation?
He looks so tan and rested already. Right?
Yeah, if you spend a lot of time on the soccer fields.
It's that Italian blood. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. U.S. forces carrying out fresh strikes against Iran, targeting air defense and surveillance sites near the Strait of Hormuz yesterday afternoon. The attacks coming after President Trump blamed Tehran for shooting down an American military helicopter on Monday. Bank of Japan Governor Kazuo Ueda has been hospitalized and is set to miss next week's monetary policy meeting. The BOJ writing in a statement, quote, his hospital stay is expected to last approximately 2 weeks. The deputy governor will serve as acting chair for the meeting. TSMC reporting a 30% rise in its monthly sales, the increase reflecting continued strength in demand spurred by a global rush to build AI infrastructure. Asia's largest company has become an essential global AI player by making cutting-edge semiconductors for companies including NVIDIA and AMD. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. More from Vonnie later this hour. Up next on the programme, a ceasefire on the brink.
I would say the ceasefire is on massive life support. In that part of the world, ceasefires when you're shooting in a more moderate manner. We're going to win one way or the other. It's going to be militarily or on paper.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations. Live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Inflation data later this morning. CPI 8:30 Eastern Time ahead of PPI later on this week. The guesses, the estimates in our survey look like this. The median for year-over-year CPI could have a 4 handle for the first time in 3 years. The estimate 4.2%. That's up from 3.8. Expecting core to hold steady just below 3%. Heading into the Fed meeting a week today. The first meeting for Kevin Warsh, the new Fed chair. Into that really volatile price action for equity markets stateside. Equity futures this morning declining by 0.8%. The losses continue on the Nasdaq, down by 1.2% after bouncing on Monday, taking it all back on Tuesday and then adding to losses this morning. That's the stock picture. Here's the bond market. 2s, 10s, 30s look like this. 2s at 413. Yields creeping higher again by a single basis point. 10s around 453. Off the back of some jitters in the commodity market. WTI and Brent shaping up as follows, even with the tension in the Middle East. Look at this. 88 handle on WTI. 91 on Brent. And unchanged on the session. When I saw the headline drop yesterday, I was like, oh, here we go. Crude might wake up.
Yeah.
Crude didn't wake up at all.
It woke up for a hot second. It was sort of up for 4%, and then it went right back down. And ultimately, people are looking through this and saying that the fact that the ceasefire is being preserved in any capacity whatsoever, with them lobbing missiles at each other and blowing things up, seems a little bit ridiculous. And that gives you a sense of what the desire here is, which is to stop the kinetic conflict and to get the Strait of Hormuz back open.
Crude rolled over and went back to sleep. Seems to be the last 24 hours. Under surveillance this morning, a ceasefire on the brink.
I would say the ceasefire is on massive life support. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. In that part of the world, ceasefire is when you're shooting in a more moderate manner. There's a reason for everything. And we hit them pretty hard. We're going to win one way or the other. It's going to be militarily or on paper.
So here's the latest this morning. The US and Iran exchanging fresh strikes after Tehran downed a US Apache helicopter, further straining the fragile ceasefire. Bloomberg's Tyler Kendall joins us for the latest. Good morning, Tyler.
Hey, John, good morning. Well, this underscores just how high the tensions are running, as this week marks the worst flare-up in fighting since the ceasefire was announced. CENTCOM says that the U.S. response yesterday was proportionate and done in self-defense, with the U.S. striking Iranian military targets, including radar sites, command and control stations, and air defense systems for Iran near the Strait of Hormuz. It comes after yesterday we heard from Iran's foreign minister in a post on X, who didn't deny that Iranian forces were involved in the downing of this American military helicopter, but seemed to suggest that perhaps the incident was unintentional. In the wake of the U.S.'s strikes, we heard from Iranian state media overnight confirming that the IRGC tried to target at least 4 American military targets, including the U.S.'s main naval base in Bahrain. Now, President Trump was asked over the weekend and pressed on it really in this interview with NBC News on what his red lines would be in order to end the ceasefire. He said if Americans were killed or if he feels that a deal could not be reached, because at this point, despite all the escalation, the White House still says that diplomacy is a viable option. And a person familiar with the matter confirms to Bloomberg News that the negotiations are ongoing this week with Pakistan as the main mediator. In fact, John, we got some new reporting from the New York Times yesterday that put a little bit more of a finer point on where these talks may be headed, reporting that the two sides appear to be closing in on 4 main issues related to Iran's nuclear program. That includes the potential for a lengthy moratorium on uranium enrichment, which the Times is reporting the U.S. feels could land at 15 years.
We'll see. Tyler Kendall with the latest down in Washington. Tyler, thank you. To build on that, Stephen Kirk of the Council on Foreign Relations writes the following. Markets seem to be waking up to the fact that the Strait of Hormuz is not opening anytime soon. Stephen joins us now for more. Steve, welcome back to the show. The president looks committed to finding the off-ramp. The Iranians look committed to testing his patience. And I just wonder, Stephen, how long we can hold on to this ceasefire.
Yeah, the president has indicated over and over again that he's unwilling to escalate. The CENTCOM's response to the downing of the helicopter yesterday was essentially a pinprick. We're talking about radar sites, a number of facilities along the Strait of Hormuz, which have been hit before. The Iranians just move these things back underground and then bring them back up when they are going to use them again. This is not a return to combat. And the president has indicated over and over again to the Iranians that he's not interested in that. That has given them license to actually make more demands and be more aggressive in the region. They're now trying to fold Israel and Lebanon firmly into any agreement so that they have some sort of control over Israeli security.
Stephen, what do you think the sticking points are right now in terms of the discussions between Washington and Iran?
I think those sticking points remain what they have been. The question of Iran's uranium enrichment. If the New York Times is right, we're basically going back to where we were with the JCPOA, President Obama's agreement with the Iranians over a moratorium on the nuclear program back in 2015. Then, of course, there is this issue of the Strait of Hormuz. That helicopter that was shot down was patrolling the strait while the Iranians were shooting drones at commercial shipping that is using a lane of the strait that the U.S. is assisting with. The Iranians have no intention of opening this strait without having some sort of control over it. And those are what the sticking points were on April 8th, and they're the sticking points today on June 10th.
But the goalposts continue to change. Earlier on in the conflict, the president said a 20-year ban would be insufficient. Now they're going to settle for 15?
He's clearly looking for that off-ramp. He's frustrated. He said last week that he was bored with these negotiations. We could be approaching a situation where the president actually capitulates. Maybe it's not 20 years, 15 years, 22 years, whatever it is. It seems to me he's looking for something that he can sell, that he can get out. The Iranians, however, haven't been willing to play ball and have remained steadfast in their demands that they have a right to enrich uranium and that they want some control over the Strait of Hormuz.
Stephen, you wrote that the markets seem to be waking up to the fact that the Strait of Hormuz isn't reopening anytime soon. Is that true? Do you really think that this market is waking up to that reality?
Well, you all would know better than I would, but it seems to me that over the course of the last few days, the market slides indicate that people are coming around to the fact that there is a major choke point in the global economy and that it's harder and harder for energy to come out. As far as the oil markets go, there is a difference between the market and the molecules, and we're starting to see shorter inventories in the oil market.
How has this complicated the relationship of some of the Gulf nations with the United States in terms of what they're looking for and how much this potentially impedes some of their ambitions to become global business centers?
Yeah, I think there's two things that are of great concern to our Gulf partners. One is that the president grows frustrated, declares victory, and goes home and leaves them with a mess that's not of their own making and something that they didn't want. It is a major concern. I've heard from Saudis, I've heard from Emiratis, I've heard from others that this is something that the leadership and others are very concerned about. And then there is the question of whether the Gulf model of development can continue as it had. The idea being that this is a safe, stable, secure place in which to invest, to establish data centers. Right now, though all of those things are questionable, although the market, once again, people seem to continue to believe that these places are, over the long term, places that can be critical parts of the global economy.
Steve, there's a whole industry dedicated to criticizing the president. This is not actually a criticism, it's just an observation. This is very off-brand for the president when it comes to geopolitics. This whole adventure has been very off-brand. And I would suggest even the last week has been very off-brand. This is an administration that has claimed to pursue peace through strength. and criticised the previous administration for not showing American military might and securing peace through those means. And yet, Steve, this is looking more and more like what we saw under Biden, particularly the last week, letting these kind of things go. Stephen, what's behind the change?
Yeah, this is a rather extraordinary change for the president. He was in the Gulf just a year ago, and he said things that are diametrically opposed to what he, in fact, is doing. Just the investment in the region, the military investment, all of that is counter to everything that he said when he was in Riyadh last May. And then now, where he is willing to let things go, it is one thing for the president to suggest, well, you know, the Iranians attacking are below the threshold of a ceasefire. But when it comes to the Strait of Hormuz, on a daily basis, the Iranians are trying to prevent commercial shipping from going through the lane in which the United States is committed to assist commercial shipping traversing that waterway. The fact that we haven't responded to that does not suggest peace through strength.
Stephen Cook, it's good to see you, sir. Thank you. Stephen Cook there, the Council on Foreign Relations. It's an observation I think we're all paying attention to, the shift that we're witnessing under this president.
The U.S. right now is very much so on the defensive. So they're responding to attacks. They're not on the offensive and making it clear that we will not be tested yet again, because we continue to see these skirmishes happen between Iranian forces, the IRGC, and the U.S., and especially our allies like Kuwait and Bahrain that have been really under intense fire and pressure from the regime.
Crude just about unchanged off the back of this mess at the moment, which is unbelievable. The price action this morning, the fireworks in equities, tech stocks declining once again. We're negative by 0.8% on the S&P 500 and down a whole lot more on the Nasdaq. On the Nasdaq, negative 1.2%. Up next on the program, we'll catch up with Thoma Bravo co-founder Orlando Bravo, declaring an end to software AI disruption fears. Plus, Yahaira has your morning movers. Supermicro joining the race to raise cash for AI spending. Check out that move in the pre-market. The stock is down 10%.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
This equity market is beginning to look increasingly fragile, particularly in the chip sector over the past few sessions. Equities declining once again, down by 0.75% on the S&P 500. At the highs yesterday, we'd bounced back big time, up 1%. Then we were down 2% at the lows, down marginally at the close. On the Nasdaq, we saw some wild swings, down 4% at one point. The Nasdaq this morning down by 1.2%. And if you want some really, really wild swings, check out the Philadelphia Semiconductor Index. That particular index was down 8.6% at the lows, and at the highs was up 2.8%. So 10 percentage point range. And to your point, Bram, I know every single morning you're looking at the same thing I'm looking at, which is South Korea and the Kospi, which is pretty wild in and of itself.
I mean, some of these losses have just been shocking, right? We saw a more than 8% move to get down on just one day. You see this incredible volatility, and you start wondering how much are these leveraged funds that are getting whipsawed by sentiment and trading around the margins. What's fascinating is, yes, you're seeing this fragility and this increased volatility, but you're seeing a broadening out with actual gains for 3/4 of the stocks, and you're seeing less bond market volatility. So there's something going on, and no one can really put their finger on what it is that's creating this volatility in these names.
Well, Steve Chivarone touched on this a little bit when it comes to this massive amount of tech equity issuance. Potentially, he says this could be the case for selling pressure when it comes to other areas in the market to make sure that they can loosen up that capital to get in. Friday is going to be a massive deal for this equity market.
There is a record-breaking mega IPO on the horizon, and in between that, some equity offerings from some single names as well. So let's get into that. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Exactly. We start with that one. We are seeing Supermicro down 10% in the pre-market as it becomes the latest company to join the party to raise capital, announcing a $7 billion equity raise. Sales of its AI servers have surged, but that just means it needs more money and more cash to fulfill some $39 billion in orders. This follows a period of significant cash burn for the company as Supermicro has to spend heavily upfront for chips and other components, which of course we know have gotten pricier. Speaking of chips, we are seeing some signs on demand from TSMC, reporting a 30% jump in sales for the month of May. That is, of course, strong, but a bit weaker than Wall Street expecting. Also, hanging over the stock is sentiment in the chip sector is weaker again today, with names like Intel, AMD, NVIDIA, all lower, coming after the Philadelphia Semiconductor Index, as you mentioned, ending the day down 7% in yesterday's session. And we get the next big test on the AI trade later today when Oracle reports shares are falling into that, down some 2.7%. And looking through analyst notes, the big question will be how quickly Oracle is building data centers and converting AI bookings into actual revenue at a time when we know demand is already strong. So all about execution here.
Yahira, thank you. Thank you for the update. More from Yahira later on in the program. On our radar this morning, SpaceX drawing tremendous investor demand ahead of its mega IPO. Reuters reporting the offering is approaching 4 times oversubscribed with over $250 billion in orders. Elsewhere, TSMC shares pulling back. The chip giant reporting a sharp rise in monthly revenue. Asia's largest company seeing a 30% rise in sales as AI demand shows no signs of slowing. And yet here we are, down by close to 3%. And finally, check this one out. Apollo and Blackstone finalizing a $35 billion finance package for Anthropic to expand its AI infrastructure. The deal will fund Google's custom chips for Anthropic to lease, with Broadcom backstopping payments on the largest senior portions of the debt.
Things are getting creative in terms of some of the structures and what pieces people are picking off and how they're backstopping some of their investments. The numbers are getting bigger and bigger, the players having to deploy things. When you talk to someone like from Apollo or Blackstone, they talk about trying to get security, having a short duration piece, maybe 5 years, et cetera. The numbers are just mind-boggling, though. I mean, you start to look at some of the circular financing. You start wondering how much everybody is just hinging on each other's success for everybody to go up. You're seeing that with respect to Google and what they're doing with Anthropic. You're seeing this across the board. Everyone is just becoming completely intertwined and hinged on this being a successful story.
That's the obvious criticism here, that this looks circular, that it's off-balance sheet debt with an IG rating. Thank you, Broadcom. And if you're not familiar with the structure of this particular deal, there are 3 tranches. The riskier piece of this, you compensated with extra yield, but Anthropic's on the hook for everything. The more senior portions of this debt, you get the residual value of the chips. If that's not enough, Broadcom steps in, hence the IG rating on the more senior level of the debt. Does it sound risky? Does it sound creative? It sounds creative, yes, but if you think back to, say, the car business of the last 20, 50 years or whatever, take a GM, a Ford, financing the purchases of their vehicles, so long as it's a small part of the business and not a large chunk of the business, and the argument I think we'd hear this morning is that for Broadcom, this is only a small part of the business. More broadly, though, Brammer, I think you're on exactly the right point. We are seeing very creative ways to raise more and more capital. And not every company has very flexible capital structures and the ability to do an alphabet and say, you know what, I'll go to Canada, I'll go to Switzerland, I'll go to the UK, and I'll borrow $40 billion, $60 billion in over 4 months. Not everybody can do that. And when you see the equity piece of this, I actually find the story that Yahara talked about just moments ago. Supermicro comes out looking to raise equity, stock gets hammered. Meta talks about raising equity, stock gets hammered, just a report of that in the Financial Times. They're the things I'm focused on. Is that pushback going to start to build to the point that these companies have to reconsider their plans?
How much are these companies increasing their risk? Essentially, if they're taking down the riskiest part, if they're taking down the leverage, if you aren't necessarily accounting for the cost of all of the purchases of the chips until those chips are deployed, that is a depreciating asset over time. How do you calculate the risk that's building in some of these companies with all this creative financing? That, I think, is the increasing difficulty. And the fact that they just keep needing to raise more and more money. I mean, really just a handful of names needing to raise more than $600 billion of debt this year gives you a sense of what we're talking about here.
We're focused on these IPOs on the horizon. I get it. They're all the headlines. I understand that. But the amount of money being raised on the debt, being raised on the debt and equity side just over the last 12 months has been phenomenal.
And it's going to pay for prices that keep going up. This is the key issue, right? Prices go up, so their CapEx has to go up. And then the prices go up further, and then their CapEx goes further. And at what point are you paying for the inflation that you're seeing in all of these different components?
Elsewhere, private market deal makers gathering at the annual Super Return Conference over in Germany. Danny Berger focused on many of these issues. She joins us now from Berlin. Hey, Danny.
Hey, John, that's correct. And there's one issue I want to focus in on particular, and it is the state of software and private equity. And we have the leading voice to talk about that. It is Orlando Bravo, the co-founder of Thoma Bravo. Orlando, always a pleasure to see you here.
Danny, so good to see you. This is our yearly tradition.
It is our yearly. I would be gutted if we didn't meet, same place, same time, every single year.
One of the reasons I come here is to do this.
Okay, hopefully among the top. And I know this year you have a particular message. I remember earlier this year you were talking at Sohn saying, the SaaS apocalypse, the worst is over. Does it go further in your mind, just the worst being over? But is this thing over, Orlando? Where are we in the world of the SaaS apocalypse?
Danny, SaaS apocalypse, for whatever term, and that's a terrible term, by the way. I really don't like that term. It is finished. No more. And it's pretty simple. You know, people are realizing that these are unbelievable companies. And you look at the numbers coming out, even after the first quarter. And secondly, and more importantly, people are realizing that SaaS companies just don't stay still. They're not static. They evolve with infrastructure. They evolve with opportunity. And SaaS and agentic are going to merge very, very, very quickly. And these companies are the future of agents in the enterprise. And the market is realizing that as well.
So the freak out is over, essentially. Is that what you're saying? In private markets, is this stuff starting to be realized, your portfolio, maybe some of your peers, at the valuations that you think they should have? Or is there still some frozen assets, some stickiness that has yet to come unglued?
In private equity, the environment is pretty stuck right now. Now, I do think that private equity is the voice of reason in a lot of this, because it makes sense that deal activity is a lot slower. Because if you're going to buy a technology company or a software company, a solution provider to the enterprise, now you really want to see that they're making a lot of progress around their AI offerings. Enough time has passed that you should see that in the business, because that's where the whole world is going to evolve to. So why not wait a little longer before you pull the trigger and have a little bit more clarity? That makes sense to me.
That doesn't sound like the worst is over, Orlando. It seems like there's still things that need to be tested and figured out. So what is the aspect? Is it just, are you saying our companies are healthy, or is there something else that the worst of the freak out is truly over?
Well, the freak out really happened in the public markets.
True.
Right? And you've seen since April, software stocks have rebounded really, really strongly. But the other thing that you notice, and this is really about public investor sentiment, is that whenever there's an announcement about one of the great LLMs coming out with an amazing model like today, the whole software industry doesn't collapse or react to it. A big place where you saw the freak out, as you called it, be completely over, is where we invest 50% of our dollars in cyber. This is a huge tailwind to cyber, and that's one of the sectors that has rebounded really strongly over the past month.
What about in lending? What are conversations with your lenders like? I remember we had a conversation saying the cost of capital has gotten a little bit higher because of concerns. Has that come back down, or are there still difficult conversations to be had?
Lending is very difficult because, and I'm going to be completely upfront about this, there are many large asset managers that need to raise so much money monthly, and from retail. And it's not the most popular thing right now to pile that money into software. So it is a much tighter environment. Now, on the buy side, of course, that hurts you with financing, but it means you pay a lot less. And funds like ours, we do a lot better in down markets than in up markets because we're value investors. So we're really enjoying this opportunity. But once again, we're treading carefully because we want to buy companies that are part of the future, not companies that are stuck in the past.
By the way, Thoma Bravo, more than most companies, has been very successful with exits. You've also had some really successful IPOs, too. We're going to get SpaceX this week. We learned that OpenAI is going to be coming to market. Anthropic also filed for an IPO. Is this good or bad for the IPO environment and prospective exits? Because, for one thing, it starts the capital flowing, but there's also this question, is it all just being funneled? Are these just black holes of capital if you're competing for the same institutional money?
Exactly. So both points are so true. I was talking to my partner, Seth Borough, about this. He's in charge of a lot of companies along with Holden Spate that look like they're great IPO candidates in the $25 billion, $30 billion valuation range based on about $1 billion of free cash flow and their growth rates. And both of them told me last year, we won't be able to do anything this year because all the attention and all the time, let alone the dollars, are going to be focused on these massive, historic IPOs. So these smaller caps, which we are now, I guess are much more difficult to get the attention in the short term. Now, medium term, I really hope they do well because they're really important moments for capital markets and their depth. And if they do well, you'll get more confidence in the IPO market.
Well, what is a typical period for that? I know SpaceX we don't really have a historical corollary because it's just so large in size. But what would be your estimation of when you can enter back into the IPO market after these come in?
Hopefully 9 months, a year after. Now, that's a guess, right? So many things are up in the air. What happens with interest rates? What happens with valuations? Is there a slowdown in the infrastructure build? There's so many questions, right? It's a wild investing environment. People are saying a lot of strange things in investing right now. And the toughest thing for people that have a core competency in something is to stay the course. And of course, once again, you have to be part of the future, but you have to stick with what you know really well.
Well, remember you and I last year had this discussion that this industry had lost its way. Do you think people have had that come to Jesus moment? Have they kind of come around, or are there still lessons to be learned, do you think?
They're having it now. Look, if you see some of the software troubled credits, which there are, it's out there. It's not yet a product of AI having impacted those companies or those companies failing to transition to the new platform, which, by the way, is the biggest opportunity in the software industry. It really, really, really is. It's an issue of how those companies were run. People thought 10 years ago, after they saw all this money being made in private equity and software, that it was really easy. I buy subscription revenue, 90% gross margin, I cut some cost, and I'm good to go. They forgot to innovate, and they forgot to invest in R&D, and they forgot the domain knowledge of existing management by replacing them. And that's coming back to create some flatness in the environment, which is very difficult for those businesses.
By the way, any huge calls of how many people are going to be losing their jobs?
Look at this conference. As you know, I'm an optimist, but what we're seeing in development, the great use case for AI is we're hiring a lot more developers.
Orlando, so great to see you. Thank you so much for joining. Always a pleasure.
Thank you.
John, that's Orlando Bravo of Tomo Bravo. Interesting to hear. Again, he didn't like the term SaaSpocalypse ever, but it is dead. But also that IPO window might need to wait a little bit before you can bring companies public, just given the gravity pull of SpaceX.
Interesting. Danny, nice work this morning. Enjoyed the conversation. Thank you. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. US CPI data due out at 8:30 a.m. this morning. Economists expecting headline inflation to touch 4.2%, the highest since May of 2023. The core CPI forecast is for it to come in at 2.9%, up 0.1% from a year ago. Investors are raising rate hike bets ahead of today's CPI print and next week's FOMC meeting. A Florida trading company says it's in advanced talks to send Cuba the biggest cargo of U.S. fuel since the Eisenhower administration. Vanguard Energy is gearing up to export 250,000 barrels of diesel and gasoline. Anthropic is releasing a Mythos-like model without cyber capabilities. Fable 5 will have guardrails that prevent it from responding to certain types of queries, including those related to cybersecurity and to biology. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, the Fed rate hike debate.
Inflation expectations, a tight labour market, both are signalling cause for concern. We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year. That leads us to 3 hikes starting in December.
That's the case to hike. Up next, the case to cut. Not once, but a few times. Veronica Clark of Citi joins us next.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, the network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equities declining this morning by 0.7% on the S&P 500, down by 1 percentage point on the Nasdaq. A pullback on the Russell by 0.7%. Yesterday was interesting. The bond market actually provided an offset. 2s, 10s and 30s, a 4 basis point drop across the curve. Yields this morning up by not even a single basis point. 2s back to 412. 10s at 452. Heading into CPI later this morning. As Lisa said earlier this morning, we're looking for a 4 handle on headline inflation.
People are going to be looking at the underlying components. What's driving this? Is it being driven purely by energy costs? The core CPI is going to be really key in focus. How much not only is being driven by energy, but also AI spending? And can you strip that all out and saying the consumer still isn't necessarily increasing their spending that much? Or do you have to take a look at some of the inflationary inputs that were really in play when the Fed was hiking rates?
And then a week today, Kevin Walsh at the Federal Reserve. Under surveillance this morning, the Fed rate hike debate.
I would think of the break-even market as a faulty fire alarm. You rely on it to get that signal, but you're not getting it. Inflation expectations, a tight labor market, both are signaling cause for concern. We need to see the Fed remove the easing bias and ultimately remove the insurance cut from last year. That leads us to 3 hikes starting in December.
So here's the latest this morning. Investors raising rate hike bets ahead of today's CPI print and next week's FOMC meeting. Veronica Clark of Citi suggesting cuts are more likely than hikes, writing, in our base case, the Fed cuts rates 75 basis points this year, with 25 basis point cuts in September, in October and December. Veronica joins us now for more. Veronica, good morning.
Good morning.
Explain yourself.
I know.
4% inflation later this morning. Potentially. We'll see what we get. And you've got 3 rate cuts for this year.
A lot has to change, of course, right? The most important thing I think that will change is that we will see weaker labor market data over the summer. Certainly don't see that yet in payrolls, but there's a lot of conflicting evidence. You know, we've had such strong payroll job growth, but the unemployment rate has stayed at 4.3%. We haven't seen wages pick up. Hiring plans have come back down again. Those tend to lead payrolls. Now initial jobless claims are rising. So I think we will see weaker employment data this summer. And then, yeah, you need to see some favorable details of inflation. And there's probably going to be more of this debate among Fed officials of what's the right inflation measure to look at. Core PCE is incredibly strong, but it seems like the outlier. And I think we'll see some better details even in CPI this morning.
Let's stay on the labour market. You mentioned that. That's the basis for this call. We had weakness in the labour market last summer, weakness in the labour market the summer before. Feels like we've got momentum this time going into this summer.
Yeah, payrolls have been stronger, but I'm really cautious that the payroll data has just gotten really volatile this last year. We've had some months now where they're consistently stronger. But what I think might happen is that when we get such a big shift in immigration patterns, and I've seen this in Canada also, is that you can just create this shift in employment patterns throughout the year. And maybe that's why you haven't seen such a retightening in the household survey, the unemployment rate, that's stayed stable. And that stayed stable while immigration has slowed, and that's stable ahead of the summer hiring season. When you do get students looking for work, new graduates entering the labor force, it's that summer season when you're supposed to hire a lot of people and then you're not. That's when we see the unemployment rate rise. So.
At the same time, we did see the employment number rise quite a bit. And a lot of investors say maybe this data is kind of messy. So look at what the companies are saying. And what the companies are saying is robust demand, robust growth, robust profits.
Yeah.
At what point does that make you a little nervous about your thesis?
Yeah, they're also saying, though, that we're not hiring people. So we got the full details of the NFIB Small Business Survey yesterday. We got the jobs details of that last week. Hiring plans in that NFIB survey do tend to be a good leading indicator for payrolls, and they broke through the lows in May. So they're the lowest that we've seen really since the pandemic. So yeah, people are still spending, but there's been this pattern for a couple years that you can have this really low hiring, weaker labor market, enough to keep the unemployment rate gradually rising, but consumption is still strong.
Can the Fed cut rates if it ends up spurring capital markets even further at a time when they are incredibly hot and people are raising tens, hundreds of billions of dollars? I mean, I can't even get my head around some of these numbers, and are able to do so because they are wide open and increasing inflation in certain pockets.
Yeah, that is the best argument for maybe why you shouldn't be cutting, because the inflation that you see really is coming from maybe the business sector, right? It's that AI-related inflation. For PCE inflation, it's also equities that are rising, those financial services prices. PCE in May probably looks pretty strong. But if you're considering what traditional drivers of inflation, tight labor markets, housing, what is higher rates going to do to home prices that are already flat on an annual basis, and wages that have already slowed back to pre-pandemic, and it's not a source of inflation.
A lot of the Fed speak has focused on individuals saying it's time to go back to neutral. Who do you think represents your position right now at the Fed?
I think the Fed official that I would pay most attention to that maybe sounds the most, cautious like I am on the labor market is Mary Daly. And yeah, most Fed officials, of course, are going to be fine leaving rates as they are now. We're going to see, guidance removed and everything next week. But if there were to be any signs of the labor market loosening again, I think someone like Mary Daly would be an early indicator of that.
Bank of America thinks it's messy as well right now in the labor market, but they don't think it's M-E-S-S-Y. They think it's M-E-S-S-I. They think it's the World Cup.
Right.
Do you think there's a World Cup impact here?
People started to cite that right after we got the data. We had the strength in leisure hospitality, a big interesting increase in local government employment. Maybe there's some security or something related there. We'll get the state level data in a couple weeks. It does not align perfectly with the national data, but probably gets more important as people try to pick out, as the hiring in these states that are hosting the World Cup.
Veronica, good to see you. Looking forward to that data as well. Veronica Clark there of Citi. Heard that explanation repeatedly over the weekend to really support that massive surprise we saw on payrolls.
I asked Scott Kirby about this from United Airlines, and he said it's an infinitesimal point. However, on my plane back from Brazil, the number of people wearing Brazilian jerseys, first of all, that's just sort of the uniform you have to wear in Brazil, is that sort of
that was the Bolsonaro
yellow
uniform at one point, wasn't it?
And green. I mean,
it took on a very national.
It was very political at the same time. Either it was political or everybody was going to the World Cup because nobody could speak English and everybody was wearing that jersey.
This has nothing to do with the economy. My favorite thing about the Brazilian team, they blessed the plane on the tarmac. I think you sent me this video.
They baptized it.
Yes. Can we get a Jesuit or something down at MSG today before Game 4?
Big game a little bit later. You heading over?
No. I mean, maybe.
Is the president going back?
A sports reporter came out and said the president will not be attending Game 4 after rumors. So I guess there was an inquiry sent from the White House, potentially, that I'm reading into this, about him going back. I think he wants to be there for a win. He doesn't want to be there for a loss. He stayed for the whole game.
Bramo's not interested.
Putting aside President Trump.
Tell us what you really think.
To have somebody shut down all the streets, all the watch parties.
But they're doing it again tonight.
All the joy
so what's the
that
reason
typically
why?
comes
I'm
from
totally
all
with
of
you.
this is you have to get there 4 hours in advance. Come on, this is New York.
They shut down the joy. How dare they?
I mean, it's not even about who it is.
I get you. I understand. Up next on the programme, could tell that Bramo was frustrated. Jim Bianco of Bianco Research.
Traffic.
Laura Galante of West Exec Advisors. Henry McVeigh of KKR. Tony Rodriguez of Nuveen, the second hour of Bloomberg Surveillance, just around the corner.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca? Maybe somewhere in the middle.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins.
We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
There's nothing in the data that leads us to believe that inflation is slowing down on a steadier basis.
All the inflation we're really seeing is supply driven.
The Fed is succeeding on the job side of the mandate, but not succeeding on the inflation side.
There's a lot of inflation in the pipeline, which is going to affect the actual CPI numbers.
I think it's going to be very important, and I think it's going to be grim.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Jim Bianco coming in hot this morning, talking about everything but financial markets.
It's the stuff people care about this morning.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your price action, financial markets, look like this. Equity futures on the S&P, negative 0.6 after wild swings in the last 24 hours. On the Nasdaq, down by 1 full percentage point. In the bond market, things settling down just a bit. Heading into CPI, 2s at 412, 10s at 453. And in commodities, energy not doing much. It's got every reason to rally, and it isn't. 91 on Brent, WTI at 87. Heading into this at 8:30 Eastern Time. Just around the corner, 90 minutes away, CPI in America.
Yeah, we're going to get a read that potentially is the hottest going back to 2023 in 3 years, north of 4%. And a lot of people are going to look beneath the headline. And the bulls, the hawks on the Fed camp are going to be talking about just the headline number and the reacceleration and how this is problematic, and it's coming from core as well. And the people who are dovish are going to say, look, it's all energy, it's all AI spend. And when you take a look at the other metrics, like we were just hearing from Veronica Clark, it isn't that inflationary trimmed bean. It's below 3%. Who's going to win out? Ultimately, this market is looking at the hawks.
There's going to be something for everyone on the Federal Reserve when it comes to this inflation print, whether you look at headline or core. But for this White House, owning a 4 handle on inflation is not a good look going into peak driving season and obviously the midterm elections.
So you've heard the case to cut from Veronica Clark over at Citi. Unemployment, the labour market. She thinks things will weaken through the summer. Don't see that right now. You've heard the case to hike from BNP Paribas. And BAP's point is something I've heard also from Matt Lazzetti over at Deutsche Bank. Framing matters here. Do you think we need to hike? It's one way of asking a question. Do you think we need to take back the cuts of last year is another way of asking the same question. And that's the push that I'm hearing more recently over the last week.
Did we take out too much insurance, given the fact that this market was running a lot hotter, this economy was running a lot hotter than people previously expected? And I would take that a step further and say right now, the momentum that you're seeing in capital markets, despite rates where they are, gives you a sense that maybe this isn't so restrictive for capital markets. It might be restrictive for families, for individuals. But for capital markets, that's fueling capital raises that we haven't seen before. And you're seeing everybody with their hand out. It's governments, it's tech companies, it's not tech companies that need to invest in all of these commodities that are increasing in the prices. And if the market is able to fund it, well, they can still pay for it and pay for higher prices. And guess what? That affects how much you're paying for your smartphone and how much you're paying for your life.
The crowding out is building, and you can see it. And there's just little bits of evidence building up that you're getting some pushback in the equity market. Friday, decent example. Meta in the FT, considering raising equity capital in a similar way to what Alphabet did a few days previously. Just last week, Alphabet raising $85 billion in equity capital. Massive number. Supermicro this morning looking to raise $7 billion in an equity deal for AI equipment. Look at that stock this morning, down by 10% in the pre-market. So you're starting to see the evidence just pile up, just little bits here and there. I don't think it's massive pushback, but just small signs of evidence that we're pushing things too far.
at a certain point, there has to be a finite amount of money unless you start printing it. If you start printing it, well, then we've got another inflation problem. But you start thinking about what Anne-Marie was mentioning, which is, where is the money going to come from to buy SpaceX that's going to start trading on Friday? And it possibly is going to come from a lot of index fund buying, right? So how are these index funds potentially rearranging their portfolios to absorb about 30% of the total float, which is what the expectation is right now?
Futures this morning down by 0.75% on the S&P 500. Coming up this hour, Jim Bianco of Bianco Research as the market sell-off is deepening. Laura Galante of West Exec Advisors with President Trump eyeing a piece of the AI pie. And Tony Rodriguez of Nuveen on how big tech is contributing to inflation. We begin this hour with stocks adding to losses. Jim Bianco of Bianco Research writing the market is operating under the assumption that the AI industry is not a bubble. AI is currently in a hype cycle. Jim joins us now for more. Jim, good morning.
Good morning.
We'll save the sports. We'll put that at the end, all right? Let's start with the financial markets. The hype. How much hype is there right now into this IPO?
Oh, I think it's off the charts right now as far as the hype goes. That AI is the biggest technology that we've seen probably in our lifetime. Everybody's investing in it. They've sold it. I'm talking about Dario Monti and Sam Altman, that if you don't invest in our company at $1 trillion valuation, everything else, everybody's going to lose their job and everything else is going to be worth zero. So they've really hyped it a lot. And so two things can be true at the same time. The technology could be very real and it could be very transformative. And we've also kind of overhyped these companies.
It's like employment protection, isn't it? We've said that a few times. You're all going to lose your jobs. You might as well buy the stock.
Yeah, you might as well buy risk on with absolutely everything and give your money away. That's how my father feels.
Do you think we're getting some pushback in capital markets now? Is it starting to build? Just small signs here, there and there.
Yes, I think so. And also I think that there's been a narrative out there that makes a little bit of sense that the sell-off we've seen this week is preparation for SpaceX on Friday. You know, where's the money going to come from to buy the IPO? Well, we're finding it out with the sell-off in the last couple of days. But yeah, I think we are starting to see a little bit of a pushback. But, you know, that's to be expected. Remember, we had an 8-week, 9 consecutive day rally going into the top. This is the kind of correction you get after that run of that magnitude.
Well, we're getting a pullback again this morning. Bring up the chart on the S&P 500. Session lows down 1%. Some comments from the president. Iran will have to pay the price. Iran is all talk and no action. Iran has taken too long to negotiate a deal.
They've taken too long to negotiate a deal, says the president, and that would have been great for them, he thinks. Quote, now they will have to pay the price. So this is definitely rhetoric in terms of escalation, not de-escalation. Just 2 days ago, I was with the president. He said we were 2 or 3 days away. Potentially, it could be very quick to get to an endpoint. He clearly is not happy with what's going on the negotiating table. He clearly is not happy with the fact that they downed a U.S. helicopter. We saw retaliation for that. It sounds like at the moment, if you take his words for real, that potentially we could see more retaliation.
Bring up crude, Brent, WTI. Push that story, those headlines through the energy market. It's worth not even a 2% rally on Brent crude this morning, just short of 93.
I was just thinking as Anne-Marie was talking, this market's not biting. I mean, essentially, people don't believe.
ओए गाइस, ये नेचुरल गैस में देखो यहाँ पर प्रॉफिट बुक करना. थोड़ी देर पहले ट्रम्प का एक ट्वीट आया है, उसकी वजह से प्राइस थोड़ा सा वॉलेटाइल हो रहा है, बट इट्स ओके. बाइंग का टारगेट डन. यहाँ से एक सेलिंग का प्लान रखते हैं वापस से. क्रूड ऑयल भी देखो रेंज के अंदर ही है, ज़्यादा कुछ मोमेंटम मुझे लगता तो नहीं होना चाहिए इसमें, सो थोड़ा कॉशियस रहना. एक सेलिंग का प्लान वापस से इन नेचुरल गैस. ओवरऑल नेचुरल गैस देखोगे ये भी रेंज बाउंड ही है, जब तक या तो ये नीचे 292 के ऊपर नहीं ब्रेक करता है या फिर 313-14 के ऊपर नहीं निकलता है, तब तक ये रेंज के अंदर ही है. तो थोड़ा कॉशियस रहना. ये लेवल भी अब ऐसा नहीं है कि नया लेवल है. दिस लेवल इज़ ऑल्सो टेस्टेड मल्टीपल टाइम. यहाँ पर मैंने पहले बता दिया था एक हाई बना था, दूसरे बार एक लोअर हाई बना था. ये थर्ड टाइम बाइंग आई है यहाँ से कल. अगर ये लास्ट स्विंग के ऊपर नहीं निकलता है, विच इज़ मुझे नहीं लगता निकलेगा, इस स्विंग के ऊपर 9300 के ऊपर, तो ये इसी लेवल पे रहना चाहिए. सो लेट्स सी कितना और ऊपर जाता है. एक सेलिंग का प्लान ही है नेचुरल गैस में. क्रूड में अभी मेरे अकॉर्डिंग कुछ नहीं है. सीपीआई का डेटा आएगा, उसके बाद फिर प्लान करेंगे क्रूड में और क्या प्लान कर सकता है.
And at the center of it was Anthropic, which has now gone from $380 billion in the first quarter to $956 billion now. And all that is now showing up in people like Amazon and Microsoft's income statements as other income. And so it's actually helping the stock market go up for a moment. But yeah, you're right. The whole premise on AI is that it's going to replace SaaS. This is really what it's going to do. That, as I like to say, there's a keyboard in front of us. In 2 years, we won't need these because we'll just have a context window. We'll just ask our computer what we want. It will produce the result we need. And so the whole interface that we'll have with computers will very well change. If that happens, then all this spending that we're seeing on AI is not overdone. But if in a couple of years, we're still going to need all the software that we personally have, plus everything else, oh, and we also pay for AI, then it is overdone. So will it meet that promise that it's going to fundamentally change the way we interact with data through software in a computer? If it does, it's not overdone.
That sounds more expensive than hiring someone to type.
It might be now, but the hope is that, you know, the cost will come down in the future. And that's really where we are. You know, if you want an analogy of what we're talking about here is the iPhone. Why do we pay $1,100 for an iPhone? It's not to make phone calls. It's that I don't need to buy a camera. I don't need to buy a video recorder. I don't need to buy a tape recorder or a photo album or anything else, or a calculator or a flashlight. It's all in one device. So I'm happy to pay that kind of price. Well, if I don't have to pay for all this software and everything else, I'm happy to pay higher prices for AI. But it has to fulfill that promise. If it does, then it's not overdone.
When it comes to what is going on, back to the president's truth about Trader Hormuz, he also said recently to the New York Post, potentially, that we could be here until September. Would that have any impact?
Well, if it runs down inventories, if, you know, the idea here is why we're at $90 is because we're offsetting it through less demand from China, who's running down their enormous inventories, and everybody else. So as long as inventories keep having room to be drawn down, we could make it to September. If we get to that, you know, operational limit that everybody talks about, then we will run into problems. It's hard to say where that level is, but the argument is, and I believe it, it's months, it's not years or anything like that.
Hey, Jim, it's good to see you in person. You want to squeeze in the rant about basketball, about New York sports? Do you want to get that in?
Yeah, well, you know...
Some friends ahead of client meetings a little bit later today. Go for it.
Right. I saw this with the Cubs 10 years ago. People were so invested in this team winning. They stood the whole game. You put so much pressure on the team, they lost all the home games. And they had to wind up winning the series on the road. And the Knicks might have to do the same thing.
Jim, it's good to see you.
Good to see you
in person too, buddy.
Thank you.
Thanks for dropping by. Jim Bianco there of Bianco Research. If you are just joining us, welcome to the programme. So these headlines just dropped in just moments ago. This statement from the President of the United States. He has taken a lot in the last week, accepted it and committed to de-escalation and diplomacy. Is that about to change? Check this out. Iran's military is a complete and total mess. Much of it, like their Navy and Air Force, doesn't even exist anymore. They've been completely defeated. Iran is all talk and no action. The bully of the Middle East is dead. They've taken too long to negotiate a deal that would have been great for them. Now they will have to pay the price.
It does look like his patience is wearing thin this morning, although we have to note we have been here before. Is this negotiating tactic from the president to put out truth like this, talking tough, to try to get them to have an agreement, because he has been hanging on to this ceasefire and he keeps signaling that he wants a peace agreement. But when I was with him on Friday and he was speaking to farmers, he said, and farmers who are dealing with higher fertilizer prices, higher diesel prices, he said it's either going to end with a piece of paper or another way. It'll be a harder way, maybe a quicker, but he was talking about more escalation.
Brent crude this morning up just 1% off the back of these headlines. Equities were already lower, down just a little bit more. We're negative by 0.9%, call it down 1% on the S&P 500. With an update on stories worldwide this morning with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Progressive Democrat Graham Plattner winning Maine's Senate primary. Plattner's campaign was plagued by a series of scandals and accusations of past misbehaviour. He'll face Republican Susan Collins in November. She ran uncontested in her bid for a 6th Senate term. California's SoFi Stadium averting a workers' strike just days before it's set to host the U.S. team's first World Cup match. Workers are scheduled to vote on ratification of the agreement, which will expire in April 2028 ahead of the Summer Olympics in Los Angeles. President Trump saying Iran is all talk and no action when it comes to working on a peace plan. The president saying Iran has taken too long to make a deal and will have to pay the price. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next, we'll get you an update on just that down in Washington, D.C. We'll catch up with Tyler Kendall in just a moment. Equity futures just off session lows. We're down almost 1% on the S&P from New York City this morning. Good morning.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Live from New York City this morning. Good morning. Check out the price action. Tech declines across the board. The Nasdaq down by 1.3%. The S&P down by 0.9%. The losses building up just a moment ago. More signs of increased tension between Iran and the United States contributing to that. Just on the margins. Check out the bond market. 2s, 10s, 30s. Yields shaping up as follows. 2-year yields up by a single basis point. And crude barely blinking off the back of some important developments taking place right now. A developing story with crude. Brent at 92 and up just 1%. WTI still holding on to an 89 handle. Under surveillance this morning, a renewed threat to Iran.
I would say the ceasefire is on massive life support. If there's no ceasefire, you're not going to have to know. You're just going to have to look at one big glow coming out of Iran. In that part of the world, ceasefire is when you're shooting in a more moderate manner. There's a reason for everything. And we hit them pretty hard. We're going to win one way or the other. It's going to be militarily or on paper.
So here's the latest this morning. President Donald Trump issuing a new threat to Iran. The president posting on social media moments ago, Iran has taken too long to negotiate a deal that would have been great for them. Now they'll have to pay the price. Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Hey, John, good morning. Well, it's clear that President Trump's patience is now wearing thin as he issues this new threat about Iran taking too long to come to the negotiating table. It's raising questions about what could be the U.S.'s next steps here after President Trump over the weekend in an interview outlined that his potential red lines for ending the ceasefire would be if Americans were killed or if he feels that a deal could not be reached or reached fast enough. Keep in mind, after we saw the worst flare-up in fighting earlier this week between Israel and Iran, our analysts at Bloomberg Economics said that this could represent 2 things. One, Iran may feel more emboldened to flex its muscles amid the ongoing negotiations being dragged out. Or 2, this could be the start of a wider escalation spiral. We'll have to see where this goes from here, because we did see the U.S. respond last night to an American military helicopter being shot down. While Iran hasn't denied that its forces were involved in that attack, it has indicated that perhaps it wasn't intentional in that helicopter going down, but it certainly flared with the tensions overnight, with both sides exchanging fresh fire. John, at this point, the White House still maintains that diplomacy is a viable option. Whether or not President Trump's comments change that remains to be seen. A person familiar with the matter did tell Bloomberg News overnight that the two sides do continue negotiations. They call the negotiations, quote, intense, and that they are being mediated continuously by Pakistan.
Tana Kendall, down in Washington, D.C. Tana, thank you. You read those headlines, you put together the stories of the last week. We said it early this morning, every single reason building up for a high crude price, and you don't see it on the screen this morning. We're up by just 1%.
Well, I think Jim Bianco really spoke to something that people in the oil industry are talking about, the fact that Kuwaiti barrels for the first time are starting to get out. They're going to China. ADNOC is getting stuff out. You had an Emirati delegation, Iranian delegation meeting when it comes to economic cooperation. Phone calls between Tehran and Riyadh continue. So maybe on the margins, more oil is coming out of the region than we can really understand. And that is what's keeping a little bit of a lid on prices. And on top of that, you get the verbal intervention of the president almost consistently, besides this morning, that he wants to see a peace settlement.
This wasn't meant to be the focus down in Washington, D.C. today. The focus was meant to be a meeting. Still don't know if that meeting's taking place between the president and a bunch of founders, leaders of the OpenAI Anthropic world.
You always call it the phantom call in Trump's first administration.
This is the phantom meeting.
This feels like a phantom meeting because the president told us on Air Force One, and he was like, did you guys know about that? And we were like, no, please tell us more. Who's going to be attending? He says there's going to be a meeting this week between, he said, all of the big ones, so Anthropic, OpenAI, SpaceX, when it comes to how there could be some sort of financing, public-private partnership. Some are even saying go as far as what they would call nationalization of these companies, the government taking equity stakes, yet there is no meeting. Potentially, though, there's one on the horizon. The president is manifesting.
The notice reporting that maybe the companies weren't even aware of this meeting.
Yes.
Ahead of this meeting. Laura Galante of West Exec Advisors and member of the OpenAI Frontier Risk Council writing the following. The Trump administration has already supported government involvement in strategically important sectors. AI seems to be the next category. Laura joins us now for more. Laura, welcome to the programme. What is the argument to take stakes in these companies?
Jonathan, the argument is around the national competitiveness of what AI brings to the U.S. So there's two pieces that I think Trump's reacting to, and Bernie has a proposal on this as well, where they're looking for ways, the administration's looking for ways to take the wealth that is going to be coming and is coming from these AI companies, from the transformation that's happening. And also, there's a public risk and an exposure piece here that's coming down the line, too, ahead of these IPOs. And look at this and say, how do you keep the innovation moving forward? How do you keep this competitive advantage moving forward, especially vis-a-vis China? And this ownership question, do you take a stake in these companies, is really where, the debate's focused the last couple of weeks. But what are we trying to achieve, and are there ways to do that still give a competitive edge to the U.S. and to this technology?
One key point will be who are the personnel staffings that are going to make some of these decisions and have the expertise. Laura, we've seen a number of individuals depart the White House recently, most recently Thomas Lind, who had really been the architect behind a lot of the AI strategy of the White House. Does that concern you?
I think that more than, a single person here or there moving on in terms of strategy, the question is what tools and who is going to be thinking through creative ways to either do competitiveness policy, do industrial policy, and look for ways to keep the innovation moving, to keep these companies in a place where they can have a public discussion around risks, and then be able to channel that to the levers of state that you have when you're sitting as an incumbent administration. And I think the capacity question that you're getting at is huge here. Do you have the people? Do you have the expertise? And then
गाइस 5 PM हो गया, 1 घंटे के बाद डेटा आने वाला है. मुझे लग रहा है शायद प्राइस थोड़ा बहुत हॉल्ट करना चाहिए करंट लेवल पे दोनों जगह, क्रूड ऑयल नेचुरल गैस में. यूएस सीपीआई मतलब इन्फ्लेशन का डेटा है मंथ ऑन मंथ ईयर ऑन ईयर बेसिस पे, एंड कोर सीपीआई का डेटा भी रहेगा. 7 बजे यूएस मार्केट ओपन, 8 बजे क्रूड ऑयल की इन्वेंट्री फोरकास्ट देखोगे लास्ट टाइम -8 था, इस बार -3 लास्ट टाइम से ज़्यादा एक्सपेक्ट कर रहे हैं. तो अगर ये बुलिस ज़्यादा आता है तो इट इज़ बुलिस फॉर द प्राइस. तो फोरकास्ट तो बुलिस है. लेट्स सी एग्जैक्ट डेटा कितना आता है क्रूड ऑयल इन्वेंट्री का. लास्ट टाइम -8 था, इस बार -3 है, मतलब लास्ट टाइम से इन्वेंट्री ज़्यादा एक्सपेक्ट कर रहे हैं, तो अगर ज़्यादा आई तो इट विल बी बेरिश, सॉरी, क्रूड ऑयल फोरकास्ट फॉर द इन्वेंट्री इज बेरिश, बट इंपॉर्टेंट डेटा इज सीपीआई, इम्पैक्टफुल डेटा रहेगा। ठीक है, बाकी जैसा मैंने बताया क्रूड ऑयल इस लेवल पे मल्टीपल टाइम टेस्ट कर चुका है, अब नीड टू सी हाउ फार इट विल होल्ड दिस लेवल। एक छोटा सा टारगेट था, हो चुका है। देखो अगर ये होल्ड करता है अबव 8700 के ऊपर, तो वापस पॉसिबल है 9000 तक चला जाए। यहाँ कोई रेजिस्टेंस नहीं है, दैट इज़ अ कंसर्निंग थिंग। रिकवर कर गया पूरा, नीचे ब्रेक करना है तो ब्रेक डाउन चाहिए 8100 के नीचे, जो अभी तक मिला नहीं है प्राइस को। तो क्रूड ऑयल ने मेरे अकॉर्डिंग तो अगर चाहो तो यहाँ पर बुक भी कर सकते हो। बाकी अगर देखो मोमेंटम एज आई सेट्स 8700 के ऊपर सस्टेन किया तो पॉसिबल है 9000 वापस जा सकता है। बट अगेन यहाँ पर कोई रेजिस्टेंस नहीं है, डायरेक्टली सेल नहीं कर सकते। सेलिंग के लिए दो ही ऑप्शन है, मार्केट या तो नीचे ब्रेक डाउन करे या वापस रेजिस्टेंस पे आ जाए, या कोई नया रेजिस्टेंस ही क्रिएट कर दे, जिसके चांसेस अभी कम है। एक और ट्वीट किया है ट्रम्प ने, ट्रम्प सेज ही इज नियरिंग अ डिसीजन on launching additional strike against Iranian power infrastructure and bridges. Major news. Obviously bullish for crude oil, bearish for the market. फॉक्स न्यूज़ की ओर से कहा गया है that Trump says it is nearing a decision on launching additional strike against Iranian power infrastructure. Let's see ऐसा होता है या नहीं होता है. थोड़ा सा नेचुरल गैस का ट्रेड का ध्यान रखना, एसएल स्ट्रिक्ट रखना, कहीं न्यूज़ की वजह से डायरेक्शनली ना जाता चला जाए प्राइस. इवन दो रेजिस्टेंस है, ठीक है. क्रूड में तो मैं सेलिंग कुछ एक्सपेक्ट नहीं कर रहा हूँ अब, या तो ब्रेकडाउन आए या फिर रेजिस्टेंस तक जाए तभी देखेंगे. चीज़ का ध्यान रखना, ये जो मैंने चार्ट लगा रखे हैं ना, ये मैंने एडजस्ट फॉर कॉन्ट्रैक्ट चेंजेस पे नहीं लगाए हैं, तो हो सकता है आपको थोड़ा सा अलग दिखे. मैं फ्यूचर के जो चार्ट यूज़ करता हूँ नॉर्मली, मैं यूज़ करता हूँ एडजस्ट फॉर कॉन्ट्रैक्ट चेंजेस, से प्राइस थोड़ा सा स्मूथ हो जाता है, अदरवाइज प्राइस आपको काफ़ी ज़्यादा अलग दिखाई देगा. तो ध्यान रखना, जो लोग यूज़ करते हैं यूज़ दैट फॉर बेटर प्राइस एक्शन, नहीं तो सपोर्ट रेजिस्टेंस आपको अलग ही दिखाई देंगे वहाँ पे. 5:30 न्यूयॉर्क सेशन ओपन होगा. कि अगर ट्रम्प ऑर्डर दे देते हैं यूएस फोर्सेस विल strike against Iranian power plants and bridges. It will be devastating for Iran actually. कल जो स्ट्राइक करी है वहाँ पर ऑलरेडी उनके काफ़ी ज़्यादा वाटर सप्लाई रुक चुकी है ऑलरेडी ईरान में. So need to be see what kind of strike US will do again if US president gives the permission. Right now, crude oil, equity market, gold पे कुछ खास impact नहीं दिख रहा है. Gold is still become a steady. अब मेजर रहेगा आज का भी सीपीआई का डेटा आ रहा है, उसके बाद गोल्ड क्या करता है, क्लोजिंग कहाँ होती है आज की डेली टाइम फ्रेम की. अगर अभी फिलहाल के लिए गोल्ड फ्यूचर देखोगे कॉमेक्स में currently trading at 4189. If it is close below 4214 COMEX, okay, I'm not talking about any specific broker chart. I'm talking about directly the US gold future, which is traded in the COMEX. So If gold closed today on a daily candle, below 4,000 4,000 to 40 continuously, आज और कल दोनों डेज पे 4,000 to 40 के नीचे क्लोजिंग आती है तो we can expect price can go more towards, as I said on morning and yesterday we can expect 3,800 as well. 4,000 to 40 के ऊपर क्लोजिंग आती है तो we can still expect price still give some pullbacks. नेचुरल गैस कैंडल इज ऑल्सो वॉलेटाइल. आज की डेली टाइम फ्रेम की कैंडल ने लास्ट दोनों डेज का लो ब्रेक करके दोनों डेज के ऊपर निकल गया है प्राइस, तो ओवरऑल तो बुलिश है. लेट्स सी थोड़ी बहुत प्रॉफिट बुकिंग मार्केट यहाँ पर करता है बिकॉज मेजर रेजिस्टेंस एरिया अगर ये निकल गया इस लेवल के ऊपर भी तो फिर थोड़ा सा देयर इज अ प्रॉब्लम यू कैन से.
in 2021, but we've left green. And so I think that's something as this story unfolds, and Lisa and you were talking about this earlier, which is it's not just the debt. You can't just keep issuing debt. You've got to put some equity into the structure too. And can the market digest that? And so we'll have to watch. But it's definitely going from a very green, incredibly positive backdrop to one that's more mixed. My personal take is it's actually not going to be the IPOs. It will be in 2027 where you have the secondary supply when the unlocks come on. So the IPOs are going to make the headlines, but when you look at it in aggregate, it's probably 300 and 400 billion. That's not a teeny number, but relative to what can come on the supply, that's more problematic.
As you look across asset classes right now, which part of the market is more vulnerable to so-called crowding out with all the supply coming through, both in debt and equity?
I think look, to me, most investors are globally underweight infrastructure. They have about 3% of their portfolios in that. That probably should be double. That's going to grow. The tech boom is where you've seen the excess, and it's hard to argue. You have this difficult thing because semiconductor chips, particularly in Korea and other places, are trading like 7 times earnings. They're growing 100%. So it's going to be what's embedded in the price, and it's going to be the second derivative. Our model is showing very strong earnings growth through 26, and then starts to slow down in 27. Higher rates, tightening, central banks, and oil. Oil's actually not a coincident indicator. It's a lagging indicator. Usually comes through the system about 12 to 15 months later. So I think what you want to watch, I think this year we have the chance that we beat earnings nicely, and it keeps the market doing okay. I think when you look more towards the second half of 27, that's where we would see a little bit of softness in the earnings.
Henry, this was a privilege, a pleasure. Thank you,
Always
sir.
Great to see you guys.
One of those conversations I'll go home and listen back to. Henry McVeigh there of KKR. Lisa was talking about the record debt that we've seen so far. Hannah Benjamin Cook and the team here in Bloomberg put some numbers on that. $504 billion of debt, sovereign, issued so far this year, more than the first half of 2020. Think about how much was issued through the first half of 2020. We've beaten that.
Yeah, well, prices are rising and the governments want to get on it too because they're all trying to solidify some of their domestic security and their critical minerals. What Henry McVeigh also wrote about in this piece, which I thought was really interesting, was that during times of industrial revolutions, there tends to be a confluence between government affairs and government issues and political issues and economic ones. And we're seeing that in a massive way, and you see it particularly in the physical goods space.
Some big shifts, that's for sure. The S&P this morning, session lows were down 1.1% on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. President Donald Trump telling Fox he's close to ordering new strikes on Iran. The warning coming after Trump posted on Truth Social, Iran will, quote, pay the price for taking too long to negotiate a peace deal. Trump going on to post about the U.S. blockade of the Strait of Hormuz, writing, quote, nothing gets through unless we want it to. It is a steel wall. Iran is doing zero business, not paying their military or any of their bills, and quickly becoming a failed nation, unquote. TSMC reporting a 30% rise in its monthly sales. The increase reflecting continued strength in demand spurred by a global rush to build AI infrastructure. Asia's largest company has become an essential global AI player by making cutting-edge semiconductors for companies including NVIDIA and AMD. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in the next hour. Up next on the programme, big tech driving inflation higher.
Inflation remains above target. I think that the rate-insensitive purchasers, the hyperscalers, that really hits the nail on the head. That is inflation or overheating. This is increased demand outstripping supply and raising prices.
Up next, Tony Rodriguez of Nuveen.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Equities declining here. We're down 1% on the S&P 500, negative almost 1.7 on the Nasdaq. It's been a wild ride for tech in the past few days, going into a record-breaking IPO in the next few days from SpaceX. Adding to this move lower, some comments from the president a little bit earlier, losing some patience with the Iranians. Only 24 hours ago, not even, the president was talking about closing on a deal with them, and now it's maybe striking him again.
Yeah, he said that to my face. He said it could be 2 to 3 days. And I said, did you mean weeks? Because he usually likes to do 2-week increments. He said, nope, I mean days. So now he's saying that basically when it comes to Iran, they've taken too long, in his mind, to negotiate a deal. He said it would have been great for them. Now they will have to pay the price. So everyone is expecting two things. One, is the president just using rhetoric to negotiate better terms or try to get the Iranians back to the table? Because we don't really have a lot of insight on where they are in the stages of these talks, or is he serious? And we're going to see more strikes.
You wouldn't know based on this move in crude. Said this a few times. Brent this morning around 93. Under surveillance this morning, focused on CPI at 8:30 Eastern Time. Big tech driving inflation higher.
Inflation remains above target. I think that the rate-insensitive purchasers, the hyperscalers, that really hits the nail on the head. That is inflation or overheating. This is increased demand outstripping supply and raising prices. It's not something that is going to return anywhere close to 2% this year.
So here's the latest this morning. Investors bracing for fresh inflation data due out today, expecting CPI to hit multi-year highs. Some on Wall Street warning big tech's AI spending spree could continue driving up prices. Tony Rodriguez of Nuveen writing, tech-related investment is now contributing to inflation. We expect this tailwind to remain over the rest of 26 and into 27. Tony joins us now for more. Tony, good morning.
Good morning.
Does the Fed have to respond to that?
We think the Fed is responding because we think the Fed was going to be cutting, so they're responding by delaying cuts. So we don't think the Fed's going to need to respond by raising rates at the moment. Now, if things really get much worse on the energy side because of what's happening in the Middle East, that could maybe push the needle towards needing a hike. But right now, what we think has happened is cuts are off the table for the balance of the year. And you need to see maybe into the middle of next year when you get some easing in the inflationary pressures.
It's inevitable that I'd ask this question. What is much worse? What does that look like?
Well, right now, if you look at energy prices and you look at kind of the futures curve, you're looking at around $85 oil at the end of the year. That's the highest it's been all year. If you just see that get up closer to $100, that's going to cause it to continue to push into the end of 2027. And I think at that point, you'll start to see the Fed need to. Right now, we think they need to take the easing bias off. By the time you get to September, if you're looking at a futures curve that's pricing $100 oil because Middle East developments have deteriorated, then I think you're going to be looking at a hike.
Are we being too cute about this, given the fact that yields are higher and that you're seeing inflation potentially running at the highest pace going back 3 years when the Fed was in a hiking cycle? Are we being overly optimistic about the disinflationary forces and the ability for consumers to just look at a very narrow selection of goods and price increases there?
Yeah, I don't think so, because I think if you were to continue to see this kind of pace of energy price increases, for example, the demand destruction becomes that much more acute. So right now you're already seeing some demand destruction, particularly when you're talking about lower income households because just of gas prices, et cetera. That would really begin to pinch even further. And then I think you'd see declines in consumer spending, increases in consumer delinquencies and defaults. So the demand destruction element would, I think, temper any need for the Fed to have to react to energy prices if they keep rising at this pace.
Are you seeing any demand destruction or destruction of appetite by investors to keep lending to tech investors right now with rates where they are and with some of the price pressures?
Yeah, I would say no, but I think one of the big reasons that's occurring is because most of the very large hyperscalers are actually also leaning into the equity market to help support their balance sheet a bit. So I think if you didn't see that, then I think the appetite in the fixed income market would not be there, and you would see a much higher increase in rates, widening in spreads, et cetera. But the fact that they're being somewhat careful about their balance sheet strength and using the equity market to help finance some of that, I think then the demand on the fixed income side will be there.
Steve Sharon brought up a good point in the earlier hour about how if you were going to hike rates, it's not going to stop this AI trade, and it's just going to hurt the lower income individuals across the country. Do you think that's the message Kevin Warsh is going to potentially hint at next week?
Well, I think if the question is directly related to do you hike over AI spending, he may point to that because, yes, the Fed really can't do anything about that, just like the Fed can't really do anything about what's happening in the Middle East, right? So they are going to try to look through as far as they possibly can, but at some point, back to like, hey, if at year-end energy prices are $100 or staying in those, this $90 range, then you can no longer look through it as easily and as rationally.
What do you think the dots look like next Wednesday?
What's that?
What does that dot plot look like next Wednesday?
That's interesting because you have a little bit of just responding to the actual macro developments that have occurred, and you have a little bit of what I would think is maybe positioning in terms of how they want to see themselves versus what they think Warsh and signaling where they want to be. So I think you're going to see dots that increase a bit.
Anne-Marie's on the no dot.
No doubt.
No dot camp.
I'm in the Jackson Pollock camp. just throwing paint at the wall and essentially seeing what happens.
Might not put a dot on.
You lost me for a moment.
Okay.
Now I'm with you.
Just like a spray of dots at all different places and being like, figure it out. It's useless anyway.
Tony, it's good to see you. Thanks for being
Good to see
here.
you guys.
Thank you, sir. Tony Rodriguez of Newfeed. Looking for inflation to come in with a 4 handle. We haven't seen that for 3 years. The last time the Fed saw that, the Fed funds, the upper bound, had a 5 handle. Has a 3 handle now. Things have changed a lot. Coming up next, we'll catch up with Gargi Chowdhury of BlackRock, Dan Ives of Wedbush, Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management with inflation on deck. That data point, 34 minutes away.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years, and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the 3rd floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
The markets are wagging the economy, not the other way around.
The majority of the opportunity here is really in the AI compute space.
As long as the capital markets remain open to these
really massive market caps. That's the opportunity.
This is really, I think, an earnings-driven story.
It could be more choppy this summer, but we don't think that the bull market in equities is over.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action, the score looks like this. We're negative 1% on the S&P 500, down by 1.5% on the NASDAQ. In the bond market, yields shaping up as follows. 2s, 10s and 30s. Yields higher by 2 basis points on 2s, up 2 on 10s. Your 10-year, 4.54. Heading into this, 29 minutes away. CPI in America at 8:30 Eastern Time. We're looking for a 4 handle for the first time in 3 years on headline inflation in America. And it might get worse from here if things develop in the wrong way in the Middle East. The president earlier on this morning saying this about Iran. They've taken too long to negotiate a deal that would have been great for them. Now they'll have to pay the price. The energy market reaction, there isn't much of one. Up 2% on WTI, still just south of 90. Brent crude just below 93.
Headline fatigue. At what point are we people saying we've heard this all before? Every time a new headline comes off, we can't change our entire structure of trading. And there's a lot of feeling right now that, frankly, everyone's being manipulated in different ways. Without seeing action, people aren't going to move. Ultimately, they're looking at the supply and demand, oil barrels that are going across, the fact that this SPRs around the world are being dragged down, and it isn't having that much of a ramification.
First, we need to say we've been here before many times with the president in terms of using rhetoric and then he actually doesn't follow through with it. But it does seem to be this morning that his patience is wearing thin, especially since just the other night he told us we could have a peace agreement in 2 to 3 days, not weeks, 2 to 3 days. So now he's saying that Iran might have to pay the price. They're taking too long. And he's telling Fox News that potentially he's close to ordering new strikes. This wouldn't be defensive in responding to the Iranians, the IRGC downing a U.S. helicopter. This would be fresh kinetic strikes. So you would think oil would move higher. And it's not at the moment, and that's because we've been here before.
There's a risk here, though, that we conflate the two stories too much. We're talking about CPI 8:30 Eastern Time. Yes, energy's a factor, a big factor, but the story has progressed in the last few months. There's a bigger focus now, I would suggest, much more so on the inflation taking place beyond just energy and what that means for interest rates. And when you speak to the people who are calling for tighter policy from the Federal Reserve, and you ask them a very basic question, how dependent is that call on what happens in the Middle East? And they say not very dependent at all. There's much happening elsewhere.
It's AI spending. Henry McVeigh was saying that he goes around and talks to all their portfolio companies, and they all say they're raising prices. They all say they're able to pass along the increases in input prices to their customers. I heard that over the past couple of days from a number of CEOs that profit margins are expanding faster.
Tell us where you heard it, Bramo.
Well, in Rio. While I was in Rio, enjoying, the samba and the beautiful weather. By the way, it's gorgeous there. It's really nice. I highly
Tell us more, please. I didn't know.
It's just the island's volcanic activity you can see from thousands, millions of years ago. Anyway, it really gives you a feeling, though, of strength, and that's the feeling that you feel all around.
What is the view like from the Bloomberg office in Rio?
I literally...
Is it better than the view in Manhattan?
Yes. That's a big yes.
I officially submitted a request for transfer.
Did you? Bureau chief? Does
Yes.
the bureau chief know about that? No. Job swap.
Honestly,
job swap.
I'll put snacks in the drawers. It's really gorgeous. They live well. They live well there.
So do you. Futures right now in the S&P 500. Totally jealous here, not pretending I'm not. Equity futures on the S&P down by 0.9%. Coming up this hour, we'll catch up with Gargi Chowdhury of BlackRock with Markets on Edge, Tiffany Wilding of PIMCO on the latest breaking inflation data, and David Kelly of JP Morgan Asset Management on investing in a diverging economy. We begin this hour with stocks sliding as fresh turbulence rocks the tech trade in the past few days, heading into this week's mega IPO. Gargi Chowdhury of BlackRock writing, stay invested, but broaden the sources of return beyond the narrowest part of mega cap leadership. Gargi joins us now for more. Gargi, good morning.
Hi, good morning.
What's behind the volatility we've seen in the last few days?
Absolutely. So I think it's the trifecta of bad news that's hit the market. Obviously, the first came with the, it was good news, but interpreted as a more hawkish turn from the Fed with the payroll data last week. On top of that, this morning, obviously, we've seen some aggravation on the geopolitical front. And then lastly, already there's a little bit of concern around, how will the supply that's coming this week get absorbed in the market? So you take all of that, and then you combine that with the tremendous rally that we saw over the course of this whole year, but certainly May, and the very narrow rally, 80% of the returns of May came from just the top 10 names. So when you combine all of that together, I think it's really fair to expect to see a pullback. I call it a healthy pullback. I think earnings are still solid. I'm not worried about it, but there are some things that the market just needs to get through.
So we've got this really big, fat, nice earnings cushion supporting demand for equities. Got that. But now you've got all this supply. And you talked about making space for it. Do we have enough space for all this supply?
It feels that way. And then, when we sort of talk to our clients, and I was on the road last week, I was in Mexico, not Brazil, but equally lovely. But just talking to our wealth and institutional clients there, as well as the United States, I think what clients are very excited about is this idea that there's all this IPO coming to the market, which does indicate a risk-taking environment, which does indicate to them that this is a good time to stay invested. Whether or not it's about this particular or that particular issuance, that's not what they're thinking about. What clients are talking to us about is just ways in which they can add to durable growers in their portfolio. Now, having said all of that, there is a little bit of concern around how much the market has rallied over the course of the last month. And I think, again, this momentum unwind that we saw even yesterday when it was very sharp, very concentrated, I think that's something that we will get. And on top of that, you have the rate back up.
You're at the forefront of one of the hottest debates right now on Wall Street, which is the index composition as some of these IPOs come to market. The fact that a number of the indexes are going to be welcoming them in much sooner than previously expected. And that under this one change, that about 30% of SpaceX's free float is going to be going into indexes versus 4% had the index characteristics not been changed. For ETF buyers, how much do you think they're prepared for this? How much does this expose them?
Honestly, that's what we've been trying to do as a team, as an organization over the last month, just educate, right? And we're having some calls today as well inside the market webinar for our clients, which is just around, as an ETF buyer, here is what you get when you hold. You get transparency, you get liquidity, and that's perhaps one of the reasons that you do want to hold something in an ETF form, because you know exactly what your underlying holding is. And on the flip side, if you want to have a slightly larger allocation than you normally might get from an index, there are so many incredible active players that can get you that similar allocation, but maybe at a more nimble, moving around from one region to another. So I think our job here as market participants is to make sure that our clients understand that just because this is so hot right now and we're all talking about it and it's a very exciting time to be alive, doesn't necessarily mean...
You sound like someone who just got back from Mexico.
I mean, it is, right?
I feel it. Keep going.
Sitting next to someone who just got back from Brazil. Continue, please.
I don't think that is the only, it's very exciting, but at the same time, recognizing that just because something is a very hot IPO doesn't mean that in the 1 or 3 months that the returns are, always as incredible as the trading on the first day. So diversification, having transparency, and making sure you understand what your index hold is what we're trying to educate our clients about.
Torsten Slok of Apollo put out a note this morning saying tech dominance is pushing single stock risk to records. I mean, how many people realize that when they buy a NASDAQ ETF, they're getting a whole lot of space and they're getting not necessarily some sort of allocation to the U.S. economy? Given that, how much do U.S. economic metrics matter to the vast majority of equity investments right now in the U.S.?
I mean, they do matter, obviously. We recognize that when we see earnings growth come through in the first quarter. Obviously, we wouldn't, yes, a lot of that is extremely secular and related to AI or energy. We know that. But even outside of that, if we looked at Q1 versus Q1 of 2025, having 8 of the 11 sectors having such strong earnings growth and seeing some signs of broadening out, not in performance, but in earnings, is related to this really solid nominal GDP environment that we're in. And I think it does matter. Having said that, right now, the themes that we're talking to clients about and that we're writing around are the 2 durable growers, which is AI and which is energy security. And then the other one is focusing on income. And that's what clients want.
You sound so optimistic. Are clients worried right now?
Honestly, clients are, we do these polling insights that we get from clients, and what we've seen is there was a large worry, there was a dip in client sentiment right around April, and that's picked back up to where we were in the January period. So risk sentiment from our clients are not exhibiting huge amounts of worry. Even if you look at ETF flows, obviously, if you look at over the last 2 months, we've seen incredible amount of inflows into both U.S. equities as well as fixed income. There is a tremendous amount of cash on the sidelines, so I would say that's another good reason for us to expect the market to hold in okay. Having said all of that, I will caution that we are primed for pullbacks in times where we've had very rapid moves and rates move higher in a very rapid fashion. Both of those, if they happen, I think pullbacks can occur. And if they do, I think it's a healthy opportunity to buy those durable growers.
What's the bond market call? You've given us the equity call. Where's the bond market fit in? Because the big risk, people were worried about a repeat of 22.
Absolutely. So I want to be very clear that this is not a repeat of 2022. This is an environment where you have supply-driven shocks, and that's very different from 2022 when rates were at zero and you had to move them up very quickly. I think it's more and more apparent that we're not going to get a rate cut anytime soon, and I think that's a realization that we have obviously all agreed upon. But I also don't think that we're going to hike very quickly either, because again, this is a supply-driven energy shock, and there's really no reason to believe that a rate hike is actually going to help consumers at this point of time. So bond market call, I think, 10 years probably stay around here, and you can get some really attractive entry points to clip some coupon. And we're actually seeing that in the fixed income ETF flows. Best month ever in May.
Mexico City?
Mexico City.
Nice, 4 seasons?
Chapultepec Park. Let's go running.
OK, very cool. I know it well. Gagi, thank you. Gagi Chaudhry there of BlackRock. Equity futures right now in the S&P down by 0.9% with an update on stories worldwide with your Bloomberg brief. Vonnie Gwynn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump telling Fox News he's close to ordering new strikes on Iran. The warning coming after Trump posted on Truth Social Iran will, quote, pay the price for taking too long to negotiate a peace deal. Supermicro is plunging in the pre-market. The AI server maker joining the race for cash with plans to raise $7 billion through a package of equity offerings. The proceeds will be used to further fuel spending and fulfill customer orders. Game 4 of the NBA Finals between the New York Knicks and the San Antonio Spurs tipping off tonight at 8:30 Eastern. The Knicks holding a 2-1 lead in this series. Tonight's game will be played at New York's Madison Square Garden. The Knicks looking for their first championship in more than 50 years. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, the Morning Calls Plus, Dan Ives of Wedbush as SpaceX draws record demand ahead of its IPO. That conversation just around the corner, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
lot of non-fundamental factors that are going to interfere with markets and cause volatility over the summer. People need to make room in their portfolios for all the equity capital that's being raised, including SpaceX. We still sit in what is, at worst, the middle of the biggest infrastructure build-out since the railroads. If we see volatility on some of these non-fundamental factors, we're likely to buy it.
That was Steve Chevron of Federated. Constructive on this equity market with these pullbacks. We're down by 0.8 on the S&P. On the Nasdaq, we're negative close to 1.5 going into the opening, about 1 hour and 15 minutes away. That's the price action. Let's get you some morning calls. First up, Barclays raising its price target on Datadog to 260, saying its product velocity will continue to drive its leading position. Elsewhere, Bank of America upgrading ST Microelectronics to buy, saying the market is underestimating the chip maker's earnings power. And finally, BTIG boosting its target on Cloudflare to 269, saying underlying enterprise momentum remains strong, and yet still that stock is down by close to 2%. Let's talk about SpaceX, already shattering records ahead of a historic IPO, lining up over $250 billion in investor demand as its market debut fast approaches. Bloomberg's Ed Ludlow joins us now for more. Ed, what do we know ahead of this one?
Yeah, the state of play is that it is many multiple times oversubscribed, but there's actually something happening in the background, which is there is a roadshow, and the book will close for institutional investors at 4 p.m. Eastern time this evening. What we know is that the allocations are going to very heavily favor long-only asset managers, and that there are several institutional entities that have submitted orders for $10 billion worth of shares. By the way, if you are one of those institutions and you have submitted an order, and please telephone me and tell me what's going on. But this is interesting because SpaceX kind of pre-priced its IPO at $135 ahead of the roadshow. There wasn't some sort of traditional range. And the question as it relates to the rest of the year, when we have an Anthropic and potentially also an OpenAI IPO, is what is the story that's being told by the bankers and SpaceX to potential investors in the interim? Yes, they're oversubscribed, which would justify the initial valuation. And our reporting suggests that actually there's a big focus on this data center in space story. SpaceX telling the pool that basically whatever was in the prospectus, they could start doing orbital tests sooner, maybe 2027, maybe 2028. So there's a lot to happen in the next 48 hours mechanically. But one thing I think is really important for the surveillance audience is take a look at the rest of the month of June. There will be a big, passive issue with the rapid inclusion into the Nasdaq Russell 1000, but also there's a lot that can drive volatility and as a catalyst in this market. So buckle in, John.
Looking forward to your coverage, Ed. It's great to have you here in New York, and Ludlow covering that story over the next several days. I'm always a little bit wary of numbers about things being oversubscribed, because this is one of those instances, just like the debt market that you've covered for years, Bramo, where you ask for more than you think you'll actually get, just to make sure that you get some.
People are trying to front run the index inclusion also. Just keep that in mind. A lot of this is baking in the inherent demand that comes from the rapid inclusion in the NASDAQ and other indexes. And so at a certain point, does this indicate desire for SpaceX or desire for a trade that doesn't really indicate longer-term demand?
Dan Ives of Wedbush writing the following: while there will be some worries that the mammoth SpaceX will take away some oxygen from the tech semi-trade, this will be a short-term bump in the road. Dan joins us now for more. Dan, good morning.
Great to be here.
The appetite for this IPO. I think Lisa makes a fantastic point. A lot of people are talking about the same thing, just trying to get ahead of the index inclusion, aren't they?
No, look, I think that's definitely a play. And I think to say it's not would be wrong because of just the unique situation here from the indexing coming out of the gates. But look, at the end of the day, it does come down to it's viewed as a derivative of the AI revolution in terms of how you're going to play space, data, AI. And look, it's a test for the market in terms of not just SpaceX, but the ripple effect across the rest of tech. And I think that's what you're seeing. You're starting last week in terms of the sell-off that we've seen in semis. I think it's playing into it's a little white knuckle moment that we're going through in tech, just to see how the reception ultimately is going to be.
But it's not just this. It's pushback to equity capital raises elsewhere. Mm-hmm. The report of maybe Meta doing the same thing. We've had another player this morning suggest they're going to do the same thing, pushback in the equity market. Do we have the space for these names?
Look, I believe you do. And I think even if you look like Google after they did the offering, the view that you were going to have a big sell-off, but instead I think actually took it pretty well in terms of the stock. Look, it's $4 trillion that's going to be spent over the coming years. This is an arms race playing out. I don't care whether it's SpaceX, Anthropic, OpenAI, in terms of the capital raise that we're seeing. And I think these companies understand the demand's there. The difference is if we go back 6 months ago, it's like, show the monetization, is CapEx going to accelerate? It's happening. And I think now that there's more of a green light, I think that just gives further confidence. I think investors now are able to see around the corner because we just saw like this weekend, like our Taiwan checks, like further just tighter supply, which is just more bullish for chips, more bullish for what we see, across semis and obviously across memory.
That said, I mean, a lot of people can buy into the story and say this truly is a revolution, but say that the pricing is already pretty full, especially because as the supply becomes constrained, people are paying more and more for it, and they're raising debt that they have to pay back later with future revenues that go to that. At what point do you see that as having a viable argument?
Yeah, look, it all comes down to like monetization on the use cases, not just on the enterprise, but on the consumer side. Because look, you build it, will they come? So now it's all built, you see the demand there, but now it comes down to the next phase, and you got to see in earnings. The big reason we saw the rally that we have, it goes back to like obviously the negative sentiment in March, but then if you go through earnings in April and May, I mean, those were, I think Jalen Brunson in terms of what we saw in terms of numbers. Now it comes down to it's setting up for what I believe is going to be earnings over the coming quarters that will further support tech stocks. We continue to think NASDAQ 30,000 in the next 6 months.
You talk about the consumer-facing side. You have to see it there. Does that mean that you like Chinese tech stocks better than the U.S. that's catering more to corporate?
Look, but it's also why I like in Cupertino what Apple's doing now, the start of at least having an adequate AI strategy, because on the consumer side, it will come and go through Apple. I continue to view them as a toll collector on the AI highway. But look, in China, robotics is where they're winning. And I think you cannot just view this market. It's not just the U.S. China, there's going to be a lot of winners, and we continue to view Alibaba, some others in terms of big tech in China, where that continues to really be, I think, just starting the next phase.
Dan, speaking of China, what do you make of the U.S. looking at potentially nationalizing parts of these companies, similar to what China does?
Look, it's his balancing act, and I think it speaks to you're not going to see any sort of what I'd be nationalization, because the reality there is that it further, I think, stumps from a regulatory perspective. But
you do think we're going to see this or not?
I don't. So I don't think in the U.S. you're going to see national, but I do think you will see stakes, just like Intel.
Well, how's that not nationalization?
Look, I think that's the problem is that a big part of where Intel is today, it's because of the investment that you saw from Trump administration. Then it comes down to was that the right move? I'd argue in that situation, I think it was the right move, because you can't have Intel basically being a blockbuster video of tech. But I think selectively they're going to take stakes in different companies, because look, it is true. In what's happening in China, that is an arms race.
Let's talk about what we're buying. What happens to demand for the products that OpenAI and Anthropic are distributing right now when they start charging what it actually costs? What happens to demand, and what are we seeing already happen in C-suites around this country?
Look, I think you're gonna have to see the cost of tokenization continue to go down. You will see limits in terms of what we see on caps in some companies, but I think it also going to come down to as companies monetize that, and as they know that those dollars are being spent for revenue that's accelerating within these companies, that's where all of a sudden the two charts start to cross.
Where do you see revenue acceleration because of AI adoption? Where do you see that right now?
Well, I think it's already started happening in the data layer. I mean, if you look at Snowflake, you look at Datadog, you look at Innodata. So it just started off, it was just chips. Now data layer. Then it's going to be software. Oracle obviously is going to be key in terms of what we see from them. Hyperscalers, I continue to think, are not being factored in terms of the true monetization, like a Microsoft being
Which ones?
A good example.
Microsoft and who else?
Look, I think, if I look at, go back to what's happened in Google, and a year ago, New York City cab drivers bearish in Alphabet. Now, what they're monetizing on Hyperscaler, on Search, on Gemini, narratives are very easy where there was change. And I continue to think this is third inning, one out.
Okay.
Relative to the AI game.
You're more confident on that NASDAQ call or the Knicks going into game 4?
Well, I think Knicks game 4, but ultimately I do think Knicks in 5, NASDAQ 30,000.
So they win in San Antonio. They win in Texas?
I think they win in San Antonio.
Okay.
Maybe we should go.
Are you going?
We never know.
Okay. Considering it?
Considering it.
Okay, Dan out of Wedbush. Dan, thank you, buddy. It's good to see you. Massive event taking place later this week. A mega record-breaking IPO from SpaceX.
I thought you were going to talk about the next game. I wasn't sure where you were going to go with that.
Same.
The key is, and I think the monetization point's a really interesting one. The areas that have monetized this the best are the ones that are starting to see some of the job justification as well. I'm talking about the financial sector, the software sector, data center, programming centers. That's the forward edge. So how much does monetization come at the expense of other areas?
Futures right now, negative 0.8%. Up next on the program, inflation data in America. We're looking for a 4 handle on CPI, something we haven't seen in 3 years. Tiffany Wilding of PIMCO is here to react. That conversation just around the corner.
Welcome to Bloomberg This Weekend. I'm David Gurray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Inflation data just seconds away. Going into it, equity futures declining. Tech jitters return. We're down by 0.75% on the S&P. On the Nasdaq, we're down by 1.2% in the bond market. Twos just off the highs of the year. We're up a single basis point, 4.13 on a 2-year yield. On 10s, up around a single basis point to 4.52. We're looking for a 4 handle on CPI this morning with the economic data. Mike McKee has more. Good morning, Mike.
Good morning, John. And we have a four handle. 4.2% is the inflation rate for the last 12 months in the headline CPI. That's exactly what was anticipated. The month over month for the headline is up 0.5% as anticipated. For the core, it is a 0.2 gain. And for the year over year number, it is 2.9%. So the Economist survey is bang on what was expected for the total month. Now, we can look at the numbers overall and see that for goods and services, now this is the kind of breakdown the Fed's going to be looking at. Goods prices were down 0.1% if you take out food and energy, and service prices were up 0.3%. I'll look for additional breakdowns of where the price action is, and I guess I'm guessing I'm seeing on the screen, John, that we're having maybe a little more market reaction to an exact hit for economists than I might have expected.
Mike, sometimes a meet is a beat. It's better than expected.
Yeah.
We had some very hawkish expectations going into next week. I can tell you that core CPI month over month, it was a very small downside surprise, but a downside surprise nevertheless. It came in at 0.2% against an estimate in our survey of 0.3. If you take this and push it into the market, to Mike's point, you do see a spike in equities just off the lows on the S&P 500, on the Nasdaq, on the Russell this morning. Equities shaping up as follows. On the S&P 500, down just 0.7%. It was down a little bit more than that going into the print. If we turn to the bond market now and check out yields, yields were pushing just a little bit higher at the front end of the curve by a few basis points earlier on this morning. Now just about unchanged at 412.24. So inflation not as hot as expected, looking at core CPI month over month, in line with expectations basically everywhere else going into this meeting a week today at the Federal Reserve.
It took off the worst case scenario, which was an upside beat that would really raise the heat for the Federal Reserve. And also, I will point out something else that people have mentioned is that earnings are not keeping pace. At least the earnings of individuals, maybe the earnings of companies are, but not the earnings of individuals. That declined 0.7% when you take a look at the real metric in this latest reading versus negative 0.3% in the previous one. So with respect to spending power, this does diminish the spending power based on wages and the wage gain that's not exactly keeping pace with inflation.
Mike, we'll give you a second and third look. Give us a second look at this data this morning. Where's the little pop coming from? Is it more than just energy?
It doesn't look like it's a whole lot more than just energy. We saw gasoline prices up by 0.7%, and that is a significant, by 7%. Which makes more sense. And that's up from last month. So we're seeing a big increase in gasoline prices. But most everything else is up slightly, not up a huge amount. I'll continue looking through this, but things like apparel up 0.3%, very similar to last month. Medical care services were up 0.5%. Now that's a big move up. So that's something to keep an eye on. It was flat the month before, but we'll keep looking through the rest of this. I can tell you very quickly that used cars and trucks contributed absolutely nothing to this. Remember when we used to watch them very closely?
I do.
No big deal from them.
We'll come back to you, Mike, in just a moment. Brahma, what do you see?
One interesting note is that rent of primary residence has ticked up just a bit. So you actually do see in this the idea that maybe people are paying a little bit more for some of the areas that have been disinflationary, which is notable. Other than that, I mean, the other issue is electricity. The fact that it still is rising at about 6%, 5.9% clip. I mean, this is going to become a political issue, but it's, yes, this is a story about oil prices, but this is also very much a story about artificial intelligence and data centers.
Without a doubt. Joining us now to discuss, Tiffany Welding of PIMCO. Tiffany, welcome to the programme. Four handle on inflation, widely anticipated. Haven't seen that for 3 years. Tiffany, can this Fed look through this?
Yeah, I think the key question right now is, is inflation elevated as a result of negative supply shocks or a positive demand in the economy that's lifting inflation? And clearly what you're seeing from the headline story when the higher energy prices is that is being driven by, the negative supply shocks that we're seeing coming out of the Middle East and high gasoline prices as a result. Now if we look at core, I think that, there's more of a question there. And I think that's why you're starting to see some Fed officials that are talking about interest rate hikes. But at the same time, we know that we've had some pass through of tariff, higher costs as a result of tariffs. And you have the AI story as well, which has been bleeding over into inflation a bit. So there's some supply shocks on that side as well, or kind of one-off things. And we think outside of that, core inflation in the U.S. still looks like, it's on a trajectory that, that eventually should be okay for the Fed. Now, again, we'll get some of the energy that is bleeding into the core, airfares elevated, and things like that. But ultimately, we do think they have room here to look through and wait and see how this plays out.
Tiffany, we've heard that for 5 years. And inflation has been above target for 5 years. And the incoming Fed chair, in his own words, said inflation is a choice. Do they need to do something here just to anchor credibility?
Yeah, so as of right now, if you look at a range of estimates for inflation expectations, they look pretty well anchored. The markets certainly are giving the Fed a lot of credibility. And if you look across the surveys, we would argue the surveys, look pretty well anchored as well. Of course, one-year inflation expectations from various surveys have gone up, but they always sort of tend to lag inflationary pressures. So I think the Fed has some room here to take a look and see what's going on. The other thing about negative supply shocks is, it's a more difficult or tricky choice in terms of the dual mandate. So although it's putting upward pressure on inflation, it's putting downward pressure on activity, potentially some upward pressure on the unemployment rate. So they're going to absolutely weigh that piece of this as well. We do think at the next FOMC meeting that they will drop the forward guidance most likely. There was, this so-called easing bias in the language in the statement. If you sort of squinted, maybe you could see that. And it's a nuance we think they probably will drop just to signal, that there are more two-sided risks here. But at the end of the day, we think the Fed is going to be careful, not to overreact to what could be supply shocks that are pushing up inflation and could be temporary.
Tiffany, when did they move their target to 3% rather than 2%?
Well, certainly that will be a question for the new Fed chair, Warsh, when he gets in there. As we heard from Powell, he said that he was not going to change the inflation target during his tenure. They just had a review of their long-term strategy that they discussed last fall, and in that longer-term review, they sort of moved the asymmetric language in terms of how they're thinking about inflation out. So now you're kind of back to just an inflation targeting, flexible inflation targeting central bank type of strategy. So all of that sort of signals to us that they're not going to move their inflation target of 2% officially. Now having said that, though, in terms of Fed strategy, we can kind of think of it like the 90s strategy, the opportunistic disinflation strategy, where we've had a series of supply shocks that keeps inflation slightly above target, and the Fed sort of knows at some point we could fall into recession. We all hope that we don't, but in that case we'll have below target inflation, and so they don't really want to overreact to get inflation to target now, just given the cost of higher unemployment that could result. So some tolerance for above target inflation for a little bit, knowing that at some point you probably will, get some of those recessionary forces that bring it below.
I don't envy the Fed right now, Tiffany. I mean, there are all these geopolitical choke points that are creating a series of sequential supply-side shocks that, on one hand, you could say they want to look through. On the other hand, there is a secular overlay of what we're seeing with artificial intelligence, this incredible demand for assets of all types, and that seems to be price inelastic. I'm just wondering, from your vantage point, how you view that in the inflation story. Should that be concerning, given the fact that electricity is rising at about 6% year over year when it comes to just the inflationary pressures?
Yeah, so I think that's the tricky thing as well, right? I mean, there is certainly a piece of this that is demand related. And again, the Federal Reserve monetary policy more generally, has more of an ability to impact demand. And they also want to try to understand, how persistent is this demand impulse going to be? And certainly the AI demand impulse is absolutely there. And we've seen it accelerate at the beginning of this year. year, coinciding with the Iran events. So I think that's certainly something they're going to weigh. And we're seeing the prices of components related to the infrastructure build out really skyrocket, and that is spilling over into the price components of those into the consumer price components in those categories. That's impacting PCE more than CPI. Not to get too wonky, but the PCE is their preferred measure. Yeah, I mean, so there's definitely, some demand-driven inflationary pressures here, but we've been talking about this two-speed economy for quite some time, and there's certainly another part of the economy outside of AI, and maybe outside of the top 20% of households that hold a lot of their wealth in stocks, that isn't doing as well as a result of these economic fundamentals. So, the labor market, for example, does not look like a source of inflationary pressures at the moment. So the Fed has to weigh all of these factors. And again, what monetary policy theory would suggest when there's a lot of uncertainty is you go slow and you wait and see. And again, we think as of right now, that means they are on hold for the next little bit.
Tiffany, appreciate your time. As always, it's good to see you. Tiffany Wilding there of PIMCO, reacting to the latest inflation data. I remember Governor King of the Bank of England looking through inflation coming out of GFC. There was a decent argument for it. I understood it at the time. These shocks keep coming. And we've now had inflation above target 4 or 5 years. Maybe this argument was a little bit more comfortable to make when inflation was around 2.5, maybe pushing 3. But through 4, I'd say it's increasingly getting more uncomfortable for this Federal Reserve.
When we were coming out of the financial crisis, we didn't have volatility in inflation. It was either going up or it was going down. It wasn't going up and down and up and down and up and down. And how does the Fed deal with volatility and inflation with consumers that are primed to prices that aren't exactly fixed and that have been moving around quite a bit?
Mike the Key still tracking the data. I promised Mike a third look. This is the third look. Mike, what do you see?
Third update here. As I mentioned, goods and services. Goods prices are flat for the month. Service prices up 0.3. And then we look at some of the categories here. Gasoline was up, as I said, 7%. That was a big one. And apparel up by just 0.3%. Rent of shelter up by 0.4, but OER up by 0.3. It was 5 the month before, so that's less of a drag on inflation. Airline fares 2.7%. That's one of the bigger ones that moved. But here's another one that's kind of interesting. Last month, tomato prices were up 15.1%. This month, they fell by 6.1%. We're seeing some give back to some categories that we saw in the last big report, and it is kind of interesting to see. Same thing happening with computers and software, up 0.2%. They were up 5% the month before. So some of the changes here are suggesting maybe a kind of change in pattern that we're going to get. But one thing that will worry the Fed, bottom line, is you look at a 3-month annualized rate, and we're at 8%, up from 7%. So inflation's still overall going in the wrong direction.
Mike, thank you, buddy. It's interesting you get a bigger bounce in the equity market than you do in the bond market off the back of this. Two's just about unchanged on the session. They were higher by a few basis points. Check out the equity market. Taking out about half the losses this morning. We're still down 0.4%.
The risk scenario for a lot of people is if the Fed does start to be hostile to the equity market. That's the phrasing that we've gotten from people. If they signal a rate hike, that could curtail some of the enthusiasm, curb the enthusiasm in markets, and that is not what they want to see.
It's hard to put pressure on this institution to reduce interest rates with inflation at 4%. Which speaks to why the Treasury Secretary more recently has given the incoming Fed chair a little bit of space. How much space the President will be willing to give Kevin Walsh in the next few months? It's going to be an interesting summer.
I'm not sure, because when we said to the President over the weekend, well, the market is pricing in a hike, he pretty much was like, well, I want to see a cut. And that was it. And maybe he's going to let Kevin Walsh, his pick, have a little bit more of an easy ride his first meeting or two, but then potentially it might become challenging, especially if you have more rhetoric from individuals on the Fed saying that they want to stamp out inflation.
We should do pay-per-view next Wednesday, box office. Kevin Walsh just around the corner. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, recapping the inflation data we just got. May CPI data meeting Bloomberg survey estimates. The headline number jumping 4.2% year over year. It's the first time CPI has crossed 4% in 3 years as the war in Iran continues to weigh on fuel and food costs. President Donald Trump out with a new warning for Iran, telling Fox he's close to ordering new strikes. The president posting on Truth Social, Iran paid the price for it taking too long to negotiate a peace deal. Global investors awaiting Friday's historic SpaceX IPO. Gulf wealth funds are putting in orders for shares worth several billions of dollars in the IPO, we're told. Saudi Arabia's Public Investment Fund and the Kuwait Investment Authority have each placed orders for shares worth between $1 billion and $5 billion. And that's your Bloomberg Brief. John.
Bonnie, thank you. That's a bit of a flex. Things are tight at the moment in that region. I think that's a bit of a flex going into this IPO.
Yeah, I think what they're saying is they're tighter, but they're not that tight. We're still able to make sure we can get in on massive opportunities, even though we're dealing with the conflict in the region.
Up next on the programme, we'll catch up with David Kelly of JP Morgan Asset Management on the risk markets may be overlooking. Plus, Yahira has your morning movers. Freight stocks falling as Amazon expands its own shipping service. That story is just around the corner.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Clearly what you're seeing from the headline story, that is being driven by the negative supply shocks that we're seeing coming out of the Middle East. Core inflation in the U.S. still looks like it's on a trajectory that that eventually should be okay for the Fed. We do think they have room here to look through and wait and see how this plays out.
Tiffany Wilding, PIMCO, headline inflation 4.2% as expected, the highest in some 3 years. Haven't seen a four handle since 2023. Core CPI, month over month, just a touch softer than expected, in at 0.2%. The survey, our survey, the median estimate 0.3%. With that, equities are raising losses going into the opening bout, about 41 minutes away. Equity futures negative just 0.4% on the S&P. On the Nasdaq, we're down by 0.65. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We are seeing the freight stocks under pressure. An announcement from Amazon that is expanding its less than truckload shipping business to all customers, not just those shipping Amazon products. So you're seeing names like Saia, FedEx Freight, and Old Dominion all falling in the pre-market, since this puts Amazon in more direct competition with them and highlights its growing presence in the freight market. Meanwhile, we're also seeing Super Micro shares falling some 12% in the pre-market as it joins the party to raise capital, announcing a $7 billion equity raise. The company's sales for the company's AI servers have surged, but that just means it needs more money, about $39 billion worth, in order to fulfill customer orders. And we end on the next big test for the AI trade, which is Oracle. It is trimming its earlier losses, now just down 1.5%. And looking through analyst notes, the big focus will be on whether Oracle is building data centers fast enough and converting those AI bookings into actual revenue at a time we know demand is through the roof. John?
Yahara, thank you. Looking forward to that report a little bit later. Joining us around the table following that inflation data, David Kelly of JP Morgan Asset Management. David, good morning.
Glad to be here.
How uncomfortable are things for this Federal Reserve next week?
Somewhat uncomfortable, but I think essentially we're going to get a 12-0 vote to do nothing. The safest thing the Federal Reserve can do politically and also economically, I think, is just to do nothing here. Inflation is higher than they want, but I think there's a good chance that this month, May, will actually turn out to be the high water mark for inflation in this cycle. We have seen gasoline prices come down pretty significantly in June. I think June will see a lower year-over-year rate, and if we come to some settlement which allows oil to come out of the Strait of Hormuz, then inflation will gradually drift down. So it's not nice seeing a four handle. There certainly is no excuse for easing at this point, but I think the Fed can sit pat.
How much of it is out of their control at the moment?
Oh, it's completely out of their control. Well, first of all, they don't really control inflation that much with interest rates anyway. I mean, let's be honest about this. We've seen nothing in the last, honestly, few decades which suggests the Federal Reserve can actually speed up economic growth by cutting rates or slow economic growth by raising them. There's very little evidence that even works. And in this case, it's about energy.
Does the new chairman agree with you?
We'll see. I think he's a very intelligent guy, and I think there was a certain amount of complexity in some of his answers to questions on inflation. I don't think he has any intention of leading a charge to cut interest rates when you've got the inflation rate basically at the unemployment rate target. I mean, their target is supposed to be 4.2% on the unemployment rate. We're 4.2% on inflation. That's double, almost, even in PCE terms, it's essentially double where they want to be.
The one thing that the Fed does have some influence over is financial conditions.
Yes.
And this is the reason why maybe you're seeing a stock market rally a bit more, respond more to this print than the bond market. At what point do they have to take that into consideration, given the amount of debt and equity being raised right now?
Well, again, there's very little. The problem is that yes, raising interest rates sharply would perhaps calm down some of the speculation and maybe cause a correction in markets, which might actually be a healthy thing. But it's such a, it's taking a sledgehammer to a fly. I mean, they will do a lot of economic damage if they do that also. And so they have to, I think they should be worried about too much speculation. I don't think there's much they can do about it.
Sledgehammer to a fly. That said, some people are saying that you have companies raising more and more money to pay for prices that are going up and up and up.
Yeah.
At what point is that directly fueling inflation in the areas that the Fed doesn't ostensibly have control over, but comes with the enthusiasm in capital markets?
Well, the inflation the Federal Reserve should honestly worry about is inflation in things like food, clothing, energy, the basics. I mean, if the cost of compute goes up, I mean, that's not great if you're a big tech company, but it doesn't really affect the average person that much. So I think they've got to look at broader inflation. There's not much they can do about it. It really is much more over on the other side of Washington that these decisions are being made. Now, there are things the federal government ought to do to try and calm speculation in financial markets, perhaps, both in terms of AI regulation, crypto regulation. There are things they can do, but I don't think there's very much the Federal Reserve can do right now to calm this down.
David, if you think this is the peak, that's predicated on you think there's going to be a deal. Because we're getting to levels that are very low on inventories and tanks.
That's right.
So most people actually are saying in the commodity market, if there's no deal, prices could surge from here.
That is our biggest concern. The biggest concern is that people will take some sort of comfort in the fact that gasoline prices have come down the last few weeks, because that's because of a massive release of inventory. including from the Strategic Petroleum Reserve, which is down 60 million barrels in the space of a few months. We can't do this forever. And I hope the administration is not taking a signal from the lack of gasoline inflation that this is somehow an equilibrium. It's not, and you're quite right. But eventually, if gasoline prices started going up again, we were moving closer and closer to the midterm elections. I expect that the issue of nuclear and the issue of Hormuz will be separated. And once that happens, and you actually negotiate honestly about trying to get stuff in and out of Hormuz, then a deal will be made.
Massive helping hand from China too, importing less. SocGen wrote about this earlier this week. The refiners reducing demand as well. That's really helped this energy market.
But that's it's not like they didn't stop moving. It's obviously an inventory draw.
Oh, no, without a doubt. That's what I'm getting at.
And again, because
these are all these
offsets
offsets that have made this a lot less worse.
The point is, the world uses 100 million barrels of oil a day. You can't take 20 million barrels out of that equation and expect it to be equilibrium. Oil is an unusual commodity in that we have massive quantities of inventory. Everybody's had a strategic petroleum reserve. So we could actually take this hit for a number of months because people realize its vulnerability. But that gets you a month, 2 months, 3 months. It doesn't get you 6 months. It doesn't get you a year. And so at some stage, a solution has to be found.
David, it's good to see you. It always is. Thank you, buddy. David Kelly there of JP Morgan Asset Management. Inflation with a full handle.
Yeah, let's just put it in perspective. This is the hottest headline read going back to 2023. Inflation moving in the wrong direction for the Federal Reserve.
Uncomfortable for the new Fed chair. Coming up tomorrow, Julian Emmanuel of Evercore, Francis Donald of RBC, Savita Subramaniam. She says there's red flags out there. Take profit. She joins us from Bank of America tomorrow alongside Nita Richardson of ADP. From New York City this morning, good morning. This was Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market. You can get that from a bank. You can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Inflation coming in hot, but the core a little bit lighter. 30 minutes until the start of trading. I'm Matt Miller. Danny Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, a tame inflation report helping calm markets this morning with stocks clawing back earlier losses. Meanwhile, President Trump warns Iran will pay a price for taking too long to negotiate a peace deal, and SpaceX fever is going global with institutional investors and sovereign wealth funds, including from the Middle East, piling into this record-breaking IPO. In terms of the stocks that we're watching this morning, NVIDIA right now down 1.7% in the pre-market. So you can see tech as well as travel, American Airlines down, and mining stocks down. Anything linked to inflation hedges like gold, for example, falling after the latest CPI print and President Trump's threats to resume strikes on Iran. Inflation, as I said, accelerated as expected in May, with the consumer price index climbing by the most since 2023. So 4.2% was the headline number, but the core number, especially month over month, was light at 0.2%. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent, here at the desk with me. So, Mike, I guess it's the month over month number that investors are paying attention to here.
Probably, and maybe the composition of what happened. We did see CPI on a year-over-year basis up 4.2%, 4.249 if you round it out to 3 decimal places to see what's going on. And the trend is obviously not your friend. But there's some interesting numbers under the hood. As you mentioned, core up just 0.2 during the month, does push the year-over-year to 2.9%. But beyond energy, the composition of what we see in terms of inflation has changed a little bit. Gasoline prices up 7%. Don't have to tell you about that. Airline fares 2.7%. That's also fuel. But core goods prices down 0.1%. And you look at what the Fed has been saying. They've been expecting tariff price increases to sort of fall out of the CPI calculation, and that seems to be what's starting to happen. Also, motor vehicle insurance, that's one that moves a lot around, and it has been falling now, 1.7%. And food at home, it was up 0.7 last month, and that was considered a real warning sign for the president because, of course, everybody hates inflation and goes to the grocery store all the time, but it rose only 0.1%. Now, overall, what we're seeing is rising inflation. But if we are seeing some decline in tariff-related indexes, then what we might see is the PCE numbers, the Fed's most important forecast, coming down a little bit, and that would be helpful. A couple other things where prices moved a lot. Well, be helpful to the folks at 1600 Pennsylvania Avenue.
And Kevin Warsh.
But I wanted to mention a couple of things that moved. One of the things that pushed up inflation this month in services was tax preparation. Of course, you got to pay the tax guy, the accountant, when you file your taxes, up 11.8%. And Matt, did you buy your World Cup tickets?
No. You know why? Because soccer is a dead, boring game.
Now, I've just put you out on a limb that the guy sitting next to you is going to argue with you about. But the point being is admission to sporting events had gone down for the last several months, and now they're up 2.8%. That's a World Cup effect.
All right, Michael McKee, thanks very much with a look at inflation. Let's get to the latest on SpaceX. Shares are said to be multiple times oversubscribed ahead of the biggest IPO in history, including billions of dollars in orders from Middle East sovereign wealth funds. Let's dig into this with soccer fan, Bloomberg Tech co-host Ed Ludlow. Ed, no offense on the soccer,
none taken.
Soccer thing. Let's talk SpaceX first. Massive oversubscription here, as expected.
There's always like a pause, though, where you're like, remember, that's part of the deal. That's part of the game the bankers are playing in a mechanism like this. But state of play is very simple. Multiple times oversubscribed. There's about $250 billion worth of orders, and they're going to raise $75 billion as it stands. Saudi Public Investment Fund, the Kuwaitis have placed an order per our reporting. And then there's this like group of long-only asset managers. institutionals that we understand, some of them have placed an order for $10 billion worth of shares in a block. Whether they get them or not, like, we'll find out. But the institutional book closes at 4 p.m. I find it super interesting because, like, SpaceX is technically in the middle of or at the end of a roadshow. But it's because they priced, and we reported that they priced $135 a share up front. It was kind of like, well, what's the point of the roadshow? And in the reporting, we detailed that actually orders have increased between Monday to Tuesday, then Tuesday to Wednesday. So it's worked, right? The bankers have done their job.
But it's all based on the dream, right? It's all based on Elon Musk was with JP Morgan and Jamie Dimon investors. Basically pitching the dream, didn't really want to talk about the hard numbers or the near-term forecasts, right?
So to Jamie Dimon's credit, though, he was like, in the end, he was like, but I'm going to ask the same question again. It's why are you IPOing? And Elon Musk was like, oh, because we need money for growth. It goes back to the original story, which we broke, right? I remember breaking the story. SpaceX is going to IPO to raise a lot of money to buy GPUs to put in space. And at the time, people basically laughed at us and were like, no, that's exactly what's happened. And so materially in the background, without making this just like us patting ourselves on the back, since Sunday night through this morning, part of what the bankers have been trying to pitch to the big anchor investors and the institutions is the orbital data center story. And you'll see various media outlets have reported that SpaceX is briefing that they might pull forward the timeline on that. So in the prospectus, they said 2028 is when into 29 is when you might first see a data center in space. They're now saying they'll aim for demos in 27. You know, this is all part of the process.
I mean, all credit to you and to Elon Musk. At the time, it was impossible to believe. And now, like so many other things, it's becoming assumed that that will turn to reality. I want to point out that we're just getting headlines across the terminal right now. Look. Senator Elizabeth Warren calling on the SEC to delay the SpaceX IPO. She's calling for a review of the IPO, so we'll continue to watch this story. It's also not something that's terribly unexpected, is it, from Senator Warren. Ed Ludlow, co-host of Bloomberg Tech, here in New York for this historic IPO. Now, part of what's happening around this and other giant IPOs that we're expecting this year is that investors are trying to free up cash and selling other stocks. But Wall Street is also digesting the latest inflation print. So we're looking at kind of an up and down trade here, as well as a situation in Iran that could be good, could be bad, or could be just the same as it is. Joining us now is Morgan Stanley Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson. Mike, even if we claw back some of the losses today, we're still seeing this rotation. It looks like maybe out of tech into something else, or maybe it's investors freeing up cash for big IPOs. How do you explain the drops that we've seen today, yesterday, and especially on Friday?
Yeah, I mean, I think so. First of all, we've had this concentrated market in the last month, and it's part of this rotation that's been going on all year from one cyclical group to the next. And I would actually say it's from one commodity to the next. Okay, we can go through that in a minute. And so now what happened last week, and we wrote about this week in pretty good detail, is that the earnings revisions that we've been probably the most bullish on, I think, than anybody this year, have even exceeded our expectations. And they've gotten to a point now where the revision breadth, the leading indicator, second derivative, is now at a level that's unsustainably high. Okay, so I'll give you an example. Semiconductor revision breadth got to 70%. That's only happened 3 or 4 times in the last 25 years. The S&P 500 revision breadth is close to 30%, also very, very high. So it's going to roll over. Now, last week, we had a couple companies report in the semiconductor industry. They were fine, but the revision breadth started to roll over. So it's a second derivative, and then there's leverage in the system in that trade, and that's sort of starting to unwind a bit. To me, there's going to be a transition now to some new leadership.
All right. Maybe it's a little too much math for my brain, but I was looking at earnings revisions, and since last time you were on, you pointed out they were pretty much convex, right? I mean, just continued to climb. We have a chart of that. We'll probably pull it up in a second. It looks like we're getting near a plateau, at least for 2026 earnings revisions, which I guess makes sense. What do you make of that? You know, how much longer can we continue to head upwards with earnings revisions? And what do you mean by revisions breadth?
Yeah, so revision breadth is just the breadth of the revisions as opposed to the absolute level, and it leads the second derivative, the rate of change on the actual growth. So I do not expect the first derivative, i.e. the forward earnings growth, to come down or fall.
We're showing it here in white 2026, right. in blue 2027.
Right, so that white line is going to continue to go, but the revision breadth is rolling over. So that there's a deceleration, a second derivative, okay, which is what the market's picking up a little bit. That's a correction. That's not a change in the trajectory. So as we go forward into next year, that NTM, forward earnings, is going to continue to rise. And that's our call. That's why stocks can continue to rise into year end. Multiples don't have to rise. It's just a forward, you move forward into 2027 as you look forward for 12 months. But the rate of change matters. In the short term, it matters. And that's what's going on right now. That to me, that's going to lead to some leadership change, just like it did earlier in the year when we went from gold and silver stocks to metals to energy, and then we went into DRAM and semiconductors. By the way, all four of those are commodities.
I see. Yeah, because you said earlier we're going from one commodity to the next.
That's right.
But semiconductors, DRAM, high bandwidth DRAM is the hot commodity of the moment,
That's
right? Are we going to shift out of that into something else?
Well, it's happening. I mean, Friday's sell-off is a sign that that's exhausted. And we did a chart this week. It was pretty interesting. We looked at silver stocks versus semiconductor stocks, and it's like right on top of each other. And we made this call at the end of January. We said gold's probably going to go down 30%, and that would be normal. That's what I would like to see, because you can't stay at that pace. To your point, you can't stay at that rate of change, right, both on price of stocks or the revisions. The key is there a place to rotate to that the market can kind of hold in? We think there is, and we've highlighted that as consumer, some of the other industrial areas like transportation stocks, and even the regional banks. And by the way, all three of those areas were up yesterday in a down tape.
All right, Mike, we're going to keep you with us. We're fortunate enough to have some time with Morgan Stanley's Mike Wilson today. Let's check on what's going on with markets as we approach the opening bell. Just about 19 minutes to go. We're looking at S&P futures that are now down about 0.5, about 0.5% right now in the S&P. NASDAQ futures down about 0.8%. You can see the 10-year yield is little changed at 4.52, 4.53, and Brent crude, which had been falling, is now rising, but only $1.08 to 92.53. So to a relatively low level. Let's get a look at some of the single stock stories we're following for you this morning. Energy stocks are climbing with oil after that turned around as President Trump says Iran is taking too long to negotiate. He threatens more attacks, so either all-out war is coming or they'll sign a deal within minutes. Supermicro is raising $7 billion through equity offerings to fill $39 billion in AI server orders from customers. That stock reacting very negatively, getting more than decimated, but of course it's incredibly volatile, SMCI. Delivery stocks like Old Dominion and FedEx are plunging after Amazon expanded its LTL freight offering to all destinations in the U.S. So when Amazon moves into a market like that, investors take note. You can see FedEx Freight Holdings down 5%. Coming up, President Trump warns Iran it will have to pay the price for taking too long to negotiate a peace deal in negotiations that he says are going very well. This is Bloomberg Open Interest.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions: software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Let's get now to high interest. Look what's making headlines around the world. SoftBank's talks with potential creditors to raise $6 billion from a margin loan backed by its OpenAI stake have stalled. Sources tell Bloomberg the company is considering various other fundraising options and could still move forward with the loan at a later stage. But it comes after the firm cut its initial target from $10 billion already. Progressive Democrat Graham Plattner won the party's Senate primary in Maine with about 72% of the votes. Plattner's campaign was marred by accusations of past misbehavior, including disturbing behavior towards ex-girlfriends or allegations of that, which he has denied. The November race is considered one of the Democrats' best shots at securing a Senate majority. And President Trump says Iran would have to pay a price for taking too long to negotiate a peace deal. The U.S. and Iran exchanged strikes overnight after the president blamed Tehran for downing an American Apache helicopter. U.S. fighter jets hit Iranian air defenses, radar sites, and ground control stations near the Strait of Hormuz. And joining us now to talk more about this is Bloomberg Washington correspondent Tyler Kendall. Tyler, it seems the president says he could escalate the conflict, but at the same time that he has high confidence or faith in negotiations that are going well.
Right, Matt, at this point, it's not immediately clear if President Trump is prepared to end the ceasefire agreement that has been in place, but also saw the worst flare-up in fighting this past week after the truce was announced back in April. At this point, this latest renewed threat from President Trump is really underscoring what has been ongoing frustration from this White House, which has repeatedly maintained that they are prioritizing diplomacy to end this conflict. But at this point, we don't know what's going to happen next year. A person familiar with the matter did tell Bloomberg News overnight that the negotiations are ongoing and that they are intense, being mediated by Pakistan. But now we have this risk that we could see further kinetic action after, as you mentioned, we saw both the U.S. and Iran exchange strikes overnight. CENTCOM confirmed that it acted in what it called a self-defense and proportionate manner after we saw this American military helicopter shot down the other day. Our own analysts at Bloomberg Economics say that this escalation in tension could mean a few different things, but their assessment is that this may be a bid to escalate in order to de-escalate, and that neither side seems to be too keen on trying to get back to high-intensity warfare. Matt, we did get a little bit more of an insight into where these negotiations may be headed. There was this New York Times report yesterday that appeared to suggest the two sides are making some progress towards the issues related to Iran's nuclear program. That includes discussions around a potential lengthy moratorium on uranium enrichment, which, according to the Times reporting, has U.S. officials thinking that that ban may last up to 15 years.
Tyler, just quickly, what do we know in terms of specifics about the Apache that was shot down, the pilots and crew that were on board, and who's responsible for it?
That's one of the big questions. We are waiting for a finalized report to be released. We did hear from Iran's foreign minister in a post on X yesterday, who didn't deny that Iranian forces were involved in the downing of this American military helicopter, but seemed to suggest that it wasn't done on purpose. That has raised questions on exactly how this attack happened. We do know, of course, thankfully, that both of those two American service members are safe and that they were rescued in what is considered a first-of-its-kind mission using U.S. U.S. drone technology. President Trump was pushed over the weekend in an interview with NBC News on what his red lines would be in order for a ceasefire to end. He said if American service members were killed or if he believes that there isn't the potential to make a deal. And those are really the threads that we're watching for this morning as we wait to see what the U.S.'s next action will be.
Is there a drum major near you? Is that a marching band?
It's actually the National Park Service, which spends a lot of time here making sure that the White House looks nice and pretty.
Good, excellent. Tyler, thank you very much for that. Bloomberg's Tyler Kendall reporting live from the White House. Let's bring back Morgan Stanley Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson. First off, Mike, how much does this really move markets anymore? I mean, we're kind of used to no outcome here.
That's right. We've likened this to the tariffs a year ago. We were probably the first ones to sort of not dismiss what's going on in the Middle East, of course, but that the market has moved past the oil spike like it did with tariffs. So if you go back a year ago in June, people were still kind of hand-wringing around the tariffs, like, because we didn't take them down, but the market moved past it, and it started thinking forward, and it started focusing on the earnings revisions, which were turning positive at the time. And I think it's a very good analogy. Nobody really knows how this is going to work out. But what I like to say is that the world is a lot more resilient than people think around these types of activities. And you know, we've had obviously some facilities get destroyed in this, particularly in Qatar. And I like to remind folks that, you know, when Russia invaded Ukraine, we saw the Nord Stream pipeline get blown up. And people are like, oh my God, this is, and what happened? Germany built a bunch of LNG facilities because the world is resilient, you know, like it won't tolerate this. And I also think that ultimately, you know, Iran is fighting not just the United States and Israel on this, they're now fighting the world, right? So the pressure is going to build here. And ultimately, like my base case is that enough flow is getting through now, and there will be new flow, and then there'll be new supply, as we were talking offline. I think this is going to lead to basically many countries basically adopting, you know, kind of going back to fossil fuels.
And new routes as well. I mean, it's interesting
right.
to me that after, you know, a U.S. helicopter is shot down, you have to assume by the Iranians, and then the U.S. launches a counterstrike, we're still seeing Brent at $92 a barrel and WTI under 90. It's like all the horror stories we have about inventories being dry aren't moving this market.
That's right. Well, we're not there yet, right? I mean, and markets, you know, they wait until the last minute because we don't know the answer. It's a binary outcome. Now, what would make me bearish is if the kinetic war really escalated again. Like if we went back to where it was in the first couple of days of this conflict, that's a situation that I'm not planning on. If that were to happen, yeah, oil's going to probably spike to 150 pretty quick, and we're going to have a real problem. But I mean, that's not my base case.
All right, we are fortunate enough to have more time with you, so we're going to keep you with us. Mike Wilson from Morgan Stanley, staying through the market open. Reminder, he still does have that 8,000 target on the S&P 500 at year-end. Coming up in the next hour, more on markets and inflation and the economy with RBC strategist Lori Calvasina. She joins us at the top of the hour. This is Bloomberg Open Interest.
up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get a look at some of our other movers, the movers on our radar this morning. Freight stocks like Old Dominion and FedEx are plunging after Amazon's expanded its LTL freight offering to all destinations in the U.S. You can see Old Dominion freight line down more than 7%. Chewy shares were surging despite earnings missing estimates and cutting sales guidance. Well, now it seems that people have read through the story and the shares are down 5%. Cracker Barrel boosted its revenue guidance for the full year, beating the average analyst estimate. Wow, the stock is up 17%, which is a strong move for a stock like Cracker Barrel. Check on what's going on in markets right now ahead of the opening bell just 4 minutes from here. S&P futures down 0.5%. Still, NASDAQ futures down about 0.9%. You can see the 10-year yield unchanged at 4.52, and Brent crude holding at $92.42 a barrel. We're about to start the trading day with Morgan Stanley's Mike Wilson. This is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We continue to see a sell-off, even though we've come back from lower levels. This morning, we were down more than 1% in futures on the S&P. Now we're down 0.5%. We are off on the NASDAQ futures about 0.9%. Dow Jones futures down 0.5% as well. So if you're watching this rotation, it's currently not helping the big indexes. Here on the New York Stock Exchange, EROC ringing the opening bell, gas generator company doing an IPO. So many IPOs. I got to talk to Mike Wilson about that. Einride, which is a Swedish autonomous trucking company, coming here to list on the NASDAQ. So another IPO there. In terms of the stocks I'm watching, NVIDIA, obviously the largest company in the world. When it moves down by 1%, that has an effect on the indexes on which it's so heavily weighted. American Airlines coming down. We're looking at the price of oil coming up, but any tech or travel stocks linked to inflation hedges like gold are falling as well. So Anglo Gold Ashanti down 5.5% after the latest CPI print came in a little bit lighter on the core than had been anticipated. Morgan Stanley's Mike Wilson still with us here at the desk. And Mike, we haven't talked about these gigantic IPOs. What do you make of the, I guess, animal spirits, right? Or else they wouldn't be here. And the mechanical effects on the market. Surely some people are selling winners to get into whatever IPO they want.
Yeah, I mean, look, the market's been very receptive not only to equity offerings but debt offerings. I mean, it's been another kind of bonanza year. Not as strong yet as 2021, but I mean that's a sign of a healthy market, quite frankly, when you're absorbing this kind of supply. So it doesn't bother me. I think the collection of stuff maybe all at once can create some digestion problems, but there's plenty of liquidity out there. I mean, I'll give you one statistic which I think will help maybe understand this. Companies distribute income, but through buybacks or dividends, and they do about $1.7 trillion a year. That's just income back to shareholders. Now, some of that's reinvested like dividends, but that's a lot of money, right? And then you have inflows from retail all the time and pensioners and asset owners. So there's capital out there, and so the fact that the market's absorbing these deals doesn't bother me. The collection in one quarter can create some disruption, but I think there's capital to absorb this.
By the way, that goes to the heart of my main question. Watching this throughout the last months and years, right? Because spreads have been so tight and equity indexes keep running up. Investors have enough money to pile it into gold and things like Bitcoin. Where is all this cash coming from?
Well, don't forget, the bond market's been in a bear market for 4 years, okay? So what we're seeing is people are not reinvesting their bond proceeds, right? They mature, and they're putting into things that can actually protect them against inflation, something we haven't talked about yet. Like the average asset owner is pretty smart. They figured out that, hey, that the biggest risk going forward is inflation, which is kind of my thought. Then I want to own assets that will protect me against inflation. That's not bonds, okay? That's equities, it's gold, it's silver, it's other real assets, and that's what they're doing. So there's a tectonic shift, okay, from the 60-40 to something that looks more like 60-20-20 or even 70-30, depending on your preference.
So what is your take on inflation? Are you concerned it can continue to climb from here? Because 4.2% is a pretty shocking CPI number. If we hadn't all been through the sort of Biden-inflation era of 9, this would be insane. Yeah. And then the core looks pretty light at 0.2 if you just month over month.
Yeah, let me make something perfectly clear. I'm a headline guy, okay? I'm not a core guy making all these adjustments because I live in the real world. And by the way, stocks live in the real world, meaning like we don't take out certain things. I mean, one of the reasons why earnings are so good this year, which is part of our call, is that nominal GDP growth is accelerating, and half of that is inflation. So inflation is very, very good for earnings growth, and it's very good for stocks so long as the Fed isn't pulling away the punch bowl, okay? So the fact that the Fed is now talking about core PCE like they did in 2021 and kind of justifying why they're not raising rates when maybe they should be, we'll see later this year, then that allows multiples to kind of stay where they are. And so there's a lot of similarities to me to 2021, right? We have this incredible earnings story driven by higher inflation, pent-up demand, and we're seeing inflation kind of breaking above levels that are comfortable. The Fed is justifying not raising rates because of core PCE, and maybe there's some AI productivity boom coming, which there probably is, and they're going to hold firm, and that's a recipe for higher stock prices. Now, we could run into trouble later this year if inflation continues to go towards 5%, and then the Fed's going to have to do something about it because they got to retain their credibility. So it's a very similar setup to 21, which was a very good year for stocks, but it rotated around. It's exactly what we're seeing right now, and I think it's going to be more of the same.
But I imagine your base case is that we don't get to 5% or more on CPI, that the Fed doesn't really do much beyond maybe one hike, right? And that we continue to have this nominal GDP growth that drives earnings.
Well, that's our base case, exactly. Yeah. Now, I think that sets us up for something maybe a little different for next year. We'll have to see, because next year we're going to have a real deceleration potentially in the growth rate, right? But between now and year end, that growth rate is going to stay probably north of 20% on a forward basis, which is pretty healthy. So I don't anticipate a lot of multiple contraction this year, but I think that could be an issue for 2027. We'll have to wait and see.
But this base case is why you like transportation stocks, why you like shippers. I mean, today's idiosyncratic, I guess, Amazon story aside, right, you think that the economy is continue humming along and that these guys are going to ship more stuff and have enough power to raise prices?
Yeah, what's really going on, Matt, is that the economy now is seeing real velocity in the private economy, right? We've had this thesis for a long time that we're seeing a rebalancing from the kind of government-driven economy to a private-driven economy. That's why all the payroll numbers now are in the private area. And there's real volume going through the economy. We got real GDP growth with volume for the first time in 3 or 4 years, which is driving a lot of these sectors that have been dormant, like consumer goods in particular. We think in the second half of this year, they were working earlier this year until inflation picked up and the war kind of evolved. But we think that comes back. Same thing for things like regional banks. Transportation is another area. And by the way, tech can work in that environment too. It just got a little overcooked here in the short term.
What do you make of the consumer? There's so much talk. Probably far too much about the K-shaped economy. Yep. But there are, many people struggling with higher prices that are having to decide whether to buy, cheaper food so they can put gas in their car. Yep. Does that not hurt the consumer stock story? It
doesn't hurt the consumer stock story because 80% of the spending is done by the top, 20% or 30% of the consumers. So it's just it's not good for the people at the bottom end of that K. But my job as a market strategist is to say, is this going to change the earnings profile? And I don't think so. In fact, we saw it this morning, some more of these, retail-oriented stocks, consumer consumption stocks doing quite well. And we think that's going to continue into the second half of the year, particularly if oil prices come back down.
All right. What a fantastic education. I love when you come on the show and we get to spend some time with you because I learn so much. Morgan Stanley, Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson. Let's get a check on what's going on in the markets right now. Just 7 minutes into the session, and we're looking at an S&P that is down, still about 0.5%, but at 73.50. So we have lost some ground over the past few days, but we're still at well over 7,000 here, which is something you may not have expected at the start of this war. On the gainers side, and there are 220 of them, you've got Applied Materials, KLA, ExxonMobil, as well as Lam Research and Koch. So some actually pretty small names on this side of the ledger. You typically see the big Mag 7 stocks up there. They're over here, right? Broadcom is not officially, I guess it's part of the Great Eight, as Katie Greifeld calls it. NVIDIA, obviously the leader of the pack. You've got Micron, which has been the standout stock this year. Microsoft, Apple, Amazon, and then Caterpillar, obviously an AI stock as well. All down today, and that's what's dragging stocks. This is the rotation out of tech stocks into those names that you haven't seen so much this year. The energy index doing well as oil turns around and starts to gain some ground. Consumer staples are also up, as well as real estate and materials. On the downside, you've got the IT stocks. This is the rotation out of tech that we're talking about. Industrials, consumer discretion, and financials. That's what's happening in the markets at this minute. Coming up after weeks of volatility in tech, Oracle's results may be the next big test for the shaky AI trade. More with Anurag Rana of Bloomberg Intelligence next. This is Bloomberg Open Interest.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg. Time now for our top call. Some of the analyst action in focus this morning. First up, RBC Capital downgrading Nike to a sector perform, saying the retailer's turnaround is slower and narrower than expected. You can see Nike shares down 1%. Next up is Piper Sandler initiating coverage of Shark Ninja with an overweight rating, pointing to the company's impressive track record of new innovations and strong growth prospects. Shark Ninja shares rising 1.33%. And finally, Cantor Fitzgerald raising its price target on Applied Materials to a street high of $650, saying we're at the early innings of an upcycle for the semiconductor equipment industry. And Applied Materials right now up 2.33%. You saw just a moment ago, adding the most points of all 500 stocks to the S&P. Tech stocks, though, are driving the market down this week, with the NASDAQ falling as much as 4% intraday yesterday. Now Oracle's earnings report after the close could be the next major test for the AI trade. Let's discuss with Bloomberg Intelligence senior analyst Anurag Rana. So, Anurag, what do we expect? Set the stage for us for Oracle earnings this afternoon.
I know they should be very good. Their infrastructure cloud business is most likely going to grow around 90%, total revenue growth of over 20%. So we should not anticipate any slowdown in growth in terms of demand for AI infrastructure. The big question for them is going to be, just like everybody else, do they have enough power, enough memory, enough chips in order to fulfill that backlog that's sitting on their balance sheet? I think that remains the fundamental question for all cloud providers right now.
For these cloud providers, we talk so much lately about token costs and companies getting into hot water, using way too much. Are they making 100% of their money back on these tokens, or are they getting subsidized somewhere along the food chain?
So as far as, the cloud infrastructure players are, whether it's CoreWeave or it's Oracle, they are getting their margins because they have bought the GPUs from NVIDIA, installed it, and sold it to the end market. It's really the end person who has to, foot the bill at the end of the day. But at the same time, right now, the cloud infrastructure margins are nowhere close to what an older CPU-based cloud margins are. But that's just to be, you would assume that because this is so early in the cycle. But I would not anticipate that to have an impact for Oracle in that sense.
So what about the spending, the funding of that spending that we're seeing everybody, I wouldn't use the word struggle, but doing, right? Companies the likes of Oracle seem to be able to tap as much investor cash as they need. Is that going to continue here, Anurag?
So, I would say, as far as their debt offering is gone, I mean, they've done that and that's fine. But they also have another equity offering that they have to do as part of their full year plan. But that's the big question as to what price they're going to do it now, because, in the last, you would say, few days, the market's been actually going southwards. So I would have said that, they probably had a better window to boost that, share equity raise, let's say a couple of weeks ago. But if the political, climate improves and we see a rebound in AI infrastructure stocks, then, Oracle will go out and issue those shares.
How will stocks like this be affected by the SpaceX IPO and the other massive, OpenAI and Anthropic coming after it? Because it looks like investors are freeing up cash, selling off Bitcoin, selling off gold, selling out of their tech winners in order to put money aside for these IPOs.
Yeah, it's actually a very good question on that end, and we will see how that shapes up. But when you look at that bucket of Anthropic and OpenAI, Oracle, CoreWeave are still in that bucket because it's part of the same AI infrastructure trade. I think the bigger damage that could happen to some of them is if rates keep on rising, because that really has an impact both on funding cost as well as the valuation of these high growth names. So there's a dual edge over there for the AI players.
What kind of valuations do you expect to see on OpenAI and Anthropic? I imagine they'll both be trillion-dollar plus IPOs, right? So are they going to be 50 times sales, 75 times sales when they go public?
Well, that's, I think, the biggest question at this point, because they already have a private, company valuation close to $1 trillion. The big question is, do the market still looks at only growth rate, or are they going to go start looking at free cash flow? Because we have seen that in the past that, when people are very excited, they only want to look at sales growth. But you see the first hint of a slowdown, then everybody start running and start looking at free cash flow. Look at Figma's IPO. When they came out, everybody was so excited. In the last, I think, 12 months or so, stocks down 80% at this point, because now everybody's focused on stock-based compensation and margins and what could happen with Claude. So there's a fair amount of uncertainty when some of these startups go public.
All right, Anurag, thanks so much for joining us. Bloomberg Intelligence senior analyst Anurag Rana talking about Oracle earnings coming up after the close. And also coming up after this break, private market titans sit down with Danny Berger. She joins us live from Super Return in Berlin with the latest next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Companies are performing just fine, but doesn't mean you aren't going to see some accidents along the way. When things grow this fast, typically some things break. There'll be some losers along the way, and at some point in the next 2, 3, 4 years, there'll likely be some kind of shakeout.
The industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up.
In private equity, the environment is pretty stuck right now. If you're going to buy a technology company or a software company, a solution provider to the enterprise, now you really want to see that they're making a lot of progress around their AI offerings.
There are entire sectors, Danny, like private equity, like real estate, which are constipated, right? They can't sell. I think on balance, it's also fair to say, my God, there are lots of the canaries in the coal mines are telling you a bunch of stuff.
Those were just some of the power players speaking with Danny Berger at Super Return, Europe's largest private equity conference. Danny joins us now from Berlin. Isn't that the biggest private equity conference in the world? I mean, what's bigger than that?
I don't know. I mean, I guess Milken and Davos have a lot of private equity people at them, but this has got to be the biggest, like, pure private equity. And I got to say, I was just listening back to those interviews and the people around here. There's a real sense of anxiety in this industry. I mean, you heard from the speakers there that things aren't clearing. Victor Kosla used the word constipated, which I guess is quite evocative. But I mean, people are here. The mood is still good. There's not any less attendees here. So even though there's this idea that things need to be worked through, there still is just this underbelly of optimism. And I guess at the end of the day, these are deal people, and they are here to get deals done. So they kind of have to be optimistic to some degree.
Is it super returns that investors are seeing from this sector right now, Danny?
Are you saying, are there super returns that they're seeing?
Yes.
I mean, I think there's this idea that on paper things look good. And the things that have been sold, those have looked good too. But what about everything else that has just been backed up? So basically all the IPOs, of course, we talked to Liftoff last week, the CEO. That was huge returns for Blackstone. We're going to sit down with Martin Brand in just moments about that. I spoke with General Atlantic, who was also part of that deal. So private equity things that are IPOing, that are exiting, they're really strong, but these are the best assets. There's this kind of other class. It's these middle returns, these middle managers who maybe have smaller assets that are struggling to find a home for them, that they're not finding buyers. That may be seeing less returns. Private credit, too, just given the rate environment, mathematically has lower returns as well. And you're seeing that with an impact for the LPs. The LPs, I've been talking to manager after manager. They're sitting down with these managers and saying, listen, we want to consolidate. We don't want as many platforms. We're not going to be giving as many people as much money. We have money to spend, but it's going to be with less people. So you're really feeling the ramifications, and it's another year where people are saying consolidation, marriages of convenience, of inconvenience. It's going to be happening at pace.
What are you hearing, speaking of private credit, about redemption requests, and how much has that spread over to private equity?
They love to say nothing to see here, that it's being worked out. I think there is a feeling that redemptions will stay elevated, but it's the refrain, Matt, you and I have heard so often, that it's a small part of the industry. Even though it's a small part, though, it is dominating the sentiment. On one hand, you have LPs asking serious questions about what's going on, what impact that has. But in the same vein, people who aren't facing those kinds of redemptions, that don't have the wealth product, we spoke to Sixth Street about this, as well as Ken Kinsella of Churchill. It's kind of a great time because people have been pulling back, process for private credit are less competitive because all of these BDC players aren't present in the market right now. They're kind of being iced out. So for those who can still compete, it's been a really, really good environment. But still, there's a lot of explaining to do. I spoke with Blair Jacobson of Ares, who said that the panic among retail investors, it's just psychological. It's not returns itself. So it's still an industry that is trying to explain itself and say, hey, the fears you have, they're not real. Look at the performance. It's still okay.
We are seeing big IPOs. There were IPOs ringing the bell at the NYSE, IPO ringing the bell at the NASDAQ. Obviously, the biggest IPO in history happens this year, and it'll be followed by two other of the biggest IPOs in history. Exits seem healthy right now.
Yes, but I don't know if they're going to continue that way after this SpaceX IPO. I sat down with Jeff Pearlman, and we'll be hearing him on Bloomberg Deals, which I know, Matt, you're so kindly anchoring for me today. So you're going to hear this conversation I had with Jeff Pearlman of Warburg Pincus. And I think it's really key because I asked him, are these IPOs good for private equity? Are they bad? He essentially said that because they're hoovering up so much of the attention, it's going to take people out of the IPO market for a little bit, that you have to sit, you have to wait maybe a couple of months before you can really dive back in. That was actually something specifically Orlando Bravo said, this idea that maybe you need to wait things out for the IPO market to be able to go back in. So that was Orlando's comment specifically. So yes, IPOs are kind of back, but for private equity, again, Jeff's comments were more, IPOs are not the right exit strategy for private equity, that the public markets are shrinking and too many people have found themselves saddled with assets where their only route is to IPO. So something's a little bit broken there. So yes, exits are starting to come back, but I think IPO exits are going to be maybe perhaps more the exception, not the rule.
All right, really fascinating stuff, Danny. Thanks so much for joining us on your show. Danny Berger there from Super Return out of Berlin. She's going to sit down, by the way, a little bit later on in the program with Martin Brand, the head of Blackstone Capital Partners. Definitely an interview you don't want to miss. Coming up next on this program, RBC's Lori Calvasina reacts to the latest inflation read and the sell-off, and then Elon Musk confidant Scott Painter joins the show after that.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these. Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
President Trump has said that prices will go down as soon as the war with Iran ends, but the war is still going on and prices are still going up. The Labor Department reporting today that inflation is at its highest level in 3 years and gas prices are leading the way.
In the 12 months leading up to May, consumer prices with food and energy included rose 4.2%. To illustrate just how much more we're paying, Moody's Analytics says the average American household has pumped an extra $510 into the family car since the start of the Iran war.
ABC's Jim Ryan. Airline fares jumped 2.7% in May and are nearly 27% higher than a year ago. Electricity rates up almost 6% since last year, and clothing is 4.2% more expensive. The United States and Iran exchanging fire overnight as President Trump says Iran has taken too long to reach a peace deal, so will now pay the price. ABC News security analyst Mick Mulroy says Iran is using the Strait of Hormuz as leverage.
Right now, Iran thinks that controlling the straits gives them a lot of leverage. They're asking for everything up front before the U.S. even gets to a nuclear agreement. Sanctions relief, unfreezing assets, all these things that Iran wants, but they want it to simply open the strait, which isn't theirs to control in the first place and obviously was open before the war started.
Microsoft co-founder Bill Gates on Capitol Hill today telling the House Oversight Committee what he knows about Jeffrey Epstein. Before heading in, Gates said,
"Glad to be here voluntarily to testify, to help with the committee's work. I'll start with an opening statement in the hearing room. I hope my testimony is helpful to the important work of the committee to find justice for the victims."
Gates' name mentioned thousands of times in the Epstein files. California vote counting is over. Republican Steve Hilton will face Democrat Javier Becerra in the governor's race this fall. You're listening to ABC News. The NBA Finals resume tonight in New York with a quieter presence around the Garden.
The city will still enforce a multi-block security perimeter. A large watch party planned for just outside the arena has been scaled down and will now be a ticketed event. Madison Square Garden, which is owned by Trump ally James Dolan, issuing a statement calling the mayor and police commissioner party poopers, saying Monday's restrictions were never about the president, just a convenient excuse to restrict how and when Knicks fans celebrate.
ABC's Sophie Flay. Looks like Bill Pulte will be getting the Director of National Intelligence job, at least in an acting capacity, despite the revolt by several lawmakers who say he's not at all qualified for the job.
Right now, Iran thinks that
the president is moving forward with Bill Pulte as acting Director of National Intelligence, despite bipartisan concern about his lack of experience.
Democrats now threatening to oppose reauthorizing the Foreign Intelligence Surveillance Act, or FISA, as long as Pulte remains in the position. FISA allows the government to collect the communications of non-citizens overseas.
ABC's Karen Wall. Say hello to new sunscreen.
I just can't emphasize enough how much dermatologists and the broader skincare community have been clamoring for this for so long. And I think the bottom line here is that American sunscreen is about to get a huge upgrade.
It's Tony Salzman with the ABC News Medical Unit says the FDA has added a new ultraviolet filter to sunscreen. Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube, streaming live at Bloomberg.com as well. Scarlett Fu out on secret assignment, sitting in. Scarlett is John
double
Tucker.
Secret, I believe
Double
that
secret.
is.
Yeah, we got John Tucker in for the next couple hours, helping us out, which is a good thing. We've got some selling on the street today. We'll get up to date on the market. Coming up, we're going to check in with Ethan Bronner, Bloomberg Israel Bureau Chief, get the latest reporting out of the Middle East. There's been some exchanges of military efforts there. Marianne Bartles, Chief Investment Strategist at Sanctuary Wealth, to get her thoughts on the markets. Caroline Hyde, B-Tech co-anchor. We'll get the latest on all the tech news out there. SpaceX, going to price it tomorrow night after the close, and we'll get that thing traded on Friday. Steve Mann, Bloomberg Intelligence Global Autos Analyst, will talk to us about SpaceX, Tesla, what's going to happen there. A lot of folks feel like SpaceX and Elon are just going to roll up Tesla at some point. So we'll get the idea what's happening there. So we got a lot coming up over the next couple of hours. Let's kick everything off here. Matt Piper's got a Bloomberg Business Flash.
Hey, thank you. The tech sell-off deepens. Another round bout of sharp swings and high-flying chip makers in just a matter of days. Stocks down after that inflation report out this morning. That report showed inflation has risen to its highest level in 3 years, with spiking gas prices helping push it there last month. Let's head over to Wall Street now and see how it's responding. The S&P is down 0.1%. The Dow is down 0.3. The Nasdaq is down about 0.2 or 43 points. The Bloomberg Dollar Spot Index is down 0.2% at 1208.47. The 2-year yield is about flat, down just slightly. The 10-year yield is also about flat. That's up just slightly. Back to that tech sell-off. Yeah, it continues. SoftBank sinking. SoftBank's talks with potential creditors to raise at least $6 billion through a margin loan backed by its OpenAI stake have stalled even after it slashed its official target. Japanese technology investor and OpenAI backer right now on Wall Street is down about 8 percentage points. It's unclear why that margin loan discussions for SoftBank stalled. And it's not just them. In South Korea, chip makers Samsung and SK Hynix are also dropping. Samsung right now is down 9%. Hynix is down about nearly 10%, that is. Traders are also watching whether peace talks in the Middle East remain on track after the U.S. and Iran exchanged strikes overnight. Stephen Cook is with the Council on Foreign Relations.
It seems to me that over the course of the last few days, the market slides indicate that people are coming around to the fact that there is a major choke point in the global economy and that it's harder and harder for energy to come out.
Well, let's look at those energy prices. Brent right now is up 1.5 percentage points at $93 a barrel. WTI at about $90 a barrel. And are those wedding bells I hear? No, it's actually an online witch, and it's not John Tucker. Brides are buying so-called weather spells as a way to manage stress and anxiety leading up to the big day. For about $25, you can cast a good weather spell from a witch on Etsy to ensure blue skies on your big day.
I mean, for $5, why not? It's just like,
Sure.
you can't take any chances on your wedding day.
Well, here's the thing. There's no
Like I
tracking that witch down if it does downpour. So who knows? For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that is a Bloomberg Business Flash. Paul and John.
All right, Matt, thanks so much. Appreciate that. John Tucker sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and at Bloomberg.com. Market drivers today brought to you by Eisner Amper. Most advisors tell you what happened. Eisner-Amper tells you what to do about it. Assurance, tax, outsourcing, and advisory services built for businesses that can't afford to guess. EisnerAmper.com. And as Matt was just reporting, a little bit of selling out there on the street. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Avalon Purnell. Avalon, what are you looking at?
We have to start off with Supermicro Computers. That is ticker SMCI, currently sinking about 12%. That's after the computer hardware maker said it's planning about $7 billion in equity and equity-linked financing transactions to fund component purchases to meet demand for its AI servers. The street is fairly split, to say the least, about what to think about this. Bernstein analysts saying that this is by far the highest equity raise in company history and also implies a whopping 27% dilution, whereas Wedbush analysts view the order momentum as positive, but believe that obviously the exact financial implications will be known later, especially they'll be dependent on margins of the business. Still, the move making that company one of the worst performers on the S&P 500 this morning.
Next up, you're looking at Chewy, and I like this line from the company that they're seeing a, quote, modest level of incremental pressure on premiumization and product attach rates. What in God's name does that mean?
Yes, that's ticker CHWY.
Dogs aren't eating their little Chewy toys anymore?
Well, the pet owners aren't really buying those special toys anymore. So it's falling about 1.3% now. And as you mentioned, they did offer more cautious commentary. To be fair, though, this is not the first that we've heard. Zoetis, Petco also offered really cautious commentary earlier in the earnings season, saying that the health of pet owners isn't that great right now, noting that Americans are really reining in their spending on their pets and even not really getting dogs as often as they were previously. Citi writing that while Chewy continues to outperform, it remains beholden to a pet category that's performance continues to remain weaker this year.
I'm still on the fence whether or not to get a dog.
Same.
I mean, my kids want one. My kids, they're in their 20s.
Yes.
It's just like, but it's like having another kid. It really is. I can't go through that
Not
right
at your
now.
age.
No.
Cracker Barrel.
Yes, that's ticker CBRL, currently jumping about 30% earlier today, touching a most intraday on record. And that's after the restaurant chain boosted its full year outlook on the back of a better than expected third quarter results and continues to see a lot of recovery in customer traffic. Benchmark writing that the results also showed improvements in the average check, noting that the company is discounting less and that customers are still buying those meals. However, what I found really interesting is actually the short interest on the company, which is incredibly high, currently about 27% of float, according to S3 Partners data.
Yeah, boy, it's stuck up 30% here, now over $1 billion. My core order there, Country Boy breakfast with country ham, extra biscuits and gravy.
Yes. So they're all over the logo change and the hit that. Okay,
that's in the
past.
You just keep bringing the biscuits and gravy and everything's fine. Avenel Purnell, thanks so much. Appreciate that, getting the latest stock movers out there in the marketplace. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. And by the way, just put a picture of unsweetened iced tea at my table, too. Then we're done.
Well, how much does that cost you, like a whole all-in for a meal?
$20.
Okay.
It's awesome. It's awesome. Let's get back to the geopolitics at hand. There's been some movement there in the Middle East. The U.S. and Iran exchange strikes overnight, endangering talks aimed at securing lasting peace in the Middle East and jolting their 2-month-old truce. Latest reporting, we go to Ethan Bronner. He's the bureau chief for Bloomberg News in Tel Aviv. Ethan, I think there's a ceasefire. I think there's a truce, but boy, there's some action going back and forth here. What's the latest?
Well, it's as you've described. That's the latest, and and since then, President Trump has said that he's irritated by how long the Iranians are taking to respond in these negotiations, and so he's threatening a kinetic action, as it's known, to attack yet again. It's not clear how serious it is, but it's a very, very perilous moment in the sense that all parties are a little finger on the trigger happy at the moment. They think it's going to help them in their negotiations, and perhaps it will, but each side seems willing to do the same thing in return. And the notion that it could spill into something broader and deeper is real.
Well, has it already done that with Lebanon?
Well, Lebanon is a fair question. I mean, Lebanon is a pretty tough situation. 1 million people have been displaced. Israel has taken over the bottom tenth of the place, and so on. But that's kind of a sideshow for Iran and a sideshow for the United States. I think the big story for the world is Iran, Strait of Hormuz, that stuff, the nuclear weapons, and Iran is, of course, a country of 100 million people, and an enormous civilization. It's a different game than the Israeli-Lebanese thing, which I don't mean to make light of, but I think it's a smaller part of it.
Ethan, before the war, the Strait of Hormuz was open to all traffic, free waters. That is not the case anymore. Will that part of the world ever get back to where it was pre-war in terms of really having an open movement in the Strait of Hormuz?
I don't know. And I think that's the great question hanging over this conflict. I think that when the United States and Israel launched it, they didn't really plan or expect the Iranians to do this, even though there was plenty of chatter in advance that they might. I think it has become a huge dilemma. We also, it's hard for any of us to really know what damage exactly Iran has sustained in terms of its ballistics, in terms of its nuclear, in terms of its proxies, all the things that give it its strength over the years. It could be much worse shape than we think, or it could be in much better shape than we think. So all of this, meanwhile, 2 elections, one here, one in the United States, pulling the forces in opposite directions. In this country, they want more kinetic activity, tougher fighting against Iran. The United States, this war is extremely unpopular. They want less, if none. And so the relationship between Trump and Netanyahu is also under strain. So there's a lot of mess underway here.
Ethan, is there worry among the Gulf states that at some point the United States just throws up its hands and declares victory and walks away and leaves them with kind of a mess not of their own making?
Yes, I mean, I think they're worried both that it would go further into war and that it would, as you say, take its ball and go home. I mean, this is a war they didn't especially want. They as worried as they may be, some of them, about Iran and its nuclear ambitions. They were happier to kind of left the status quo where it was. So yes, of course they're worried. I mean, everyone abroad is worried that President Trump marches to his own drum, and you never know what he's going to do next. Of course they're worried.
Ethan, thank you so much. Appreciate it. As always, Ethan Bronner. He is
always
the
good
bureau
to talk,
chief
guys.
For Israel, in Israel for Bloomberg News. He is based in Tel Aviv. That is boots on the ground reporting, folks, for sure. I'm just not sure if we have anybody negotiating with Iran right now. I mean, we haven't sent a negotiating team over there in a number of weeks. So I'm just not sure how this is all playing out through intermediaries. But again, it seems like both sides are talking past each other.
And it's a matter of, I don't know, credibility from what are essentially tweets from the top guy in charge at this point.
Yep.
Who do you believe? And is that something you rely on for negotiations of this complexity?
Yeah, this is not like, past conflicts where you had the State Department kind of leading the way, your Secretary of State and so on and so forth representing the country. It's a little bit different now. And we're seeing that a little bit in the energy markets today. We had that, again, the flare-up of some of those tensions yesterday. And we've got WTI crude oil up $1.50 here, just under $90 a barrel. So it's, again, recall that before this conflict, oil was trading south of $60 a barrel. So a big premium put into the price of oil here. The markets had come back from where they were in the futures market here. The S&P is down 7 points. The Dow's down 230. That's about 0.4%. And the NASDAQ off about 39 points. That's 0.1%. The VIX, it is up to 20.3, but it's off its highs of the day. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers Studio, I'm Matt Piper. This Bloomberg Business Flash is brought to you by IBKR. For the last 3 years, Interactive Brokers, individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170 global markets matter. Visit ibkr.com/performance. Well, the tech stock retreat deepens as investors cut risk ahead of this morning's inflation report. That report showed U.S. inflation accelerated again in May. The Iran war helped push energy prices up. And speaking of the Middle East, this comes as the president this morning posted online that Iran will pay the price after it targeted U.S. assets in 3 countries. To the big board we go. The Dow right now is down 0.4%, or down 212 points. The S&P is down just slightly. The Nasdaq is down as well by about 0.1%. The Bloomberg Dollar Spot Index is down 0.1% as well. The focus has been on the consumer price data for May that came out earlier that showed inflation at its highest level in 3 years. Consumer prices rising 4.2% in May from a year earlier. Now, that may offer the clearest signal yet on whether a Fed led by Kevin Warsh will keep borrowing costs higher for longer. All eyes on that decision next week. Meantime, shares of Cracker Barrel are up 27% right now. This after the restaurant chain reported a surprise quarterly profit and lifted its outlook for the year. It appears its turnaround effort is back on track after backlash against a short-lived rebranding attempt and logo change, that is. And of course, people like John buying those pancakes, right?
Yep. There you go.
Why not? For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
I've been good lately. I've been good.
Yeah.
You know, with the oatmeal. So
okay, the turkey sausage.
Healthy. Yeah.
There you go. All right, very good. Matt Piper, thanks so much. Appreciate that. As always, John Tucker sitting in for Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. The S&P now turns positive. Go figure. Marianne Bartels joins us. She is Chief Investment Strategist, Sanctuary Wealth. Marianne, what's the conversation you're having with your clients these days? I mean, stocks hitting all-time highs. Volatility's with us. Lots of big IPOs coming. What's the conversation like with your clients?
Well, a lot of it is about SpaceX right now, to be quite honest. And how do you get exposure before it launches its IPO? But obviously, there's been a lot of volatility in the markets. And what clients really want to know is this the peak of a bubble? Do we have to get out? Do we have to raise cash? And our answer is no. Technology, particularly semiconductors, just got way over their skis, extremely overbought. I mean, you cannot go up parabolically and sustain those kind of price moves. We kind of equate it to like the start of a roller coaster. You go up really slow, but when you come down really hard and fast. And I think one of the reasons why we've had such a sharp, fast pullback is that there was a lot of leverage in the market. And I think you've seen some of the leverage now come out of the market. And we're starting to get early signs of an oversold condition. So I think we can bop around in here. And that's why I think you're seeing the market try to stabilize a little bit here today.
Given where margins and earnings have been, can stocks perform well in an inflationary environment?
So we actually took a long look at inflation, and we've bucketed inflation into 3 different categories. We call it the inflation boost, the inflation squeeze, and the inflation damage. And we think we're in the inflation boost, where companies are able to raise prices, and consumers are able to pay for those higher prices, and it results into stronger earnings. And the last time we had a period like this was in the 1950s and the 1960s. Now, obviously, our economy was very different. The interest rate sensitivity was very different. But you can actually have a cycle where inflation is extremely bullish for earnings. And that's the cycle that we think we're in right now.
How about in the bond market here? I can sit there in a 2-year treasury. Boy, you can get 4.11%. I don't have to take any risk. I don't have to be a rock star. That's not bad. Do I just do that?
That's not very exciting either.
I know it's not very bad. Hey, you're talking to the guy who's in laddered municipal bonds for New Jersey. What do you think about the bond market here, Marianne?
I think you can use fixed income as a ballast in a portfolio for income in a portfolio, but as it can really generate the returns that investors want or need, I don't think so. But I do think what I'm stressing is it really is a time where you need a diversified portfolio. And that helps you in periods of volatility that we've recently have seen. And it also gives you broad exposure. What I really like about this market is we've started to see small caps stabilize and improve. And we are recommending to start diversifying in terms of market cap. And we really haven't seen that in a number of years. So diversification across asset classes, diversification among a cap size, and also between growth and value. I think there's a lot of still opportunity sets available for clients. You know, fixed income is part of it.
Hey, at the top, you mentioned one of the mega IPOs. Does that suck the oxygen out of the room?
I don't think so. You know, there's been a lot of blame that this correction has to do with investors raising money for the IPO, but we've stopped talking about all the cash that's on the sidelines. I can tell you our advisors do have cash. Cash is not zero. Now, I'm sure there's some repositioning for this SpaceX IPO, but I don't think it's the cause of the volatility and decline that we recently have seen.
Marianne, thanks so much. Appreciate it. As always, Marianne Bartels, she's Chief Investment Strategist at Sanctuary Wealth, joining us via that Zoom thing. Got a big IPO pricing tomorrow.
Oh, we do?
We do. We do. And it's spaceships, it's Mars, it's AI, and it's Elon. So it's got everything. It's got something for everybody.
It's got a lot of promises.
Yes. And we need some clear reporting on that. So we turn to Caroline Hyde. She is a BTEC co-anchor here. What are we hearing about the roadshow, Caroline? I mean,
what an extraordinary roadshow.
What an extraordinary. I saw the
Jamie Dimon hosting the bro love that went on.
That was very cool. I saw the video. Looked pretty cool. I mean, there's seemingly something for everyone out there, but boy, you really have to just hitch your wagon to Elon Musk.
I got to just say, from that roadshow, the next day I was reporting on it for the morning, and I was trying to pull a cut of Elon.
Yeah.
I couldn't use anything.
No.
I don't know what the hell he was talking about.
You had to be there as a JP Morgan client, listening inherently. And then Morgan Stanley's been doing it too.
Right.
Look, all of this is as the hype around this IPO is extraordinary. It's done everything slightly differently. Like, we know the price that they're aiming for, even though there's so-called technical pricing tomorrow. It's going to be $135, we understand. Of course, it's raising up to $1.8 trillion of market valuation and $75 billion of new equity. But this is going to be 30% allocated to the retail community. They're still going to be able to get allocations. So mom and pop can
get a piece of this,
tomorrow.
Right?
What's interesting is, of course, depending who you get allocation through, is how quickly you're allowed to flip it. Now, a lot of these retail offerings, if you go and buy it through Fidelity, they're going to punish you if you try and sell it on the day. So you're going to be like contained for 15 days. But there's a lot of volatility that's going to go into this. And many think that actually the price is going to be pushed higher by the amount of passive funds. They're going to rush in to buy SpaceX because there's been this fast tracking of entry into a lot of the main indices, like the NASDAQ, for example, of SpaceX shares. And so suddenly, if you're a passive fund and you need allocation, there's going to be this sort of fuel and frenzy behind it. But all of this is to say that demand is clear. $250 billion worth is what's been reported by Reuters, and we understand from our sources that that is similar in terms of level of demand. Some big fund managers are coming in asking for up to $10 billion worth of SpaceX shares because, of course, they've got so many funds they've got to distribute it within. And then you're looking at which particular areas, and geographically, the Middle Eastern investors who have been very long the AI trade, very much piling into XAI, OpenAI, Anthropic. While we know the Kuwaiti investment fund has been asking for about $5 billion worth, we know that there's been big demand coming from the other players as well. So clearly, the hype cycle's there. I mean, we've just got 2 more days to white knuckle this.
Yeah, like Prince Alawid bin Talal. He was one of the early backers of Elon Musk. He's going to get a big payday, it looks like, right?
Yeah, and it's going to be interesting as to whether people hold on to their allocation, whether it's paper money, whether they want to sell more broadly in the future. And look, this is why there was that great reporting yesterday, wasn't there, showing the truest data that if you look back at the 30 biggest tech IPOs in the last 15 years, generally a majority of them will sink in their first 12 months of trade. That's because lockups expire. CEOs and people want to be able to make some profits. Liquidity wanted from some of the people that work at these companies. So there is some sort of pressure, but more broadly, this looks as though a lot of people are going to be not only holding it in their private funds, but maybe wanting to even buy it in their public funds too. Maybe want even more skin in the game.
All right, I'm going to put on my analyst hat here. Valuation. Bloomberg Television had a great graphic they ran yesterday. Just looking at it, IPOs, big tech IPOs, multiples of revenue, and 15 here, 20 times there. Crazy stuff we never talked about back in the day. This one, SpaceX, 95 times revenue.
It's kind of like Tesla, right?
Yeah.
What could possibly go wrong?
Is there any pushback we've heard from the marketplace from some of these meetings on valuation? I haven't really seen any.
I think it's all about whether you believe in the cult of Elon Musk, whether you believe in the idea of getting orbital data centers. They've started to at least show demonstrations, pictures, if you like, of how that might work. So that's been a key focus. But really, in the same way that Tesla does not trade on fundamentals of electric vehicles, nor does SpaceX, it's bigger than the sum of its parts when you're putting all the business together, because it is the idea of Mars, it is the idea of the moon, it is the idea, though, that this currently is almost a monopoly. Look, who else has been making these reusable rockets, the cadence and the reliability that we've seen with the Falcon 9, now with Starship managing to demonstrate such feats of science? I think for many it's just like, well, I've been burnt if I've bet against him in the past.
But there has been some pushback, particularly New York and California pension funds. And the concern there by the controllers seems to be Elon has too much control.
Governance. And in fact, funnily enough, shock horror, who's weighed into this as well, is Elizabeth Warren, is sending a last-minute ditch attempt to the SEC, Paul Atkins, saying, look, you've got to stop this IPO process because I'm worried about governance and I'm worried about the safety of retail investors, as you are seeing the fast tracking of shares going into some of these big indices. Look, whether you like it or not, you're probably going to have exposure to SpaceX because it's going to be in your 401k. It's going to be in some of these, as you say, the funds that are managed by New York City, by New York State, they're pension funds, right? And they're saying, look, we're not so averse to this that we're going to rule out them in our funds. But we are going to keep trying to chew Elon's ear, trying to get letters to him, which he thus far hasn't responded to, saying, we're worried about this. We're worried about your 80% voting rights. We're worried about the overall governance structure of the business. But look, like, for many investors, they want a founder mindset. They want the ability of Elon Musk to be able to drive forward with the big decisions. And for many long-term bettors on him in the private markets, they kind of love that. In fact, that's why they think eventually SpaceX and Tesla should merge.
Yep. I wonder what the over-under is on when this thing will open for trading on Friday. Because when I was doing these IPOs, if I didn't get it open by 10:15, my boss was all over me. Now they don't trade these things till 12
like midday.
Exactly.
Figma, I was there for ages until we got 1 p.m., 2
I don't know
2
how
p.m.
this is going to work. So
it is a feat.
That's Morgan Stanley's problem. They're a stabilizing agent, so that's their job. Caroline Hyde, thank you so much for joining us. We appreciate it. Caroline Hyde, she's both BTech co-anchor along with Ed Ludlow, who we chatted with on surveillance earlier today. So we're getting a double dose of BTech, which is awesome for us because there's always a ton of stuff going on out there in the world of technology. S&P unched on the day. I got Dow down 240 points. That's 0.4%. But I got the NASDAQ up 42 points. So there you go. The VIX, which was up at 22 and change, is now at 20.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers Studio, I'm Matt Piper. All eyes on what the Fed may do next week after the consumer price index today showed that inflation climbed 4.2% from a year earlier, the most since early 2023. That news has the markets down at this hour. The S&P right now is down just ever so slightly, about 7 points. The Dow right now is down half a percentage point at 280 points. The Nasdaq is down 0.1%. The Bloomberg Dollar Spot Index is down 0.1%. Well, the more policy reactive two-year yield is flat at 4.11. The 10-year is up a point just slightly at 4.52. Taking a look at oil after the U.S. and Iran exchanged strikes overnight, which could hinder talks aimed at securing lasting peace in the Middle East. Brent right now is at $93 a barrel, WTI at $90 a barrel. Jim Bianco of Bianco Research on why even with this news today, oil prices are not moving much.
I think there's headline fatigue. I mean, a little bit of that because we've been going back and forth with it. I also think that there's a trouble trying to understand this current state of the crude oil market. How much are we running down inventories? How much is actually sneaking out of the Strait of Hormuz? Kuwait is now starting to ask that they're going to start shipping oil. How are they going to pull that off? I thought the Strait was closed. Maybe it's not.
Well, not great news for those retirement bennies. Social Security is now projected to run short of funds in late 2032. That's 3 months earlier than previously forecast. At that point, it would only be able to pay 78% of scheduled benefits if no changes are instituted before then. As the population shrinks, fewer people are paying into the system. More than 70 million of us received Social Security benefits in April, netting an average of a little more than $1,900 each month. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Paul and John.
All right, Matt, thanks so much. Appreciate that. I don't know about you, Mr. John Tucker. My personal budget has zero in for Social Security.
Yeah, I never really anticipated that it would be solvent by the time I get there, and I'm getting there.
I know. I mean, it's just, can we depend upon Congress to do something to fix it? I don't think so. So in my personal budget, in that little cell there in my spreadsheet, zero per month coming from Social Security. So we'll see.
It would just be gravy for me.
Yeah, exactly. So we'll see how that plays out. All right, we got the SpaceX IPO. That is the big news. But kind of like a corollary to that is, what is Elon Musk going to do with the rest of his stuff that he owns, and most notably Tesla and all the stuff that's in Tesla? What does he do with that? And I don't know. A lot of folks, I think, are suspecting that at some point, if for nothing else, he'll just kind of roll it up into one big company there under SpaceX. Steve Mann, he covers Tesla. He's a global autos and industrials analyst for Bloomberg Intelligence. Hey, Steve, when you talk to Tesla investors, is there an expectation that at some point Elon Musk and SpaceX will buy in Tesla?
It really depends on the timeline you're talking about. I mean, it's you can speculate. There's a lot of synergies, probably many years away from now that, for example, the Tesla vehicles could be riding on or driving on the surface of the Mars, or the Boring Company is drilling tunnels in Mars for colonization. But that's very, very far away. We published a piece of research today, and we looked at it, and really the only thing that Tesla is really contributing in a consistent, meaningful way is actually their battery storage business. And even that, it's a small chunk of Tesla's profits. So we don't really see imminent or near-term synergies for a merger.
Okay, so if there were to be a merger, roll-up, or whatever you want to call it, is that an admission that one company is not really performing, that it would need the other to help prop it up?
I wouldn't necessarily say that. I think Elon really has a long-term view on what he wants to do, so specifically in space exploration. And that's where Tesla could really contribute. Like I was saying earlier, you can have cars, automated cars, driving on another planet, or you can have compute or satellites and communications through their satellite system that communicates between interplanetary communication. I mean, you can see all the possibilities in both energy and vehicle. But I think a lot of those things need to be proven out first, and I think that's what they're trying to do on Earth first. And secondly, Tesla, really the focus is really on autonomy, the robo-taxi. And I don't think combining the two companies is a good time at the moment. It serves as a distraction, really.
Bloomberg News has got some reporting out on the autonomous vehicle. Tesla has just 59 vehicles in its robotaxi fleet as of Tuesday, limited to 3 Texas cities after Elon Musk said the company would have an autonomous ride-hailing in about half the population of the U.S. by the end of 2025. Talk to us about that part of the business and where we are and maybe where the company's falling short.
Yeah, I think for some investors, it is falling behind. They were hoping the rollout's a little bit faster, but the company did tell us in the first quarter earnings that a bulk of this rollout is in the second half. I wouldn't be surprised that they're waiting for that the steering wheel-less, the brake pedal-less Cybercab to be ready before they ramp up that service in more cities around the country. So let's wait and see. Maybe the Cybercab build out and roll out will be the turning point.
All right. Did Elon overpromise? I'm trying to get you in trouble here. Did he overpromise?
Grand plans. It's not a bad thing. Stretch targets, you want to call it that. But reality is, these technologies do need time to play out and to be invented, to be discovered, to be developed, and to make it commercially viable. So these things do take time.
Steve, one of the concerns from Tesla investors when Elon Musk was in the U.S. government running the Doge campaign was that he wasn't paying enough attention to Tesla. Is there a concern now with SpaceX that once again his attention will be diverted away from Tesla?
It's very interesting. He was very visible within the government early in the year. It kind of quieted down, but now we're seeing him, on Air Force One from time to time. I'm sure he's got one foot in, and then he needs to, right? A lot of these businesses require regulatory approvals, and I wouldn't be surprised that he's working on all those fronts to make sure his business runs well and gains business, new businesses.
Is Tesla becoming more of this? Is one thing that does excite me, Paul. Okay. More of a battery company where I can load up on batteries at my house and draw from the grid at night when electricity prices are much lower, that sort of thing?
Yeah, that's a great question, because battery business is becoming a bigger part of Tesla. It's 13% revenue, but if you look at the gross profit line, you're looking at a quarter to a third of contribution. And battery sales are becoming more important, especially during this AI build out phase. A lot of these data center actually requires their own power systems to run the chips. And part of that is really having battery backup to make sure these AI data center is running 24/7. So, you saw Ford Motor Company getting into that business, and Ford's been doing
I think GM's
things,
doing
right?
the same thing too.
Yeah, GM is also doing the same thing. Repurpose those battery plants that we use for EVs into battery storage. I think there's a demand for that.
All right, Steve, thanks so much. Appreciate it. Steve Mann, Global Autos and Industrials Research Analyst for Bloomberg Intelligence. He's safely ensconced down there in Princeton, New Jersey. Fantastic breakfast, fantastic lunch down there, so I can speak very highly of that. Coming up, we're going to check in with Eliyahu Kamishar, Bloomberg California reporter, on the big take story. Billionaires flee to tax haven just across the California border. I bet it's Incline Village, Nevada. I'm a huge fan of Lake Tahoe. Squaw Valley, one of my favorite places to ski in the world. That's coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, got John Tucker sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. You know, we love the big take stories on the Bloomberg terminal. These are awesome. They're usually really, really cool topics, deeply sourced. They throw a lot of resources at it, and they make these great, great stories. They oftentimes have very fun, colorful graphics to help me understand. Here's a good one I really love. Billionaires flee to tax haven just across the California border. Where? It's called Incline Village. I've been there. Has become a billionaire's playground with prime lakefront property, alpine seclusion, and no state income taxes. That's attracting ex-Californians.
Lake Tahoe.
Yeah. Squaw Valley, which has now been renamed something.
But that's Squaw's in California. Yeah, I forget what it's called.
It's right there on the border. So, and it's just some of the greatest skiing in the world is there in Lake Tahoe. And we've got the story here for you. Eliyahu Kamishar, California reporter. There is a California reporter for Bloomberg News based in San Francisco. Eliyahu, thank you so much for joining us. Talk to us about Incline Village, Nevada. What's going on there?
Yeah, well, Incline Village is a really interesting town. It's just right across the California state line, and it's become this haven for wealthy people to kind of set up their new residency, often leaving California. And the big attraction is the zero state income taxes that Nevada has. So you're seeing a lot of people from Silicon Valley that can maintain their relationship with Silicon Valley because it's only about a 40-minute flight away, but they don't have to pay California's 13.3% upper income tax bracket. And there's also a billionaire tax that could be on the ballot in November that has kind of created a lot of this momentum as well.
So the border goes pretty much right through Lake Tahoe, California on one side, Nevada with no taxes on the other side. So why not? You know who had an estate on Lake Tahoe, a compound?
Who?
Michael Corleone.
That's right.
Remember?
Exactly.
Fredo got whacked. So Fredo's body is somewhere at the bottom of Lake Tahoe, as I remember. The billionaire's tax, is that going to go through? What are the prospects for that?
It has a very good chance of being on the ballot in November. There's still a chance that state Democrats like Gavin Newsom can negotiate it off the ballot. They have until June 25th to reach an agreement. If they don't, with the healthcare union that's put it forward, it'll be before voters, and there's a poll that has it a slight majority of voters in California support it. But it definitely would be a big, costly fight between a lot of billionaires that have come out against it and the healthcare union backed by people like Vermont Senator Bernie Sanders who are supporting it.
And now San Francisco had one too, and the voters rejected that, or what happened to that?
Well, San Francisco had what was called the overpaid CEO tax. It was actually a tax on big businesses doing in San Francisco. It was seen by many as a litmus test for this statewide billionaires tax, like to kind of test the waters of like what's the appetite for taxing the wealthy. It failed in San Francisco in this June primary. That was and that was with the help of money from people like Sergey Brin, the Google co-founder. Usually in San Francisco, raising business taxes has a pretty friendly reception. So for that to fail, it actually was kind of a big win for opponents of the billionaire tax.
So one of the reasons I love, and I always recommend folks, particularly non-U.S. folks, when coming over to ski, to go out to Tahoe, is because they get a lot of snow, like 30 feet of snow a year.
Yeah, but it's called Sierra Cement for a reason.
It's okay. They groom it nice. I like my groomers. What are the regular people doing there, Eliyahu, in this area? Because we see a lot of times people get priced out of some of these resort areas.
Yeah, the snow, it's gorgeous there. And there's world-class skiing in Lake Tahoe. There's still a lot of regular people that go to Lake Tahoe. I mean, a lot of vacationers, they rent Airbnbs. They have an old family house that's been, that might be worth millions of dollars now, but it's falling apart. And then there's also a lot of foreign workers that staff the ski slopes, and they share apartments or they're staffing restaurants. So there is kind of a diverse mix of people there that get to enjoy Lake Tahoe. But there is kind of this essentially a billionaire's row that's been around, and it's these prime lakefront properties that have, you know, $40 million homes on them. And then recently there was an estate that sold for $125 million, and that set a record for the region.
And I love the fact in your reporting, I think you talked to the liquor store owner who had to sign a non-disclosure agreement if he wanted to do business with, you know, the rich out there.
Yeah, that's what's interesting about Incline. It's a small town, and the wealthy people and the billionaires really kind of loom large in the town. So you have a liquor store owner who had to sign an NDA before he did some business with with one of the billionaires in town. You know, I talked to another person. His wife does mobile dog grooming for the wealthy. And there's also, you know, Dave Duffield, the co-founder of Workday. He's a longtime billionaire in town, and he's kind of been a benefactor to the town and funds the local sheriff as well. So,
all right, very cool. All right, Eliyahu Kamishar, thanks so much for joining us. He's our California reporter with the big take story. Maybe I'll have to go to Egan's Liquors in Spring Lake and ask him to sign an NDA.
You need an NDA. Exactly. You don't want people knowing what you're buying.
Exactly.
Or how often.
Exactly. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence Radio starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
All right, we got John Tucker sitting in for Scarlett Fu on Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Coming up, we're going to check in with Michael McKee, Bloomberg International Economics and Policy Correspondent. We had some inflation data today. It's high, folks. It's, you know, the printed number was 4.2% on CPI. That gets your attention. Woo Jin Ho, Bloomberg Intelligence Senior Hardware and Networking Analyst. Talk about Super Micro, $7 billion capital raise. Stocks getting crushes on that. Priya Misra, fixed income portfolio manager. She's at JP Morgan Asset Management. She's pretty smart. She's going to give us some thoughts on the bond market. Diana Rosado Pena, Bloomberg Intelligence consumer analyst, talked to us about Chewy shares. Pretty good. Stocks trading higher. The dogs, they need their bones, I guess. I don't know. We'll see how that plays out. Right now, let's get a Bloomberg Business Flash. Matt Piper from Bloomberg News.
Hey, Paul, thank you. Live from the Bloomberg Interactive Brokers Studio, I'm Matt Piper. Tech stocks are leading the way down for a second straight day, and it all comes right before that monster SpaceX IPO. The sell-off driven by cooling enthusiasm for AI and investor concerns over those huge stock valuations. That all comes amid that inflation report this morning showing that it has risen to a 3-year high. Taking a look at the markets, the Dow right now down 440 points or 0.8%. The S&P is down a 0.5 percentage point. The Nasdaq is down 0.6 or 177 points. The Bloomberg Dollar Spot Index down 0.1% at 1208.99. Oil little changed. Brent is at $93 a barrel. WTI at about $90 a barrel. One of those tech stocks we are watching, Super Micro Computer, the maker of artificial intelligence servers, tumbling after disclosing plans late Tuesday to raise $7 billion in a series of equity offerings. Right now, shares of Super Micro are down 17%. Well, there's been a lot of questions on what the Fed will do next week. Economists see more price indexes on the horizon, increases that is on the horizon, which could prompt Federal Reserve officials to consider an interest rate increase this year. Andrew Hollenhorst with Citi says they are looking at 3 rate cuts by the end of the year.
We think cuts are certainly more likely than hikes. To get to rate hikes, I think you need to see evidence that inflation is really picking up, the labor market is tightening, and we have kind of broad inflationary pressure. But having said that, the Fed does have an issue here with their preferred measure of inflation, which is core PCE inflation.
Well, the European Union does not like what it sees when it comes to paramount Eastern funds, helping to bankroll the takeover. A trio of Middle East funds agreed to provide about $24 billion of equity finance to help bankroll Paramount's bid. All up in the air still. For on-demand news 24 hours a day, subscribe to Bloomberg News Now whenever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Paul and John.
All right, Matt, thanks so much. Appreciate that. John Tucker sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As Matt was just reporting, got some red on the screen here. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Christine Aquino. Christine, what are you looking at today?
Well, Paul, I'm looking at a green stock today, and that is Robinhood, ticker HOOD. Those shares are up more than 6%, bearing some opening gains, but still very much in the green today. And that is because of its latest data on prediction markets volumes. So apparently, their May volume for those prediction markets contracts are at 3.9 billion, which is up 22% from April. And that is reason enough for Goldman, for instance, to raise its price target on the stock to 108 from 105, currently trading at 88.93. So that's quite a premium on its current share price. Cantor also similarly positive on that prediction markets metric, and they have raised their target on the stock to 110 from $100 previously. Cantor also seeing that this prediction market venture will raise Robinhood's net revenue by 2% this year and 4% by 2028.
So all this AI stuff, it ain't cheap. So Supermicro, they have to dilute their shares to raise more money to buy this stuff. As an investor, I wouldn't be too happy if they're diluting my existing shares. But
Absolutely, John. That and that is very much a reaction in markets today. Supermicro, ticker SMCI, those shares are down now more than 16%, so extending some of the opening losses that we're seeing today. And again, yeah, as you mentioned, right, the company is going to plan $7 billion in equity and equity-linked financing transactions because they want to satisfy orders for AI servers. That has now amounted to $39 billion. So that's going to be a lot of money that they're going to need to fulfill those orders. And exactly right, John. I mean, a lot of the word on the street is very much about worries over the share dilution impact. Bloomberg Intelligence analyst Woo Jin Ho saying that, you know what, though, it will dilute near-term EPS, yes, but it does also signal that AI demand could lift fiscal revenue for 2027 above the $50 billion consensus. So maybe some short-term pain and then long-term gain that we're looking at here.
All right. Woo just coming on in a couple of minutes. We'll talk to him about that. One more.
All right, let's take a look at Oracle today. Earnings after the bell, of course, ticker ORCL. Those shares are up about, at the moment, 1.4%, so not doing too shabby. Right, the big question for the release, of course, is how quickly can a company get its massive AI data center projects built? And so in focus, of course, their cloud infrastructure sales. That's projected to have increased about 91% to $5.72 billion in the fiscal fourth quarter. And of course, we have Bloomberg Intelligence Anurag Rana weighing in. We also need to apparently watch Oracle's ability to bring additional GPU capacity online. That is going to be an important determinant of its fiscal 2027.